Good morning, friends. Let's now continue. Let's now start with your FM revision. I'm going to first talk about the subject in general as to what are the areas which are there, what is important, what is not so important from exam point of view. If you look at the paper, 60 marks is dedicated to FM, 40 marks is dedicated to economics. I think you're already done with your economics revision. Now coming to FM, it is broadly split into 10 chapters. But this 10 can also be reorganized as maximum 6 or 7 chapters. It's not that there are 10 chapters. Your chapter 4, 5, 6 is a single cluster. It used to be a single chapter called as financing decision earlier. Now they have made it into multiple chapters. But so this is a single chapter. So you have chapter 4, 5, 6, which is a single cluster. Chapter 1 and 2 is technically also a single cluster, which is purely theory based. You have purely theory based area, which is your chapter 1 and 2. I have not covered it as part of my material also in the revision because it's purely theory based. From your exam point of view, what happens in costing as well as financial management is the theory question can purely be an optional question. So what happens is there are 4 questions of 5 marks each, which is mandatory for you to attend, which is a 20-mark question. Then you have 5 questions of 10 marks each. There will be 5 questions of 10 marks each and you are required to answer 4 out of 5 in exam. So 20 marks of mandatory question and then 4 out of 5, 10 mark questions. So technically you are required to answer for 60 marks and if you are well prepared, you would be in a position to answer entire 60 marks of practical problem. In case you are struggling with some question, then theory will come as a in that rare scenario where you are not confident, theory is going to come as a savior for you. Otherwise, theory is something which we normally don't expect you to attend as far as FM is concerned. The same thing I had told you in costing also. So 1 and 2 is one chapter, which is single cluster. 4, 5, 6 is again a single cluster. So you have 2 clusters. 7 and 8 again becomes a one cluster. Both are on capital budgeting. One is from return point of view, second is from risk point of view. So broadly speaking, we have 1 ratio analysis, 2 financing decision, 3 investment decision, 4 dividend decision and 5 working capital management. Totally 5 areas are only there from a problem solving point of view, and these 5 areas are basically the role of CFO. If you would have gone through the different decision a CFO takes, he has to take investment decision, he has to take financing decision, he has to take dividend decision, and for doing dividend decision he has to do some financial analysis. So these are your chapters. Working capital is basically a hybrid decision which is there. Today I am going to start with a very simple area which is on leverages. Leverages on financing decision side. Now why I am starting with leverages? One, it's quicker, easier to complete, and also every exam I am seeing one question coming from leverages. So it is the simplest of the lot, but still every exam we are seeing questions coming from leverages. So come to page 73. Computation of or your format for calculation of leverages. Now let's first listen for some time and then we start solving problems. When it comes to leverages, there are 3 types of leverages. One is your operating leverage, second is your financial leverage, third is your combined leverage. What leverage basically says is the reward which an organization gets, the reward comes in the form of profit after tax or earnings per share. The reward which an organization gets is going to be disproportionate to the efforts taken. What is disproportionate to the efforts taken is sales. Sales is my effort. The end result of that is profit after tax or earnings per share. Sales has doubled. My understanding, profit should also double. But when sales double, profit will become 5 times of this earlier profit. Profit, instead of doubling, it will become 5 times, 4 times, 3 times. When sales come down by 50%, profit may come down by 100% also or 150% also. So what you may think that if sales is going up by 10%, profit should ideally go up by 10%. That's a normal understanding. But the reward which an organization gets is going to be disproportionate to the efforts taken. This disproportionate thing comes because of 2 reasons. One, if you have fixed cost in your capital structure, or second, if you have fixed capital, sorry, fixed cost in your cost structure, or fixed capital in your capital structure. What is fixed capital? Is preference capital and debenture, because for that you have to pay a fixed preference dividend and fixed interest needs to be paid irrespective of what an organization earns. Whether organization is earning profits, not profits, you are required to pay interest and preference dividends. Similarly, you are required to incur fixed cost irrespective of whether turnover is happening or not. So broadly, three types of leverages. Operating leverage occurs because there is fixed cost, there is fixed cost in the cost structure of the company. Financial leverage occurs because there is a fixed capital which leads to interest and preference dividend, and combined leverage is a combination of these two, which is OL into FL. Go through this part, go through the format and the formula. Go through the format and formula. Okay, your operating leverage is going to measure how much is the EBIT going to change with the change in sales. If sales go up by 10%, EBIT may go up by 20%. It can be even double of that. That change is measured through operating leverage. The formula for that is contribution by EBIT, or percentage change in EBIT by percentage change in sales. The second approach which we have is, which is your financial leverage, which is going to measure how much is going to be the impact on EPS. What is going to be the change in EPS for a percentage change in EBIT. So the formula for that is EBIT divided by earnings before tax. The difference is the preference dividend, difference is the interest, minus preference dividend divided by 1 minus tax rate, or percentage change in EPS by percentage change in EBIT. If you look at what distinguishes or what differentiates of contribution in EBIT is fixed cost. Contribution minus fixed cost is EBIT. Operating leverage occurs because you have fixed cost. Operating leverage occurs because we have fixed cost. Financial leverage occurs because we have interest and preference dividend. And the differentiator is this: EBIT to EBT, the gap is interest, and from there you have to subtract the preference dividend. Combined leverage is multiplication of these two. Let's start with problems. Let's come to question number 1. X Limited has estimated that for a new product, its break-even point is 20,000 if the item is sold for 14 per unit and variable cost is 9. Calculate the degree of operating leverage for sales volume of 25,000 and 30,000 units. So the requirement was simple. You have to just calculate the operating leverage. Your wish, whether you want to solve problems along with me or listen, your wish. Wherever it is critical, I'll tell you to make notes, but otherwise it's up to you. How do you want to do it? That's something you can manage. Now the question says, it is going to break even at 20,000 units if the item is sold for 14 per unit and variable cost is 9 per unit. I am required to calculate degree of operating leverage, which is technically operating leverage. I am required to calculate operating leverage. How do I calculate fixed cost in this case? How do we calculate fixed cost? Marginal costing. How do you calculate fixed cost here?
The break-even units into contribution.
Yeah, break-even point is equal to fixed cost by contribution per unit. Break-even point is equal to fixed cost by contribution per unit. Fixed cost is something which I'm going to calculate. My break-even point is 20,000 equal to fixed cost by 14 minus 9. Fixed cost turns out to be 1 lakh. Fixed cost turns out to be 1 lakh. Your fixed cost by contribution per unit is the formula for break-even point. So break-even point is 20,000 is equal to FC by 14 minus 9 into 5 you end up getting 1 lakh as fixed cost. The fixed cost figure is 1 lakh rupees. Computation of leverages. Friends, now it should be fine. Computation of leverages. Computation of leverages. We are required to calculate the operating leverage. Operating leverage for 25,000 units and 30,000 units. The requirement is to calculate for 25,000 units and 30,000 units. So particulars 25,000 units, 30,000 units. The formula for operating leverage is contribution by EBIT. So I need to get to the contribution number, contribution by EBIT. Contribution by EBIT. So sales less variable cost, contribution less fixed cost, EBIT. Sales less variable cost, contribution less fixed cost, and EBIT. The selling price is how much? 14. So 25,000 into 14, 30,000 into 14. Variable cost is 9 rupees per unit. Variable cost is 9 per unit. So 25,000 into 9, 30,000 into 9. You get contribution. Fixed cost we have calculated, which is 1 lakh. And you get EBIT. 25,000 and 50,000. EBIT is 25,000 and 50,000. My operating leverages, contribution divided by EBIT. Contribution divided by EBIT. 5 times and 3 times. Contribution divided by EBIT, 5 and 3. 5 times and 3 times. Now, what does operating leverage indicate is, it is going to measure how much is going to be the change in EBIT for a percentage change in sales. For example, when I started with 25,000 units, 3,50,000 is the sales. Sales of 3,50,000 is going up to 4,20,000. If you look at the percentage, it's a 20% increase. It's a 20% increase. 3,50,000 going up to 4,20,000 is technically a 20% increase in sales. If sales is going up by 20%, EBIT will go up by 20% into 5. Sales is going up by 20%. EBIT will go up by 20% into 5, which is 100%. EBIT would have doubled. From 25,000, EBIT has doubled to 50,000. When sales went up only by 20%, EBIT has doubled in this case. 25,000 has become 50,000. Clear? Let's look at question 2. There's nothing much to do here. It's a quick discussion. Following summarizes the percentage change in operating income, percentage change in revenue, and betas for 4 pharmaceutical company. Change in revenue, change in operating income, and beta. Calculate the degree of operating leverage for each of these firms. Comment also. Use the operating leverage to explain why these firms have different beta. See, beta is something you would have learnt when we would have done your financing decision cost of equity calculation. Beta basically indicates how risky a company is. High beta means high risk, less beta means low risk. Here, change in revenue is given. Change in operating income is nothing but EBIT. The term operating income is EBIT. So my operating leverage is equal to percentage change in EBIT by percentage change in sales. Percentage change in EBIT by percentage change in sales. The data is almost available, nothing much to calculate. Now, if you have a very high operating leverage, you are considered to be a risky company. Reason for that is high operating leverage means even sales go down by 1-2%, profits can go down by a very high number. Go up, it can go up by a very high number. So it's a volatile kind of a company. If you have an operating leverage of 5 times, if sales in the previous example had come down by 20%, EBIT would have gone down by 100%. So it would have become 0 EBIT there in the previous question. So having a high operating leverage can be linked with high beta. So 0.9 to find lowest beta, 1.28, then 1.15. So your beta and operating leverage can be linked together. Beta and operating leverage can be linked together. High operating leverage leads to high beta. So when operating leverage is lowest, beta is minimum at 1 time, and when operating leverage is maximum, beta is highest at 1.40 times, because your beta also measures the risk. Operating leverage also indirectly tells the risk of a company. Go through question 3. Okay, this is a comprehensive question where they've given the capital structure details, then the cost structure details. They want us to calculate what is the change in EPS, calculate financial leverage, operating leverage when the sales is 2 lakh units and 2,40,000 units. So let's do this. Working note 1, income statement. Income statement at 2 lakh and 2,40,000 units. 2 lakh and 2,40,000 units. Particulars 2 lakh units, 2,40,000 units. Two lakh and 2,40,000 units. We have a format to calculate all leverages. Starting with sales, you go until EBIT, deduct interest, EBT, deduct tax, EAT, deduct preference dividend, EAES, number of shares, and EPS. EAS, number of shares, and EPS. Starting with sales till EPS, till earnings per share. Starting with sales and going on till earnings per share. So sales is 2 lakh units, the selling price is 10 per unit. The selling price is 10 per unit. 2 lakh into 10, 2,40,000 into 10. Variable cost is 6. Contribution 8 lakh and 9 lakh 60. Fixed cost is 4 lakh. So normal income statement, I don't have anything tricky to explain here. Interest is 10% debentures of 20 lakh rupees. 2 lakh. Tax rate is 50%. No data on, I think, preference part of it. $20,000 shares are there, and we get the EPS 5 rupees and 9 rupees. This income statement I really don't want to explain much. Let me know if there's a doubt here. Any doubts on the income statement? It's a straightforward income statement which we need to prepare. We follow the format, and the format guides us to the income statement. Any doubts on this? Now questions requirement were, what is the percentage increase in earnings per share? From 5 rupees it has gone up to 9 rupees, which is a 4 rupee increase or an 80% increase. It's a 80% increase. Also they want us to calculate OL and FL, operating leverage and financial leverage. OL, FL, operating leverage formula is contribution by EBIT. FL formula is EBIT by EBT. There is no preference dividend in this question. So my operating leverage is contribution of 8 lakh by EBIT of 4 lakh, 2 times and 1.71 times. This is EBIT by EBT, 2 and 1.56, 2 times and 1.71 times, 2 times and 1.56 times. Question somewhere has asked, comment on the behavior in relation to increase in production. See, earlier we were selling 2 lakh units. At that time the OL and FL were 2 times. That is, if sales go up or come down, the EBIT can double change, and from that EPS can further double change. That is what has happened in this case. Your sales has changed by 20%. Your EPS has changed by 80%. That 80 is nothing but 20% into 2 into 2. Your OL into FL is the combined leverage. OL into FL is the combined leverage. So indirectly, if sales changes by 1%, earlier the profits were changing by 4%. Now that has come down. The reason for that coming down is simple. Earlier I was at a lower volume. Now I have become a bigger company. When I become a bigger company, its change from there will not impact me that much. So earlier, when I was a smaller company, even a small change was impacting my profit significantly. Now when I become a bigger company, the risk is coming down. The risk is coming down, and that is being reflected in OL and FL coming down. When production increase, your both have come down, which signifies a reduction in the risk for the company. There's a reduction in business risk as well as the financial risk. Business risk is measured through operating leverage. Financial risk is measured through financial leverage. Go through question 4. Okay, an income statement has been given. We are required to calculate OL, FL and CL, and then there is some change in sales. They want us to find the new earnings per share. So they have given an income statement. I don't want the income statement in this format. My format is slightly different. So I'll put the income statement in the format which helps us in getting the leverages. So for getting the data of leverages, we'll have to follow this format. So I start with sales, which is given in the question. Sales is 3,40,000. Your operating cost is 1,20,000, which includes a depreciation of 60,000. Depreciation is a fixed cost. Depreciation is a fixed cost, so minus 60,000. Fixed cost is 60,000. I get EBIT. Interest is given, which is again 60,000. EBT is 1,60,000. Tax is 56,000. EAT is 1,04,000. No preference dividend. EA is 1,04,000. Number of shares are 8 lakh by 10, 80,000. And I get a EPS of 1.3. I get a EPS of 1.3. Once this is done, OL is contribution by EBIT. FL is EBIT by EBT minus preference dividend, but that part is not there. So OL is 1.27. Automatically it's a formula driven area, so I don't want to spend much time there. FL is 1.38 times, and my CL is contribution divided by EBT. Contribution divided by EBT, your combined leverage or operating leverage into financial leverage. If you want to do that multiplication, then you should calculate 4 decimals for OL and FL. Otherwise, rounding off issues will happen. Your combined leverage is 1.75 times. Combined leverage is 1.75. This is not the important part of the question. This is just a formality. This is a formality which I have completed. I have calculated all the leverages. After that, the question is saying, if the total assets remain at the same level, but sales increase by 20%, decrease by 20%, what will be the EPS at the new sales level? So they want us to find what is going to be the new earnings per share when the sales go up and come down, when there is an increase in sales and when there is a decrease in sales. They want us to find out what is going to be the new earnings per share. Which leverage combines sales change and EPS change? Combined leverage. So combined leverage, listen, this links percentage change in EPS and percentage change in sales. Question has asked sales is changing and they wanted us to find the EPS. Your financial leverage, percentage change in EPS and percentage change in EBIT, and your operating leverage links percentage change in EBIT and percentage change in sales. So question has said sales changes and they wanted the EPS. The question sometimes could have said the sales changes, but they wanted you to calculate the earnings before interest and taxes or earnings per share. They could have asked any of that. Now here the requirement of the question was sales is changing and they want us to find the EPS. They want us to find the EPS. Sales change is equal to 20%. Combined leverage is equal to 1.75. EPS change is equal to 1.75 into 20, 35%. EPS change is going to be 35%. If the question had asked for new EBIT, not the EPS, then I would have used the operating leverage. So different leverages link different items. The question could have said the EBIT is changing, find the EPS. Then I would have to use financial leverage. So old EPS 1.3, new EPS is 1.3 plus 35% and 1.3 minus 35%. One time sales is going up, another time sales is coming down. When sales go up, EPS will go up by 35%. When sales come down, EPS will come down by 35%. Very simple calculation. You have the old EPS that will either go up by 35% or come down by 35%. Go through 5. Okay, there are two parts to the question. In the first part, they have given sales, they have given variable cost. Sales is 90 lakh, variable cost is 54 lakh. You get your contribution, you have your fixed cost, you get the EBIT, you subtract interest, you do everything and get to the EPS. I'm not going to talk about the first part of the question. I'm going to talk about the first part of the question. When I come to the second part of the question, they are saying what should be the level of EBIT if EPS is 4, 2 and 0. The existing EPS, let me just give me a minute. Okay, existing is 3.71. Okay. If it was, I will prepare this income statement again. I will keep it till this only. The income statement from EBIT till EPS, from EBIT till EPS, from EBIT till EPS. They wanted EPS of 4, EPS of 2 and EPS of 0. These are the three levels given in the question, and we are going to reverse work and get to the EBIT number. We are going to reverse work and get to the EBIT number. EPS is 4, 2 and 0. The number of shares in this case is 4 lakhs. So you reverse work and get to the earnings available to equity shareholders. 16 lakhs, 8 lakh and 0. I don't think so, preference is there. So 0. EAT. Tax rate given in the question is, sorry, okay, 30% is the tax. So this is 100, tax is 30 and this is 70. 100, 30 and 70. Your earnings before tax is 100, tax is 30%, earnings after tax is 70. So I am doing grossing up of this. So this should be my EBT. This should be my EBT. Tax is 30% of this. Tax is 30% of this. Interest in this case is, you have 12% debentures of 40 lakhs, so 4 lakh 80, and reverse working we get to know my EBIT should be this much. The question's requirement was to calculate what is the likely EBIT if EPS is 4, 2 and 0. Clear? Any doubts on this? Let's go through 6. It's more of a discussion thing. Go through 6. No major calculation to be done. Okay, from the following information has been extracted. They have given sales PV ratio using the concept of leverage. Find out and verify. I'm going to discuss only about the verification part of it. Finding out is something you can do it later. You'll have to prepare an income statement, do it. Percentage change in taxable income if sales increase by 15%. What do you mean by taxable income? How much? Sorry, what is that? No, I don't think so. That's EBIT, because look at the last question. Percentage change in taxable income if EBIT increased by 15%. EBT, it should be earnings before tax. So they want us to find percentage change in EBT if sales is changing by 15%. Can you think and tell me sales and EBT? Sales and EBT is linked with which leverage? Combined leverage. EBT is basically EAT. EAT is basically earnings available to equity shareholders. So whatever is the percentage change in earnings per share, the same percentage change is going to happen in EBT. The combined leverage is 1.4 into 1.25. Can you do this? 1.4 into 1.25. So the percentage change in taxable income if sales increase by 15% is equal to 15 into 1.75. Percentage change in taxable income is equal to 15 into 1.75. Which leverage links EBIT and sales? Operating leverage. So operating leverage is 1.4. This is 10%. So percentage change in EBIT is equal to 10 into 1.4, 14%. 10 into 1.4, 14%. Which leverage links EBT and EBIT? Financial leverage. This is 15%, so 15 into 1.25. 15 into 1. This is one part of it. This is the verification part of it. First, you will have to do the calculation of it. So you will have to do the calculation and then show the verification. So this 26.25 is what we have calculated using the logic of the leverage. Then you have to prepare this statement and show that the 26.25 is exactly happening that way. Similarly, here the 14% is exactly happening that way. And similarly here I think the change is 18.75. Clear? Any doubts on this? Question 7, I'm not doing it. It's a slightly tricky question. It will take us some more extra time. So I'm not doing it, but you can get back to me if there are doubts. I've explained it in a simple manner, so you can solve it. Later on, if there are doubts, you can get back to me. I'm not discussing it as part of the class. Go through question 8. Go through 8. Okay, now onwards what you are going to see is the reverse working kind of a problem. What is reverse working is they'll give you some leverages, some missing information would be there, and based on that missing information somewhere using the leverages understanding, if we prepare an income statement, the question has not asked for an income statement, but most of the times you will be required to prepare an income statement. The question wants us to calculate financial leverage and PV ratio. For PV ratio somewhere indirectly the income statement would be needed. So I'm going to do an income statement. The income statement will broadly give me the solution to this answer. So let's start. We have our format of income statement. It starts with sales and goes on till EA, ES and EPS. Some question your income statement may have to stop at earnings before tax. Some question it may have to stop at earnings before tax. That depends whether we have data on tax rate in the question. Some question data on tax rates will not be there. If data on tax rates is not available, you may have to stop it at EBT. If data is available, you go on till earnings available to equity shareholder and go on till EPS. Let's look at this. Combined leverage is 2.5, so I'm filling whatever is available. Combined is 2.5. Your operating is 1.25, which indirectly means this is 2 times. Your financial leverage is 2 times. OL into FL is CL. So your financial leverage indirectly has become 2 times. Given that equity dividend is per share is rupees 2, interest is 1 lakh. So I know interest is 1 lakh. This is an information available. Fixed cost is 50,000. Fixed cost is 50,000. Sales is 10 lakh. Sales is 10 lakh. So sales is 10 lakh, fixed cost is 50,000, interest is 1 lakh. These are the 3 terms we have. Sales is 10 lakh, fixed cost is 50,000 and interest is 1 lakh. I don't have anything else in the question. I don't see tax rate data being there in the question. So I'm not going to try to go beyond this, okay. I will stop my calculation at this. I don't think so I'll be able to move beyond this. I'll not be able to move beyond this. So I'm going to try to restrict my analysis at EBT level. I can assume a tax rate and close it also if I want. I can assume some tax rates and prepare the income statement. The requirement was not to prepare an income statement. Now, OL is there. OL is contribution by EBIT. If you have a leverage and if you have one of the two, contribution or EBIT, or the item which is in between them. See, if you have the operating leverage and you have either contribution or EBIT or the item which is in between, you can calculate all the three. Basically, contribution, fixed cost, EBIT, everything can get calculated, assuming you have one of them. If you have either contribution or fixed cost or EBIT, if you have one of these three items, it is possible for you to calculate the balance. So, OL is equal to contribution by EBIT. OL which we have is 1.25, contribution is X, EBIT is X minus 50,000, EBIT is X minus 50,000, EBIT is X minus 50,000, your fixed cost was 50,000, this will give me the answer to contribution, So, 1.25x minus 62,500 is equal to x. X finally I think will be 2,50,000. X is 2,50,000, which is your contribution. So, contribution is 2,50,000. EBIT is now 2 lakhs. EBT is 1 lakh. Variable cost balancing figure is 7,50,000 and PV ratio is contribution by sales. They have asked for PV ratio, which is contribution by sales.
Sir, can we take EBIT as X?
Anything EB, you will get the same thing. Here then contribution should be X plus 50,000. It is X, if EBIT is X, contribution is X plus 50,000. I will check the calculation later. 9 I am not doing it, it is a fairly simple question. Go through 10. Go through question 10. Okay, this is a problem where multiple concepts are tested. They have asked for multiple items. I don't see tax data there in the question, so I'm going to stop my income statement at EBT. I'm going to stop my income statement at that level. I can proceed forward also if I assume a tax rate. You can assume a tax rate and proceed forward as well. So, sales is 75 lakhs. Variable cost is 42 lakhs. Contribution is 33. Fixed cost is 6 lakhs. EBIT 27. This is interest is 4,05,000. EBT is 22,95,000. My operating leverage is contribution by EBIT 1.22 times. This is EBIT by EBT and combined leverage is contribution by EBT. I am not discussing much on the leverage, but these are formality, nothing much is there. Questions requirement, return on investment, ROI. What is firm's return on investment? ROI or ROCE, these are the two alternative names. You could have learnt about this in ratio analysis. So, ROI is equal to EBIT by capital employed. EBIT by capital employed. Return on investment is equal to EBIT by capital employed, or you can say EBIT into 1 minus tax rate by capital employed. There's a pre-tax ROI and there's a post-tax ROI. So which is 27 lakhs. 27 lakhs by 45 plus 55. Capital employed is debt plus equity. Debt plus equity, which is 45 plus 55 into 100. So this is 27%. Your return on, this is called pre-tax ROI. This is called pre-tax ROI. We also have a post-tax ROI. There are two types of return on investment: pre-tax ROI and post-tax ROI. Pre-tax is 27%. Post-tax we cannot calculate because tax rates are not there. Does it have a favorable financial leverage? Financial leverage are of two types. One is favorable, second is unfavorable. A firm has favorable financial leverage if ROI is greater than cost of debt. If return on investment, which the company earns, is 27%, cost of debt is only 9%. Company is paying 9% interest, but on that capital it's earning 27%, because capital also includes the debt. So you are earning 27%, whereas you are paying only 9%. That is a favorable financial leverage. Sometimes you may be earning only 5%, but you have to pay interest of 9%. That's an unfavorable financial leverage. So does it have a favorable financial leverage? Yes, it does have a favorable financial leverage. If the firm belongs to an industry whose capital turnover is 3, does it have high or low capital turnover? So capital turnover formula is sales by capital employed. Sales by, we have some multiple turnover formula. Asset turnover is sales by assets. Working capital turnover is sales by working capital. Fixed asset turnover is sales by fixed asset. Similarly, capital turnover is sales by capital employed. Capital employed is debt plus equity. Debt plus equity. So the capital turnover here is 75 lakhs by 1 crore. 75 lakhs by 1 crore, which is 0.75 times. The industry is at 3. So we have a low capital turnover. We have a low capital turnover as compared to the industry. Different leverages we have calculated. I'm not going to do all this 4 parts, but I want to discuss few things. Sales drop to 50 lakh. What will be the new EBIT? 2 option. You prepare another statement. Sales and EBIT is linked with which leverage? Sales and EBIT. Operating. So what you can do is, sales has dropped to 50 lakh. There is a percentage change in sales you can calculate. You know the operating leverage. Percentage change in EBIT is percentage change in sales into the operating leverage. Something like this. Okay. Earlier sales 75 lakhs, new sales 50 lakh, decreases 33%. Operating leverage is so much, so the percentage fall in EBIT will be this, and you get the new EBIT. To avoid rounding off issues, I've calculated so many decimals, else there can be a huge rounding off issue which can happen. This 16 lakh is also possible for you to calculate if you prepare an income statement like this, because sales from 75 lakh has come down to 50 lakh. Sales has come down, your variable cost will also proportionately come down, and your EBIT is 16 lakhs. EBIT is 16 lakhs. This is an easier part to do, but in exam the expectation is you will interpret and do. You will interpret the leverages. Next is, if the sales is increased by 10%, what will be the EBIT increase? Which leverage links sales and EBIT? Operating. So you multiply and then calculate. At what level of sales EBT will be equal to 0? First tell me, EBT and sales is linked with which leverage? EBT and sales. Combined leverage. So what I can say indirectly is, EBT is coming down by 100%. EBT is coming down by 100% because EBT is becoming 0. So sales should come down by what number? Sales should come down by what percentage? Normally sales will be given and you calculate the EBT change. Here the EBT is going to change by 100% because EBT is technically becoming 0. So EBT changes 100%. The combined leverage which we have is 1.44. So I can say 100 by 1.44. Sales should change by 69.55%. Technically you may work with 4-5 decimals to avoid rounding of differences. If sales fall by this percentage, EBT will technically become 0. If EBIT increases by 20%, by what percentage EBT will increase? EBIT and EBT which leverage? Financial leverage. So you will have to be very careful about which are the leverages linking them. Go through 11. Go through 11. Vishnu, 5 minutes lower now, well over. Okay, I need to prepare an income statement. Income statement questions when asked in exam, high probability, it's a missing information question because some of the data points would not have been given in the question. We have some leverages. So the rule is simple. If you have operating leverage in the question, and you need either contribution or fixed cost or EBIT. One of the three you have, you will be able to calculate the balance. If you have financial leverage in the question, then you either need EBIT or interest or EBT. One of the three you have, you will be able to calculate the balance. Let's put the format first. Our format will start with sales. I think tax rate is also there in this question. EBT less interest, EAT. EBT less interest and EAT. Simple rule, will fill whatever is available. Once you do that, you will be able to get to the balance information. Company A, company B. Sales till EAT, starting with sales till EAT. I have some data points in the question. Variable cost is 56,000. Fixed cost is 20,000, interest is 12,000, 9,000, tax rate is there and sales is there. Sales is 1,05,000, variable cost is 60%, contribution is 42,000. So this is the information available in the question. The leverages which I have is financial leverage. The formula for financial leverage is EBIT by EBT, assuming preference dividend is not there. If you have either EBIT or interest or EBT, you will be able to calculate everything. So I use financial leverage of company A. FL is equal to EBIT by EBT. The FL given is 5 times. So 5 times is equal to, if I go to my income statement, I take EBIT as X. EBT will be X minus 12,000. I'll solve this, I'll able to get what is X. X will turn out to be 15,000. So that gives me my EBIT number, and balance part will be a formality. More or less I'll get to the balance part, which is, this is 15,000, EBT is 3,000, tax rate is 30%, EAT is 2,100, contribution is a balancing figure which is 15 minus of minus 20, 35,000, and my sales is reverse working. 35,000 minus of minus 56, 91,000. So I got sales as 91, variable cost was given, contribution is 35,000, fixed cost we had calculated, EBIT is 15,000, interest is 12, and EBT. The other scenario they have given OL. OL is contribution divided by EBIT. That makes it more simpler. Contribution is already there. 42,000 divided by EBIT is 4 times. So my EBIT is indirectly 42,000 by 4. My EBIT is indirectly 42,000 by 4. Fixed cost, EBT, this is sorry, less tax and EAT. Clear? Any doubts on this? Any doubts on this part? Question 12. Okay, you do this. You start doing question 12. Okay, this is a straightforward, simple question. Nothing much for me to discuss except for the last item, which is called earning yield. That's the only area I just wanted to discuss. When you do earning yield, what is the formula for earning yield? EPS by market price per share. The formula for earning yield is earnings per share by market price per share. So that's the formula you'll have to use. Balance is more or less a straight formality. EPS by MPS would give you this answer. 13 is okay, that's kind of a homework. You can kind of manage it. 100. Okay, I'll come to question 14. This is also slightly different kind of a question. Let's discuss 14. The capital structure of JCPL Limited is as follows. Guys. Capital structure of JCPL Limited is as follows. Equity share. Guys. You have any doubts, you discuss with me. I don't want any cross discussion, please. Any doubts you can ask to me. I don't want any cross discussion. Equity share capital 8% preference share, 10% debenture. This is a question where preference capital is also there. I want to discuss this question. Also some more other information is there. Additional information, profit after tax is 1,82,000, operating expense 1.5, equity share dividend paid 15%, market. One is operating and financial leverage, which is what we normally do, but this question also has preference dividend. So good question to practice. Preference dividend coverage and earnings dividend coverage. This is learnt in ratio analysis, but I'll discuss it here. Earnings yield and price earning ratio. Again, learnt in ratio analysis, we're going to discuss here. And net fund flow. Let's first prepare an income statement. This question also has preference dividend and all. Everything is there in this question, including preference dividend. Starting with sales, less variable cost, contribution, less fixed cost, EBIT, less interest, EBT, less tax, EAT, less preference dividend, EAES, number of shares, EPS, operating leverage, financial leverage. This question, my financial leverage can't be EBIT by EBT. It has to be EBIT divided by EBT minus preference dividend divided by 1 minus tax rate and combined leverage. Let's fill whatever we have. Profit after tax is 1,82,000. Profit after tax is 1,82,000. I take tax as 100, sorry, EBT as 100, tax is 30, EAT is 70. Operating expense including depreciation of 90,000 is 1.5 times of EBIT. I'll park it for the time being because I don't know the EBIT number. I'll calculate this later. Equity share dividend paid is 15%. That's the dividends actually paid by the company. Again, not using it for the time being. Market price is 20. This market price, equity share dividend and all will help me in calculating this price earning ratio, earning yield, all that information can be calculated. I can now reverse work and say 1,82,000 by 70%. EBT is 2,60,000. Tax is 78,000. Interest is 10% debenture of 100 each, 4 lakh. So this is 40,000. EBIT is 3 lakh. My operating expenses was 1.5 times of 3 lakh, which is 4 lakh 50. 1.5 times of 3 lakh, which is 4 lakh 50. In that 4 lakh 50, depreciation is 90,000, which is fixed, and variable cost is 360, 7 lakh 50. Preference dividend is also there in this question. Preference dividend is 8% into 6 lakh 25, which is 50,000. EAES, number of shares are 80,000. EPS is 1.65. EPS is 1.65. Now, operating leverage is very simple, which is contribution by EBIT 1.3. I just want to do financial leverage calculation properly. FL is equal to EBIT by EBT minus preference dividend divided by 1 minus tax rate. The reason is why we are dividing 1 minus tax rate is EBIT is before tax, EBT is also before tax. So preference dividend has to be grossed up. Preference dividend is an item which is deducted after tax, after you get your earnings after tax. So EBIT is 3 lakh, EBT is 2 lakh 60, preference dividend is 50,000 divided by 1 minus 0.3, which is 0.7 times. 1 minus 0.3 is 0.7. So 3 lakh, 2 lakh 60 minus 50,000 divided by 0.7. How much you get denominator? 188,571, and you finally end up getting the financial leverage, which is 1 point. Okay, so that's your financial leverage, operating leverage and financial leverage. This question has preference dividend. Other questions till now did not have preference dividend. Cover for the preference dividend, equity share of dividend. Cover for the preference dividend is, this is a coverage ratio. How you calculate coverage ratios? Preference dividend coverage. Any coverage ratio is from where are we paying that money divided by what are we paying. For example, preference dividend is paid out of EAT of the company. Preference dividend is paid out of the EAT. So PD coverage is equal to, I am going to pay it out of the EAT and I am paying preference dividend. You can calculate, the calculation is not the important part. Preference dividend coverage ratio is, what are you paying is the denominator. From where are you paying it? You are paying it out of the earnings after tax. Equity dividend coverage is equal to, what are you paying is equity dividend. From where are you paying is EAES. EAES by equity dividend. From where are we paying? Equity dividends would be paid out of the earnings available to equity shareholder. Denominator, what are you paying is the equity dividend. Earnings yield is EPS by MPS, and P multiple is MPS by EPS. P multiple is price by earning. The name itself will say price earning multiple. So the formula is price divided by earning. Price by earning, MPS divided by EPS, price earning multiple, and this side it is EPS by MPS. Net fund flow is nothing but PAT, add back depreciation, which is a non-cash item, and subtract the two dividends which you are paying, because in the profit after tax the dividends would not have been subtracted. PAT plus depreciation and subtract the two dividends, preference dividend and equity dividend. Go through question 15, a quick discussion on this. Go through this.
Sir, can you just tell the meaning of net fund flow again?
Net fund flow is basically the cash flow which the company gets. So the net cash inflow to the company is profit after tax, add back depreciation because it's a non-cash item, and subtract the two dividends which you are paying, because that's a money outflow. Go through 15th question. Okay, not much for us to solve in this question. They have given two scenarios where the fixed cost can either be 5,000 or 10,000, and your borrowings can be either 10,000 or 30,000. Borrowing is going to change your interest expenditure. There can be a problem where they can give you three different level of fixed costs and three different level of interest expense also. This is only 2 and 2. So I need to calculate operating leverage and combined leverage. I don't know whether the fixed cost is 5,000 or 10,000. So two scenarios. One is 5,000 fixed cost. Second scenario, fixed cost is 10,000. Similarly, the interest expenditure can either be 1,000 rupees or 3,000 rupees. So put together it's 2 into 2, 4 scenarios. If a question has three different fixed costs, and 3 different interests, it's 3 into 3, 9 different scenario. It's not 3 plus 3, it's 3 into 3, 9 different scenario. Format remains the same. Fixed cost of 5,000 plus interest of 1,000. Fixed cost of 5,000 plus interest of 3,000. Fixed cost of 10,000 plus interest of 1,000. Fixed cost of 10,000 plus interest of 3,000. You add them together and then try to calculate it. I just want to discuss one, I think the additional question which is there, which is a recent question. Go through question 9, page 192. Additional question. Question 9, page 192. Please go through this. Okay, I'll discuss this question and start solving it also. There is one tricky part which you'll face when you start solving it. Company P and Q are having the same earnings before tax. Margin of safety of company P is 0.20. Margin of safety is you go back to an area in your marginal costing. For company Q, it's 1.25 times than that of company P. This is 0.20, this is 1.25 times higher. Interest expense is 1,50,000. Company Q is 1/3 less. Financial leverage is 4 and this is some 75% less. PVR is given, tax rate is given. You are required to prepare income statement. Let's try preparing an income statement. We'll struggle at some place. Particulars, company P and company Q. Company P and company Q. Sales less variable cost, contribution less fixed cost, EBIT less interest, EBT less tax and EAT. There will be few challenges in this question. It's not a straightforward, direct kind of a question. EBIT? No, I'll come to it. So this is a format. Both the companies have same earnings before tax. I don't know that number. Margin of safety is 0.20 for company P. Company Q is 0.25. Company P is 0.20, 1.25 times. There's a use of this margin of safety. That is where the tricky part came. The interest expenses, company P is 1,50,000. Company Q is 1/3 less than that of company P. Company Q is 1/3 less. So this is 1 lakh, 1/3 less. Financial leverage is company P is 4 times. Financial leverage of company P is 4 times. And Q is 75% of company P. Q is 75%, which is 3 times. Can you get me EBIT and EBT quickly? Get EBIT and EBT quickly. 4 times and 3 times. You have interest expense, so you will be in a position to calculate EBT and EBIT. EBT and EBIT would be possible for you to calculate. One is X, other one is X minus 150. Use the financial leverage and get EBIT. Use the financial leverage. EBIT is X, EBT is X minus 150. So X divided by X minus 150 is 4 times. You will get an answer to X, which is going to be 2 lakh. For the other scenario, it's going to be 1 lakh 50. Other scenario, it's going to be 1 lakh 50. Okay. Beyond this is where the difficult part of the question comes in. Tax rate is 45%. EAT, all this is perfectly fine. I don't have a problem with this. I don't have any problem with this part of the calculation. I don't know the contribution because question has not given me the information on contribution. I also don't have information on fixed cost. I don't have information on fixed cost. What we have been normally doing is, if you have either contribution or fixed cost or EBIT, you'll be able to calculate the balance too, provided question gives you operating leverage. Question gives you operating leverage, because you use the formula for operating leverage and then get to the solution. The problem is this question has not given operating leverage in a direct manner, they have given in an indirect manner. And this is a formula which I have not touched upon till now, and even in my regular classes I have not done this formula. This is a formula which they have given. This is a good right interpretation. There is a margin of safety given in the question. What margin of safety indirectly mean is, margin of safety is 20% of sales, which indirectly mean my break even point is 80% of sale. My break even point is 80% of sale. So margin of safety 20%, break even point 80%. Break even point is linked with an item called as fixed cost. Break even point is linked with an item called as fixed cost. Margin of safety is going to be linked with an item called as EBIT in this question. Normally it's linked with profit. Normally it's linked with profit. Here it's linked with EBIT. Together is your contribution. EBIT plus fixed cost is together called as contribution. Now, whenever margin of safety is given in the question, you can say operating leverage is equal to 1 by margin of safety. Operating leverage is equal to 1 by margin of safety. Wait for a minute. Operating leverage is equal to 1 by margin of safety. If I take first example, what is the margin of safety for the first company? So operating leverage is 5 times. Operating leverage is 5 times. Listen. Now what this means is, contribution is going to be 5. Okay. Just for an imaginary sake. Okay. Contribution is 5. Or let me take 50,000. Okay. Contribution is 50,000. Fixed cost is 40,000. EBIT is 10,000. I have the exact numbers. I can calculate it in some time, but let's understand the concept. 50,000 by 10,000 is your operating leverage of 5 times. This is break even sales. This is margin of safety. Margin of safety is 10,000 on a base of 50,000. Margin of safety is 10,000 on a base of 50,000, because margin of safety will give me the EBIT. Margin of safety into PVR will give me EBIT. Normally it gives profit. Okay. Normally it gives profit, but in this the context of this question, it will give you EBIT. Break even sales into PVR will give you fixed cost, and total sales into PVR will give you contribution. So if your margin of safety is 0.20, if your margin of safety is 0.20, your fixed cost or your break even sales is 0.80. So the link between these two items, Margin of safety is indirectly 1/4 of break-even sale. Margin of safety is indirectly 1/4 of your break-even sales, or 1/5 of the total sales. 1/5 of the total sales. So what you can do is, once you do a reciprocal of margin of safety, that ratio, you get operating leverage. That's the only formula I wanted to touch upon, because balance is simple. Once I tell you operating leverage, you will calculate contribution, you will calculate sales, everything will be a formality. The important part is inverse of margin of safety. Inverse of margin of safety is your operating leverage. This is a detailed explanation. MOS is 20%, break-even sales is 80% of sales. Therefore, I can say fixed cost is 80% of contribution. EBIT is basically 20% of contribution, and this is the interpretation. Contribution by EBIT, 1/20% is equal to 5 times. In short, it's inverse. Inverse of margin of safeties. This is an explanation for you. I don't need you to present this in exam. In short, operating leverage has a new formula which I did not touch upon till now, and that is inverse of margin of safety. That is your inverse of margin of safety. Balance is formality beyond that. Once you use that, you will get your contribution. Using that, you will get your sales. All that is okay. The important thing is inverse of margin of safety. You will have to use inverse of margin of safety to get to the operating leverage. Operating leverage is equal to 1 by margin of safety. This formula was not there in any of the ICA material till now. This is a right formula. The formula is right, but we have never used in any of the question. So this question has that, so that's why I have discussed this. Inverse of margin of safety will become, this is I think May 2022 RTP question. Inverse of margin of safety will become your operating leverage. Clear? Any doubts on this? Balance, your additional questions are fairly simple. That's not an issue. Okay, so I'm kind of done with your discussion on leverages chapter. In the leverages side, I think this should broadly be okay. We have kind of covered almost all the question except for one or two question which I've left it. That is something which you can manage. It's a fairly simple area, format driven area. It's purely a format driven area. Go through ratio analysis. Multiple formulae will be there. Go through that.
Details, so can we stand in one corner and just count?
Yeah.
Thank you.
Please go through the various ratios formulae. Please, when I start solving question, then you will struggle. Please start going through the formulae. Go through the formulae. Guys, the time is given for you to go through this, please. Okay, there are multiple category of ratios there. There are three types of questions which will come in exam. One, they'll ask you to calculate ratios. Second, you may have to reverse work with the ratios and prepare a balance sheet or an income statement. So they may ask you even a trading P&L or only a P&L or only a balance sheet also. So that's the second type of a question. The third type of a question is where they'll tell you to do some interpretation, where you will are required to compare your ratios with the industry averages and give some commentary on the company's performance. When it comes to ratios, we have multiple category of ratios. So you may have some 35-40 kind of a formula, but different categories have different, there is a general theme for every formula. For example, the first is liquidity ratio, in which the basic two questions which will come mostly in exam is current ratio and liquid ratio. Current ratio and quick ratio are the most two important problems. Current ratio is current assets by current liability. Quick ratio is quick assets by current liability. In quick assets, from current assets, I'm going to subtract stock and prepaid expenses. The other ratio I'm not discussing much because that's not that critical. Second is on capital structure. What is capital structure? Is the term capital means long-term money, which is the composition of debt, equity and preference in a company. Composition of debt, equity and preference in a company, or how you are funding your asset side of it. There is a liability side, and how are you funding that? There is asset side of it, multiple assets are there. How are you funding that is also done. The first is debt ratio, which is total debt by capital employed. Capital employed is debt plus equity plus preference. In the debt, sometimes you can even include preference capital. In a practical world, the term preference can either form part of debt or can it form part of equity depending on the characteristic. So debt ratio is total debt by capital employed. Equity ratio is total equity by capital employed. Debt to equity ratio is total debt by total equity. The term debt can be interpreted as total debt, can also be sometimes said as long-term debt. Sometimes it can even be said as outside liability. What is outside liabilities? Even creditors will be included in that. Your other current liabilities will be included in that. So anything other than equity will form part of total outside liability. Debt to total assets ratios, again debt by assets. This is one important, these two are important ratios here. Capital gearing ratio and proprietary ratio. What is capital gearing ratio is fixed charge bearing capital by shareholders fund. What is fixed charge bearing capital is fixed capital. What is fixed capital is debenture and preference capital. Debenture and preference will form part of fixed capital. Denominator is your shareholders equity. Proprietary ratio is proprietors funds by total assets. Proprietary fund is owners funds. How much is the owner funding the balance sheet of the company or funding the assets of the company. Coverage ratio, I'm not discussing the formula. The rule is simple. Coverage ratio is what are you paying is the denominator, from where are you paying is the numerator. Interest coverage ratio, interest is paid out of the EBIT of the company. Interest is paid out of the EBIT. Debt service coverage ratio, debt services, interest and installment, they are paid out of the profits of the company. They are paid out of the profits of the company. So what are you paying is the denominator, from where are you paying is the numerator. Activity ratio or efficiency ratio or turnover ratio. For turnover ratio, your numerator will mostly be sales. Your numerator will mostly be sales. Denominator will be whatever is the item they are saying, except for few ratios. One is stock turnover ratio, where the numerator is COGS. Where the numerator is COGS. For example, total asset turnover ratio, the numerator sales by total asset. But sometimes if you don't have sales, you can use COGS as a proxy. That or is the proxy, that's the second preference. But for inventory turnover ratio, COGS is the first preference and sales is the second preference. Sales is the second preference. Debtors turnover ratio, we will use credit sales. We will use credit sales rather than the sales. Payables turnover ratio, we will use credit purchases. Now, whatever turnover ratio you calculate, that is described in times. You will say inventory turnover ratio is 5 times, debtors turnover ratio is 10 times. This can be calculated as inventory days, debtor days, creditor days. For that, you have to do 360 or 365 divided by the turnover ratio. 360 or 365 by the turnover ratio. And one more rule is, if any ratio, if you have one item from income, one item from P&L, and another item from balance sheet, if at all any ratio, one item comes from P&L, another item comes from balance sheet, the balance sheet item has to be the average. The balance sheet item has to be the average wherever possible. For example, you see here, credit sales by average accounts receivable, average debtors. If I have data, I'll have to take average of debtors. All this also you have to take average, okay? Average fixed assets, average total assets if you have data. If you have data, you have to take average, else you take the for the year period and close it. These items I'm not going to take any average, okay, because this is both the items from P&L. If both items are from P&L or both items are from balance sheet, current assets by current liability, you're not going to take any average there, because both items come from the balance sheet. One item from balance sheet, one item from P&L, you need to take the average for the balance sheet item. This is related to profitability ratios. The denominator is going to be sales. The numerator can keep changing: gross profit, net profit, pre-tax profit, operating profit, COGS. So whatever is that ratio, the name of the ratio will tell the formula. Again, no averaging here, no concept of averaging, because both comes from P&L. Return on investment ratios, ROI or ROC, which I had discussed in one of the question. EBIT by capital employed or EBIT into 1 minus tax. The rule is you have to take average capital employed if you have. If you have average data, you have to take average capital employed. Return on equity is what goes to the equity shareholder, which is EAES. Finally, the equity shareholder will get that. Divide by equity shareholders fund. Again, average if possible. Again, average if possible. Return on assets, net profit after tax by average total assets. See, some of the formula I would have used the word average. Some of the formula I wouldn't have used the word average. Rule is very simple. If you have one item from P&L, another item from balance sheet, please take an average of the balance sheet item. Earnings per share, dividend payout ratio, all these are self-explanatory. Apart from this, I think there's one more item called as your return on equity calculation as per DuPont model. I'll come to the DuPont model when I do a problem. Let's start with question 1. Following information and ratios are related to a company: sales for the year, GP ratio, fixed asset turnover ratio based on COGS, stock turnover based on COGS, liquid ratio, current ratio, debtors collection period, reserves and surplus, capital gearing ratio, fixed asset to net worth. You are required to prepare a balance sheet. Nothing much for you to go through. I'm going to focus on few questions. I'll do the detailed balance sheet. Few questions I'll give you indicator that what items could be there, and based on that, how do you go about preparing your balance sheet or income statement. Let's look at this balance sheet we need to do. So I write the format and leave it, okay. Balance sheet, liabilities amount, assets amount. I'll just write the format and then leave it here. I don't have any of the numbers, may not be there. Okay, liabilities amount, assets amount. Now let's look at what you can do. Any question, if you have this combination, liquid ratio and current ratio, if you have this combination in a question, you can use understanding of your quick assets, get somewhere inventory and get to know what is current asset and current liability. Liquid ratio, current ratio combination there in a question, it can help you in calculating current asset, current liability, provided you get to the inventory information. For getting inventory information, I have sales, I have gross profit, and I have stock turnover ratio, which is based on COGS. Stock turnover ratio, which is based on COGS. So first working notice, or first to notice, computation of stock. Once I get stock and I use current ratio and liquid ratio, this will somewhere help me in getting current assets and current liability. So computation of stock. Now what the question has mentioned is sales is 30 lakh, GP margin is 25%. So GP is 25% of sales, hence COGS is 75% of sales. COGS is 75% of sales. So I can indirectly say COGS is equal to 75% into 30 lakh, 22 lakh 50,000, and I can use the formula. Now stock turnover ratio, what's the formula? COGS by, I'll not use the word average stock because I don't have data on average opening and closing, so I'll just use the word stock. Whatever I'm calculating is the closing stock and I'll use it in the balance sheet. So our turnover ratio given in the question is 6 times is equal to 2250 by stock, and stock turns out to be 3,75,000. Once I have stock computed, and if you have current ratio and liquid ratio, you can use this combination and get to know what is current asset and current liability. So I have got stock information. So I go to the balance sheet. I'll write current assets, stock in bracket note 1. You'll have to give reference to which note you are calculating this. 3,75,000. Stock is 3,75,000, which is computed in note 1. Note 2 will give me the current assets and current liability. Computation of current assets and current liabilities. I'll somewhere get the current assets and current liability. Now, what I have is current ratio is how much? 1.5 is to 1. So current asset by current liability is 1.5. Current assets is equal to 1.5 CL. Current assets is 1.5 CL. I also have quick ratio. What is the quick ratio given? Liquid ratio or quick ratio, whatever name you want to give, 1, which is quick assets by current liability. Quick assets by current liability is 1. Quick assets is equal to CL. Quick assets is equal to CL. Now what I can say is current assets minus quick assets is equal to 1.5 CL minus 1 CL. Current asset is 1.5 CL. Quick asset is 1 CL. Current asset minus quick asset is nothing but inventory. Current assets minus quick assets is nothing but inventory, because quick assets is equal to current assets minus inventory. Ignore prepaid expenses, we don't bring that item. Inventory is equal to 0.5 CL, and CL is equal to, what was the inventory we calculated? 3,75,000 divided by 0.5. Current liability is 7,50,000. Current liability is 7,50,000. Current assets is going to be 7,50,000 into 1.5. 11,25,000. We'll see how we can break it further, but this is the information. Current asset is 11,25,000 and current liability is 7,50,000. If you have current ratio, quick ratio and stock in this combination, it is possible for you to go to current assets, current liability. So technically, if I look at my balance sheet, I know what is the total of current assets. I'll see if I can break it further, and I also know what is the current liability. Next information we have is fixed asset turnover ratio based on COGS. Fixed asset turnover ratio based on COGS. Normally fixed asset turnover ratio is based on sales. Question says it's based on COGS. We'll have to follow that. So my fixed asset turnover ratio is COGS by fixed asset. COGS by fixed asset, which in this case is 1.5, 22,50,000 by fixed assets, and fixed assets will turn out to be 15 lakh. Fixed assets will turn out to be 15 lakh. 22,50,000 divided by 1.5. So we are getting closer to completing this. Fixed assets is 15 lakh. I know the current asset total. Technically, I know the asset side fully now. Unless there is an investment balancing figure, I know the asset side fully as of now. I have used the sales information, I have used the GP ratio, I have used the fixed asset, I have used the stock turnover, liquid ratio, data. Debtors collection period. Debtors collection period is 2 months, which indirectly mean debtors is equal to 2 months of sales. Debtors is equal to 2 months of credit sales. Assumption is normal sales and credit sales all are same. So my debtors is 30 lakh into 2 by 12, 2 months of sales, so which is 5 lakh. We'll see if we can break it further, or I'll more or less leave it at this stage. If further breakage is possible, we'll break it further. Otherwise, because my current asset total was some 11 lakh 25. If we have some other information, we'll see it. As of now, I've used this information. Reserves and surplus to share capital, capital gearing ratio, and fixed assets to net worth. I'll have to use these three. At this stage, what I'm going to do is current liability 7 lakh 50. Current liability is 7 lakh 50. I also closed this cash balancing figure. This is a balancing figure of the current asset. Okay, this is a balancing figure of the current asset. Current asset total was 11 lakh 25. In that, 5 lakh is eliminated, 3 lakh 75 is eliminated. Assumption I don't have anything else. Okay, so I put a total here. So this side should also be 26 lakh 25,000. This side should also be 26 lakh 25,000, which is share capital, reserves and surplus, and fixed capital. What is fixed capital? Is preference and debenture put together. Some data is there to split it. Share capital, reserves and surplus, and fixed capital all put together is 20 balancing figure, which is 18 lakh 75,000. All put together is 18 lakh 75,000. The balancing figure. So there is a ratio there. Capital gearing ratio is 0.5. What is capital gearing ratio is? Fixed capital by equity. Equity means share capital and reserves and surplus put together. Okay. Fixed capital by equity is 0.5. Fixed capital is equal to 0.5 equity. Fixed capital is equal to 0.5 of equity. I don't know the equity as of now. Fixed capital is 0.5 times of the equity. I can also say fixed capital plus equity is equal to 26 lakh 25,000 minus 7 lakh 50. 26 lakh 20,000 minus 7 lakh 50. That balancing figure, asset side total minus the current liability. 0.5 equity plus equity is equal to 18 lakh 75. Can you tell me the equity number? 18 lakh 75 divided by 1.5. 12 lakh. This 12 lakh 50 includes share capital and reserves and surplus. This 12 lakh 50 has share capital and reserves and surplus. I could have calculated this 12 lakh 50 even with this ratio. Okay. Fixed assets to net worth. Fixed assets to net worth also would have given the same. To net worth means share capital and reserves and surplus put together. So at this stage, I can say this is minus 12 lakh 50, which is some 6 lakh 25, minus 12 lakh 50, which is some 6 lakh 25,000. This 12 lakh 50 has to be split further. What they are mentioned is reserves and surplus to the share capital. Reserves and surplus to the share capital is 0.6:1. So what I am going to write here is this is 0.6. This is 1. This is 1. The ratio is 0.6:1. Or in this calculation, share capital, reserves and surplus 0.6 split 12 lakh 50 in the ratio of 1:0.6. Split 12 lakh 50 in the ratio of 1:. See, sometimes they can say reserves and surplus to net worth is 0.6. If they use the word to net worth, reserves and surplus is 0.6, share capital is 0.4, balance. Share capital is balance 0.4. Here what they mentioned is reserves and surplus to the share capital. Reserves and surplus to the share capital. So 0.6:1. 0.6:1. Split this 12 lakh 50 in the ratio of 0.6:1 and we are done. So 12 lakh 50 into 0.6 by 1.6. and into 1 by 1.6. We get 781, 250 and 468, 750 and we are kind of done with the balance sheet. So unique or regular adjustment in this question was, one of the common adjustment which will be there in exam question is, one is your current ratio and your quick ratio combination. Current ratio and quick ratio combination is a normal adjustment which will be there in many of the question. Current and quick ratio combination. And second is your capital gearing ratio. capital gearing ratio. Others are self-explanatory. I'm not telling them as an important adjustment. Stock turnover ratio based on COGS is easily understandable, or fixed asset turnover ratio based on COGS is easily understandable. The critical ratios are, one is liquid ratio and current ratio with stock combination, and the second one is your capital gearing ratio. Go through question 2. Okay, similar requirement, I am required to prepare the balance sheet. I do see that combination again there in the question, current ratio, quick ratio and inventory turnover is there, but I don't think so you'll be able to follow the approach which you followed in the previous question. Stock is something which may not be possible to calculate here. So this question, you are going to link this and this item. Working capital, this is another way of using these two ratio. They may give you working capital, which is CA minus CL, current asset minus current liability, and using that and current ratio, you will get current asset and current liability. Using this you will get quick assets, and the gap between them is technically your inventory. So working note 1, computation of current assets, current liability. Note, first let's write the format, liabilities amount, assets amount. Any question, please write the format first, so that you at least know some of the information could be there in the question. That makes it easier. Share capital 5,75,000. I don't think so anything else is directly available. Share capital 5,75,000, I have written that. Now note 1, computation of current asset and current liability. Current asset and current liability. Current ratio is 1.5 times. Current ratio is 1.5 times. So I can say current asset is equal to 1.5 current liability. Current assets is equal to 1.5 current liability. Then working capital is equal to how much given in the question? This is another combination, like you use the combinations, current ratio, quick ratio and your stock. This is another combinations. Current assets minus current liability is equal to 1,50,000. 1.5 CL minus CL is equal to 1,50,000. 1.5 current liability minus current liability is equal to 1,50,000. I can say current liability is equal to 3 lakhs. Current assets is equal to 4,50,000. Current liability is 3 lakh. Current assets is 1.5 times of 3 lakh. 1.5 times of 3 lakh, which is 4,50,000. Current liability is 0.5 CL is equal to 1,50,000. So you divide by 0.5, you get current liability as 3 lakh. More or less my balance sheet is fitting in place. I know the current asset, I know the current liability. I may want to break it further. So I am writing current assets here. I may want to break it further. I am not writing current liability as a line item because mostly will not break it. So we will directly write that item. We will see if breakage is possible. Current assets as of now I get to know is 4,50,000 and current liability is 3 lakh. Now comes the formula of your quick assets. What is the quick ratio given in the question? Quick assets is equal to 0.8 times of current liability. Quick assets is equal to 0.8 times of current liability. So my quick assets is going to be 2,40,000 and inventory is going to be 4,50,000 minus 2,40,000, 2,10,000. Inventory is going to be 2,10,000. So I go back and write here inventory 2,10,000. You will give reference to whatever note you have used to calculate that. Inventory is 2,10,000. So this is one information which we have calculated. using inventory, if you want, you can calculate COGS. I'm not sure whether there's a need for that, so I'm not getting into the calculation as of now, but I can calculate COGS. You'll have to think about all of this. Using COGS and gross margin, you can calculate sales. Using sales and collection period, you can calculate debtors. So you'll have to think about that much combination. Using your inventory is how much? Sorry, what was the inventory we calculated? 2 lakh? COGS is 5 times of 2 lakh 10. COGS is 5 times of 2 lakh 10, which is 10 lakh 50. COGS is 10 lakh 50. Then next stage, COGS is 75% of sales. Why 75%? Gross margin is 25%. So COGS is 75%. Sales is 10 lakh 50 by 75%. 14 lakh. And my debtors is 14 lakh into 1.5 by 12. Debtors is 14 lakhs into 1.5 by 12. I had the inventory turnover. From there, I got the COGS. From COGS, I got the sales. And from sales, I'm getting to the debtors number. So debtors is 14 lakh into 1.5 by 12. 14 lakh into 1.5 by 12. I don't have any other information, so I'm going to write cash as a balancing figure here. Cash at bank as a balancing figure. This is a balancing figure of the current assets, okay? This is not the balancing figure of the balance sheet. This is a balancing figure of the current assets. Current assets was 4 lakh 50. Current assets was 4 lakh 50. So in that 4 lakh 50, I got this as 65,000. Cash is 65,000. Somewhere there is a relationship between cash and reserves and surplus. There's a relationship between cash and reserves and surplus. They mentioned reserves and surplus to bank and cash is 4 times. So reserves and surplus is 65,000 into 4. 2 lakh 60. 65,000 into 4. I think I've used all ratios now. Now I don't have any other ratio which is pending to be used. We have used data of share capital, working capital is used, gross margin is used, inventory turnover used, average collection period used, current ratio used, quick ratio used, reserves and surplus. The only point I have in the top is current liability comprise bank credit in the ratio of 2:1. Bank credit means short term bank loan. Bank credit is short term loan. So current liability, I'm going to split it as bank credit, others, bank credit and others, 3 lakh into 2 by 3 and 3 lakh into 1 by 3, 2:1. They said bank credit in the ratio of 2:1. So of that 3 lakh of current liability, 2 lakh is bank credit, others is 1 lakh. Now I'm in a stuck situation. I have used all ratios, all information is used. I seem to be ending nowhere because the balance sheet is not completed. I'm just putting a normal total. This side total is 1135, okay? I'm not writing a total, but you'll have to do this in the calculator, 1135. This side total is 4 lakh 50. So somewhere there is a balancing figure which has to come in the asset side. I'm assuming there are no other liabilities. What are no other liability? I'm assuming there's no debenture, no preference capital. I don't have data, so none of them is there in the question. So total of this side is 1135. Total of this side is 4 lakh 50 as of now. My balancing figure is fixed assets. My balancing figure is fixed assets, which is 1135 minus 4 lakh 50, 6 lakh 85. In case the asset side total is higher at this stage itself, then I'll say there is no fixed asset in this company, and balancing figure could have been bank borrowing, long-term loans. Long-term loans could have been a bank borrowing if the asset side total was higher than the liability side, because we have used all ratios. After usage of all ratios, I cannot do much about it. So we have used all ratios, we may have to take some assumption. So this question also the same combination of current ratio, quick ratio, but not with stock. It is with your working capital. It's with the working capital. That combination got used. Any doubts on this? Which one? Which answer you're saying?
Yes, sir. The
Okay, sales is, ठीक है, that's error. 15 lakh into 1 point. 1 lakh 75 is coming as, no, if you do 15 lakh into 1.5 by 12, or, ठीक है, that's a typing error then. That's a typing error. Let's not worry. Let's come to question 3. I'll see if there's a need to solve it, or I'll discuss wherever there's a need. I want to just tell you the important combinations from an exam point of view. Okay, broadly similar to the previous question. Stock turnover ratio is there, GP to sales is there. One more ratio which I see, sales to fixed asset. This ratio was not there in the previous question. Average debt collection period, current ratio, liquidity ratio, net working capital. Current, liquidity, net working capital combination can give you current assets, current liability, stock. Using stock and stock turnover ratio, you can go to COGS. Using COGS and GP margin, you can go to sales. Using sales and debt collection period, you can go to debtors. So that's a combination which is there in this question. But apart from that, they have also given data on ratio. Sales to fixed assets is given in the question. So fixed asset can't become a balancing figure. Let's quickly do this. So if you see here, current ratio is 2 times. So current asset is equal to 2 times of current liability. I'm going to do a quick discussion. Some of the items I may not solve also. Current assets is equal to 2 times of current liability. Working capital is current asset minus current liability is 8 lakh. Net 2 CL minus CL will be 8 lakh. CL is going to be 8 lakh. CA is going to be 16 lakh. Current assets will be 16 lakh in this question. Current assets is going to be 16 lakh. I'm not going to explain this because this is a normal adjustment. I don't want to spend time there. Current liability is 8 lakh. Quick assets is 1.25. Which is 10 lakh. Stock is 6 lakh. How we got stock of 6 lakh is 16 lakh minus 10 lakh. Stock is 6 lakh. COGS 42 lakh, 7 times. COGS 42 lakh, which is 7 times your inventory turnover ratio. Inventory turnover ratio based on COGS is 7 times. So 6 lakh into 7, 42 lakhs. GP margin is 25% of sale, which means COGS is 75% of sales. COGS is 75% of sales. Can you tell me sales is how much? 42 lakh by 75%. 56 lakhs. And using this 56 lakh, debtors is into 1.5 by 12. Into 1.5 by 12, which is 7 lakhs. Clear? Any doubts on this? This is an item which I normally do. Normally we solve it. This is what I solved it in the previous question. I want to discuss something beyond that. So if I look at this question at this stage, current assets. In current assets, I have calculated stock, which is 6 lakh, debtors 7 lakh. I'll take cash as a balancing figure, 3 lakh. Cash is the balancing figure, which is 3 lakh. Current liability, I don't have a breakup, 8 lakh. Current liability is 8 lakhs. Then I have a ratio called as sales to fixed asset is 2 times. They have not mentioned fixed asset turnover ratio or anything. They have given, sometimes they may give fixed asset by sales, sometimes they may give sales by fixed asset. If they give something, follow as it is. Let's not get into a formula and all. Sales by fixed asset is 2 times. So sales by FA is 2 times. FA is equal to 56 lakh by 2, 28 lakh. Sales by fixed asset is 2 times. So fixed asset is going to be 56 by 2. So I get fixed asset this side. 28 lakh. Okay. Now we have used stock turnover, we have used GP to sales, we have used sales to fixed asset, debt collection, current ratio, liquid ratio, net working capital. Reserves and surplus to capital is 0.25, and one more good information is long term debt is nil. If you remember, we had a similar scenario in the first question which we did today. In that I said the balancing figure capital employed, share capital plus reserves and surplus plus fixed capital is equal to that balancing figure. In this case they are very clear. Long term debt is nil, which means the balancing figure is share capital and reserves and surplus. The balancing figure is share capital and reserves and surplus. The total at this stage is 44 lakhs, 8 lakhs this side. The gap is 36 lakh. The gap is 36 lakh, which is share capital, reserves and surplus. The ratio for them is 0.25. 0.25 by capital. Split 36 lakhs in the ratio of 0.25 is to 1. 36 lakhs, 7 lakh 20 and 28 lakh 80, and this is done. So this was combining some adjustments of question number 1, some adjustments of question 2 that got combined here. Go through question 4. Tell me quickly current assets, current liability. Quickly get the current assets and current liability. Tell me the current asset and current liability figure. 1 lakh 60 and 4 lakhs. So I can break it down further. I'm not getting into that breaking down further. Breaking down further, I think the only breaking down you can do is stock you can calculate, and balancing figure could be other current assets. So the balance sheet may look like this. Current assets is 4 lakhs. Current liability is 1 lakh 60. This is the stage at it is. Now, I don't know the fixed assets this side. Okay, fixed asset is missing information. I assume bank overdraft is part of current liability. You can also take it as outside the current liability also. If it's a long-term bank overdraft, it goes under the long-term loan, else it goes under the category of current liability. That's an assumption based. Solution will change based on the assumption. Current asset, current liability, you get it. Now this side I have owner funds. Owner or proprietor funds. Owner or proprietor funds. I don't have anything else is my assumption, okay? Nothing beyond this. I don't want to get into long-term loan. All those items are not there in the question. The only thing you can do is if you want to treat bank overdraft as a long-term loan, that's your wish. Bank overdraft can be taken as a long-term loan. Now listen. Capital employed is equal to, this is one of the formula, okay? Capital employed is equal to current assets, fixed assets plus current assets minus current liability. Fixed assets plus current assets minus current liability. The term capital employed means debt plus equity plus preference, or this is from the liability side. From the asset side, you will say current asset plus current liability current assets plus fixed assets minus the current liability. Either you go from the asset side route or you go from the liability side route. Technically both are same. So capital employed is equal to fixed assets plus current asset minus current liability. This is one part of it. I'll come back to this in a minute. The second thing they mentioned in the question is fixed assets to proprietor funds is 0.75. Fixed assets to proprietor funds is 0.75. So I can say fixed assets is equal to 0.75 proprietor funds. Fixed assets is equal to 0.75 proprietor funds. Capital employed is equal to proprietor funds. My assumption is there is no other thing. What is capital employed is debt plus equity plus preference. I am assuming there is no debt in the company, there is no preference in the company. So this capital employed is equal to 0.75. Capital employed is equal to proprietor's funds. Alternatively, you can say capital employed is equal to proprietor funds plus bank overdraft of 40,000. If you want to trade bank overdraft as a long-term loan, if you want to take it as long-term loan, see the basic thing is in a balance sheet, capital employed is either these three things together or this. From the asset side, you subtract the current liability. So I am equating both. I have some of the asset side information. This is the previous question, not this question. I have some of the asset side information, some of the liability side information. So what I have done is capital employed is equal to fixed asset plus current asset minus current liability. I am assuming capital employed means only proprietor funds. I am assuming capital employed means only proprietor funds. Fixed asset is 0.75 proprietor funds and current asset minus current liability. What was the working capital number? 2,40,000. This will give me proprietor funds. 0.25 proprietor funds is equal to 2,40,000. Proprietor funds is equal to 9,60,000. This 9,60,000 has reserves and surplus given in the question, balance is share capital. Reserves and surplus is given in the problem, balance is share capital. Balance is share capital. Proprietary funds, proprietor's funds, they have set fixed assets to somewhere the ratio as mentioned in the question. Fixed assets to proprietary ratio. Fixed assets to proprietary. The normal formula for proprietary ratio is proprietor's funds by fixed assets. That's the normal formula. Here I think they have specifically mentioned take it as fixed assets by proprietor's funds. Fixed assets by proprietor's funds. The normal formula is proprietor funds by fixed assets. So I do this, I get to know this is 0.75. Your proprietor funds is 9,60,000 and this side I'll say share capital is 8 lakh. Reserves and surplus is 1,60,000. 8 lakh plus 1,60,000 is 9,60,000. Fixed asset is 7,20,000 and my balance sheet is over. 7,20,000. How 7,20,000 is 75% of 9,60,000. 75% of 9,60,000. Clear? Any doubts on this? This is with an assumption bank overdraft forms part of current liability. You take an alternate answer, then if bank overdraft forms part of long term debt, then you have to write 40,000 plus proprietor fund is capital employed. 40,000 plus proprietor fund is capital employed. That's a different answer. That's a different assumption and that will give you a different solution. Go through 5. Go through this question. Okay, this problem wants you to prepare an income statement also indirectly because they want you to calculate operating expenses, which is a balancing figure in my P&L account. Because there are data to calculate P&L information. So I may have to prepare a P&L either in a statement form or in your normal T account form, whatever way you want to do it, but I need to prepare a P&L which will give me the OPEX as the balancing figure, and I need to prepare a balance sheet. Sales is there, return on net worth. Return on net worth is basically profit after tax as a ratio of your shareholders funds. Profit after tax, or you can even say EAES. Return on net worth. Net worth means shareholders funds. Shareholders funds means share capital and reserves and surplus. If there is a preference dividend also in the company, then EAES is 25% of shareholders funds, else PAT is 25% of shareholders funds. Rate of income tax, share capital to reserves ratio is 7:3. 7:3. Like we had 0.5, 0.6, something like this. This is 7:3. Current ratio is there. Net profit to sales after tax. Net profit to sales after tax. Inventory turnover ratio specific requirement based on COGS and closing stock. They have specifically mentioned this is on closing stock, which is what we normally do. We normally take it as closing stock. Some question may specifically want us to do it on average stock. There will be information there. COGS is there, interest on debentures, trade receivables, trade payable. Let's first prepare an income statement. Income statement. I'll do it in the statement form. Particulars and amount. So we start with sales. We start with sales, which is 600 lakhs. Sales is 600 lakhs less COGS. Sales less COGS. COGS is also given in the question, which is 180 lakhs. I get gross profit. I get gross profit. Gross profit is 420 lakhs. From GP, we subtract operating expenses. Your operating expenses will normally go to your P&L, trading and P&L. There are two components of it. So this goes to the P&L part, less operating expense. You may get EBIT, less interest, EBT, less tax, EAT. Your OPEX can become a balancing figure. Less operating expenses, EBIT, less interest, EBT, less tax, EAT. Somewhere some information is there. What is the EAT number? They have given something on profit after tax. What is profit after tax? They have mentioned something on profit after tax. Profit after tax is 6.25% of sales. So this is into 6.25%. Tax rate given in the question is 40. So this is 100. Tax is 40 and EAT is 60. EAT is 60. So I gross this up and get to the EBT number 62.5. Interest can be calculated. We have interest is given in the question, in fact. 6 lakh. Interest on debentures. Interest on debentures 6 lakh. I get EBIT. And the OPEX is a balancing figure. Should be 351.5 unless there's something else to be considered. My operating expenses is a balancing figure, which is 351.5. Any doubts on this? Next segment is on balance sheet preparation. Any doubts on this OPEX balancing figure? 351.5. Sorry? Interest? No, so they've said interest on debenture is 6 lakh. This at 15% is for a reason. They have not said debentures is 6 lakh. They've said interest on debenture is 6 lakh. At 15% will help you in calculating the amount of debentures. That 15%, if you divide 6 lakh by 15%, you will be able to tell how much is the value of debenture, which is going to help you in your balance sheet side. Okay, let me use some of the ratios quickly. Return on net worth is 25%. Return on net worth is 25%. My earnings after tax is this. By 25%, My net worth should ideally be 150 lakh. Net worth should ideally be 150 lakhs. 37.5 by 25%. I'll prepare the balance sheet in some time. I'm quickly using the ratios. Return on net worth is nothing but PAT by net worth. PAT by net worth is 25. So net worth is equal to PAT by 25%. PAT by 25%. Share capital is 7105 lakh. Reserves is 45 lakh. 7 is to 3. 105 lakh and 45 lakh. That 150 lakhs. 105 and 45. Current ratio, I'll come back to it in some time. Inventory turnover based on COGS and closing stock. Based on COGS and closing stock. So I can say closing stock is 180 lakh by 12, which is 15 lakhs. 15 lakhs is my closing stock. I have receivables of 20 lakh. I have payables of 20 lakh. Receivables will go on the asset side. Payables will go on the liability side. And debentures is going to be 6 lakh by 15%. Debentures is going to be 6 lakh by 15%, which is 40 lakhs. So if I imagine my P&L balance sheet as of now, I can say share capital is 105. Reserves is 45. Debentures is 40, trade payables were 20, fixed asset is going to become a balancing figure, stock was 15, receivables was how much? 20. So I'm still not done with the question. I cannot take a balancing figure directly. There is a current ratio given in the question. Current ratio is how much? 2 is to 1. The current ratio is 2 times. Now listen. You can take one of the two assumption, depends on how it will work. For example, let's assume they give receivable as 35. In the question they give receivables as 35. I will assume that current assets include only two items, stock and receivables. I'll assume current assets include only stock and receivable. Why do I make that assumption? You will understand. Stock and receivable put together is 50 lakh. Your current liability can be half of 50. Current liability can be half of 50. So you can say other current liability and write 5 lakh here. Write 5 lakh here. In case the receivable figure given in the question was 35. Now the receivable figure given in the question is how much? 20. If you say these are the only two current assets. If you say these are the only two current assets, current asset total is 35. Current liability has to be half of which is 17.5, which is not possible because trade payables already sitting as 20. So my assumption is only current liability is trade payable. Only current liability is trade payable, which is 20, which means current assets has to be 40. Current assets has to be 40. So other current asset 5 lakhs. Other current asset 5 lakhs, and then I have a balancing figure which is fixed asset. Balancing figure is going to be fixed assets, which is 170. Balancing figure is fixed asset, which is 170. Any doubts on this? Any doubts on this? Go through question 6. We'll take a break at 1 to 1:45 or 1 to 2 should be the break. I think 1 to 2 would be the break, and the next session would be 2 to 5. Okay, coming to this question, some of the information is given, and good part is the format is also given to us. So we are just required to estimate these items. This is becomes more simpler because once the format is known, you know what is to be calculated. So my shareholders funds is given 6 lakh. Shareholder funds is given in the question, which is 6 lakh. GP is 50. See, your mind should start registering things. GP is 54,000. GP margin is 20%. This should help you in calculating something. What will you calculate? Sales is how much? 2 lakh 70. Your mind should start registering that way. GP is there, GP margin is there, so sales is 2,70,000. Credit sales is 2,16,000. Credit sales is 2,16,000. Total asset turnover is 0.3. Total asset turnover is 0.3, which is sales by total assets is 0.3. So which I can say total assets is equal to sales is 2,70,000 by 0.3, which is, and I'm going to write 9 lakh here as well, 9 lakh this side, because assets total is equal to liabilities total. Assets total is equal to liabilities total. So both side I'm writing 9 lakh rupees. Both the sides we have written 9 lakh rupees. Inventory turnover ratio is 4 times. Inventory turnover ratio is 4 times. You have sales which is 2,70,000. You have GP which is 54,000, which means COGS. COGS is 2,16,000. COGS is 2,16,000, and my ratio is 4 times. My ratio is 4 times, which means inventory is 54,000. Inventory is 54,000. Then debtors is 20 days of credit sales. 20 days of credit sales, not the total sales. Okay, 2,16,000 into 20 by 360. Into 20 by 360. 12,000. Current ratio is 1.8 times, which is your current asset by current liability. Just give me a minute. Okay, I'll come to this. I'll just quickly close this first. Long-term debt to equity is how much? 40%, which means my long-term debt is 2,40,000. And writing this 9 lakh this side makes a lot of sense now, because this is where it will help you in calculating creditors of 60,000. Else you will get struggle. You will be struggling at this stage because you don't know what to do, because I'm not using current ratio as of now, because current ratio is current asset by current liability. Unfortunately, current asset has a cash which I don't know. Current liability has a creditor which also I don't know. So I cannot have two missing information. I cannot have two missing information. If I have one missing information, it's possible for me to proceed ahead. So unfortunately, cash is also not there. Creditors is also not there. So I went to the next ratio. I went to the next ratio, which gave me long-term debt as 2,40,000, and this is where copying this 9 lakh this side makes a lot of sense. It helps you in completing the question. When I copied this 9 lakh, creditors become a balancing figure, which is 60,000. Current asset all put together is 1,08,000, 1.8 times, and balancing figure is 7,92,000 of fixed asset. Balancing figure is 7,92,000 of fixed asset. Your current ratio is 1.8 times, which means current assets is going to be 1.8 into 60,000. Clear? Any doubts on this? Again, I'm repeating, ratios you need to keep linking items. If you are not linking items, you will struggle. Go through 7. Not much is there in the question for you to estimate. They've given very limited kind of information, so it may become a very short balance sheet. I may not have a lot of information. Now, when I start doing this, equity capital is 1 lakh. I don't know reserves and surplus, so let's not get into that. Total debt to owner's equity is 0.6. Total debt to owner's equity is 0.6, which means overall debt is 60,000. Overall debt is 60,000, which can be split as long-term debt, short-term debt. Short-term debt is 40% of total debt. Short-term debt is 40% of total debt. So this is 24,000, 36,000. Fixed asset is 0.6 of owner's equity, which is 60,000. And now I have total asset turnover and inventory turnover. Those are the only two ratios pending. Those are the only two ratios pending. I have good amount of information on the liability side. Asset side, I have written only fixed asset as of now. I have written only fixed asset till now. I am assuming that these are the only liability and putting a total, which indirectly means there are no creditors, nothing is there in the question. I don't have a choice. I am putting a total of the liability side. It is 1,60,000. I don't have other information in the question, and we cannot calculate also. We cannot calculate. This is also 1,60,000. I can take a balancing figure of current assets and close it, but current assets can be split. I can split the current asset in this question. Now, they have given total asset turnover is 2 times, which means sales is 2 times of 1,60,000. Sales is 2 times of 1,60,000. So, sales is 3,20,000. What is the formula for inventory turnover ratio? Normal formula. COGS by inventory. This question it's sales by inventory. This question it is sales by inventory. Sales is 3,20,000. Inventory is 3,20,000 by 8. 3,20,000 by 8. So inventory is 40,000. Other current asset balancing figure 60,000. Other current asset balancing figure is 60,000. Inventory is 40,000. Other current asset balancing figure is 60,000. Any doubts on this? Go through 8 and try doing it. Go through 8 and try doing it. You try doing it. I want you to solve this. The format is there, so try doing it. More with practice, so I want you to attempt this. Okay, one thing I think I've not properly aligned the question or whatever. The 68,50,000 is the total of creditors and provisions and outstanding expense. Maybe that part is not coming out properly. At least when I read, I didn't understand that. That 68,50,000 is the total of creditors and provisions. Okay, that is not coming out properly in the question. 68,50,000 is the total of creditors and provisions and outstanding expenses. try doing it. It'll come with practice. That's where I want you to attempt it. That 68 lakh 50 is the total of current liability. First, you will use the formula of current ratio. 68 lakh 50,000 is the total of current liabilities. That can give you the current assets, which is 109.6. Then you can get the cash and bank. Then another information which is there in the question is net fixed assets is 20% of total assets. So fixed assets plus current assets is total assets, and that can give you the figure of total assets. So keep doing it. It's with practice. You'll have to keep trying it out. No, they want, no, that's the format they've given. No, they want you to find those two missing information: opening WDV and depreciation. If not, we normally don't get into it. I hope you would have got till this. Then I think there's one adjustment which is a little tricky, so maybe I'll explain it. But I hope you have got till this. Share capital is 25 lakhs. Your net WDV is 27.4. The fixed asset figure is 27.4. Opening WDV, it's like this: 100. Depreciation is 15. So net WDV is 85. So 85 is 27.4. You reverse work and get your opening WDV and depreciation. 27.4 is this: fixed asset plus current asset is equal to total assets. 0.2 total assets plus 109.6. 109.6 was the current asset number, is equal to total assets. Total assets became 137. In that, fixed asset is 27.4 and current asset is 109.4. Current asset is 109.4. Let me know if there's a doubt till this. Anywhere there's a doubt till this. Okay. Now slightly tricky. That's why I'm discussing it. what I can say is stock and debtors put together is stock and debtors put together is some 93.16. Stock and debtors put together is 93.16. I don't know how much is stock, how much is debtors. Somewhere they have given a debtors turnover ratio which is 12 times. They have given a stock turnover ratio which is 16 times. Debtors turnover ratio is 12 times and stock turnover ratio is 16 times. GP margin is also given in the question, but beyond this I don't have anything. GP margin is there in the question, but I don't know the GP number, I don't know the COGS number, I don't know the sales number. So debtors turnover ratio is equal to sales by debtors. So I can say debtors is equal to sales. What was the turnover ratio? How much? 12. Debtors is equal to sales by 12. Debtors is equal to sales by 12. Inventory is equal to COGS by 16. So inventory is equal to 0.8 sales by 16. Inventory is 0.8 sales. Why 0.8 is COGS is 80% of sales. COGS is 80% of sales because the GP margin is given in the question. GP margin is how much? 12%. So indirectly I can say debtor plus inventory is equal to 93 lakh 16,000. 93 lakh 16,000. It's a very good adjustment. So net what happens is sales by 12, 0.8 sales by 16 is equal to 93 lakh 16,000. Solve and get the sales number. Sales by 12 plus 0.8 sales by 16. Sales by 12 plus 0.8 sales by 16 is equal to 93 lakh 16,000. Is equal to 93 lakh 16,000. Sales is your debtors by, debtors is equal to sales by 12 and inventory is equal to 0.8 sales by 12, 0.8 sales by 16. This should be the number, I think. How much? Exactly 498. How much is the sales number you're getting? $698 something. No? Okay, sorry. 698.70 lakhs. Let me know if there's any calculation error here. Debtors is sales by 12. Inventory is 0.8 sales by 16. 0.8 sales by 16. Just give me a minute. Okay, 698.70, that's right. 698.70 lakhs is the sales figure. Beyond this is a formality. Your debtors is 698.70 divided by, what was the debtors turnover ratio? 12. Your stock is 698.70 into 0.80, 0.80 COGS into 0.80 divided by what ratio? 16 times. So we have got the stock debtors is done. Your creditors is what ratio they have mentioned? Creditors is 10 times and that is based on what? Cost of goods sold. Creditors is based on cost of goods sold. Normally it's based on credit purchases, but they have mentioned creditors ratios on the basis of cost of goods sold. So 698.70 into 0.8 divide by 10, 55.90, 55.90, overall was some 68.50, so this becomes 12.60, overall was some 68.50, some rounding of differences can be there here and there. I've worked with in lakhs, the solution could be in normal numbers, that's not a problem. Creditors is 698.70 into 80% divide by 10. Any doubts on this? The missing information now is reserves and surplus and 12% long-term debt. Reserves and surplus and 12% long-term debt. I'm not going to do it, I'm going to just quickly discuss it. Can you tell me which ratio will help there? Capital gearing ratio. What is capital gearing ratio going to do is, capital gearing ratio is fixed capital by shareholders funds. Fixed capital by shareholders funds. What I can indirectly say is 137 minus these two numbers. 137 minus these two numbers is the share capital, reserves and surplus and long-term debt put together. Share capital, reserves and surplus, long-term debt put together is 68.50. Capital gearing ratio is equal to fixed capital by shareholders funds. Fixed capital by shareholders funds. So you will somewhere get this 12% long-term debt. What is the capital gearing ratio? 0.6. Just give me a minute. I think this should be the number 25.69 if there is no calculation error. This should be the number. You can apply the formula and get to it. Capital gearing ratio is 25,68,750. So the important part in this question was on the adjustment of stock and debtors. This is something unique. We haven't seen in any other question. This was something unique. That's why I wanted to try it out and then discuss it. Any doubts on this question? Any doubts on this? Because the question did not have data on sales, it did not have data on COGS. So we were struggling to start, because if we have one of these information, we are used to calculating the balance part. Okay. Now this is one type of the question where you are required to prepare a balance sheet. This is in fact more trickier. What we have done till now is more trickier. The second part of the questions is where they'll ask you to calculate some missing data or some ratios. This is easier to do. Getting some items. For example, let's come to this question. Question 9. Following accounting information and financial ratios of M Limited are as under: inventory turnover ratio, creditors turnover ratio, debtors turnover ratio, current ratio, GP ratio, total sales, cash purchases, working capital. Closing inventory is 80,000 more than opening inventory. We are required to calculate average inventory, purchases, average debtors, average creditors, average payment period, average collection period, current asset, current liability. I'll give you maybe 3-4 minutes. I want you to try it. I want you to try and then I discuss. Try it out, we'll discuss. Okay, let's start. Average inventory is COGS by your inventory turnover ratio. The COGS is 75% of sales, so average inventory should be 22 lakh 50 divided by 6 times, which is 3 lakh 75. Purchases is your COGS is nothing but opening stock plus purchase minus closing stock. Opening stock plus purchase minus closing stock. COGS can also include other direct expenses like direct wages and all can be there, but normally this is the formula if there are no wages and other things. Your COGS is 22 lakh 50. Opening stock minus closing stock. They said closing inventory is 80,000 more than opening inventory. So opening stock minus closing stock is minus 80. Opening stock minus closing stock is minus 80. They said closing inventory is 80,000 more than the opening inventory. So the difference is 80,000 but minus because it's opening minus closing plus purchase. So purchase will turn out to be 23 lakh 30,000. Purchase will turn out to be 23 lakh 30. In that cash purchase is 2 lakh 30. Credit purchase will be 21 lakh. Credit purchases is going to be 21 lakh. Cash purchases 2 lakh 30. Total sales is 30 lakh. Cash sales is 25% of credit sales. This does not mean credit sales is 75% of sales. So they have said cash sales is 25% of credit sales. So you'll have to be careful about this. Cash sales plus credit sales is equal to total sales. What is mentioned in the question is cash sales is 25% of credit sale. So 0.25 credit sale plus credit sale is equal to 30 lakh. Hence my credit sale figure is 30 lakh by 1.25, which is 24 lakh. And cash sales is 25% of this. So debtors is equal to 24 lakh by 8. Debtors is equal to 24 lakh by 8, which is 3 lakh. And creditors is equal to credit purchases. Credit purchases, which is 21 lakh by 10. 21 lakh by 10. Next is average payment period and average collection period. Average payment, average collection. My average payment period is nothing but 365 by creditors turnover ratio. 365 by creditors turnover ratio. Collection period is 365 by average debtors turnover ratio. 365 by your debtors turnover ratio and 365 by creditors. Payment is how much time you are taking. Collection is how much time you are taking to collect the money from your customers. As of now, my inventory figure, can you tell me what is the inventory figure? How much? 3 lakh 75. Debtor 3 lakh. Creditor 2 lakh 10,000. Now I am required to calculate current assets and current liability. Okay, working capital is also there. You'll use the understanding of working capital and get to your current asset and current liability. CA minus CL is 2 lakh 80 and CA is equal to 2.4 CL. 1.4 current liability is equal to 2 lakh 80. Current liability will turn out to be 2 lakh rupees. Current assets will turn out to be 4 lakh 80,000. Current liability is 2 lakh. Something wrong then. Is the creditor 2 lakh 10?
Yes, sir.
Okay. Okay. Technically there is some issue with the question then, because my current liability is turning out to be 2 lakh, which is not possible. The only logic I can give to that is, just give me a minute. The only possibility for that is what you have calculated is average creditor, and maybe the closing creditor is lesser than this number. That's the only thing I can say, because what you calculate in the formula is average creditor, because my current liability is turning out to be 2 lakh in the end. It can't be lower than current your creditors of 2 lakh 10,000. Okay, go through 10. It's a very simple question, but yeah, I've used this question, used this understanding in one of the problem. We have used this in one of the problem. I'm going to use it again. This is a typical 5-mark exam question, or it gets added onto a detailed problem also. Okay, we had done one of the question where this proprietary fixed assets to proprietors fund ratio was there, and we linked it and tried to get the balance sheet. Now listen. Question has said working capital, current asset, fixed assets, current liability, proprietary fund. These are the 4 forms. They have used this word, there is no debt capital. Even if they don't use this word, I have to assume that only there is no debt capital is my assumption, else I will not be in a position to proceed. Current asset minus current liability is 12 lakh, okay. I am writing 12 lakh this side, I am writing 0, okay. Current asset minus current liability is 12 lakh. And then they have said fixed assets to proprietor fund is 0.75. Fixed assets to proprietor fund is 0.75. So my fixed asset is 0.75 proprietor fund. Fixed assets is 0.75 proprietor funds. Capital employed is equal to fixed assets plus current assets minus current liability. This is proprietor funds is equal to 0.75 proprietor fund plus 12 lakhs. 0.75 proprietor fund plus 12 lakhs. You will get to the proprietor funds now. Proprietor funds would be 48 lakhs. Fixed assets would be 36 lakhs. Proprietor funds is 48 lakh. Fixed assets to your proprietor fund ratio. Fixed asset is 48 lakh. Sorry, fixed asset is 36 lakhs and proprietor fund is 48 lakhs. Can you get me this net profit ratio? Think and see. How can you get to net profit ratio? Your fixed asset figure is 36 lakh. Proprietor fund is 48 lakh. Think and tell me how will you get to net profit ratio. What's the formula for your net profit ratio? Net profit by sales into 100. Can you tell me how can you get to net profit here? There's a way to get net profit. There are only limited ratios there. You tell me how will you get net profit? How will you get to the net profit? Which ratio you will use? What is the formula for return on equity? Return on equity formula. Okay, EAS by equity shareholders fund. If there is no preference dividend, EAS is equal to what? Profit after tax. So my net profit is 15% of proprietor funds. Net profit is 15% of proprietor funds. Net profit is 15% of proprietor funds. How can you calculate sales? This you should be able to easily tell. Which formula you will use? Working capital turnover ratio. Working capital turnover ratio is equal to sales by working capital. This is 5 times. So sales is equal to 5 times of working capital, which is 60 lakh. And net profit ratio 7 lakh 20 by 60 lakh, which is 12%. 7 lakh 20 by 60 lakh, which is 12%. Any doubts on this? Do 11. Do 11. Please do this. It's a quick calculation, there's nothing much to do. The second part may need some calculation. First part is fairly simple. First part is going to be fairly simple, first part of the question. Second part may need some computation at your end. This question, there is some data of average inventory and all, so you'll have to, so there's some opening data, closing data, all that is there, so we'll have to give effect to that as well. How will you get to average inventory? I want participation. How will you get to average inventory? COGS is 85% of sales, which is, my assumption is credit sales is equal to total sales. I don't have data on cash sales in the question. So 85% of 12 lakh 80. Can you tell me what is the average inventory? 2 lakh? In that, closing is only 96, the balance is opening, so I'll have to take the average, but anyway they have not asked me to calculate opening inventory and all. Closing is 96,000. Your average inventory turns out to be 2,72,000. Second, I need average collection period. For average collection period, I have to calculate debtors turnover ratio. Debtors turnover ratio is equal to sales by, I'll have to use average debtors, not debtors. Reason for using average debtor is they've given data on opening debtor. They've given data on opening debtor in the question. If they're not given, I'll not do it, because see, the point is the term average collection period does not mean you'll have to take average. As a general rule, for any ratio where there is a P&L and a balance sheet item, you have to take the average for the balance sheet item, provided you have information on that. I can also directly calculate average collection period. The average collection period formula is average debtor by sale. It's the inverse of that into 360 or 365 depending on the number of days in the year. Now coming to sales, 12 lakh 80. Coming to debtor figure, my current liability is 1 lakh 92. Current assets is 1 lakh 92 into 1.75. Current assets is 1 lakh 92 into 1.75. How much is that? In that 3 lakh 36, closing inventory is 96, cash is 32. Closing inventory is 96, cash is 32, leftover is debtors. How much is debtors? 2 lakh 8,000. Closing is 2 lakh 8, opening is 4 lakh 32, average is how much? 3 lakh. So divide by 3 lakh 20, 4 times, and my average collection period is 360 by 4. 360 by 4, which is 90 days. The average collection period is 360 divided by 4, which is going to be 90 days. Okay, I think we'll take a break and then resume again. Some of the questions I still need to discuss in ratio analysis, so I'll cover that post the break. We'll resume again at 2 o'clock, 1 hour break, and then we resume again. Okay, let's now continue with question 13. We'll start with that question now. Following is the information of XML Limited related to the year ended 31st March 2018. Gross profit, net profit, inventory holding period, receivables collection period, non-current assets to sales, non-current assets to current assets, current ratio, non-current liabilities to current liabilities, share capital to reserves and surplus, and the data on non-current assets. Assume that there is no change in non-current asset, no depreciation, ignoring tax. We are required to calculate COGS, net profit, inventory, receivables and cash. So the requirement is not to prepare the entire balance sheet. They have asked us to compute some of the specific ratios, which is COGS, net profit, inventory, receivables and cash. Some of the missing information needs to be computed by us. Let's start. I have gross profit margin, net profit margin, inventory holding period, receivables collection period. All this is there, and in the end I get this information. Non-current assets is 50 lakh. This is the data which is going to help us in doing most of the requirements. Non-current assets is 50 lakh. So non-current assets to sales is 1:4. So sales is 2 crore. Sales is 2 crore. So this is the first information. My GP margin is 20%. So COGS is 80%. 1.6 crore. COGS is 80% of sales. 1.6 crores. Net profit is 10% of sale, which is 20 lakh. Net profit is 10% of sale, which is 20 lakh. For inventory calculation, we are going to use the formula of inventory holding period, which is COGS into 3 by 12. COGS into 3 by 12. So this is 40 lakhs. COGS is 1.6 crore into 3 by 12. We also have receivables calculation. For that, you are going to use receivables collection period, which is sales into 3 by 12. Sales into 3 by 12, which will be 50 lakhs. And the last requirement is cash also needs to be calculated. So I have sales, I have inventory of 40 lakhs, receivables of 50 lakhs. Somewhere we are going to use the formula of non-current assets to current assets. Non-current assets to current assets is 1:2. Non-current assets are fixed assets, which are 50 lakhs. So current assets is going to be 1 crore. In that, you know inventory, you know debtor, cash is going to become a balancing figure. Let's come to question 14. Calculate the return on capital employed in bracket total asset from the following information relating to company X and Y. Net sales, total assets, net profit, turnover of total assets, and gross margin. Basically, we are going to try to fill that table. Go through this. Okay. They've asked for return on capital employed. In bracket they mentioned total asset basis. Basically, capital employed means fixed assets plus current assets minus current liability. I can make an assumption that there are no current liabilities, so your total assets is going to be equal to capital employed. So they mentioned return on capital employed in bracket they mentioned total asset. Capital employed in bracket they mentioned total assets. Your capital employed is fixed asset plus current asset minus current liability, or equity plus debt plus preference. Coming to this table, first this item is 5720 by 25%. 5720 by 25%. Last line, gross margin 5720 in bracket 25%. In bracket 25%. So that will give me the sales figure. What is the sales number? 20,000? 22,880. Turnover of total assets. Not very clear exactly what they mean by that. Are they saying sales by total assets or total assets by sales? Just give me a minute. Friends, you're able to see the screen क्या? Okay, ठीक है. Okay, so 5720 by 25%, that's the sales figure. Turnover of total assets is not very clear, but I'll take it as sales by total assets. I'll take it as sales by total assets. So this is 22,880 by 55,500. What's the number you get? Turnover of total assets, 22,880 by 55,500. Point? Okay, and this side I can get my total assets as sales by total assets is 5 times, sales is 3,25,000, total assets balancing figure is going to be 65,000, and we are required to finally calculate return on capital employed, which the formula is EBIT. The formula is EBIT by capital employed. I don't see information on EBIT in this question, so I'll take net profit as the proxy for EBIT. I'll take the net profit. So in this question, ROCE will be equal to net profit by total assets. It will be net profit by total assets. I don't see other information in the question. EBIT, I think the proxy should be net profit. Yeah. Net profit will be taken as proxy for EBIT. Total assets will be taken as capital employed as indicated in the question. Net profit, you know, net profit on sales is given. So sales into net profit margin will give you the net profit, and you divide by the overall assets. Similarly, you do it for company Y as well. Go through, okay, 15 you can do it as later as homework. 16, this is on DuPont framework. Go through question 16. Go through 16. Okay, now we have a normal formula for calculating ROE. ROE is nothing but net profit or EAES by amount of equity. If you calculate ROE that way, or you do ROE as per DuPont framework, the answer is going to remain same. But the question would sometimes ask based on the DuPont model. So the normal formula for ROE is net profit by equity. Net profit by equity or EAES by equity. Net profit in this question is net income. Net income means profit after tax. Operating income means EBIT. The term operating income means EBIT. The term net income means profit after tax. So 3,60,000 by 4 lakhs into 100. This will give you the ROE as per the normal formula. But in exam, I cannot present ROE like this. So what DuPont has said is ROE is net profit by sales. Net profit by sales. The formula doesn't have sales as the denominator. Your ROE formula doesn't have sales as the denominator. So he said sales by total assets. And then he said total assets by equity. Net profit by sales is technically called as net profit margin. Sales by total assets is called as what? What formula is this? Total asset turnover ratio, and this is technically called as equity multiplier. This is technically called as equity multiplier. That is, how much is the asset as compared to the equity of the company. The equity could be lesser, but the assets could be at the higher end. Rarely it could be lower also, but mostly it will be higher than your equity. So that's your equity multiplier. Instead of directly using net profit by equity, you will have to use it in 3 different ways. You will have to first do net profit by sales, and then do sales by total assets, and then do total asset by equity. Will the answer be different than 90%? No, it's going to turn out to be the same 90%. But DuPont framework means you will have to do it this way. So the question has given net profit margin is 12%. Asset turnover is 2.5. Equity multiplier is not given in the question, so we may have to calculate the equity multiplier. Equity multiplier is total assets by equity. Equity is given in the question, which is 4 lakhs. I need this total asset. 3,60,000 is the profit. 12% is the profit margin, which means sales is 30 lakh. Sales is 30 lakh. Asset turnover is 2.5. 30 lakh divided by 2.5 is how much? How much? So this is 12 lakh. Total asset is 12 lakh. You will end up getting the same answer. The answer is not going to change in any way. Just that your presentation has to be this way. Net profit margin, which is net profit by sales, into asset turnover, into total assets by equity. It will turn out to be the same answer. 90%. 90% is going to be the number. That's not going to change. But presentation wise, you will have to do it this way. That's how ROE is computed as per DuPont framework. Any doubts on this? This question 15 is also on the same thing. It's ROE as per DuPont framework. I'm not doing that. Net profit margin, return on asset, asset turnover, and then return on equity. Technically, it's going to be similar to that. Okay, we have done 2 segments of your ratio analysis. The third segment is on some interpretation related area, or somewhere you will have to look at the ratios and give some commentary. Some commentary could be there, or some interpretation related requirement. Assume that the current ratio of a company is 2. State in each of the following cases whether the ratio will improve or decline or will have no change. Payment of current liability. For the time being, my current asset is 200. Current liability is 100. Okay. I am going to pay off a current liability. If I pay current liability, liability will come down to 90. Current asset will come down to 190. Liability will come because your cash is going to reduce. So 190 by 90, the ratio is going to improve. Whether the ratio will improve or decline, the current ratio is going to improve if you pay a current liability. 200 will become 190 and 100 will become 90. Purchase of fixed asset by cash. What will happen to the current ratio? Whether any current asset, current liability change if you purchase fixed asset by cash? Current assets will come down to 190. Let's assume the transaction is 10 lakh rupees. 190. Current liability will continue to be 100. It will come down to 1.9. Cash collected from customers. Current asset will? Think. It will remain same. No, you are going to collect your debtors. Debtors is also a current asset only. So if you collect 10 lakhs, debtors will come down, cash will go up. Debtors will come down, cash will go up. The ratio is going to remain same. Bills receivable dishonored. Current? Why will liability increase? I at least see no change in this. The reason is bills receivable is anyway part of my current asset. Instead of bills receivable, it should now become sundry debtor. Instead of bills receivable, it should now ideally become sundry debtor. So what is the bills receivable in my books of accounts? Is it part of current assets or not part of current assets? Part of current assets. And now it will be called as debtor. If you are going to say that I am going to write it off, then that's a different story. If you are going to write off this amount, then your current ratio will get impacted. I at least don't see any impact. Let's see. Bills receivable dishonored means from bills receivable it will be now called as debtors. If you call it as debtors or you call it as bills receivable, doesn't really matter. Both items form part of current asset. Issue of new shares. Will any current asset, current liability change? Cash or bank will be received, so your current assets will go up. Current assets will go up, so ideally it should improve. Bills receivable will come down, sundry debtors will increase, no change in current asset and current liability. There's not going to be any change. Explain the important ratios that would be used in each of the following situation. A bank is approached by a company for a loan of 50 lakhs for working capital purpose. See, whenever you go to a bank for loans, working capital chapter also, they focus on more on this current assets and current liability, which is basically your liquidity ratios. So he will look at current ratio, he will look at quick ratio, he will look at your net working capital position. So that's the important ratio you will look at when you are funding for working capital purpose. A long-term creditor is interested in determining whether his claim is adequately secured. There is a short-term solvency and there is a long-term solvency. Short-term solvencies are understood through your liquidity ratio. Long-term solvency is understood through your capital structure ratio, which is your debt ratio, equity ratio, debt to equity ratio, debt to total assets ratio, proprietary fund ratio, capital gearing ratio. All those ratios are very critical if I want to know the long-term solvency of a company. Short-term solvency, I can understand it through liquidity ratios. A shareholder who is examining his portfolio is to decide whether he should hold or sell his holding in the company. From a shareholder point of view, I would look at ratios like which are related to my return, which is earnings per share, dividend per share, what is the payout the company is doing, what is the P multiple the company has, what is the earnings yield, what is the dividend yield. So return from an owner point of view, which can also include ROE and ROC also. These are the few ratios I would like to look at if I am a shareholder of a company. A finance manager wants to know how effectively the company has used the available resources. Turnover ratio, which is your fixed asset turnover ratio. If you want to know the effectiveness of the usage of your assets, you will check whether you have good fixed asset turnover ratio, total asset turnover ratio, working capital turnover ratio, capital turnover ratio. All those ratios will help us in knowing whether we have used the assets effectively or not. Quickly go through 19, there's nothing much to do here. Quickly first see the 9. Okay, I am required to comment on the ratios. Now they have given 2017, 2018 and average. So when I'm going to pass my commentary, one comment would be 2018 as compared to 2017 and another comment would be on the average also. For example, first liquidity ratios. The company, if I look at a broad overview, current ratio has improved in line with the industry. Quick ratio has improved in better than the industry. Receivables turnover, inventory turnover, receivables collection period, that's on the working capital side. So from a liquidity point of view, I can say that the current ratio of the company has shown an improvement. It has improved from 2.2 times vis-a-vis 2.5 times, and with the improvement, the ratio is in line with the industry average. The improvement has been supported with an improving quick ratio of the company, which has improved from 1.5 times to 2 times. This would also indicate that major chunk of the current assets is not stuck in the form of receivable. Is not stuck in the form of stock. If stock is going up and then current ratio is going up, that's not a great thing to have. So stock is also not increasing. My quick ratio is also showing an improvement from 1.5 times to 2 times. However, we need to take care that significant buildup of assets can erode the profitability of a company. If you have too much of current assets, profitability will be lesser. This is a concept which you could have seen in working capital area called as liquidity versus profitability. If you have too much of liquidity, that is if you have money stuck in the form of debtors or inventory too much there, your profits can be on the lower side. Next is commentary on the receivables turnover ratio. No major comment. We are remaining status quo. We are in line with the industry. Industry is 6 times. We are at 6 times. Inventory turnover ratio is anyway better than the industry. It is better than the industry and it is further going up in 2018. Technically, I see some issue with these two. Either I have typed it wrong or I don't know what. 87, 86, 85 and this is 6 times. Basically, your receivables collection period should be 365 by the turnover ratio. So, I don't know whether it is a typing error or whether it is a question error, but nothing much to be commented on. I am not going to comment anything much on the turnover ratio because we are broadly in line with the industry as far as receivables is concerned and we are slightly better on the inventory turnover ratio. Next is operating profitability, ROI. Return on investment is coming down. Return on investment is coming down. So we would say that there is a reduction in the ROI of the company. The same has dropped from 25% to 22% despite the operating profit being maintained by the company at 19%. The company may have to analyze the reasons for the fall because I cannot comment on this. In a practical world, I used to work in a profile where we used to analyze this and understand what exactly happened and why did this happen. So you used to analyze with extra information. I don't have extra information here. So I'll tell the company you will have to understand what happened. Despite the deterioration, we still are better than the industry. We still are better than the industry because industry at 15%, we are at 22%. Debt ratio. debt is debt by capital employed. We are at 49% as compared to the 57% of the industry. That indicates that I am borrowing lesser amount. I am borrowing lesser amount as compared to the industry average, which is a good indication of long-term solvency. It's a good indicator of the long-term solvency of the company. Return on equity has improved. This is slightly not correct, because if this comes down, mostly we see ROE coming down, but that's going up. So you will say again we are better than the industry. Some commentary on 2017 vis-a-vis 2018. One thing which you should be very sure is whether the ratio has to go up or come down. Certain ratios we want to go up, certain ratios, for example, debt ratio, lower the better. Debt ratio is lower the better, whereas return on equity, higher the better. So you need to be very clear which is an improvement. 49 becoming 48 is an improvement as far as debt ratio is concerned, and it is better than 57, whereas 24 becoming 25 is an improvement from ROE point of view, and it's better than 15%. If you see this, nothing much would be commented on. Current ratio improved from last year, matching the industry average. Quick ratio also improved above the industry average. This may happen due to reduction in receivables collection period, quick inventory turnover. However, it also indicates idleness of the funds. You are keeping too much of funds at your end. Overall, it is reasonably good. All the liquidity ratios are either better or same in both the years as compared to the industry average. See, you are going to write about the same point. You cannot much. Basically, the table, whatever table is given, you are required to convert it into words, and you are going to use words like better, weaker, improved from the last year, deteriorated from the last year. Nothing much can be done beyond that, because you don't have information to do that. In a practical world, we will have extra information to pass commentary. Operating profits reduced from last year, but operating profit margin has been maintained. However, both the ratio are still higher than the industry average. Financing, the company has reduced its debt capital and saved operating profit. It also signifies dependency on debt is lower as compared to the industry. Return to the shareholders, ROE has improved. So beyond that, we are not going to comment much. Our commentary is going to be broadly on these items. Page 186, there are some 4 new questions of the latest one. In that, I just want to discuss question 3. I don't have other questions, discussion is not critical. Question 3. It's a very lengthy question. I don't expect such question to come in exam, but if at all comes, you should be prepared. So that's why I'm discussing this. Question 3. J&S Pharmaceutical is in the business of manufacturing pharma drugs, including the newly invented COVID vaccine. Due to increase in demand for COVID vaccine, the production had increased at an all-time high level. Company urgently needs a loan to meet the cash and investment requirement. Statement of profit and loss and balance sheet is given for 3 years. Statement of profit and loss and balance sheet is given for 3 years. A lengthy P&L and a balance sheet. Industry averages are also given. Current ratio, asset test ratio, receivables turnover ratio, inventory turnover ratio, long-term debt to total debt, debt to equity, net profit, return on total assets, interest coverage ratio. The only difference between the previous question which I discussed and this question is, previous question that calculated the ratios and given to you. In this question, they have given you the industry average and they have given you information to calculate the ratios. They have given you information. Below that, if you see, as a loan officer, you are required to appraise the loan proposal on the basis of comparison with industry average of key ratios, considering closing balance for accounts receivable is 6 lakh and 6 lakh 40 as on 31st March 2018. I have 18, 19, 19, 20 and 2021, and somewhere 17, 18 some closing balances are given. Reason is some of the ratios you take average number. Some of the ratios you have to take average number. So I have to calculate all the 3 current ratio. So for all the 3 years, I'll have to calculate current ratio, asset test ratio, receivables turnover ratio, inventory turnover ratio. Wherever you take one P&L and one balance sheet item, you will take the average, else you just take the number as it is. So current ratio, you know what is to be done. You have the current asset total, you have the current liability total, you divide and get the ratio. For example, just quickly one ratio I check. 2.54, 1.8, 1.60, industry average is 2.3. So I'm going to write a commentary saying that there seemed to be a deterioration in the liquidity profile of the company. The current ratio has been deteriorating over the last 3 years, as reflected in a ratio of 2.54 times as compared to an average ratio of 1.6 times. This has also gone below the industry average of 2.3 times. So that's my commentary as far as the current ratio is concerned. Like that, you have to calculate all asset test ratio, wherever, for example, receivables turnover ratio, you'll have to take average receivables. The reason for giving the data below closing balance of accounts receivable of 6 lakh and inventory of 6 lakh 40 is to take average. You'll have to take the average data, pass a commentary on that. Finally, pass a commentary on that. Looking at the improvement or deterioration in the ratio, you can finally say that there seemed to be an overall deterioration in the liquidity profile. So hence, the company or the bank should not be providing loan based on. However, you should also take into additional factors. In a practical way, it's not only ratios. I also need to look into the future prospects. I also need to look into this companies into some pharmaceutical drugs, which is a fairly stable industry. Plus, it is also critical that vaccine manufacturing is increased. These are called as non-financial factors. You will learn that more in detail at CA final in SCMP. But it's not only financial factors, you also take into consideration certain qualitative factor. Because for example, the ratios could show a deterioration, but still I may have to extend the loan because he is going to manufacture a pharma product, which is very critical for overall country as such. It's very critical. So I'll have to keep in mind, I think they would have passed that in the commentary. However, before jumping to the conclusion relying only on the key ratio, it's pertinent to keep in mind the industry. Company dealing in with the pharmaceutical drug is one of the major contributor and is expected to grow further. COVID situation, people are more cautious towards the health. That's why analyzing the loan proposal, both the factor financial and non-financial has to be kept in mind. We normally don't give a conclusion. That's how the analysis would ideally be done, because whenever non-financial factors come into picture, you cannot give a conclusion, because what is critical or what is not critical, the bank has to finally take a call. This is as far as your ratio analysis part is concerned. 3 types of question. One type where you have to prepare a P&L and a balance sheet. Second type where you will have to calculate ratios. They would have given some information. In that you also have ROE as per DuPont framework, which you cannot use the normal formula. And third is the interpretation or commentary type of a question. Now I'll move to, we'll move to an area called as cost of capital. Go through the initial theory which is there in page 27. There's some good amount of theory which is there. I think 2 pages or so. Go through the initial theory. Go through the initial theory.
Sir, for the initial best rate NPV, sir, will we do the 2/3 into accounting rate?
I'll come to it. That is in capital budgeting. Here it will not work that way. I'll come to it.
Sir, in that exam, will they ask like that, sir? Like doing 2/3?
No, they won't ask anything. Okay, I'll start maybe discussing itself. See, the term capital means long-term funds, which is debt, equity and preference. From a problem solving point of view, we'll have to first understand how do you calculate cost of debt, cost of equity and cost of preference, and then we combine this together and calculate something called as WACC, weighted average cost of capital, or WMCC, weighted marginal cost of capital. When it comes to cost of debt, the first question I have in mind is whether it is a redeemable debt or an irredeemable debt. Whether it is redeemable or irredeemable. If it's irredeemable in nature, cost of debt is equal to interest after tax by net proceeds. Interest after tax by net proceeds. Interest is equal to face value into coupon rate. Interest is equal to face value into coupon rate. Interest after tax is interest into 1 minus tax rate. Net proceeds is, if it's a new issue, it's called issue price minus flotation cost, and if it's an existing issue, it's current market price. For net proceeds calculation, we will always try to see if there is a possibility of a new issue happening. The first preference for net proceeds is issue price minus flotation cost, because we have to calculate the current cost of capital. For current cost of capital, you will have to take issue price minus flotation cost. If that data is not there, you go with current market price. When it's redeemable in nature, then we do interest after tax plus average other cost by average funds employed. Interest after tax plus average other cost by average funds employed. Interest after tax is interest into 1 minus tax rate. Average other cost is redeemable value minus net proceeds by balance life. Redeemable value minus net proceeds by balance life. Redeemable value will be redemption at par if the problem is silent. If the problem is silent, assume redemption is at par, else you'll have to calculate based on the data given in the question. Net proceeds is, as I said, issue price minus flotation cost or current market price. Average funds employed is redeemable value plus net proceeds by 2. So interest after tax by net proceeds, which is your irredeemable debt, and this is interest into 1 minus tax. This is cost of redeemable debt, interest after tax plus average other cost by average funds employed. Some question will tell you to calculate cost of a redeemable debt using IRR method. That's a question specific requirement. If question tells you using IRR method, you need to find year and cash flow of that bond. Year 0, what is the outflow? Year 1 to 5, what is the inflow? From an investor point of view, or from a company point of view, exactly opposite. Year 0, what is the inflow? 1 to 5, you have to pay interest. At the end of the year 5, you have to pay some redemption value. So whatever is the cash flow, for that cash flow, I need an IRR. For that cash flow, I need a IRR. If you are able to get that IRR, for that you need one positive NPV, one negative NPV. All that you do, you get to the IRR, and that IRR is called as cost of redeemable debt. Calculate cash flows associated with the debt instrument. Discount at an initial guess rate. Calculate NPV. If NPV is positive, negative, you increase the rate, reduce the rate. All that is your normal way of calculating IRR. And finally, that IRR is called as cost of debt. This is whatever I have talked about is non-convertible debt. Some question will have an item called as convertible debt. What is convertible debt is, after 5 years or 10 years, instead of going for redemption, you can go for conversion into shares. You can go for conversion into equity share. That's an option which could be there, or it could be mandatory also. Mostly it's an optional thing which will be given in the question. Redeemable value, everything remains the same. Whatever I've told you till now, everything remains same formula. It can be through IRR method, it could be through approximation method. Everything remains same. The only change is redeemable value is equal to higher of the value which a person will get if he converts into shares. After 10 years, I'm going to convert, so I need to forecast after 10 years what will be the share value I will get. See, I can either get 100 rupees of principal back, or I can convert into 10 shares. Today I have to ascertain that 10 shares will be worth how much after 10 years. That's my assumption. If those 10 shares are going to be worth 80 rupees, redemption value is 80 or 100, whichever is higher. If those 10 shares are going to be worth 150 rupees, 150 or 100, whichever is higher. Everything else remains same. The formula will be the same thing. Redeemable value minus net proceeds by balance life. Or you do it in the IRR method. The question may even ask you to do in IRR method. Everything remains same. The only change is higher of debt redemption value or fair value of equity post conversion. higher of debt redemption value or fair value of equity post conversion. Then we have cost of irredeemable preference, cost of preference share. Cost of preference is same as cost of debt. Instead of using the word interest after tax, you will have to use the word preference dividend. So for irredeemable preference, the formula is preference dividend by net proceeds, or preference dividend plus average other costs by average funds employed. We will not have interest after tax, we will have preference dividend. This also can go through IRR method also. This can also be done through IRR method, where you will have to calculate the cash flows, discount one positive NPV, one negative NPV. Cost of equity is equal to D1 by P0 plus growth rate. D1 by P0 plus growth rate. This is also technically called as Gordon's model, or technically called as valuation of a growing perpetuity. This is a formula for growing perpetuity. So K is equal to D1 by P0 plus growth rate. This is the same formula if you have growth or you don't have growth. Same formula for both. If you have growth, you're going to add growth in the formula. If you don't have growth, you will make it 0. One area of confusion which will be there in most of the question is whether the given dividend is D0 or D1. That's purely an assumption based area. It cannot be something I can say consistently, because in a practical world, D0 means dividend which is going to be paid immediately. D1 means which is going to be paid in the next 4 or 5 months, or it is going to take a longer period of time. 2021 dividend can be called as D0 today, or 2021 dividend. So same 2021 dividend can be D0 or D1. For example, if you are in the month of, let's take example, you are in the month of February 2022. If you are in the month of Feb 2022 and dividend will be paid in the month of March, then that is called as D0. The same dividend is going to be paid in maybe June, July for the same year. That will be called as D1 in a practical scenario. Distant dividend and nearby dividend is the concept. Question may not be very clear, so you take your assumption and proceed. In the denominator, we may have minus F. Minus F is called flotation cost. If there are flotation costs, you will have to subtract them. So dividend divided by current market price minus flotation cost. Dividend by P0 minus F plus growth rate. You will have to add the growth rate. Growth rate has a formula called as IRR into retention ratio. IRR slash ROE into retention ratio. Realized yield approach is basically same as IRR approach. Realized yield is IRR approach. You are required to calculate the IRR of the investor, and that's called as the cost of equity from a company point of view. Capital asset pricing models, RF plus beta into RM minus RF. This is specifically used for companies which are not paying any dividend. There are companies which do not pay dividend. For them, this is the best formula to be used. Cost of retained earnings is same as cost of equity. Cost of retained earnings is same as cost of equity, except for two situations. One, retained earnings is part of equity, but I don't incur any flotation cost in retained earning. So when you apply the formula says D1 by P0 plus P0 minus F plus growth rate, or D1 by P0 plus, D1 by P0 minus F, or D1 by P0 minus F plus growth rate. This minus F should not be done for retained earnings. You should not subtract the flotation cost, because on the retained earnings we don't incur flotation cost. This is one scenario. Okay. Second scenario, when it comes to equity, the company will declare dividend. This will go to the shareholder. Shareholder has to pay income tax on this. So cost of equity will be higher than cost of retained earnings technically. Reason for that is, see, retained earnings is the money which is retained by the company. That also there is a cost attached to it. When it happens to equity, what happens is whatever money is declared, unfortunately the shareholder will not get the entire dividend. Government will take away 15%, 20%, 30% depending on your slab rate. So the government will take away some amount of that in the form of taxes. So cost of retained earnings will be lesser than cost of equity. Because of this personal tax. This information may be there in few question only, but wherever it is there, KR is equal to KE into 1 minus personal tax rate. Because on the retained earnings there are no taxes, minus if any flotation cost is there, because you don't incur flotation cost on the retained earnings. There's no flotation cost on the retained earnings. Once you are done with this individual components of capital, once you are done with cost of individual components of capital, After that we are required to calculate WACC, for which we have a format called as source, cost, weight and product. Source and cost will come from your whatever I have explained till now, calculation of individual components of capital, cost of debt, cost of equity, cost of preference, cost of term loan, whatever we have learned till now, you will have to apply all of that. Weight can be either book value or market value. Book value would be given in the question, market value you may have to calculate. You do product, which is second column into third column. Sum of product by sum of weights is WACC. Institute answer, the weights will add up to 1. That's not mandatory for you to do. In my format, I normally don't add the weights to 1. So I leave the weights as it is. Multiply and then we finally divide sum of product by sum of weights. Let's start now with few questions. Let's come to question 1. Let's come to question 1. A company's equity share is quoted in the market at 25 per share currently. It pays a dividend of 2 per share. Investor expects a growth rate of 6%. You are required to calculate, we'll go step by step, cost of equity capital. The first requirement is cost of equity capital. Question has given information on growth rate. Question has given information on dividend. The only headache is that to D0 or D1. That's a headache which will always be there. If time permits in exam, your wish, you can do both, assuming that to be D0 and assuming that to be D1. If time doesn't permit, then you will have to write a note saying that what are you doing. So now write K is equal to D1 by P0 minus F plus growth rate. D1 by P0 minus F plus growth rate. My assumption is this 2 is D1, okay? That's my assumption. You want to take an alternate assumption, that's up to you. I am taking that to be D1. 2 divided by 25 plus 0.06. 2 divided by 25 plus 0.06, 14%. 2 by 25 plus 0.06, it will become 14%. I took an assumption that this given dividend is D1, which is a distant dividend. The given dividend is D1 is my assumption. Clear? Any doubts on this? If the growth rate is 8%, what is the market price? So now they're saying growth rate was 6% in part 1 of the question. I want to change that growth rate. I want to change that growth rate. Same thing we are going to do. K is equal to D1 by P0 plus growth rate. If I interchange this, P0 is equal to D1 by K minus G. G goes this side. K minus G. So P0 is equal to D1 by cost of equity minus growth rate. Cost of equity minus growth rate. D1 is 2 rupees. Cost of equity is 14%. Growth rate is now 8%. Growth rate is 8%. So this is 33.33. 2 by 14 minus 8%. 2 by 14 minus 8%. 33.33. Clear? This is with an assumption that the 2 rupees per share is D1. If the company issues 10% debenture of face value of 100, realizes 96, which are redeemable after 12 years at a premium, what is the cost of debenture? Assume tax rate to be 50%. See, the tax rate is not an important information as far as cost of equity was concerned. But for debenture, it could be an important information. So the tax rate data is also there. We are required to calculate cost of debt. This is a redeemable debt. This is a redeemable debt. So redeemable debt, cost of debt is equal to interest after tax plus average other cost by average funds employed. Interest after tax plus average other cost by average funds employed. Interest after taxes, see, you need to calculate for only one debenture. There's no point of calculating for multiple debenture. Question has not said how many debentures. Some question will say 1 lakh debenture, 10 lakh debenture. It doesn't matter. We're going to do calculation for only one debenture. So interest after taxes, 10% debenture on a face value of 100. So 10 into 1 minus 50%. 10 into 1 minus 50%. Average other cost is redeemable value minus net proceeds. 112 minus 96. 112 minus 96. Redeemable value minus net proceeds. 112 minus 96. Divide by 12 years. Whole divide by 112 plus 96 by 2. Whole divide by 112 plus 96 by 2. Redeemable values 100 plus 12%. I'm not going to get the answer and all. This is the format. This is the calculation. Okay. 100 plus 12%, 112. Your net proceeds is 96 per debenture divided by 12 years life, and average is 112 plus 96 by 2. Any doubts on this? We're kind of done with this question. Let's come to question 2. Let's come to question 2. A company issues 10 lakh 12% debentures of 100 each. Debentures are redeemable after a period of 7 years. 35% tax rate. Calculate cost of debt if debentures are issued at par, 10% discount, 10% premium. If brokerage is paid at 2%, what will be the cost of debenture if issue is at par? Totally 4 situations are there. Totally 4 situations are there in the question. One is issue at par. Second is issue at 10% discount. Third is issue at 10% premium. And fourth is issue at par with a 2% brokerage. Issue at par with a 2% brokerage. One part is, the formula says interest plus average other cost by average funds employed. We may see a scenario where average other cost can be negative also. Average other cost can be negative, which basically mean when I'm issuing it at a higher price, and when I'm redeeming it at a lower price. So instead of average other cost, technically it's an average other income for the investor, average other income for the company, average other income for the company. So we may see a scenario where average other cost can be negative. I'm going to just use that formula now. First situation, interest is, I'm least bothered about this number. Least bother about this number. It's 100 rupee debenture, 12% is the interest rate. 12% is the interest rate. 12 into 65%, how much? 1 minus tax rate. 12 into 65%. 7.8 plus. 7.8 plus redeemable value minus net proceeds by life divided by redeemable value plus net proceeds by 2. There's no information on redemption. No information on redemption. Par. 100. Issues also at par. 100 minus 100 by 7. 100 plus 100 by 2. 7.8 plus 100 minus 100 by 7 and 100 plus 100 by 2. This is if you are issuing it at par. Second scenario, you are issuing it what? Discount of 100 minus 90 by 7. 100 plus 90 by 2. 100 minus 90 by 7 and 100 plus 90 by 2, because we have issued it at a 10% discount. We have issued this at a 10% discount. Third scenario, issues at what? Premium. 100 minus 110 by 7. Redeemable value will remain 100 only for all the scenario. Net proceeds for the first scenario is 100. Second scenario is 90. Third scenario is 110. This is a negative average other cost scenario. Negative average other cost, 100 plus 110 by 2. 100 plus 110 by 2. Last scenario, issues at par, but there's a flotation cost of how much? So 100 minus 98. Net proceeds is issue price minus flotation cost. Issue price minus flotation cost. 100 plus 98 by 2. Issue price minus flotation cost. Clear? 100 minus 98 by 7, whole divided by 100 plus 98 by 2. Any doubts on this? I am least bothered whether there are 10 lakh debentures, 1 lakh debenture, 1000 debenture. I am going to broadly do my calculation in this manner. Let's come to question 3. A company issued 14,000 12% redeemable preference share. That 14,000 number is of no use to me. 12% preference share of 100 at a premium of 5. Redeemable after 10 years at a premium of 10 flotation cost is 2, you are required to calculate cost of preference capital with dividend distribution tax of 20%. This is not something which can get tested now, but this question has this. Dividend distribution tax was there, something which companies were required to pay when they were paying dividends. Companies have to pay dividend. On top of that, they have to pay dividend distribution tax. So both were expenses of the company. When you pay interest, you get tax saving. But when you were paying dividend, companies were required to pay on top of the dividend a dividend distribution tax. So when you calculate dividend per share, to that dividend you will have to add dividend distribution tax. I want you to quickly calculate this. KP is equal to preference dividend. I want you to try average other cost by average funds employed. Preference dividend, average other cost by average funds employed. Preference dividend plus average other cost by average funds employed. The preference dividend will be 12 plus that 20% extra. This adjustment of dividend distribution tax may not come now onwards, but in this question we have that 12 plus extra 20%, which is 14.4. Average other cost is redeemable value minus net proceeds by balance life. What is the redeemable value? 110. Net proceeds 105 minus 2. 105 minus 2. Issue price minus flotation cost, which is 103. Life is 10 years. Whole divided by 110 plus 103 by 2. 110 plus 103 by 2. Any doubts on this? I'm least bothered whether there are 40,000 shares or 10,000 shares or 2,000 shares. We are just going to do calculation for 1. Any doubts on this? Okay, let's proceed to this. XYZ Limited is currently earning a profit after tax of 25 lakhs. Its shares are quoted in the market at 450. Company has 1 lakh shares outstanding, no debt. Same level of earnings will be maintained for future years also. 100% payout. Calculate cost of equity, and then they are changing the payout ratio. What will be the cost of equity? So 2 parts. One, they are asking original cost of equity, and then they are changing some ratio. They are asking us to calculate cost of equity. See, wherever there is dividend payout data there in the question, your cost of equity will be D1 by P0 minus F plus growth rate. D1 by P0 minus F plus growth rate. If that data is not there, then you may go through your capital asset pricing model, which is RF plus beta into RM minus RF. So cost of equity is equal to D1 by P0 minus F plus growth rate. D1 by P0 minus F plus growth rate. Question is saying company has a 100% payout policy. 100% payout means retention is 0. If retention is 0, growth will be 0%. The formula for growth rate is retention into IRR. Retention into IRR. Part 1 of the question, there is no growth. There is no growth in this question because the question says it has a 100% payout policy. It has a 100% payout policy. So if you have a 100% payout policy, growth is 0. And that's a better question because whenever growth is 0, I don't have a confusion of D1, D0. D1, D0 confusion will not be there because D1 is D0 plus the growth rate. So if growth itself is not there, that headache will not be there. So growth is 0. D1 is 25 lakh by 1 lakh. Entire profits will be paid out. Entire profits will be paid out. 25 lakh by 1 lakh. So 25 by 450 plus 0 is the cost of equity. 25 by 450 plus 0. Whatever answer comes, that's first part of the question. Any doubts on this? 25 by 450 plus 0.
Because we're not retaining anything, we are paying the entire profit.
Yeah, that's what the question says. Company has 100% payout policy. Last line. 100% payout policy. Second part says, I am going to have a payout of only 70%. I'm going to have a payout of only 70%. Last time I paid 25 rupees. Now I'm going to pay only 17 rupees 50 paise. I'm going to pay only 17 rupees 50 paise. Your wish whether you want to take it as D0, D1. An assumption may be needed. Your wish whether you want to take it as D0 or D1. Based on assumption, answer can undergo a change. I'm going to pay only 70%. Denominator is 450 minus 0. Growth rate is equal to IRR or ROE. Two names, IRR or ROE into retention ratio. 20% is the IRR. 20% is the IRR. Retention ratio is 70% payout. Retention is 30%. So growth is 6%. Growth is 6%. Growth is 6%. And based on that, you get to the answer. Growth is 6% and dividend is 17.5. Your wish whether you want to take it as D0 or D1. That is an area which needs assumption. That's an area which needs assumption. In the solution, I think 17.5 has been taken as next year dividend. That's the assumption taken there. Go through question 15. So question 5. Hello? Yep. Yep. Okay. Okay, let's understand this question. We are required to calculate required rate of return for an equity share. Required rate of return for an equity share is technically cost of equity. There is before the issue and after the issue. Before the issue means flotation cost will not come in the formula. Before the issue means flotation cost is not going to come in the formula. Or technically before the issue is like cost of retained earnings, because I cannot incur flotation cost if the issue has not happened. After the issue means flotation cost is going to come in the formula. So my calculation is K is equal to D1 by P naught plus growth rate. D1 by P naught plus growth rate. D1 is 20 rupees, proposes to pay 60% dividend in the current year end. Now is this end in the next 2 months or in the next 5 months or next 6 months? I don't know, depending on your assumption of D0 or D1. So this is taken as D1 is 12 rupees. D1 is 12 rupees. Price earning multiple, PIE ratio, this should have been P by E ratio. It should have been P by E ratio. P by E is price earning ratio. 6.25 is the price earning ratio, which means my market price is 6.25 times of the EPS. My price is 6.25 times of the EPS, which is 125. Stuck area is growth rate. Growth rate is something which is stuck as of now. Growth rate is stuck. Now listen. Formula for growth rate is ROE into retention ratio. Formula for growth rate is ROE into retention ratio. Retention I know. I am paying 60%. I am paying 60%. So retention is ROE. The formula is EPS by book value. ROE formula is EPS by book value. EPS on an overall basis is called earnings available to equity shareholder. EPS, when you multiply with the number of shares, is called earnings available to equity shareholder. Book value per share, if you multiply with the number of shares, is called as value of equity. So EPS is, how much is the EPS in the question? 20. I'm assuming market price and book price is same. This is an assumption, okay? Market price and book price is the same is my assumption. You change this assumption, answer will undergo a change because book value per share is not given in the question. So what is the ROE number? 20 by 125 into 100. 16. Growth rate is 6.4. Growth rate is 6.4. Now, this is one part of the solution. When you do the rework scenario, which is after the issue, the only thing you need to do is in this 125 you have to subtract flotation cost. In the 125 you have to subtract flotation cost. That subtraction has to be done. Let's come to question 6. Anova Limited is considering raising of funds of about 250 lakhs by two alternative methods. 14% institutional term loan, 13% non-convertible debenture. The term loan will attract no cost and can be ignored. Debentures will have to be issued at 2.5% discount. Cost of issue of 2% on face value. Advise the company as to the better option based on effective cost of capital. Assume a tax rate of 50%. Okay. Now, I need some 250 lakh rupees. I have two options. One is going for a term loan. Second is going for a debenture. Cost of term loan is 14% before tax. After tax is into whatever 1 minus tax rate. Your NCD non-convertible debenture before tax is 13%. After tax will ideally be 13 into 1 minus tax rate provided all this extra information was not there. This extra information on some face value, some coupon, some discount, all that has been given. So cost of term loan is 14 into 1 minus tax rate. 14 into 1 minus tax rate 7%. 14 into 1 minus tax rate 7%. When it comes to cost of debenture, either it can be a redeemable debenture or it can be a irredeemable debenture. If the question does not have any information on life, I cannot assume it to be redeemable, because for calculating a cost of redeemable debenture, I need the data on the life. You can assume redemption is at par, issue is at par, all those assumptions can be taken, but I cannot take an assumption on the life of the instrument. So this is an irredeemable because data on life is not there. Now the term loan will attract no other cost, so all that is done. Debentures will have to be issued at a discount of 2.5%, would involve a cost of issue of 2% on face value. I'm going to assume the face value of the debenture to be 100. You can take 10, 100,000, whatever you want to do. So the interest is 13 into 1 minus tax rate, divide by net proceeds. My face value is 100. Net proceeds is issue price. Issue price is 97.5 minus flotation cost of 2 rupees, 2% of face value. Net proceeds is issue price minus flotation cost. Issue price is 97.5. Flotation cost is 2 rupees of the face value. I am assuming face value to be 100. You can take any number to be the face value assumption. That doesn't really matter whether you take 10, 100. So this will give me a cost of 6.81. Obviously 6.81 is better than 7%. 6.81 is better. So I'll go ahead with this. Okay, go through 7. This has that approximation and IRR method. Go through this. Okay, also it's a convertible debenture. Convertible, approximation, IRR, all the three are there here. Okay, this is a question on convertible debenture. One, they want us to follow an approximation method, and second is an IRR method. Now, when it comes to the information, let's capture basic information first. I need some information like interest after tax, redeemable value, net proceeds. These are the items which I extensively use in my formula. Interest after tax, redeemable value, net proceeds, and life. The formula is whether it's a convertible debenture or the normal debenture, the formula remains the same, just that the word redeemable value will have two items to be calculated now. It was higher of two numbers. It was higher of two numbers. So my interest after tax here is, it has issued 20,000, irrelevant information, 10% debenture of 100 each, 10% debenture of 100 each. The tax rate is 25%. So interest after tax is 7 rupees 50 paise. Interest after tax is 7 rupees 50 paise. At maturity, the holders will have the option to convert debentures into equity shares of the company in the ratio of 1:5. It's an option, okay? It's an option. The current market price of equity share is 20, and historically this share has grown at the rate of 4%. Now listen. Price of share after 5 years. Price of share after 5 years. All this is my assumption at this point of time. Today the price is 20. It will grow at the rate of 4% for 5 years. It will grow at the rate of 4% for 5 years, it will become 24.33. You can just do plus 4% 5 times or into 1.04 5 times, you will get the price. Likely value of 5 shares. Likely value of 5 shares, which is, now it's my wish whether I want to get this 121 or I want to get 100 rupees of premium on 100 rupees of value on redemption. See, the redeemable value is 1. You redeem it at par or premium, whatever the question says. The question has not mentioned anything on the redemption at par or at premium. That is not mentioned in the question. So I am assuming that redemption will happen at par, which is 100 rupees, or you can convert it into 5 shares. You can convert it into 5 shares. If you convert into 5 shares, you will get a value of 121.65. So my redeemable value is 121.65. Redeemable value is 121.65. Net proceeds today is, they have not mentioned I think anything on issue price, flotation cost, nothing is mentioned. So today it would have been issued at par 100 rupees. Life is 5 years. Life is 5 years. You will use your normal formula and get to the answer, which is your cost of debt is equal to 7.5 plus 121.65 minus 100 by 5 whole divided by average. Can you tell me this answer? I want you to calculate and tell me the answer. Calculate and tell me the answer. How much? 10.7. Okay, whatever, just check the answer. 10 point. Okay. So this is the answer you get. Okay. Now sometimes in exam they may ask you to do IRR method also. They may ask you to do IRR method. Normally it's not asked, but the question says calculate the cost of convertible debenture. So we did this. We got it as 10.676%. We've got it as 10.676%. Next requirement is using internal rate of return method. The reason I wanted this answer is I have this 10.67 which I have calculated. For IRR I need an initial guess rate. This question not a problem. I can use 10 and 15. I can use 10 and 15 because that's below the table. So approximately one will be positive, one will be negative. Else my initial guess rate will be 11%. What is that? 11 is 10.67 you got. Closer number is 11%. So I'll start with that rate. I'll start with 11%, see whether I get positive NPV or negative NPV and increase or reduce the rate. Now for calculating IRR, listen. This also, there is another tricky part also there. Year, cash flow, PVF at 10%, DCF, PVF at 15%, and DCF. Somewhere I know the answer is going to be between 10 and 15, so it's a fairly simple thing. But many a times you will struggle to know what trade to start with. That is the difficulty of the IRR. Here the question has given those two numbers. So I've taken 10 and 15 here. Now you can put your cash flow from company point of view, or you can put your cash flow from investor point of view. Both will give the same answer finally. If you put from company point of view, company gets an inflow of 100 rupees on day 0. Company gets an inflow of 100 rupees on day 0. They have to pay 7 rupees 50 paise every year. They have to pay 7 rupees 50 paise every year, and in the end have to give free shares of 121.65. Have to give free shares of 121.65. You can calculate IRR for this. You can calculate IRR for this. Just give me a minute. See, the IRR, when I calculate at 10%, I've got a negative NPV of 3.97. I did at 10%, I got a negative NPV. The rule, when you would have gone through IRR analysis, the rule would have said if you get a positive NPV, you have to increase the rate. If you get a negative NPV, you have to reduce the rate. That's what the IRR approach would say. If you look at the cash flows which is written there, any normal problem we would have done IRR. If you have checked those questions, you will find that there will be an initial outflow, and every year there will be an inflow. There will be an initial outflow, and every year there will be an inflow. This is exact opposite. This is exact opposite. So here the rule is also exact opposite. If you get a negative NPV, you should increase the rate, and if you get a positive NPV, you should increase the rate. You don't want all this headache. Means I'll write the cash flow from an investor point of view. I am the investor, okay. I'm going to give 100 rupees today. I'm going to give 100 rupees today. Every year I will get 7.5, and in the end I'll get 7.5 and 121.65. So I've got a positive NPV. Now increase the rate, you get a negative NPV, and you get to the answer. Whatever way you are comfortable, one positive and one negative NPV is readed. Net the IRR answer is 10.98% would be the IRR answer. This is the exact answer. Approximate answer can be slightly different when you do it in, because the gap between the lower rate and the higher rate is very high, 10 and 15. Whether I use this as 100 and minus 7.5, or whether I use the positive negative or negative positive, the answer is going to be 10.98 only. Answer is going to be 10.98. It doesn't really matter what approach you are using. The answer here, this is the approximate answer. This is not the exact answer. 11.08 is still an approximate answer. The reason for this still being an approximate answer is, in this 11.08, the problem with this 11.08 answer is, we are technically using a gap which is very high. The rule says the gap between L1 and L2 should be as low as possible from an IRR point of view. So here the gap is slightly on the higher side, and that is why the accurate answer is not 11.08. Exact answer, if you want, it is 10.98. Exact answer is 10.98. Clear? Any doubts on this? Any doubts on this part? This is your IRR calculation or cost of debt. Up to you whether you want to write minus 100 as the day 1 figure or plus 100 as day 1 figure. That's up to you. You write minus 100 and then write the series of inflow, or write plus 100 and write a series of outflow. Both will give you the same answer in the end. The only thing is, if you write a positive and then series of negative item, if you get a positive NPV, you have to reduce the rate. If you get a negative NPV, you have to increase the rate. Let's come to question 8. Development Finance Corporation issued zero interest deep discount bond of face value 1,50,000, issued at a price of 3750, repayable after 25 years. Compute the cost of debt if there is no corporate tax. Now this is a deep discount or a zero interest bond, doesn't pay any interest. So there is zero interest payout by a zero interest bond. So my formula of cost of redeemable debt, cost of irredeemable debt, nothing helps there. Nothing helps there. So you are required to calculate IRR. You are required to calculate basically IRR of the bond. IRR of the bond. So year 0, 3750 outflow or inflow, your wish, okay? Whether you want to write from an investor point of view or from a company point of view. And year 25 inflow is 1,50,000. 3750 is an outflow or inflow today, and after 25 years you will get 1,50,000. Now what rate to start with is very, very tricky for a deep discount bond. It is very difficult to know what rate to start with. What you can do in calculator basically is, you will calculate for 25 years, you calculate a factor, you do a 10%, 12%, 13%, 14%, and then calculate the NPV in the calculator itself. If you are getting an NPV as 0, start that as the initial guess rate, closer to 0. If you are getting an NPV close, because I don't have any of the formula used, you will not get to the answer. The best thing is if they give you 2 tables below the question, it is good. Else, what you can do is, because it's only one cash flow, for 25 years, if I take 15%, the NPV is 806. The NPV is 806, and at 16%, the NPV is minus 80. You can start even at 10%. I don't see, because if you start at 10, then maybe 12, maybe 14, maybe 16. I don't know how many iteration you have to do, because this is one tricky area. Because none of the formula will work. There is a formula called as initial guess rate, which is 2/3 of ARR. Or if you use shortcut method and do this question, for shortcut method, your interest after tax is 0. If you do 1,50,000 minus 3750, you will get a very high answer. So it will not exactly work that way. So your shortcut method is not going to work in this question. For IRR, I don't have a choice, because that's why I have not tried explaining how I got this 15 and 16, because it's impossible to explain a logic for this 15 and 16. It's only a trial and error. In an Excel, I can keep doing so many trial and error and then get to the answer. From an exam point of view, you will have your challenges, so that you have to take care. Okay, now we are going to get into WACC question. We have discussed all the questions where individual cost of capital was to be done. Now our focus would shift to WACC. There's nothing different from WACC or the individual cost of capital. Whatever you are doing there is exactly what is going to be repeated. On top of this, you will have to use product weight, sum of product by sum of weights need to be done when you do WACC problem. Go through question 9. I want you to calculate cost of equity, cost of preference, cost of debt. Cost of equity, preference and debt. Part 1. I want you to quickly get me the cost of debt, cost of equity and cost of preference. That is critical part. The second part which I am going to do is just a formality. That's not the important part. So I'll do the WACC calculation, but what is critical is getting the right cost. Cost of equity is going to be 2 rupees by 20 plus 5%. I don't see a need for an assumption also. We'll pay next year a dividend of 2 rupees. So 2 by 20 plus 5%. I think cost of equity is 15%. Cost of equity is 15%. Cost of preference will be 11.5 as it is. Cost of preference will be 11.5 as it is. Cost of debentures will be 6.5. 10 into 1 minus tax rate. 10 into 1 minus tax rate. Question says compute WACC based on the existing capital structure. They have not mentioned whether they want us to follow book value weights or market value weights. If problem is silent, we do both. In exam, you can take even one assumption and proceed. So computation of WACC. What I am going to do now is more of calculator's job. Nothing much needs to be done at your end. Computation of WACC. This is purely calculator's job. Source, cost, weight, which will have two components, book value and market value, product, We'll have two sub-columns, book value and market value. Source, cost, weight, product, book value and market value. Source we have calculated, sorry, that's given in the question, equity, preference, debentures. Equity, preference and debentures. The important part is this is what you have done the calculation. Cost of equity was 15%, preference was 11.5 and debenture is 6.5. If you go wrong here, everything else will go incorrect. I don't want any errors at this stage. 15, 11.5 and 6.5. Book values are as the value given in the question, 40 lakh. 40 lakhs, 10 lakhs, 30 lakhs, 40, 10 and 30. The values as given in the question, 40 lakh, 10 lakh and 30 lakh. Market value is, I can calculate market value only for equity capital. I can calculate only for equity capital, others nothing is there. The market value of equity share is 20 rupees. Okay, I think that is also going to be the same. 2 lakh into 20 is going to be 40 lakh. So in this case, book value, market value, both approaches will give same answer, because 2 lakh into 20 is 40 lakh. So technically, I need not do two approaches in this question. Question anyway did not talk about two approaches. Question did not say about two approaches. The market value of equity is same as book value, which is a rare scenario, but the question has given the numbers that way. So product is second column into third column. Second into third column. Similarly, when you do market value, use market value numbers and sum of product and sum of weights. Sum of product and sum of weights. Book value as well as market value gives the same answer here, okay. Book value as well as market value is going to give the same answer. Exam, you just do one approach if the problem is silent. If the problem.
Market value is given as 32 lakhs.
Where is it 32 lakh?
2 lakhs into 16 rupees.
That is rework scenario. Original scenario. 2 lakh into 20. So WACC is equal to 9 lakh 10,000 sum of product by sum of weights into 100. How much is this? 9 lakh 10 by 80 lakhs. 11.375%. 11.375%. Any doubts on this? 11.375%. Okay. Next they say calculate the new WACC if I am going to raise an additional debt of 20 lakh by issuing 12% debenture. This will result in increase in equity dividend, growth rate will be unchanged, but the price will fall to 16. Now you need to take a call whether you want to follow book value approach or market value approach, because both approaches will give different answer now. Both approaches are going to give different answer because there is a change in the value of equity share. Whenever something like this happens, first job is to calculate cost of individual components of capital again. Now there are 4 forms of capital. Earlier there were only 3 forms of capital. Cost of equity is going to undergo a change. Cost of equity is going to undergo a change, which will be 2.4 by 16 plus 5%. How much is this? 2.4 by 16 plus 5%. How much? 20%. Cost of equity is 20%. 2.4 by 16 will be 15% plus 5%, 20%. Preference share, nothing changes. 10% debenture, nothing changes. 10% debenture, nothing changes. The question can even change that also. Okay, the question can even change those costs also. 12% debenture is 12 into 1 minus 35%. How much is the cost of 12% debenture? 7.8. And I'm going to repeat this calculation now. Repeat this calculation now. Cost of equity is 20, preference remains same. I have 12% debenture and I have 10% debenture. There are 2 debentures. 10% debenture, yep.
Sir, is this process of raising additional capital on marginal cost of capital? Is this WMCC?
No, this is not exactly WMCC. This is not WMCC. They'll ask for a WMCC schedule. Okay, 12%, 10%. 10% debt was already there in the company. This is 12% debt is 12 into 65%. 7.8. He has raised 20 lakh. Market value of equity is now 32 lakh. Market value of equity is, see, I do have the flexibility to both the approaches. It doesn't take me much time. In exam scenario, you follow one of the approach, your wish. The approach is up to you. Sum of product by sum of weights will give me the answer. Sum of product by sum of weights will give me the answer. 11 lakh 6,000 by 92 lakh or 12 lakh 66,000 by 1 crore. Both the approaches will give a different answer now. Both the approaches will give a different answer. Your book value approach will be different answer and market value approach will be different answer. So you will have to take care of that. Okay. Here I have followed both the approaches. I think solution will have market value approach mostly. Okay, both have been presented. Both have been presented. In an exam scenario, I don't see a need for both. Your wish, you can do one of the approaches by writing a note. Clear? Any doubts on this? Go through question 10. Calculate cost of individual components of capital. Individual is 5 components are there totally. Equity, capital, preference, retained earning, debenture, term loan. For all the 5, I want you to calculate individual components of capital. Calculate the cost of individual components of capital. For all the 5, please take that time. I want you to do it. Cost of individual components of capital. The WACC part I'll quickly show it in the system. That's not going to take much time. Important part is cost of individual components of capital. WACC calculation can take good amount of time, but there's no major thing to be learnt there. You don't have any major concept to be learnt there. Cost of equity is 3.6 by 40 plus 7%. 3.6 by 40 plus 7%, which is 16%. 3.6 by 40 plus 7%. Cost of preferences, there is a data given about life which is redeemable after 10 years. Listen, net proceeds can be issue price minus flotation cost. That's your first preference always, okay? Net proceeds, issue price minus flotation cost is always the first preference. Some question will give you current market price, but they'll say the company is making a new issue. Then you have to take issue price minus flotation cost. Because if a question is asking WACC, obviously the issue is already made because it is there in the balance sheet, issue is already made. But always the first preference is issue price minus flotation cost. This question I don't have anything on that. So my net proceeds is going to be current market price of 75. Net proceeds is going to be current market price of 75. This is not a choice which I would want to take. I would want to take it as issue price minus flotation cost. You will see, I think 1 or 2 problems where both will be there, and we'll take issue price minus flotation. We'll not consider current market price for your working note 1. Working note 1 is individual components. For working note 2, which is WACC calculation, you will consider market weights because the market value would be there. That will be used for market weights calculation. But in this question, it is going to be used for individual components as well as market weights calculation. So cost of preference will be 11 plus 100 minus 75 by 10 whole divided by 100 plus 75 by 2. 100 minus 75 by 10 whole divided by 100 plus 75 by 2. What's the number? 11 plus 100 minus 75 by 2, 100 plus 75 by 2. 13.75 divided by 87.5 into 100. How much? 15.4? Okay, 43%. Retained earnings will be same as cost of equity, no other information. Unless there are information on flotation cost or there are information on personal taxes, I copy the same rate. Retained earnings will be same as cost of equity. Debenture, again, I have extra information. Redeemable after 6 years, selling at 80 per debenture. Net proceeds will be equal to current market price. Net proceeds is going to be equal to current market price. First preference is issue price minus flotation cost. Unfortunately, that data is not there. So it is going to be, tax rate is 40%. So 8.1, 100 minus 80 by 6, 100 plus 80 by 2. 100 minus 80 by 6 plus 100 plus 80 by 2. 8.1 is the interest on debenture. 13.5 into 1 minus tax rate. How much is the cost of debenture? 12.70. Okay. Term loan is simple. 15% term loan into 1 minus tax rate. Term loan, whatever is the interest rate, into 1 minus tax rate. Now, this is one part of the calculation. They want us to calculate WACC. I don't want you to do anything here, okay? Let's not spend time on this. I have equity, preference, retained earnings, debenture and term loan. Equity, preference, retained earnings, debenture and term loan. Equity is, we had calculated cost to be 16%, retained earnings was 16, preference was 15.43, debenture was 12.7 and term loan is 9%. The book values given in the question: 15 crore, 1 crore, 20, 10, 12.5. Term loan book value and market value will be same. So I've copied the same, 12.5. When it comes to equity capital, the book value is 10 rupees. The face value is 10 rupees. So there are 1.5 crore shares. What is the market price per share? 40, which means basically 60 crores is the value. Now, in a practical world, you do not have a separate value for retained earnings, because when you buy a share of TCS, you become an owner of TCS. And when you are an owner, you are owner of the shares as well as the reserves and surplus, because you are the owner of the share as well as reserves and surplus. So this 60 crores, which I calculate, 60 crores is 15 crore divided by 1.5 crore share into 40. 60 crore will be split in the ratio of 15:20. 60 crore will have to be split in the ratio of 15:20. 15 will come here and 20 will come here. Split in the ratio of 15:20, because I do not have a separate value for retained earnings. We do not have a separate. In a practical world, nobody does this. They directly write 60 crores and leave it. They don't consider retained earnings in the calculation. When it comes to preference, 1 crore by 100, 1 crore by 100 into 75 rupees. 1 crore by 100 will give you the number of shares, into 75 will give you the market value, which is 0.75. Similarly, 10 crore by 100 into 80. 10 crore by 100 into 80. Net by WACC number are sum of product by sum of weights. Broadly, the answer is 13.93 and 14.59. I'm not bothered about this calculation, okay? 13.93 and 14.59. Somewhere this can become slightly challenging for few people, so that alone you be careful. Equity is 60 crores in the ratio of 15:20. Preference share 1 crore divided by 100 into 75. Debenture 10 crore divided by 100 into 80, because the market price is given in the question. Next comes capital schedule, marginal cost of capital schedule. This is technically called as WMCC, marginal cost of capital schedule, technically called as WMCC. Now the company plans to raise 10 crore. So for a WMCC, we first put a chart, amount to be raised. 10 crore. It will be broadly split into 2 or 3 categories. Amount to be raised is 10 crore. The question says, define the weighted marginal cost of capital schedule if it wants to raise 10 crores. Amount will be raised as equity and debt in equal proportion. So, equity 5 crore, debt 5 crore. In the equity, the company expects that it will retain how much? 1.5 crore. So, this equity split as retain earnings of 1.5 crore, external equity of 3.5 crore, 1.5 crore of retained earnings and external equity of 3.5 crores. In the borrowing, they are saying first 2.5 crores is 15% and next 2.5 crores is 16%, 15% and 16%, two rates they have given. So, this is split as 15%, 2.5, 16%, 2.5. Now, you can forget whatever is the existing capital structure, just ignore that for the time being. Basically, this is a new company. This is a new company. It has 4 capital. One is retained earnings, second is external equity, third is a debt, fourth is another debt, which is one is 15%, another is 16%. For all this 4, you will have to first calculate the cost. You will have to calculate the cost, source, cost, weight, product, and calculate WACC. The WACC is technically called as WMCC. That WACC is technically called as weighted marginal cost of capital. Weighted marginal cost of capital. For example, retained earnings will continue to be 16% because that is retained by the company. The cost of retained earnings was 16%. For the external equity, unfortunately, the price is different now. Price will be at 32. So, this is going to be 3.6 by 32 plus, I think the growth rate was 7%. How much is this? 3.6 by 32 plus 7%. 18.25. I'm not bothered about the existing equity and all. This is a fresh equity which the company is going to issue. That will be issued at 18.25%. Retained earnings is already there in the company, which is going to be 16%. 15 into 1 minus tax rate 9%. 16 into 1 minus tax rate 9.6%. 9% and 9.6%, 15 into 1 minus tax rate, 16 into 1 minus tax rate. So, I have cost, I have weight, source, cost, weight, product, sum of product by sum of weights will give you the WMCC answer. That has no linkage with the existing answer. If you see here, this would be a separate calculation. Cost, weight, sum of product by sum of weights. Cost, weight, sum of product by sum of weights. The answer is 13.44. It has no linkage to the existing answer. It has no linkage to the existing answer. This is altogether like an independent problem. This is an independent problem where the cost turns out to be 13.44. And this is called as WMCC schedule. This is technically called as WMCC schedule, weighted marginal cost of capital schedule. Go through 11. That's what we did know, that IRR is YTM. Anyway, there are questions. IRR is YTM basically. Anyway, I think 2 or 3 questions are there on that aspect. Go through 11. Okay, coming to this question, they have given a capital structure where there is a heading which says which is considered to optimum. Optimum means any additional money if I want, I will bring that money only in this combination. What is the combination? The overall total I think is 24 lakh. Combination is 15%, 5% and 80%. 15, 5 and 80 is the combination I am going to follow if I am going to raise any fresh money. The fresh money would be raised in the combination of 15, 5 and 80. The dividend of the next year is going to be 50% of 2004 EPS. This is the growth rate in EPS. 1 becoming 1.12 is 12%. After that also it will be steady 12%. If you check the rate, it will be a growth rate of 12%. Every year there is a growth rate of 12%. So the growth rate in this question is 12%. Calculate after tax cost of new debt, new preference, ordinary equity, assuming new equity comes from retained earning. Question talks about 13% debenture and 11% preference share capital. Okay, and here I am looking at the company can issue 14% new debenture. The new preference share can be sold at a net price of 9.8, paying a dividend of 1.20 per share. The company's marginal tax rate is 50%. So there is currently the company is paying some 13 and 11%, but the new issues are going to happen at 14% and dividend is going to be 1 rupee 20 paise, 1 rupee 20 paise on a base of 10 rupees if I take, it's 12%. So the dividend rate are going to be different. Now listen, whatever be the scenario, whatever be the existing interest, I'm least bothered about it. If I'm asked to calculate a cost of debt, I should look at the latest information. Latest information is what can happen if the company issues today. Whether they are issuing or not issuing it, I'm not bothered about. If they go ahead and issue today, what will happen? So they are saying if you issue today, you'll be able to issue 14% debenture. You'll be able to issue 14% debenture. You'll be able to issue preference share with a dividend of 1.2. Let's do cost of debt is equal to interest after tax by net proceeds. Interest after tax by net proceeds. Interest is 14 into 1 minus tax rate, 14%. 14 into 1 minus tax rate. 14 into 1 minus tax rate. Interest is 14 into 1 minus tax rate. Net proceeds 2 option, okay. Sorry, net proceeds 1 option only, issue price minus flotation cost. The only thing is the company's debentures are currently selling at 98 they've mentioned. If you want, you can take the issue price to be 98 if you want. I would prefer it to be taken as 100, but if you want, you can even take it as 98. For preference, it's very clear, but for debenture, it's my wish whether I want to take 98. Because for preference, they are saying you can sell the preference at 9.8. That is very clear. That is very clear that 9.8 is what you will realize if you issue preference share today. I will take it as 98. What is the cost of debt? 14 into 1 minus 0.5 divided by 98. How much is the cost of debt? 7.14. Cost of preference is 1.20 by 9.8. Preference dividend by net proceeds. Preference dividend by net proceeds. How much is that? 12.24. 12.24. Cost of equity is equal to D1 by P0 plus growth rate. The dividend of the next year is 50% of this EPS. Somewhere the question had mentioned. The dividend is expected to be 50% of 2004 earnings per share. So 2.773 into 50%. 2.773 into 50%. What is the price today? 27.75 and growth rate is 12%. Calculate the cost of equity. Growth rate is 12%. Calculate cost of equity. How much? 16 point? Okay, it should be 17% then. Rounding off issue. 17% is the cost of equity. 17% is the cost of equity. Now listen. Question says calculate the after tax cost of new debt, new preference, ordinary equity assuming the new equity comes from retained earnings. I don't want to know that whether it comes from retained earnings or not, because as of now cost of equity, cost of retained earnings, everything is same, because there's no information on personal taxes or any flotation cost, nothing is given in the question. So we are done with part 1. The second thing is saying marginal cost of capital. They have not used the word weighted average cost of capital, they have used the word marginal cost of capital, doesn't matter. WACC or WMCC same in this question, because the current capital structure is considered to be optimum. So if you want to raise any fresh money, that will be in the combination of 15, 5 and 80. That will be in the combination of 15, 5 and 80. So WMCC source cost weight product, source cost weight product, we have preference, debt, preference, retained earnings. Somewhere the question has said that your equity is going to come from retained earnings. It doesn't matter whether I use the word retained earnings or I use the word equity as of now. As of now, debt had a cost of 7 point how much? 12.24 and retained earnings was 17%. Assumption is I am going to raise some 100 rupees, okay? I am just assuming 100 rupees to be raised. The combination is already decided, 15, 5 and 80. So 15 rupees, 5 rupees and 80 rupees. WMCC or WACC is 15.28%. WMCC or WACC is 15.28%. Now, next part of the question says, how much can be spent for capital investment before new ordinary share must be sold, assuming that retained earnings available for next year investment are 50% of 2004 earnings. Now, what the company wants to know is how much investment can I do with the retained earnings. See, any investment I do, 80 rupees out of 100 has to come from equity. 80 rupees out of 100 has to come from equity, and equity will also have some limitation. You cannot keep adding equity and say that retained earnings also has a limitation. It's not that I have unlimited retained earnings. So if you want to do 1 lakh of investment, maybe you will have adequate retained earnings. 1 crore of investment may not be, I don't know, I'll have to do that calculation. That is, how much investment can I do with the retained earnings? Now the question says, we have 2 lakh shares, profit is 2 lakh into 2.773, profit is 2 lakh into 2.773, that is earnings per share into the number of shares. So profit after taxes 2 lakh into 2.773, how much is this? And retained earnings is only half of this. Retained earnings is only half of this, which is going to be 2,77,300. Now the problem for me is I can do any amount of investment, I don't have a problem, but retained earnings can support only till some extent. The issue with us is retained earnings has to be equal to 80% of investment. Retained earnings has to be equal to 80% of investment. If investment goes beyond that number, retained earnings will not support it. Retained earnings will not support it. The rule is here. Initially we had written 15, 5 and 80. So whatever, if you are doing 100 rupees of investment 100, retained earnings is 80% of 100. Retained earnings is 80% of 100. So what this can support is 277,300 is equal to 80% of investment. Investment can be 277,300 divided by 80%. How much is this? 3 lakh 46,625. I cannot do any investment beyond this. I cannot do any investment beyond this, because investment beyond this will not be supported by retained earnings. Investment beyond this will not be supported by retained earnings. If you want to go beyond this, which is part 4 of the question, you will have to issue shares at 20 rupees. You will have to issue shares at 20 rupees. So when you are issuing shares at 20 rupees, what will happen is your cost of equity will change. And then they are saying, what is the cost of capital if you want to go beyond that 3,46,625. If you want to go beyond 3,46,625, possible. If you are going beyond that, extra cost is to be incurred. Can you tell me what will be the cost of capital if price is 20? Calculate cost of equity and tell me. Cost of equity if price is 20. Price is 20.
So you're telling out of 3,46,625, we can raise only 2,77,300 from the retained earnings.
Yeah, balance will come from debt and preferential. What is the cost of equity when the price is 20? 2.773 it was something into 50% by 20 plus growth of 12%. How much is the cost of equity now? 18 point. Okay, so the problem for me now is same table. It will not be equity retained earnings. It will be now this 18.93. And cost will go up to 16.83. From 15.28, it will go up to 16.83 if you want to go beyond that limit. So it's always better if I can use retained earnings for my expansion purpose, because that has a lower cost. Okay, here I think the answer has assumed issue price at par. Okay, issue price is taken as 100. I had taken it as 98. That's an assumption. You can even take it as 100 itself. So 15.26 and 16.80 is the answer here. 15.26 and 16.80. Okay, let's continue with this now. I think we have just few more questions to discuss. Maybe another 40 minutes kind of a discussion and we should be done for today. Let's come to question 12. You are required to compute WACC of Ganpati Limited considering of given data. Using book value weights as well as market value weights, you will understand the importance of the point which I was saying earlier. Capital structure is as under, market prices are as under. Additional information: 100 per debenture redeemable at par, 10% coupon rate, 4% flotation cost, 10-year maturity. 100 per preferential redeemable at par, 5% coupon, 2% flotation, 10-year maturity. Equity share, firm has a practice of paying all earnings in the form of dividend. Corporate tax rate. So some data is there in the question. Now, I am required to calculate a WACC. For that, the first step is calculating cost of individual components of capital. When you do cost of individual components of capital, don't look at this information. This will unnecessarily try to complicate things for you. This information is not going to help me in calculating cost of individual components of capital. When I do cost of individual components of capital, my first preference will be issue price minus flotation cost. That is there in this question. This question is talking about some flotation cost, some coupon rate, some issues being made. If this data was not there, then you could have taken this as net proceeds. So there is information in the question to calculate net proceeds, which is issue price minus flotation cost. If that data is not there, my net proceeds is equal to current market price. Then what is the use of this data? This data will be useful to calculate market value, because you are required to do book value as well as market value approach. Both have been asked in WACC. Book value weights as well as market value weights have been asked. So if I look at this, cost of debenture is equal to 100 per debenture redeemable at par, 10% coupon rate, 4% flotation cost, 10-year maturity. So 5 rupees interest after tax, 100 is the redeemable value, 96 is the net proceeds. Issue price, assumption is issued at par. Flotation cost of 4 divided by 10 years by 100 plus 96 by 2. 100 plus 96 by 2. This will give me the cost of debt. This will give me the cost of debenture. How much is the cost of debenture? How much is the cost of debenture? 5.15. If you use this 105, no, your net proceeds will be altogether different. If you use this 105, the net proceeds will altogether be different. I would have used 105 as net proceeds if that below information was missing in the question. The below information was missing in the question, which said 100 per debenture ready. If nothing is mentioned about new issue, I will have to take existing issue and proceed ahead. Wherever there is data for a new issue, my first preference will be new issue information, which is issue price minus flotation cost. Cost of preference is 5 rupees, 100 minus 98. 100 per preference share, redeemable at par, 5% coupon rate, 2% flotation cost, 10-year maturity. 100 minus 98 by 10 plus 100 plus 98 by 2. 100 plus 98 by 2, how much is this? 5.25%. And last is cost of equity, which is 4 rupees flotation cost, market price of 24. I will have to give preference to a new issue being made. So the dividend is 1 rupee divided by 24 minus 4 plus 5% of growth rate. Plus 5% of growth rate, how much is this? 1 by 24 minus 4 plus 5% is, I think, no. 10%, 5% plus 5%. See, if you are getting confused with percentage, then write 0.05 plus 0.05, because 5% plus 5% is not 5.5, either write it as 0.05 plus 0.05, because somewhere some students do make that mistake. So write it in decimals and then finally convert into percentage. I am not getting into the WACC part of it, which is just a multiplication job. This was the critical part. You have your book value weights, you have your market value weights, you have your market value weights, and then sum of product by sum of weights. I have not used the market value information for my step 1, and which is what we don't do for most of the question. I don't use that data for most of the question. Let's come to question 13. Navya Corporation has a capital structure of 40% debt, 60% equity. Company is presently considering several proposals costing less than 20 lakh. Corporation always raises the required funds without disturbing the debt equity ratio. Project costs up to 2 lakh, above 2 lakh and up to 5 lakh, above 5 lakh and up to 10 lakh, above 10 lakh and up to 20 lakh. Assume the tax rate. Cost of capital of 2 projects, X and Y, whose fund requirements are 6.5 lakhs and 14 lakhs respectively. If project is expected to give a return of 10%, determine under what condition it would be acceptable. Go through the question. Quickly go through this. Okay, now my WACC can also change based on the amount of capital I am raising. If I ask somebody a 2 lakh loan, he may give me at a lower rate of interest. But if I ask for a 20 lakh loan, he may increase the rate of interest. The reason is simple. 2 lakh loan, I have the ability to repay. 20 lakh loan, maybe he doubts my ability to repay, because my income has to go up significantly if I have to repay a higher amount of loan. So if the amount goes up, we may see this interest rates going up, which is what is happening. 10 becoming 11, 11 becoming 12, 12 becoming 13. I have a project which is 6.5 lakh. 6.5 lakh means this is the cost. 12% for debt, 14% for equity. Our debt equity mix is 40:60. So for a project which is 6.5 lakh, the cost of capital is 12% into 40 plus 14% into 60, 40-60 mix. Another thing you have to take is this before tax or after tax? That's an assumption. That's an assumption. I will take that to be before tax. I'll take that to be before tax. If you take that to be before tax, you'll have to do 12 into 1 minus tax rate. See, instead of doing source, cost, weight, product in a detailed format, cost of debt is 12 into 1 minus tax rate 5%. Weight of debt is 40%. cost of equity is 14%, weight of equity is 60%. 5 into 40% plus 14 into 60% is the cost of capital if you are doing a project worth 6.5 lakh. If you are doing a project worth 6.5 lakh, 5% into 40 plus 14% into 60. If you are doing a project worth 14 lakhs, if you are doing a project worth 14 lakh, cost of debt is 13 into 1 minus tax rate, cost of equity is 14.5. 10.8% and 11.3%. 10.8 and 11.3 are the two cost of capital if you are planning to do a project worth 6.5 lakh and 14 lakh. As you increase the quantum of the project, the cost of capital goes up. The reason for that is people believe it is more riskier. Now the question says the company can earn a return of only how much? 10%. I will accept a project if the cost of capital is also lesser than 10%. The cost of capital has to be lesser than 10%. If you can earn a return of 10%, I can do the project if the cost of capital is lesser than 10%. Simple logic. Cost of capital should also be lesser than 10% because you are able to earn only 10%. So cost of capital, if it is lesser than 10%, I go ahead with such project. For that, you may have to do a weighted average calculation of this as well as this and see which of the scenario the cost of capital is lesser than 10%. If I don't think so, I can do a project of 10.8, 11.3. These two projects I don't think so I can do because these cost is more than 10%. If your cost is lesser than 10%, I think which is 2 lakh worth of a project and 2 to 5 lakh worth of a project, these two projects I can take it up. Because the cost of capital is lesser than 10%. 14 is something you can manage it. Okay, go through 15. I think this has come so many times in exam as well. Frequently tested area, RTP, MTP exams. Nothing much is there in the question, but because of it being tested so many times, okay, this is a question on WMCC, weighted marginal cost of capital, some fresh money the company plans to raise. It wants to raise an additional capital of 10 lakh. It has 3 lakh in the form of retained earnings. Following are the further data. Debt equity mix is 40-60. In that, up to 1 lakh 80 has a different tax rate. Above 1 lakh 80 has a different tax rate. First, they want us to find out what is the pattern for raising the additional finance, what is the post-tax cost of debt, what is cost of retained earnings, cost of equity, and finally cost of capital, which is technically weighted marginal cost of capital. Now, pattern of raising additional finance, I need 10 lakh. We need 10 lakhs. We have done this in one of the earlier question. What is the broad breakup? Debt how much, equity how much? Debt is 4 lakhs. Equity is 6 lakhs. In the debt side, I have further breakup. There are two types of borrowing. One is 10% debt, which is 1 lakh 80,000, and there's another 16% debt, which is 2 lakh 20. 10% debt 1 lakh 80, and 16% debt is 2 lakh 20. And this is retained earnings, external equity, retained earnings and external equity. Retained earnings is somewhere the first line of the question mentioned. How much retained earnings is there? 3 lakhs. External equity is 3 lakh. This is one part of the question. The second part of the question, what is the average post-tax cost? There are two costs. They want an average of that. Average post-tax, weighted average. Technically it is weighted average. Now listen, cost of debt is 5% and 8%. Why 5%? 50% is the tax rate. There's a tax rate of 50%. So 5% and 8% is the cost of debt. I don't need one number. I don't need two numbers. I need only one number. Average cost they wanted. What is the post-tax average cost of additional debt? What we have understood is we are going to take this 1,80,000 and this is 2,20,000. 1,80,000 is 5% and 2,20,000 is 8%. So average cost is 5 into 1,80,000, 8 into 2,20,000 whole divided by 4 lakhs. This is weighted average. 5 into 1,80,000 and 8 into 2,20,000 whole divided by 4 lakhs. Whole, how much? 6 point? No, it will not be 6. It's a percentage, no? Okay, 6.65%. Okay, 6.65%. 5 into 1,80,000 plus 8 into 2,20,000 divided by 4 lakh. Divided by 4 lakhs. Cost of retained earnings and cost of equity. There's no data on flotation cost in the question. There's no data on personal tax. Both are going to be same. Which is cost of equity is equal to 2 rupees. Dividend payout of 2. Current market price is 44. I'm adding 10% on top of this. I'm assuming this to be D0, okay? I'm assuming this to be D0. Your wish, you want to take it as D1, I don't have a problem. I'm taking it to be D0, 2 plus 10% by 44 plus 10%. 15% is the cost of equity. 15% is the cost of equity as well as cost of retained earnings. Both are same. Cost of equity as well as cost of retained earnings, both will turn out to be 15%. And then finally we put it in the format. Debt is at 6.65. Equity is at 15. Retained earnings is also at 15. This I think we had 4 lakhs, 3 lakhs, 3 lakhs. So I think this will be 11.66%. 11.66%. 1,16,600. Any doubts on this? We have taken debt. You can write as two separate line item also. 5% debt and 8% debt. We have taken it together and made it as 6.65. Because that was one of the specific requirement of the question, average cost of additional debt. Okay, let's come to question 16. It is similar to one of the question we did earlier, but there's only one change I think there. Compute WACC by using market value weights, debenture, preference share, equity share, market price of these securities, additional information, 100 per debenture, redeemable at par, 10% coupon rate, 2% flotation cost, 10-year maturity, all that is fine. What question said is, you are required to use YTM method to calculate cost of debenture and preference share. YTM method is your IRR method. We are required to calculate YTM method to do this calculation. Now, when we did that previous question, if you remember what we had done, we used to calculate in that shortcut method. So I use the shortcut method and I'll get an answer. I'll use the shortcut method and get the answer. We had assumed this is an assumption based solution, okay? If you remember this question, this is the question I was talking about. In this question, we had taken issue price to be 100 and flotation cost was 4%, and we did that calculation, whatever we had to do. We had taken all the issues to happen at par. One of the problem I had said I'll take the issue price to be 98, ICA answer was at 100. That's an assumption based answer. I think this question, they have assumed, okay, it's not that I'm using, this information will mostly not be used for calculating cost of individual components of capital. The only thing is they have assumed issue price to be equal to this number. They've assumed the issue price to be equal to this number. That's an assumption based solution. I cannot tell you exactly when to do this, when not to do this, because I have a exactly same question sometime back we had done where the issue price was taken as 100. Here the issue price in ICA solution is taken as current market price minus flotation cost. Basically, the issue price is taken as current market price. Net proceeds is equal to issue price minus flotation cost only. It is not net proceeds is equal to current market price. Net proceeds always the first preference is given to issue price minus flotation cost. The only thing which is done here is you have assumed this to be issue price minus flotation cost. You have assumed this to be the issue price. This is an assumption. This is an assumption based solution. The assumption is issue price is equal to current market price. The assumption is issue price is equal to current market price. Let me do this because one of you have told me to do a YTM solution. So let's do this quickly. Let's first take the basic information. Interest is, in this question, the interest is 100 per debenture, redeemable at par, 10% coupon rate, the tax rate is 30%. So interest is 7 rupees after tax. Then you have interest after tax, redeemable value. Redeemable value is 100. Redeemable value is 100. Net proceeds is issue price minus flotation cost. The only assumption I am taking at this stage is my issue price is assumed as equal to current market price. I did take that assumption in one of the question where the solution was different. 115 minus 2%. Can you tell me how much is this? 115 minus 2%. Life is 10 year. I want you to do the shortcut method and tell me the answer. First do the shortcut method in your calculator. Shortcut method is interest after tax plus average other cost by average funds employed. Do that and tell me the answer. Shortcut method. How much? Whatever. So you have to do that calculation. You get exactly the same. Well, even if you make a mistake at this stage, I will not be bothered. It won't be 7 point. It will be lesser because your net proceeds, average other cost is negative in this case. 5.38. Okay, if you have got 5.38, I need an IRR calculation. I'll take the starting rate to be 5%. I'll take the starting rate to be 5% because I need an initial guess rate to start with IRR calculation. So, for doing IRR calculation, year cash flow PVF at 5%, DCF, PVF at 5% and DCF, year 0, 1 to 10 years is an annuity, and at the end of 10th year you will get back the principal. Year 0, 1 to 10 and year 10. Year 0, 1 to 10 and year 10. Year 0, I am going to write minus 112.70. Minus 112.70. I can write plus 112 also. The company is going to receive this amount, but I'll write it as minus 112 so that I get a positive NPV, I increase the rate, I get a negative NPV, I reduce the rate. Every year you will get 7 rupees, and at the end of 7th year you will get 100 rupees. At the end of 7th year you will get 100 rupees. This now needs to be discounted at 5% now. $7.722, 0.614, and this can give me a positive NPV as well it can give me a negative NPV. Anything can it turn out to be. I've done 5%, I get a positive NPV of 2.754. I can increase it to 6, I can increase it to 7 also. If I increase it to 7, high probability I'll get a negative NPV. If I increase to 6, maybe again I may get a positive NPV. So I'll increase it to 7. PVF at 7% and DCF. I'll not get into IRR calculation and all. That is something we maybe discuss it once I go to your investment decision chapter. One positive, one negative, somewhere in between your YTM will be there. Yield to maturity. YTM is basically yield to maturity. Technically calculation as per IRR method. Technically calculation as per IRR method. I think the final answer will be more or less closer to your initial answer. You got an initial answer of 5.7 some percentage. I think the final answer is, we did 5%, 7%. The final answer is 5.36. The final answer is 5.36, which is almost same as the initial answer. You had done an initial answer. That's why I said do that initial answer in the calculator and then start doing it. Now the only difference is this question and the earlier question is here I've assumed issue price to be equal to current market price. Is there a logic for that? I cannot explain a logic, because that question and this question, the words are exactly same. The words are exactly same. That question we said issue price is equal to 100 rupees. This question we have said issue price is equal to current market price. The same thing you will continue for preference also, okay, which is current market price minus, you will get the answer under shortcut method and then follow it up under the IRR method. Clear? Any doubts on this? I'm not discussing beyond this because everything else is same. Everything else is same. Just that the only difference here is, one, you have to do YTM approach. Second, they've assumed issue price to be equal to current market price. They've assumed issue price to be equal to current market price. Both question exact same wordings. There's no difference between the wording of that question and this question. But one place we took it as current market price. One place we have taken it to be the face par value. That's purely an assumption. Okay, come to 17. I'll focus more on calculating cost of individual components. Come to 17. Go through this. I think one tricky part is going to be debenture. Balance is fairly simple. I want you to calculate cost of individual components. Debenture alone can be slightly tricky. Okay, in fact, I'll take you through this. Go through the question first. Go through the question. Even equity can have some bit of confusion. Go through the question. Okay, this question has 4 types of capital. One is equity share, retained earnings, preference, debenture. Book values are given, market values are given. You just need to do multiplication and get to the answer. That is calculation of WACC part. When you do market value, this 2 crore will have to be split in this ratio, 120:30. That is the rule. Your market value of equity will have to be split in the ratio of equity shares and retained earnings, because we don't give a separate value. Now I have few issues in this question. One, during the previous 5 years, dividends have increased from 10.60 to 14.19. Dividend at the end of the current year is expected to be 15. First, in the calculator, 15 minus 14.19 divided by 14.19. Can you tell me what percentage is this? Okay, let me take it as 6% for the time being. Okay, in the calculator, start with 10.6 and keep adding 6% for 5 years and see what number you get. Yeah, 10.6 is the starting part. Add 6% for 5 years, plus 6%, plus 6%. 14. So the growth rate is 6%. The growth rate is 6%. They have not given the growth rate directly in the question. 15 minus 14.19 divided by 14.19. In fact, this should not have been 15 in fact. Can you tell me 14.19 plus 6% is how much? 14.19 plus 6% is how much?
15.041.
So So this should have been 15.04, but they gave it as 15. I can't do much about it. 15 minus 14.19, I did the calculation, I got 5.7. I've rounded off to 6 and checked in the calculator, starting with 10.6. If you check in plus 6%, you keep doing, and if you don't get 14.19, you get a number higher or lower, then keep adding 5%. Somewhere closer the growth rate is going to be. Either it is 6% or 5% or maybe 5.5%. Some closer growth rate it will be. So the growth rate in this question is 6%. The growth rate in this question is 6%. So K is equal to D1 by P0 minus F plus growth rate. D1 is 15 rupees. Assumption is this is the next year dividend. Assumption is this is the distant dividend. Issue price is 125. Flotation cost is 5 rupees. Growth rate is 6%.
So why can't we just take it as 5.7 itself, whatever we calculate?
So the point is that 5.7 is not the past growth rate, no, 10.6 to 14.19. That's why I told you to do that check. From 10.6 to 14.19, when you did the check, let's say in a practical world, what will happen is, if I have this number 10.6, 14.19, this divided by this, I can do power 1 by 5 and all in Excel. Technically, you will have to do that, which is not possible for you to do in your calculator. The answer is 6.01%. Exact number is 6.01. I wouldn't even tell you to do 15 minus 14.19. Nothing needs to be done. I have the number 14.19 divided by 10.6 power 1 by 5. Basically, I am trying to take a square root, another square root. It is 1 by 5. If it is 1 by 4, I would have told you to do a square root. But it's 1 by 5, which is not possible for you to do in calculator. So that number turns out to be 6%. Issue price is 125. So P0 minus F. Issue price is 125. Between 130 and 125, 125 would be preferred. Between 130 and 125, 125 is going to be preferred because our first preference is always to issue price. The second preference is to the current market price. So 125 minus 5. When you do retained earnings, just don't subtract this 5. Leave this 5 to be subtracted. If you look at this 1 plus r power 5, in calculator you cannot do that. That's the issue. I can do this in Excel. I did power 1 by 5 to get that answer, which is not possible for you to do in this. So this is fine. Your retained earnings, you are not subtracting that 5. Another important issue is preference capital is also fine. 15% preference share with face value of 100 would realize 105. No information on the life of the instrument. So 15 rupees is the dividend. Net proceeds is 105. They have mentioned net proceeds to be 105. The other problem is with debenture. The company proposes to issue 11-year 15% debenture. 11-year 15% debenture, but the yield on similar maturity and risk class is 16%. Listen, I normally say if you don't have the issue price, issue at par and all, you assume that is fine. This question, that logic is not going to work out. What they are saying is, company is planning to issue a 11-year debenture. The company is planning to issue a 11-year debenture, paying what interest? 15% debenture. What others are doing is they are paying 16%. See, the rule in the finances, whenever you issue any security, if it meets expectation of the investor, what is people expectation is 16%. If you meet that expectation, you can issue at par. If you meet the expectation of people, you can issue at par. We are giving 15%. People are expecting how much? 16%. People would want this to be issued at a discount. People would want this to be issued at a discount because you are not meeting the expectation of the people. Ignoring the taxation aside, cost of debt is equal to interest by net proceeds, or technically let me call it as current market price for the time being. This is a formula which you learn at CF final. This is basically on current yield. This formula is technically called as current yield. Cost of debt is equal to interest by current market price. What is that the company wants to pay? How much they are planning to pay? 15. I am assuming face value to be 100, okay. So company will pay 15 rupees. Company will pay 15 rupees. People want 16%. People want 16%. Company is paying only 15%. So the issue price can technically be 15 by 16%. You will have to issue at a lower price. You will have to issue it at a lower price. The issue price is you are paying only 15 rupees. People are saying give me 16%. What is this price coming out to be? In a scenario if both were 16, no, both were 16. You are paying what investor wants, he will give you 100 rupees. He will give you 100 rupees. In a scenario, you pay more than 16. If you are paying 18, people want 16%. So 18 by 16%, you will get an answer. So here 15 by 16% is 93.75. Clear? Any doubts on this? So beyond that, there's nothing much there. The issue price of the debenture will be 93.75. The issue price of the debenture will be 93.75. There's a flotation cost of 2%, your wish. You can take 2% of face value. You can also take 2% of issue price. You can take 2% of face value or 2% of issue price. I am assuming the face value to be 100 in all my calculation, okay. So you see here the computation would have been presented. 93.75. The company is not meeting the expectation of the investor. The issue will happen at 93. My flotation cost 2% on face value is the ideal assumption here. That's the assumption taken here. Just give me a minute. There's no much additional questions in this area, so I think broadly we are done with this. So we have covered 3 areas today. Balance areas I'll start tomorrow. Will start at 9:30 itself. Tomorrow class will start at 9:30. Should go until I think 4:30. That's the timing I'll keep for tomorrow. Okay, we'll end with this. Okay, good morning friends. Okay, let's now start with a new area called as capital structure. Just close that. Capital structure. Now, when it comes to financing decision capital structure, it has multiple sub-components. The first part of the chapter focuses on something called as indifference point and break-even point. Indifference point is the level of EBIT at which 2 different financial plans will give same EPS. So, a company may be funded entirely through debt. It can be funded through debt and entirely through equity, or debt and equity, debt, equity and preference. So, we are looking at a combination wherein the level of EBIT at which 2 different plans will give the same amount of EPS. That is basically called as indifference point. In order to do that, we assume EBIT as X, get the EPS in terms of X and then equate. When we equate, we'll get to know what is the level of EBIT at which 2 different plans will give the same amount of earnings per share. Then we also have something called as financial break-even point. The term break-even point basically means zero profit, zero loss. Financial break-even point means the level of EBIT at which EPS is 0, earnings per share is 0. Financial break-even point is equal to interest plus preference dividend divided by 1 minus tax rate. Interest plus preference dividend divided by your preference dividend alone is divided by 1 minus tax rate. This is the first segment of the chapter. The second segment of the chapter focuses on capital structure theories. We have something called as net income theory, net operating income theory, Modigliani-Miller theory and traditional theory. So multiple theories are there and each of them has a focus area. Each of it has a different, okay. Others, can you confirm, is the audio getting stuck? I got a message that audio is getting stuck. Others, is the audio clear, not clear? Friends, can you confirm on the audio part? The audio is getting stuck. Okay, now clear. Okay. Clear or not clear? Some of you are saying it is clear. Okay, so then we have different capital structure theories. Each theory has made a conclusion about value of the firm. I will discuss that when I do a problem, but this is the format we will follow to calculate the value of firm. EBIT less interest, EBT less tax, EAT if it's with taxation. Without taxation means less tax will not come in our format calculation. Cost of debt, cost of equity, cost of capital, value of debt, value of equity and value of firm. There are certain assumptions which capital structure theories have made. One of the assumptions is there are only 2 forms of capital. We don't have preference in the different capital structure theories. All earnings are distributed as dividends. So technically there is no concept of retained earnings. Whatever the company is earning, the entire amount will be paid out as dividend, which also indirectly means there is not going to be any growth in any of the companies. We'll see this when I do problem on those theories. Let's first look at your financial break-even point and indifference point. Let's come to question number 1. Let's come to question number 1. Question number 1, page 51. Question 1, page 51. Modern Chemicals Limited required 25 lakhs for a new plant. This plant is expected to give EBIT of 5 lakh. While deciding about the financial plan, the company considers the objective of maximizing earnings per share. 3 alternatives to finance the project: either go with debt of 2 lakh 50 or 10 lakh or 15 lakh, and the balance in each case by issuing at rupees 150. The issue price will decline to 125 in case the funds are borrowed in excess of 10 lakh. Funds can be borrowed at the rate of 10% up to 250, 15% over 250 up to 10 lakh, and 20%. Tax rate is 50%. Which form of financing should the company choose? This is basically a problem on optimum mix. That is, this company needs 25 lakh rupees. They have an option of borrowing 2 lakh 50, issuing shares of 22 lakh 50, or borrowing 10 lakh, issuing shares of 15 lakh, or borrowing 15 lakh and issuing shares of 10 lakh. I need 25 lakh rupees. Plan is to borrow 2 lakh 50 or 10 lakh or 15 lakh, and the balance is going to be through equity share. Our objective is to maximize earnings per share. The objective is to maximize earnings per share. Whichever option is giving maximum earnings per share, that is the choice I am going to take. Let's start. Working note 1. Identification of alternatives. Identification of alternatives. Alternative 1. Alternative 1. Raise debt of rupees 2 lakh 50 and equity of rupees 22 lakh 50. Debt of 2 lakh 50 and equity of 22 lakh 50. Alternative 2 is raise debt of rupees 10 lakh and equity of 15 lakhs. And last alternative, debt of 15 lakhs and equity of 10 lakhs. So we are basically trying to find what are they going to do for the different plans. So these are the plans they have. Either they can go for borrowing of 250, 10 lakh and 15 lakh. Balance obviously will come in the form of equity. For all these 3, I want to know what is the EPS, what is the earnings per share of the company. Working note 2, computation of interest, preference dividend and number of equity shares. Interest, preference, dividend, number of equity share. It's not mandatory to do this step. You can directly do the calculation. I follow series of steps. You can even directly do the third step. When I do the third step, you will understand. Particulars, alternative 1, alternative 2 and alternative 3. See, what is going to be distinguishing these 3 plans is interest expenditure or preference dividend or number of shares. This question doesn't have preference dividend, but some question can also have preference dividend. From an optimum mix point of view, this is a problem on optimum mix. So what we do is interest, existing, new, total, preference dividend. Most of the question preference dividend may not be there, so you need not even write this. Existing, new and total. Number of shares, number of equity shares, existing, new and total. Now this could be a company which is currently existing. If it's a currently existing company, if at all they give data, they can give some data on current interest expenditure, current equity share or current preference dividend. Existing data will be same for all the 3 plans, because on top of that you are doing something. So existing, I don't see any information in this question. So there is no existing interest expenditure, there is no existing preference dividend, there is no existing equity share. Question can give you this data. If they give you, it's the same for all the 3. Existing data will remain same for all the three: existing equity share, existing interest and existing preference dividend. On top of this, in the first plan, I am borrowing 2,50,000. On the first plan, I am borrowing 2,50,000. What's the rate of interest for 2,50,000? 10%. So I have to pay interest of 2,50,000 into 10%. 2,50,000 into 10%, 25,000 interest I have to pay. 2,50,000 into 10%, 25,000 interest I have to pay. In alternative one, we have to pay interest of 25,000. We have to pay interest of 25,000. In second alternative, I am borrowing 10 lakh. First 2,50,000 will be at 10%, and that extra borrowing will be at 15%. Somebody can even say, no, the entire 10 lakh I want to take it as 15%. That's possible. I am assuming slab rate. You can assume also flat rate. Slab rate is what happens in income tax. The first 5 lakh has a different tax rate. Next 5 lakh has a different tax rate. So you can assume a slab rate kind of a system. Or you can say, no, the entire 10 lakh will be at 15%. That's your wish. I think ICI in this question did this. So 25,000 plus another 7,50,000 into 15%. Another 7,50,000 into 15%, that extra amount. Similarly, 137,500 plus another 5 lakh into 20%. Another 5 lakh into 20%. So this would be the interest expenditure for the different plan. The first plan has an expense of only 25,000. Second plan has 137,500. Third plan has 237,500. I have assumed something called as okay. Just give me a minute. Okay, I hope you will not have audio issues now onwards. I've changed the Wi-Fi connection. Okay, so this is the interest expenditure. Balance, I'm going to issue equity share. 22,50,000 divided by 150 issue price. 22,50,000 divided by 150 is the issue price. They have said balance money will be raised by issuing the shares at 150 rupees, but it is expected to decline to 125 in case, not in cash, in case the funds are borrowed in excess of 10 lakh. If you borrow more than 10 lakh, the issue price of share is 125. Otherwise, the issue price is 150. So in this case, 22,50,000 by 150, 15 lakh by 150, and 10 lakh by 125. My issue price comes down to 125. Once this is done, balance becomes more of a formality to get to the answer. They want us to calculate earnings per share. For all the three plans, we are required to calculate earnings per share. Sorry, I should have copied it here. Preference dividend anyway is not there. This question doesn't have any preference dividend. So the number of shares are 15,000, 10,000 and 8,000. Any doubts on this? Working note 3, computation of EPS. We have a standard format for calculating EPS. Whichever plan gives us the maximum EPS, that is what we will choose. We start with EBIT less interest EBT less tax, EAT less preference dividend, EAES, number of shares, EPS. Most of the question will end here. This question is going to end here. Sometimes after this you can do P multiple. I may do it in some question, okay. MPS, number of shares, market value of equity, market value of debt, market value of preference, and market value of firm. Some question may ask you to complete till the valuation of firm. Some question may tell you to stop at EPS. This question, the objective was to maximize EPS. The objective was to maximize earnings per share. Now, this is a very simple thing. I'll quickly do it. The EBIT given in the question is 5 lakhs. The EBIT given in the question is 5 lakhs. The interest will keep changing for different alternative. So, 25,000, 137,500 and 237,500. The interest will keep changing. 25,000, 137,500 and 237,500. EBT 475, 362, 500 and 262, 500. Tax is at 50%. Tax is at 50%. EAT. I'm not really bothered about explaining this part of it. What was critical was the earlier part. Preference dividend is 0. EAES is this amount itself. Number of shares you had calculated earlier, 15,000, 10,000 and 8,000, and my objective is to maximize earnings per share. So, I have maximum EPS in alternative 2. My maximum amount of earnings per share is in alternative 2. So, I will go ahead with alternative 2. If the objective is to maximize earnings per share, we will go ahead with alternative 2 because that maximizes the earnings per share of the company. Any doubts on this? Clear? Let's come to this. Calculate the level of earnings before interest and tax at which the EPS indifference point between the following alternatives will occur. So, the question is on indifference point. The steps are broadly going to remain same. Equity share capital of 6 lakh, 12% debenture of 4 lakh. Equity share capital of 4 lakh, 14% preference share capital of 2 lakh, 12% debenture. Tax rate is 35%. Par value of equity share is 10 in each case. The par value, the face value is 10 rupees. Clear? Nothing much for you to see in the question. I'll follow these steps again. The initial, I think some 7-8 questions will follow the same pattern. My alternative 1 and 2 are given in the question. I'm going to technically copy paste those alternative. The alternative 1 is equity of 6 lakh and debenture of 4 lakh. Equity of 6 lakh and debenture of 4 lakh. Alternative 2 is equity of 6 lakh, preference of, okay, sorry, equity of 4 lakh, preference of 2 lakh and debenture of 4 lakh. Now, some of you may feel that this is unnecessarily repeating thing. You can directly even do the working note 3. That's up to you. I'll calculate this. There is no existing data in this question. I have only 2 alternatives. No existing data. There's no existing information in this question. The interest for alternative 1 is 12% debenture of 4 lakh. 48,000 rupees is the interest. 48,000 is interest. And this side it is 12% debenture, again 48,000. 4 lakh rupees. Debenture is 4 lakh rupees in both. No existing preference dividend. Alternative 1 does not have preference capital. Alternative 2, the preference dividend is 28,000. 14% into 2 lakh. 14% into 2 lakh. No existing equity share. Alternative 1, the equity share is 60,000. This is 40,000. 60,000 and 40,000. Now, I am going to take this as X. EBIT will be taken as X. In order to calculate indifference point, you will assume EBIT as X. You will assume EBIT as X. So, this will become X minus 48,000. X minus 48,000. Assume EBIT as X. You could have directly started here itself. You could have directly started at this stage itself. EBIT X, interest you subtract, because that step which I do is just to ensure that you don't make any mistake. In case you want to do it directly also you can do. Taxes, I think 35%. So 0.35 X minus 48. I'm not going to simplify the equation. 0.35 into X minus 48. This is 0.65 into X minus 48, 0.65 into X minus 48. No preference dividend, alternative one. This has a preference dividend of 28,000. Can you tell me 0.65 into 48,000 is how much? Into 48,000. 31,200. This side 0.65x, 31,200, another 28,200, 59,200. And the EPS is alternative one. The alternative one EPS is 0.65x minus 31,200 by 60,000. This is the first alternative EPS, 0.65x minus 31,200 divided by 60,000. Second alternative is 0.65x 59,200 by 40,000. You need to solve this and get an answer to X. That's the indifference point. Once you solve this, you will get an answer to X. That is basically the indifference point. Indifference point is the level of EBIT at which EPS is same. So we are equating both. This side 3, this side 2. 1.3x minus 62,400. 1.95x minus 177,600. Solve X and let me know. 1.3x minus 62,400, 1.95x minus 177,600. Solve this. Same thing which we did in the previous question, just that I have taken EBIT as X. Solve and let me know. Is it 177 to? Yeah, 177 231 is the number I get. Let me know if at all any calculation error are there. Otherwise, the answer should be this: 1,77,231. 1,77,231. Clear? Any doubts on this? Any doubts on this part? I'll move to question 3. I'll move to question 3. So for indifference point, you have to assume EBIT as X and keep proceeding. Let's come to this. A company needs 31,25,000 for the construction of new plant. Following 3 plants are feasible. 3,12,500 shares of 10 each. 1,56,250 shares of 10 each and 15,625 debenture of 100 denomination, 8% rate of interest. That should have been interest. 156,250 of 10 per share, 15,625 preference share, bearing a 8% rate of dividend. EBIT is so much. What are the earnings before tax? Which alternative would you recommend? Financial break-even point. EBIT, EPS indifference point by formulae between plan 1 and 2, 1 and 3 and 2 and 3. Okay, again, it's pretty much the same thing. It's so many things have been given, but it's pretty much the same thing which I've done, except for one additional point called as financial break-even point. Indifference point can only be between 2 alternatives. For example, if they give 1, 2, 3 plants, then you have to get one indifference point between 1 and 2, then 1 and 3, 2 and 3. If they give 4 plants, then between 1 and 2, 1 and 3, 1 and 4, 2 and 3, 2 and 4, 3 and 4. So many indifference points may have to be calculated. Sometimes when you try calculating, you will not get an answer. That would mean there is some domination. You will understand what is domination as we proceed. Now, they have given so many levels of EBIT. They say EBIT is 62,500, 125, 250, 375, 625. I cannot keep preparing so many statements because I have to start with 62,500, get the EPS. Start with 125, get the EPS. Start with 250, get the EPS. The first question we did. Start with 375, get the EPS. Start with 625, get the EPS. So many calculation may take you, from an exam point of view, it could be slightly difficult. For me in Excel, I just change the EBIT number, the EPS will automatically come. But in your case, it could be difficult. So we'll answer 1 and 2 in some time. We'll answer 1 and 2 in some time. I'll directly go to the third part, that is calculation of your financial break even point and your indifference point. So I am bringing alternative 3 here. I am not following those initial steps, okay. The initial step is you will have to first write the alternatives. After writing the alternatives, you will have to calculate interest, preference, dividend separately. I'll directly do the calculation here, okay. I've assumed XXX as EBIT. First alternative, I don't see any interest expenditure being there because it has entirely equity financed. Entirely equity financed, so 0. Interest is 0. EBT is X. Tax is 40%. 0.6x. 0. 0.6x. 312,500. And EPS is 0.6x by 312,500. 0.6x by 312,500. I started with EBIT as X. There is no interest expenditure. There is no preference dividend in alternative 1. We used to write it as a separate step and come here. When it comes to alternative 2, can you calculate the interest expenditure? How much? 1 lakh? 125. X minus 125. 0.4 into X minus 125. I'm not going to simplify this as of now. 0.6 into X minus 125. No preference dividend. So 0.6x minus 75,000. We have simplified, and this has I think 156 250 share. This has 156 250 share, and this number is 0.6x minus 75,000 divided by 156 250 divided by 156 250. This is the EPS of your alternative 2. You started EBIT as X and kept on working out. It turned out to be 0.6x minus 75,000 whole divided by 156 250. This alternative I don't have interest, so till this it will remain like this. Then there is a preference dividend of 1,25,000. So 0.6x minus 1,25,000. Number of shares is this. Okay, so we have got the EPS for all the 3 in terms of X. Okay, the first level EPS is 0.6x by 312,500. The second level EPS is 0.6x minus 75,000 whole divided by 156 250. The third one EPS is 0.6x minus 1,25,000 whole divided by 156 250. So we have computed this in terms of X. Any doubts till this? Okay, now after the EPS is calculated, I will do something called as financial break-even point. Financial break-even point. The formula for financial break-even point is interest plus preference dividend alone divided by 1 minus tax rate, because the objective is what is the level of EBIT at which EPS will be 0. So I want to recover my interest expenditure. I also want to pay preference dividend. Preference dividend unfortunately is paid out of profit after tax. So whatever you are earning, you have to pay tax on that and then pay preference dividend. On interest, you can directly pay out of EBIT. Tax may not be there, because if your interest is equal to EBIT, you will have 0 taxation. But unfortunately for preference dividend, we have to do divide by 1 minus tax rate. This is 0. There is no interest, there is no preference dividend. This is 125, the entire interest expenditure, and this is 125 by 0.6. 125 by 0.6. The first plan, no interest, no preference dividend. Financial break-even point is 0. Second one is 1,25,000 of interest. Third one is 1,25,000 of preference dividend divided by 0.6. Divided by 0.6. So we have got this. Now we are required to calculate indifference point. I am required to calculate between plan 1 and 2, 2 and 3, 1 and 3. I am just going to do 1 and 2 and 2 and 3. I am not doing 1 and 3. 1 and 3 is of no use. Basically, you will not learn anything there. 1 and 2, if I do, between 1 and 2, you will have to equate 0.6x by 312,500 divided by 0.6x minus 75,000 by 156 250. 1 times 2 times this goes this side. 1.2x minus 1,50,000. 1,50,000. 2,50,000 will be the EBIT. 2,50,000 will be the EBIT, at which plan 1 and 2 will give the same result. 1 and 2 will give the same result. 1 and 2 is going to give the same result at 2,50,000 of EBIT. Any doubts on this? If I do 2 and 3, 2 is 0.6x minus 75,000 by 156 250, 0.6x minus 1,25,000 by 156 250. This and this got cancelled. This and this got cancelled. Now I am left with something. I cannot have minus 75,000 is equal to minus 125. So something seemed to be wrong. If you try to solve and you don't get an answer, it means one plan is dominating the other plan. It means either 2 is always better than 3 or 3 is always better than 2. What is indifference point is, before indifference point one plan will be good. After indifference point the other plan will be good. That is what indifference point is. If you don't get an answer to indifference point, either 2 is always better than 3 or 3 is always better than 2. Now which is always better is a plan between 2 and 3, whichever has lower financial break-even point. Between 2 and 3, whichever has lower financial break-even point is going to dominate the other plan. Between 2 and 3, don't look at 1 now. Between 2 and 3, 2 has a financial break-even point of 1,25,000. 3 has a financial break-even point of 2,08,333. It means plan 2 always dominates plan 3. Plan 2 always dominates plan 3. In short, there are only two plans, plan 1 and 2. 2 and 3 is of no use. That 3 is of no use. So I did not try doing 1 and 3 in exam. You may have to do it if the question asks, but 3 is of no use. 3 is of no use. You can get an answer, but 3 will never come in my analysis. 3 is not going to come in my analysis because 2 is always better than 3. Now question had also asked, calculate your EPS for all of this. Now I cannot prepare a statement. So what we did is, we say EPS is 0.6x by 312,500. In place of x, you can substitute 62,500, you will get one answer. Substitute 1,25,000, you will get the second answer. Substitute 2,50,000, you will get the third answer. Substitute 3,75,000, substitute 6,25,000. That substitution would have been done here. This is the EPS. I substitute here, and this is the earnings per share. I substitute and I get the earnings per share. You will see 2 is always better than 3. You can just check. 2 will always be better than 3, whatever is the level of EBIT. Whatever is the level of EBIT, plan 2 will always be better than plan 3. At 2,50,000, 1 and 2 will be same. At 2,50,000, 1 and 2 will be same. Below 2,50,000, a plan between 1 and 2, below 2,50,000, a plan with lower financial BEP will be better. Between 1 and 2, below indifference point, a plan with lower financial break-even point is better, and above indifference point, a plan with higher financial BEP is better. Between 1 and 2, 3 is anyway eliminated. 3 is anyway eliminated. This is the final selection. Less than 2,50,000, plan 1 is better. At 2,50,000, plan 1 or plan 2, you are indifferent. About 2,50,000, plan 2 is better. You can understand that in this table also, or you can say this has lower financial BEP and this has higher financial BEP. Lower financial BEP will be better for below indifference point. Higher financial BEP will be better for above indifference point. Simple rule, take EBIT as X. Start calculating EPS in terms of X. If they give so many EBIT level, you keep substituting. You keep substituting and do the calculation. If they have not given so many levels of EBIT, then you can directly do it, which is what we did in the first question. When you are trying to solve an indifference point, if you are not getting an answer, it means one plan is dominating the other plan. One plan is dominating the other plan. The rule is a plan with lower financial break-even point will dominate the plan with higher financial break-even point. Any doubts on this? Let's come to question 4. X Limited is considering the following two alternative financing plan: equity share, 12% debenture, preference share. Indifference point is 2,40,000, corporate tax rate is 30%. Calculate the rate of dividend on preference share. So they have given the indifference point. They want us to calculate what is the rate of dividend on preference share. This will become like a balancing figure. It will become like a balancing figure. I follow the format which we normally do. I am not doing that part of your writing the alternatives and then calculation of interest, preference, dividend for want of time. I normally expect students to do that, because when you do that you will ensure that mistakes are not done, but it's up to you if you want to do it in exam or not. But I would obviously prefer you to follow those steps of writing the alternative, calculation of interest, preference, dividend and your number of equity share, and then you follow this. The indifference point is given in the question, which is 2,40,000. Indifference point is the level of EBIT. 2,40,000 is the indifference point. Interest in the first alternative is 24,000. Second alternative, I do not have interest expenditure. Tax rate is 30%. EAT. I don't have preference in the first option. Second option I have preference. We'll see what is to be done. Number of shares in the first option is 40,000. So my earnings per share is 3.78. Earnings per share is 3.78. In the alternative 2, I don't know the preference dividend. In the alternative 2, I don't know the preference dividend. But the rule is at indifference point, both plan will give same EPS. So I copy this 3.78. The number of shares for the second alternative is also 40,000, which means EAES is 151,200 reverse working, and preference dividend balancing figure is 16,800. The preference dividend balancing figure is 16,800. They wanted the rate of preference dividend. Rate of dividend is 16,800 by 2 lakh. 16,800 by 2 lakh. They wanted the rate of dividend, which is 8.4%. The rate of preference dividend is 8.4%. The rate was not given in the question. Let's come to this. Akash Limited provides you the following information: EBIT, interest, EBT, income tax, EAT, number of equity share, EPS, P multiple. This question has P multiple also. Company has reserves and surplus of 7 lakh and require 4 lakh further for modernization. Return on capital employed is constant. Debt plus debt, in bracket they have said debt ratio, debt divided by debt plus equity higher than 40% will bring the P ratio down to 8 and increase the interest rate on additional debt up to 12%. You are required to calculate what is the probable price if you raise amount as debt, if you raise amount as equity at the ruling market price. First go through the question. Okay, now there are certain things which you need to understand. This is an existing company, okay? It is an existing company. For an existing company, there could be an existing interest expenditure. On top of that, extra expenditure can be there. There can be an existing number of equity share. On top of that, extra shares can be there. So it will make a lot of sense for us to do that step which we normally do. I am anyway going to directly explain it, but existing will remain same for both. On top of that, if you are raising, they have said they have two options. You can raise it as debt or you can raise it as equity shares. You can raise it as debt or you can raise it as equity share. Also they are bringing in one complication. They are saying debt divided by debt plus equity. This is called as debt ratio, which we did as part of our calculation, as part of our analysis in ratio analysis. Higher than 40% will bring the P multiple down and increase the rate on additional debt to 12%. So this new borrowing I am getting, I don't know what is the borrowing rate for that. The existing borrowing is at 10%. The new borrowing can continue at 10%, can also be 12%, provided I want to check this debt ratio. So first let's check this debt ratio. Working note 1, computation of debt ratio. Computation of debt ratio. particulars, alternative 1, alternative 2, debt, equity, reserves, debt ratio. Debt, equity, reserves and debt ratio. As of now, the company has debt of 40,000 divided by 10%. You look at the interest of the company is 40,000. So the existing debt is 40,000 by 10%. On top of that, another 4 lakh will be taken. 40,000 by 10%. On top of that, another 4 lakh is going to be taken by the company. They have planned to raise 4 lakh in the form of debt. If the additional amount is raised as debt, this side it will continue to be 4 lakh. When it comes to equity, I have 30,000 shares. In my books of accounts, they will be valued at 10 rupees per each. In my books, it will be only 10 rupees. So 30,000 into 10, and I plan to raise another 4 lakh. So 3 lakhs and 7 lakh. Reserves and surplus as of now is 7 lakh rupee. So debt divided by debt plus equity. The ratio is going above 40%. If it goes above 40%, the new debt will be taken at the rate of 12%. The new borrowing will be taken at the rate of 12%. The question has said, in case the debt ratio is higher than 40%, it will bring the P multiple down to 8 and increase the interest rate on additional debt to 12%. So the new loans will be taken at a rate of 12%. The P multiple for that is 8 times. What is the use of P multiple? You will understand. As of now, the P multiple is 10. So I can also write one more thing. Applicable P multiple. Here the P multiple will be 8 times. Here the P multiple will be 10 times. The P multiple will be 8 times and 10 times. The P multiple will help you in calculating the price later. This is one part of it. The second important part is something like this. They have mentioned ROC is constant. Return on capital employed is constant. This is a very important word there. As of now, company is earning 2,80,000. Okay. This 2,80,000 is earned with borrowing of 4 lakh, equity of 3 lakh, reserves of 7 lakh. Company is earning 2,80,000 with 4 lakh of borrowing, 3 lakh of reserves and 3 lakh of equity and 7 lakh of reserves. What is this percentage coming out to be? 20%. ROC is constant. If they use this word, means when you do that calculation, you're going to calculate EPS in the next working note. When you do EPS, the first line item is EBIT. I cannot copy 2,80,000 as EBIT. The reason for that is, today you are earning 2,80,000 with 14 lakhs. 2,80,000 with 14. This 14 will go up to 18 either with debt or with equity. Either you borrow money or you issue equity share. Overall, the capital will from 14 lakhs will go up to 18 lakhs. The capital is going to increase from 14 lakhs to 18 lakh, which indirectly mean you will earn 18 lakh into 20%. You will earn 18 lakh into 20%, and EBIT will be now 3,60,000. EBIT will be 3,60,000. Some question in fact will say ROC will further improve, ROC will deteriorate. They can mention anything. So it will now become 3,60,000 of EBIT. Beyond this, I don't have much to do.
So can we say when you raise further capital, EBIT will increase?
It has to go up because you are bringing in more money. When you bring in more money, you have to pay now money to your shareholders or to your debenture holders. Some extra income has to be there. If there is no extra income, then there is no point in raising money, no, because when I raise money, I have to pay interest, or I have to pay preference dividend, or I have to pay equity dividend. Why should I raise money when your EBIT cannot go up? So I follow this now. EBIT is going to be 3,60,000. Beyond this, there's nothing much to be explained. EBIT is 3,60,000. Interest is, I've copied 40,000 for both as of now, just 40,000, which is your existing interest. On top of this, another 48,000. On top of this, another 48,000, because the new loan which you are going to take, you will take it at 12% rate of interest. Alternative 1, you are borrowing money. Alternative 2, you are raising it in the form of equity share. EBT. What's the tax rate given in the question? 50%. Tax rate is 50%. You get EAT, no preference dividend, EAES. My number of shares, existing shares are 30,000. Existing shares are 30,000. I need to raise 4 lakh money. At what price they will issue? They have mentioned something in the question. They are going to issue this 4 lakh at what price? What is the current market price?
So
EPS into P multiple. The current market price is 40. The current market price is 40. So 4 lakh divided by 40 will lead to how many extra shares? I think 10,000 extra share. 10,000 extra shares. So this is 40,000. I get my EPS. P multiple is 8 times here, 10 times here, and this is the market price. Some 36 rupees and 40 rupees. The market price is going to be 36 and 40. 36.27 and 40 rupees. That's going to be the market price for the two scenario. They just asked for the market price. Yeah, they've just asked us to calculate the market price. They've not told us to do anything beyond that. 36.27 and 40 rupees. Any doubts on this? One important factor is calculation of EBIT. I have explained this in detail here. 2 lakh 80, 14 lakh, 20%. Same 20% continues, but the capital employed will now become 18 lakh. So your EBIT will go up to 3 lakh 60. Any doubts on this? Go through question 6.
So the new IPAT, both the alternatives will have the new IPAT.
Yeah, whatever is the new EBIT you're getting. Go through question 6. Okay, a company earns a profit of 3 lakh after meeting its interest liability of 1 lakh 20. This profit can be assumed as PBT or PAT. They have used the word after meeting its interest liability. So I would mean that from EBIT interest could have been subtracted, and this is EBT. This indirectly mean EBIT is 4 lakh 20. When you look at the number, you will have to think about all this. EBIT is 4 lakh 20. It also mean my debenture value is 1 lakh 20 by 12%, 10 lakh rupee. The debenture value is 10 lakh rupees. The tax rate is 50%. Number of shares are 10. 10 into 80,000. Retained earnings is 12 lakh. Company plans to take up an expansion for which a sum of money of 4 lakh is required. It is anticipated that after expansion, the company will be able to achieve the same return on investment as at present. I want you to do only two things. Can you tell me what is the existing ROCE or ROI? Both are interchangeably used words. And what will be the new EBIT after expansion? What is the existing ROCE and what is going to be the new EBIT post expansion? We are now going to calculate EPS and all. No, Tarni, it's not 21%. Check it again. What is the existing ROCE of the company or ROI, whatever name you want to use? And what will be the new EBIT post expansion? What will be the EBIT post expansion? Similar to the previous question, but I am not getting into that EPS calculation, all that I am not doing it. You do calculation on ROI and new EBIT. Correct. Get the new EBIT. Get the ROI and the new EBIT. ROI and the new EBIT. What is the new EBIT? Tell me that. Yeah, 14 is right, Kavya. Tell me the new EBIT post expansion. Balance is a formality. I don't want to really spend time on that. How much? No, 56 is not right. 4, yeah, it should be 4,76,000. The new EBIT will be 4,76,000. Listen, the existing is 4,20,000. The existing is 10 lakh of debenture, 8 lakh of equity share, 12 lakh of retained earnings. Put together the capital is 30 lakh. Put together the capital is 30 lakh, which indirectly mean the return is 14%. The return is 14%. 10 lakh of debentures, 8 lakh of equity share and 12 lakh of retained earnings, all put together 30 lakh is the capital employed. My ROI is 14%. This 30 lakh will now become 34. It will become 34. Either you raise extra debt or you raise equity share, but 30 lakh will become 34 lakh. 30 lakhs will become 34 and my EBIT will be 34 lakh into 14%. 34 lakh into 14%, which is I think 4,76,000. Clear? Any doubts on this? Let's look at quickly question 7. Following figures of Theta Limited are presented as under: EBIT, debenture interest, long-term loan interest. See, when they give that rate, the reason for giving the rate is you can reverse work the amount. You can reverse work the amount at 8%, at 11%, income tax, earnings, EPS, market price, P multiple. The company has reserves and surplus of 20 lakh. It is in the need of 30 lakhs to pay off the debentures and modernize its plant. It seeks your advice on the following alternative: raise entire amount as term loan from banks at 12%, raising part of the funds by issuing 1 lakh shares of 20 and rest of them at loan at 12%. Company expects to improve its rate of return by 2% as a result of modernization, but P multiple will likely to go down to 8 if the entire. Advise the company on the financial plan to be selected. It's assumed that there will be no change in P multiple in either of the two alternatives adopted. Would your advice still hold good? Now, I want you to calculate 2-3 things again. Go through the question in detail. First, tell me what is existing ROI, okay? The new ROI is not going to be same. Something is mentioned in the question, okay? The new ROI will be different. After the new ROI, what is the new EBIT? What is the new EBIT? Read the question carefully. Existing EBIT is 23 lakh. Existing EBIT is 23 lakh. Tell me what is the existing return on investment percentage? What is the return on investment percentage? Existing return on investment percentage. Capital employed will include debenture, term loan, equity shares, retained earnings. How much? 23%. Okay. 23 should be right. 80,000 by 8%, 10 lakh. 2 lakh 20 by 11%, 10 lakh. 5 lakh shares of 10 each, 50 lakhs. And sorry, 2 lakh 20 by 11% is 20. And reserves of 20 lakh. So all put together, the capital is now 1 crore. The existing capital is 1 crore. So the existing ROI is 23%. The existing ROI is 23%. The question says this ROI will improve by how much? 2%. The ROI will improve by 2%. The company expects to improve its rate of return by 2%. So 23 will now become 25. Read carefully and tell me 1 crore capital will become how much now? Read carefully, read carefully. Read carefully and tell me 1 crore capital will become how much? Go through it carefully. How much money are we raising? 30 lakhs. So should 1 crore become 1 crore 30? Normally it should become 130 lakhs, but it's not going to be 130. There's something there. Can you read what is the purpose of raising money? To pay off? So unfortunately this 10 lakh will not be there in future. This 10 lakh will not be there in future. So 30 lakh will get added, I agree to that, but 10 lakh will get removed. 30 lakh will get added, but 10 lakhs will get removed in the capital employed of the company, because one of the purpose is to pay off debenture. One of the purpose is to pay off debenture. That is what the question has mentioned. So because of that, 1 crore will become 90, 90 will go up by 30 and will become 120, and your new EBIT is 30 lakh rupees. Beyond that, I don't have much in this question. 25% into 120 lakh. 25% into 120 lakh. The question has clearly mentioned that I am planning to pay off the debentures. That is where I think detailed comparison would have been presented here. Equity capital continues, reserves continue, debentures do not continue. Debentures do not continue. So term loan is their preference and new capital is introduced of 30 lakh. So all put together, now the capital has become 1 crore 20, not 1 crore 30. From 1 crore, the capital has become 1 crore 20 only. It has not become 1 crore 30. In a normal scenario, I agree it will become 1 crore 30, but understand the objective. Sometimes the question may say the company is planning to raise 10 lakh to repay the debenture. Capital will not change itself. The capital is not going to change itself. Also, you need to take care of one aspect when you prepare your statement. This interest of 80,000 will not continue. That is where I normally prefer doing the statement. If you do step by step, you will not make those mistakes. In existing interest itself, that 80,000 would have to be eliminated. That 80,000 would have to be eliminated. Your wish whether you want to write this or directly do, that's up to you. But what was critical is getting this 30 lakh, which I have explained. Beyond this, it's more of a calculator's job. It's more of a calculator's job. So I am not spending time on that. I'm not spending time on that. The question wanted us to select, advise the company on the financial plan to be selected. One question said maximization of EPS. Okay. Another question wanted you to calculate the market price. This question said what plan is to be selected. When that is asked, wherever P multiple is there, you have to go till market value of firm. You have to go till, see, EPS into P multiple will give you MPS. MPS is market price per share. Number of share will give you market value of share. With that, you have to add debt, preference and get market value of firm in the end. Market value of firm. Whichever has better market value of firm, that one I'll select. The market value of firm includes even your debt and preference. So calculate. Sometimes they may say stop it at market price. Please stop it at market price. The question may say maximization of MPS can also be an objective. If P multiple is available in the question, you can calculate market price. You can calculate market value of firm if the question wants you to do. This question wanted us to do that because the problem did not say maximize MPS. So we calculated market value of firm. Question 8, you can manage it. It's on indifference point. Same with 9 as well. 8 and 9 can be managed at your end. Okay, let's come to 10. Let's come to 10. It's on indifference point. The only small point I just need to discuss. A new project is under consideration in ZIP Limited, which requires a capital investment of 4.5 crores. Interest on term loan is 12%. Corporate tax rate is 50%. Debt equity ratio is 2:1. Calculate the indifference point for the project. When you read the question fully, just read it once. Okay, For doing indifference point, I need always two alternatives. I need two alternatives. One there said is 2:1 debt equity ratio. What is 2:1 debt equity ratio is? Of this 4.5 crores, 3 crores will come in the form of debt, 1.5 crores will come in the form of equity. That's one alternative. That's not two alternative. What is the second hidden alternative, which is not given in the question? The hidden alternative is going with 100% equity. Going with 100% equity, because if you are not ready to go with a bank borrowing, you have to put your own money, full own money. Beyond that, I don't have much to do. I'll assume EBIT as X, keep subtracting interest and divide by the equity share, get the EPS in terms of X, equate, get to the answer. That's not the difficult part. The only thing is the question has not given the second alternative. The question has not given the second alternative. So if they are not mentioning the alternative is raising entire amount as equity. Raising your entire amount as equity. You will assume X, you will equate, get to the answer. That's a simple part of it. I don't want to spend time on that. Clear? Any doubts on this? So the bank is ready to give you a 3 crore loan. If you are not ready to take that, you will have to bring your entire money. Entire money has to be brought at your end. Okay, this was one part of it. Okay, this was one part of it, which is on your indifference point, your financial break-even point, or your optimum mix. The second segment of the chapter focuses on an area called as capital structure theories. Capital structure theories. We have a format to do that. Let me just spend a little bit of time on the format. I start with EBIT, subtract interest, get EBT, then cost of debt, cost of equity, cost of firm, cost of capital, value of debt, value of equity, value of firm. This is a format we are going to follow. There are multiple theories which are there. Different theory has different conclusion. I'll explain the conclusion when I do a problem. This is one format. Another format can have less tax EAT. There are two capital structure theories. One, without taxes were there. So the theories when came, the taxes were not there at that point of time. So most of the theories assume no taxation, but taxes came into picture. So Modigliani Miller had also revised its theory and they brought in with taxes. Now we have a formula called as cost of debt is equal to interest by value of debt. You can interchange this formula and say value of debt is equal to interest by cost of debt. You can also say interest is equal to cost of debt into value of debt. You can keep interchanging the formula. Cost of debt, interest, value of debt is interlinked. Cost of equity, EBT and value of equity is interlinked. Cost of equity, EBT and value of equity is interlinked. Sometimes you may say value of equity is equal to EBT by cost of equity. Sometimes you will say EBT is equal to cost of equity into value of equity. And cost of capital, EBIT and value of firm is interlinked. Cost of capital, EBIT and value of firm is interlinked. Sometimes I will say value of firm is equal to EBIT by cost of capital. Sometimes I will say EBIT is equal to cost of capital into value of firm. You can keep interchanging. If the question has taxation data, then everywhere into 1 minus tax. EBT into 1 minus tax is EAT. EBT into 1 minus tax is EAT. If at all question has information on taxation. So we will have two types of problem. One with taxation, second is without taxation. Cost of capital, value of firm, EBIT is interlinked. Cost of debt, interest, value of debt is interlinked. Cost of equity, EBT and value of equity is interlinked. Now depending on the theory, depending on the capital structure theory, there could be some adjustments here and there to be made. So I'll explain based on the theory what needs to be done as we proceed. Let's come to this question. Zordon Limited has net operating income of 5 lakh and total capitalization of 50 lakh during the current year. The company is contemplating to introduce debt financing in capital structure and has various options for the same. The following information is available at different levels of debt: debt value, interest, equity, capitalization rate. Assume no tax. Firm always maintains books at book value. You are required to calculate amount of debt to be employed by firm as per traditional approach. Amount of debt to be employed by firm as per traditional approach. Equity capitalization rate if MM approach is followed. I will come to the equity capitalization rate, which is MM approach in some time. This question does not have any taxes in it. There is no tax data in this question. First we are going to do traditional approach. Okay, so I have this format. Along with this, I'll keep adding the multiple alternatives which the question may give. The question can give multiple alternatives, so we'll keep adding them. The question has given 0 debt, 5 lakh debt, 10 lakh debt, 15 lakh debt, 20 lakh debt, 25 lakh debt, 30 lakh debt. Every question I'm going to follow the same format to get to the answer. I don't have anything beyond this to be done. 0 debt, 5 lakh, 10 lakh, 15 lakh, 20 lakh and 25 lakh and 30 lakh. That's given in the question. The interest rates are also given in the question. 0, 6%, 6.2%, 7, 7.5, 8. These are given in the question. Cost of equity is also given in the question. 10, 10.5, 11, 11.3. I'll explain the conclusion of theory as we proceed. 13.5, 16. These are given in the question. It initially said net operating income is 5 lakh. Net operating income is EBIT. Net operating income is 5 lakh.
Operating income only EBIT. Net.
No, both are same. Net income is PAT. The term operating income, whether you use word net operating income or operating income, both are EBIT. 5 lakh is given in the question. Total capitalization is 50 lakh, means value of the firm is 50 lakh. This is the initial information, okay. This is the initial information. I'll keep doing this scenario now. There is no interest. There is no interest in this scenario. My EBT is going to be 5 lakhs. EBT is going to be 5 lakhs. Value of debt is interest by cost of debt. So in this scenario, there is no debt. In this scenario, there is no debt. Other scenario, I think they had given the debt 5 lakhs, 10 lakhs, 15, 20, 25, 30 lakhs is the amount of debt. Just give me a minute. Okay. Now, this is the data given in the question. They have given cost of debt, cost of equity, cost of capital. They have given the amount of debt. After I copy this data in this format, any rework scenario, the EBIT will remain same unless they give a new number. The EBIT will remain same unless they give any extra data. If they have given some extra information, I can consider it. Otherwise, the EBIT is going to remain same. Interest, what is the formula I said? What is the formula I can use here? Value of debt into cost of debt. Value of debt into cost of debt into 6%, 6.2, 7%, 7.5 and 8%. I get EBT. So you keep calculating EBT for different alternative. I just need to fill this format, okay. Cost of debt is there, cost of equity is there. Cost of capital, what is the formula? Cost of capital formula. EBIT by value of firm. I'll park it for the time being. I have EBIT, but I don't have value of firm. I don't have value of firm. What is the formula for cost of equity?
EBT by value of equity.
Sorry, value of equity. What is the formula for value of equity? EBT by cost of equity. EBT by cost of equity. EBT by cost of equity. And now I get value of firm. I get value of firm. We copied the value of firm. And I can now get the cost of capital, which is EBIT by value of firm. EBIT by value of firm. Now, I will select an alternative which has the maximum value. I'll select an alternative which has the maximum value. Whichever has the maximum value. So, the alternative which I am going to select is this. The alternative which I am going to select is this. This is as far as the traditional approach is concerned. What we have followed now is the traditional approach. Same question I'm going to repeat it under Modigliani-Miller. There is a second part where they have mentioned follow it under Modigliani-Miller approach. This question we had the cost of equity, we had the cost of debt, we copied it. Now question says equity capitalization rate if approach is followed. Equity capitalization rate if approach is followed. Now listen. Under Modigliani-Miller, the value of firm for all the 7 alternatives will be same. The value of firm for all the 7 alternatives will be same. What they want you to calculate is equity capitalization rate. The equity capitalization rate is already given in the question. But they are saying what will be the equity capitalization rate if you follow approach. Under approach, I am talking about the conclusion of approach. Approach has said, same question under approach, same 50 lakhs has to be repeated. has said, please follow same 50 lakhs. We want you to follow the same 50 lakhs. The 50 lakhs cannot change. That is the conclusion of the approach. He said value will remain same. He also said cost of capital will remain same. The same 10% will continue. Cost of capital will remain same. So what now we are going to do is, as far as approach is concerned, value of firm has to remain same. Cost of capital has to remain same. We have all of this. EBIT does not change, 5 lakh. Interest was calculated by us. EBT is calculated by us. Cost of debt is there. Cost of capital is there. Value of debt is there. Value of firm is there. Now reverse working. Value of equity is value of firm minus value of debt. Value of firm minus value of debt. After this is done, can you tell me what is the formula for cost of equity now? Cost of equity formula. EBT by value of equity. You will have to keep interchanging the formula. So this should be the cost of equity for different alternative. 10%, 10.44, 11, 11.63, 12, 12.5 and 13%. Modigliani-Miller has basically said that if you borrow more money, cost of equity will go up. Because it goes up, the overall weighted average cost of capital will remain same. The overall weight. This is the answer under Modigliani-Miller. You tell me the change in theory, my answer will change. According to Modigliani-Miller, the answer is this. According to Modigliani-Miller, the cost of equity should have been this and not what is given in the question. Question has given some cost of equity. So what I did is I copied the EBIT, calculated the interest, computed the EBT, the cost of debt was given in the question. Cost of capital will be same 10% always. Cost of capital is going to be same. Value of debt is given in the question. Value of firm will be same 50 lakhs. It is going to be same 50 lakhs. That's not going to change. So we copied the same 50 lakhs, got the value of equity as balancing figure, reverse work the cost of equity. Any doubts in this?
So cost of capital and value of firm is same.
Yeah, always same. Let's come to this. Alpha and beta limited are identical except for capital structure. Alpha is 50% debt, 50% equity. Beta is 20% debt, 80% equity. Borrowing rate is 8%. Capital markets are assumed to be perfect. No tax world. So great, there's no taxation in this question. If you own 2% of alpha, what is your rate of return if the company has net operating income of 360? Overall capitalization rate. Beta is same net operating income. What is its implied rate of return? Why is it lower than that of alpha? Now, few points you have to see. Whenever you see a problem, first you search whether it is with tax or without tax. Okay, that's one thing. Second, see, is the question talking about any approach? If the question does not talk about any approach, it becomes very simpler. I am least bothered about the approach to be followed. Also, even if an approach is given in the question and there is no rework to be done. See, last question said 0 lakh, 5 lakh, 10 lakh, 15 lakh, 20 lakh. If there is no rework to be done, all 4 approaches, the answer will remain same. Because only in rework, different theory has different conclusion. Modigliani-Miller said value of firm will remain same. Net income theory said value of firm will increase if you borrow more. That is the conclusion of the net income theory. Net operating income and Modigliani-Miller gave the same conclusion. NOI Modigliani-Miller said the same thing. Your value of firm is not going to change even if you borrow more or you change the capital structure. So different theories are different. This question, one, without taxation. Second, there is no rework to be done. When there is no rework to be done, your answer is going to remain same whichever approach you follow. So we are going to put this data in this format only. Go through the question for the time being. Particulars, and I'll start doing it in a minute. Alpha, beta, alpha and beta. Okay. Now, without taxation format is there. I'll read alpha and beta are identical. Identical will mostly mean same value also. We'll understand except for capital structure. Alpha has 50% debt, 50% equity. Beta has 20% debt, 80% equity. I can't use this as of now. The combination is 50-50 and 20-80. All percentages are in market. The borrowing rate for both the companies is 8%. Cost of debt is 8. Cost of debt is 8%. If you own 2% of alpha, let's not bother about. What is your return if a company has net operating income of 3,60,000? Net operating income of 3,60,000 and the overall capital. What do you mean by overall capitalization rate? Any idea what is overall capitalization rate? Cost of capital is 18%. Cost of capital is 18%. What is the implied rate of return on equity is the question. Return on equity is from my point of view. From a company point of view, it's called cost of equity. So what you need to calculate is this. What you need to calculate is this. Can you tell me how do I proceed beyond this? This is the only information I have.
So cost of capital formula is EBIT.
I have EBIT. I have cost of capital. I can calculate what? Value of firm. So value of firm is 3,60,000 by 18%, 20 lakh. Then the question said split this 20 lakh into debt and equity, something they have given for alpha. How much is the mix they said? What is the mix for 50-50? So 10 lakhs, 10 lakhs. Okay. I have cost of debt. I have value of debt. I can calculate what? Interest. Cost of debt and value of debt is there. We can calculate interest, which is 80,000. We get EBT as 2,80,000. You have EBT. You have value of equity. You can calculate cost of equity. What is the cost of equity? 2,80,000 by 10 lakh, 28%. So the implied rate of return on equity of company alpha is 28%. Then we move to beta company. They said beta has the same net operating income as alpha. So same 3,60,000. Same 3,60,000. What is its implied rate of return and why is it lower than that of alpha? So they gave same 3,60,000 I have copied. Cost of debt I have copied. Nothing else is mentioned in the question. Okay. If nothing else is mentioned in the question, identical companies will have same cost of capital. Identical companies will have same cost of capital. If they had given some cost of capital, I would have used it. Identical companies, same company, similar companies will have same cost of capital. With this, what can you calculate? Value of firm. After value of firm, you can split into debt and equity. What is the combination?
20-80.
So 20% is what? Debt. 20% is debt. 80% is equity. With this, what can you calculate now? Interest is 32,000. EBT is 3,28,000 and cost of equity is 20.5. Cost of equity is 20.5. The format will give you the answer, nothing beyond that. The format will give you the answer. Cost of equity is 20.5%. Question wanted us to know why is it lower? The reason for it being lower is beta has less debt. When you have less debt, you carry lesser risk. You carry lesser risk. So when you obviously carry lesser risk, you are going to have lower return. The concept is high risk, high return. So if you are taking more risk, you will get more return. This company has lesser risk, so it will obviously give you lesser returns. So the returns are on the lower side. Let's look at question 13. KLM Limited has an operating profit of 46 lakh. The term operating profit is basically your EBIT. Debt, total interest charge of 10 lakh. Existing cost of equity, cost of debt. It has a proposal of requiring funds of 100 lakh to be raised by additional debt 10%, which will bring in some additional profit. Assume no tax. You are required to find out existing WACC and new WACC. Put it in the same format. You will get the WACC in the same format itself. What is WACC? Is cost of capital. WACC is cost of capital. Put it in this format. There is no tax in this question. No tax in this question. Put the data in this format. Put the data in that table format. I want you to do it. Put the data in that format, you will get to the answer. Please try doing it. Please try to do this. Put the data in that format. We had an EBIT given in the question, which is 46 lakhs. Subtracted the interest, got EBT of 36 lakhs. Cost of debt is 10 and 18. So that gave value of debt of 1 crore, value of equity of 2 crore, and value of firm was 3 crore. Reverse working, cost of capital is 15.33. Cost of capital is 15.33%. The question has said additional profit of 19 lakhs. So 46 became 65. Interest went up. EBT is now 45 lakhs. Value of debt from 1 crore is going up to 2 crore. Value of equity remains same 2 crore. So value of firm has gone up to 4. And when I reverse work, I get cost of capital is 16.25. Cost of capital is 16.25. Cost of capital balancing figure is 16.25. Just give me a minute. Any doubts on this? Any doubts on this part? Clear?
Sir, cost of debt also same.
10%, no? The new debt is also 10% only, no? The new borrowing is also 10%. Any doubts on this? Quickly do 14 in the same format. Do 14 in the same format. There's nothing rework to be done. Put 14 in the same format, you will get to the answer. Do question 14 in the same format. Put the data in the same format, please, quickly. EBIT is 1 lakh. Cost of debt is 10%. Value of debt is 5 lakhs. Equity, cost of equity is 15%. Value of firm and cost of capital is EBIT by value of firm, 12%. So the question wanted value of the firm, which is 8,33,333, and cost of capital, which is 12%. Cost of capital and this both were asked. Cost of capital is 12%, value of firm is 8,33,333. Any doubts on this? Now, till now we have done questions on without taxation. Questions on without taxation. Now we are going to bring to questions with taxation. When I do problems with the taxation, if approach is asked in a question, they may give a scenario called as without debt and with debt. You will understand as we do this question. Let's come to question 15. There are two firms P and Q which are identical except P does not use any debt in its capital structure while Q has 8 lakh 9% debenture in its capital structure. Both the firm have same earnings before interest and tax. Capitalization rate is 10%. Corporate tax is 30%. Calculate the value of the firm according to hypothesis. They would have given two companies. One company has borrowing, another company does not have borrowing. So how does that impact in the calculation? You'll understand now. The same format I'm going to add now on less tax EAT, EBIT less interest, EBT less tax EAT. Now listen for some time. Firm P and firm Q will first complete the solving of a company which does not have any borrowing. Will solve the company which does not have any borrowing. There are two firms P and Q except P does not use any debt in its capital structure. So let's focus on completing firm P and then we'll come to firm Q which has borrowing in its capital structure. It said Q has 8 lakh 9% debenture. Both the firms earn 2 lakh 60. 2 lakh 60. It does not have any borrowing. So your EBT is 260. Tax rate in the question is 30%. EAT is 1 lakh 82. Cost of debt is not applicable. Cost of capital, the capitalization rate. Both the firms have EBIT of 2 lakh 60 and the capitalization rate is 10%, which is cost of capital, or technically it is the cost of equity because it does not have any borrowing. For it, cost of equity or cost of capital both are same. Value of debt is 0. Value of equity is EBT into 1 minus tax rate by cost of equity. EBT into 1 minus tax rate by cost of equity. Can you tell me how much? Or technically it's EAT by cost of equity. EBT into 1 minus tax rate is nothing but EAT. 1 lakh 82,000 by 10%. 18 lakh 20. Value of firm is EBIT into 1 minus tax. I can add also, but the formula is EBIT into 1 minus tax rate by cost of capital. EBIT is 2 lakh 60. 1 minus tax rate is 0.7 and cost of capital is 10%. Cost of capital is 10%. We got the unlevered company. We are done with the unlevered company, the company which does not have any borrowing. Value of levered company is equal to, this is what MMS said, value of levered company is equal to value of unlevered company plus debt into tax rate. Debt into tax rate. Why we are adding debt into tax rate is because when you borrow money there are tax benefits. So he went ahead and said that unlevered company will have lower value. Levered means company which has borrowing, their value will be slightly better. Why is it better? Because they are taking borrowing. When you take borrowing, you pay interest. When you pay interest, you get tax benefit on interest. So value of levered companies, unlevered 18 lakh 20. How much is the borrowing of the second company? 8 lakhs into 0.3, which is 20 lakh 60,000. They've just asked for valuation. Some question in not only valuation, they may ask for other items also. Like they may ask you for cost of equity, cost of capital. So I'm going to fill this table now. Value of firm of this entity is 20 lakh 60. 20 lakh 60. Value of debt is 8 lakh. Value of equity balancing figure 12 lakh 60. Your EBIT is 2 lakh 60. Interest is 8 lakh into 9%. 8 lakh into 9%. I think the rate of interest was 9% debenture. Your EAT is 131,600. EAT is 131,600. Cost of debt is 6.3. Cost of debt is 6.3. Interest into 1 minus tax rate. Interest into 1 minus tax rate, or you can say interest into 1 minus tax rate by value of debt. This interest expenditure of 72,000 into 1 minus tax rate by value of debt. What is the formula for cost of equity? Formula for cost of EBT into 1 minus tax rate by value of equity, or technically EAT by value of equity. So this.
Sir, after finding value of firm, can you just repeat what you did, sir?
Value of firm I got. After getting the value of firm, I have copied the value of debt given in the question. Value of equity is balancing figure 2060 minus 8 lakh. Value of equity is balancing figure, and then copied the EBIT because both are earning same. Subtracted interest, EBT, subtracted tax, EAT. Cost of equity is EAT divided by value of equity, and cost of capital is EBIT into 1 minus tax rate by value of firm, which is 8.83. 8.83. Some questions may tell you to just do the value of firm. Some question may tell you to ask you to calculate even cost of capital and cost of equity. Any doubts on this? First, we will do a company which does not have borrowing, and then value of the company with borrowing is equal to value of the company without borrowing plus amount of debt into tax rate. Put it in the format. The format will give you balance answer. The format will give you the balance answers. Just give me a minute. Okay, do question 16. Part B, okay, not part A. I don't want you to do without taxes. Do second part, 40% taxes. Question 16. Determine the market value, equity capitalization rate, weighted average cost of capital, assuming 40% taxes. Do the format with taxes. Do with taxes format. First, complete the value for a company which does not have borrowing. First, do the company without borrowing. same format, you will get to the solution. An extremely simple area, purely format driven. Purely format driven. The company which does not have borrowing has a value of 60 lakh. The company which does not have borrowing has a value of 60 lakh. Cost of equity was given in the question, which will give you value of equity and value of firm. Company which does not have borrowing has a value of 60 lakh. Without borrowing, the value is 60 lakh. First, to do the company which does not have borrowing, whose value is 60 lakh. What is the value for the company which has borrowing? 60 lakh plus what is the amount of borrowing? 54 lakhs into tax rate 0.4. 81 lakh 60. In that, debt is 60 lakh. Equity balancing figure. Equity balancing figure 2160. Equity balancing figure 2160. Value of debt is 60 lakh. Equity balancing figure 2160. How much is the debt? Oh, sorry, 54. Sorry. 2760. Sorry? Can be. Cost of equity is 25.4%. Cost of capital is 13.24. Straightforward format driven area. I don't have anything beyond the format. The format will give you answer to almost all the questions. All questions can be solved using this format. $25.04 and 13.24. So there's one format for with taxes, one format without taxes. With taxes, if it's Modigliani-Miller approach, then you'll have to follow without. First, you will have to value the company for a company which does not have borrowing. Then the valuation is done for a company which has borrowing. Value of levered companies, unlevered plus amount of debt into tax rate. I'm not doing 18, but the 18 talks about something called as net operating income approach. Whenever question uses the word net operating income approach, that net operating income is nothing but Modigliani-Miller. NOI approach is basically Modigliani-Miller. Both the approaches are same. Both made the same conclusion. So if taxes are there, it will work the same way. It will work the same way. Now let me quickly touch upon the, just give me a minute. 17 is okay, manageable. Just give me a minute. Okay, net income theory, net operating income or Modigliani-Miller. These are the only two types. Traditional theory is there, but that doesn't have a major conclusion. They have made some conclusion on cost of equity, cost of capital. If you are doing any rework scenario under a net income approach, cost of equity will remain constant. cost of equity. That is whether you have 0 borrowing, 5 lakh borrowing, 10 lakh borrowing, 15 lakh borrowing, 30 lakh borrowing, 50 lakh borrowing, cost of equity will be same. Cost of equity will be same. So if the question says follow net income approach and do a rework, you should copy the cost of equity for all years. You should copy cost of equity for all the scenarios, because the theory said cost of equity will remain constant. Because cost of equity does not change, cost of debt is normally lower than cost of equity. Your borrowing is always cheaper than equity. So cost of capital will come down with borrowing. Will come down with borrowing. This is what this theory said. Will come down with borrowing, and value of firm will increase with borrowing. Why does value of firm increases? The formula for value of firm is EBIT by cost of capital. If denominator keeps coming down, the value of the firm will keep going up. This set will increase with borrowing. Constant. We did a problem where initial problem they said calculate cost of equity as per Modigliani-Miller approach. So I said value of firm will remain constant, cost of capital will remain constant. Traditional theory, there's another theory where the question has to mention. The traditional theory said cost of debt can rise till some time, cost of debt can come down, cost of equity can remain constant, can go up, can come down, cost of capital can come down, can. So it did not make any major conclusion. It said it all depends on the market expectation. Modigliani-Miller said your cost of capital and value of firm has to remain constant for all rework scenario, unless you bring in taxation angle. When you bring in taxation angle, what happens is your value of firm is equal to value of unlevered firm plus amount of debt into tax rate. A same company today could be unlevered. What is unlevered is it does not have any borrowing. After that they may borrow. If you are borrowing, your value will go up. Your value will go up as far as approach with taxes is concerned. Approach with income tax, because what is said is value of levered company is equal to value of unlevered firm plus amount of debt into tax rate. You can quickly note this. Just quickly note this alone.
Value of firm will increase
With borrowing. Okay, clear? Okay, this is the question I was talking about. RES is an all equity finance company with a market value of 25 lakh, cost of equity 21%. Company wants to buy back equity shares worth 5 lakh by issuing and raising 15% perpetual debt. Rate of tax may be taken as 30%. After the capital restructuring, applying model with taxes, you are required to calculate market value, cost of equity and WACC. Before, I was an all equity finance company. I am going to do some buyback of share, borrow. So earlier RES is an unlevered company. After that RES will become a levered company. So we were doing comparison of two companies. Now the same company is called as an unlevered company as well as a levered company. So we will do the valuation before restructuring. It's an unlevered company. After restructuring, it is a levered company. In the same format, you will get to the answer. Let's put it in that format. Particulars before restructuring and after restructuring. Before and after. Before restructuring. After restructuring. Their plan are before buyback technically. They are planning to do some buyback and all. Before restructuring and after restructuring. Before and after. Before restructuring and after restructuring. Before restructuring, it's an all equity finance company. let's capture whatever value they have given. Market value is 25 lakh. Equity will also be 25 lakh because there is no debt. Value of firm is 25, equity is 25, there is no debt in this company. Cost of equity is 21. Cost of capital will also be 21, no cost of debt. Equity and debt will be 21. Okay, before I come to the other part, I have these data. If you have if you have cost of equity and value of equity, you can calculate earnings after tax. You can calculate earnings after tax. The formula was cost of equity is equal to EAT by value of equity, or EBT into 1 minus tax rate by value of equity, which is EAT. So earnings after tax is going to be equal to cost of equity into value of equity. You have to keep interchanging that formula and get to the answer. So this is 25 lakh into 21%, 5 lakh 25,000, 5 lakh 25,000, 5 lakh 25,000. I think tax is some 30%. So divided by 70, 0.3, EBT is 7 lakh 50, there is no interest. EBT is 7 lakh 50 and there is no interest. This is before restructuring. This is before restructuring. After restructuring, it becomes a levered company. It becomes a levered company. The value is unlevered firm plus amount of debt. How much borrowing they are going to take? 5 lakhs. What is the tax rate? 0.3. So value of debt is 5 lakh. Equity balancing figure 2150. Value of debt is 5 lakh. Equity balancing figure 2150. Equity balancing figure 2150. EBIT copy pasted 7 lakh 50. Interest is into 15%. EBT is 675. You know the formula for cost of equity. Cost of equity is EAT by value of equity. WACC is EBIT into 1 minus tax rate by value of firm. $21.98 and 19.81. 21.98 and 19.81. Okay, I'll maybe take a break of 15 minutes and then continue with the next area. We'll take a break of 15 minutes and then continue. Okay, let's now move to another chapter, which is on risk analysis and capital budgeting. A chapter which has a lot of computation to be done because it's a computation heavy chapter. But there are few areas only to be discussed. This is not a voluminous chapter. It is slightly lesser on the volume side. Now, in this chapter, you will learn first about how do you calculate expected NPV. Listen for some time. How do you calculate expected NPV? Expected NPV is the weighted average of various possible NPV with probability being the assigned weight. Second, you will learn about standard deviation, where there is something called as independent cash flows and dependent cash flows. You will understand when we do it. Third concept you are going to learn about is RADR approach, CEF approach, and then finally you do something called a sensitivity analysis. So broadly limited concepts are there. Let's directly start with some problem solving. Let's come to question 1. Shivam Limited is considering two mutually exclusive projects A and B. Project A cost 36,000, project B 30,000. You have been given the following NPV distribution: project NPV probability, calculate expected NPV, calculate standard deviation, calculate profitability index, and which project would you recommend and why? Now, let me first explain this question. In this question, NPV has been given, probabilities have been given. The same type of a problem you may do a second or third question where NPV may not have been given. You'll have to calculate NPV and then follow this approach. So we are required to calculate expected NPV and standard deviation. So there's a format to do this. Let's start. Working note 1. I'll do only one project. Computation of NPV and standard deviation. Computation of NPV and standard deviation. NPV and standard deviation. NPV, probability. These are the two numbers I want, okay. If I have NPV and probability, I can calculate expected NPV and standard deviation. Everything can be calculated. NPV and probability as given in the question. NPV, probability, product, deviation, and PD square. Probability into deviation. NPV, probability, product, deviation and PD square. This is the format we will follow. In that, NPV and probability either can be given directly or you will have to calculate. Important part is getting NPV and probability. This problem in short doesn't have anything because it's only calculator's job. There's nothing which you need to do in this question. The NPV given in the question is, I'll do it in thousands. If you do it as 15,000, when you square it, it will become 15,000 into 15,000, a huge number. So it will become difficult for you to solve. So in thousands, 15, 12, 6, 3, probabilities are given 0.2, 0.3, 0.3, 0.2. Probability is, understand the calculation. Let's not get into much of writing. I don't think so much of writing will help in this question. In this area at least, writing is not going to help because you will keep focusing on writing things rather than understanding it. Let the focus be on understanding stuff. Other areas at least it's not that voluminous. This is a hugely time consuming area from a calculation point of view. NPV into probability is product. NPV into probability is product. So I'll put a total because it will take you a lot of time to do the calculation. So let's not spend time on calculation. NPV into probability is product. Deviation is NPV minus sum of product. NPV minus sum of product. So 15 minus 9, 12 minus 9, 6 minus 9, 3 minus 9. And PD square is probability into deviation into deviation. Probability into deviation. Square is only for deviation. Probability into deviation into deviation. We put a total for this as well. Expected NPV is sum of product 9,000. Expected NPV is 9,000. Sum of your product. Standard deviation is square root of PD square. Square root of PD square. So I'll take a square root of this. And I'll multiply this with 1000, okay. Standard deviation is rupees 4,450. Rupees 4,450. That is the standard deviation. I've taken a square root, multiplied with 1000 because we did the problem in 1000. So your standard deviation is 4450. The problem is over. That's all. This is what this question wants you to do. It is more of a calculator's job. I can change the numbers for the second one and I can get to the answer. They've also asked for profitability index. This is more of the solving. Can you close the door? Profitability index. When you do profitability index, you will learn of more about this in investment decision. Profitability index is inflow by outflow. Inflow is NPV plus outflow. I'm not going to spend much time on this. This is something which you learn in investment decision. NPV plus outflow. NPV was 9,000. Outflow was 36 by 36. Some 1.25 times. 1.25 times. That's on the profitability index. The important part is this: NPV, probability, product, deviation and PD square. This is the format which will help you to calculate the expected NPV and standard deviation. Expected NPV is NPV into probability. You get the product, put a total of the product. That's called as the expected NPV of the project. Deviation is NPV minus the sum of the product. And PD square is probability into deviation into deviation. Any doubts on this? Let's get to question 2. A Limited is considering two mutually exclusive projects. You have been given the following net cash flow probability distribution of each project. Probability net cash flow 50,000, 60,000, 70,000. Expected net cash flow, variance, standard deviation, coefficient of variation. I'm not bothered about project Y. I'm just going to focus on project X. The only difference between this question and the earlier question is, earlier questions use the word expected NPV. This question is saying please calculate expected net cash flow. And net cash flows are given in the question. So what I'm going to do is, I'm substituting here, okay, 50, 60, 70, the probabilities are given 0.3, 0.3, 0.4. The expected net cash flow is 61,000. The expected net cash flow is 61,000. Expected standard variance is 69, and your standard deviation is 8,307. Standard deviation is 8,307. So the same thing, instead of using the word NPV, they have used the word net cash flow. 50, 60, 70. The probabilities were given 0.3, 0.3 and 4. I have done a product of that. The total is 61. Let's ignore this part of it. Deviation, probability into deviation, the sum was 69. So this is there. The only thing is, in variance you will have to do into 1000 two times, okay, because variance is a square. So you'll have to do into 1000 two times. Your standard deviation is 8,307. Okay, I'll touch upon coefficient of variation. Now listen, coefficient of variation formula is NPV, the formula is risk per unit of return. This is the formula, okay. Risk is measured through standard deviation, return is measured through NPV. Coefficient of variation formula is standard deviation by NPV. This question, it is standard deviation by NCF, standard deviation by net cash flow. I have done only project X, I have not done project Y. Previous question also read only one project. Now last part of the question may ask you this. Now how do you select this? For example, if you look at the previous question, the NPV was 9,000, this also 9,000. The return is same for both. The project, but from a risk point of view, this was 4450, this is 3795. So what I do is, I will select a project which gives me lower. See, there are two types of people. There is a conservative investor and there is an aggressive investor. An aggressive investor is one who chooses higher return. Both the projects give same return, 9,000. A conservative investor wants lower risk. So you will go ahead and select this project. Standard deviation is lower, return is same. Return is 9,000 but lower standard deviation. What you will see mostly is, the question will say return is 10,000, 12,000. Standard deviation is 4,000, 6,000. It's very difficult for me to select a project now. Why it is difficult? Because 10,000 and 12,000, return is higher here, risk is lower here. So one person will say project A, another person may say project B. So what will get selected will depend on the riskiness of the investor, risk appetite of the investor. Certain people are not interested in taking risk. If you are not interested in taking risk, if you are a conservative investor, you will select project A. If you are an aggressive investor, you will select project B. Sometimes a rare scenario, this could be 6,000 and this could be 4,000. Then this is the best possible thing, because high return as well as low risk, So obviously I go ahead with the second project. Okay, let's come to question 3. Project X and project Y are under the evaluation of XY company. Estimated cash flow and their probabilities are as follows. Project X, investment of 70 lakhs in year 0, probability, cash flows. Project Y, investment of 80 lakh, probability and cash flow. Which project is better based on NPV? Compute the standard deviation and analyze the inherent risk of the project. Go through this. Okay, if I compare this with the earlier question NPV was given to you. They gave you 3 different NPV and then you calculated the answer. This question they have given the cash flows. If I compare with the question 1, they have given the cash flows, they have not given you the NPV. So how do we go about solving these type of problem is what you're going to understand. Let's come to project X first. When it comes to project X, for every year they have given the cash flow. For example, year 1 can be 30 or 50 or 65, year 2 can be 30, 40 or 55, year 3 can be 30, 40 or 45. For every year you have to calculate NPV and standard deviation. For every year you will have to calculate NPV as well as standard deviation. What is the use of standard deviation? You will understand. So NPV and SD of year 1, NPV and standard deviation of, sorry, not NPV, expected cash flow and standard deviation of year 1, same format. They have given the cash flows as 30, 50 and 65, 30, 50 and 65 for the first year. The probabilities are 0.3, 0.4, 0.3. The expected is 48.5. So expected cash flow is 48.5. Standard deviation of year 1 is some 13.61. You can just check the calculation if at all any error is there. 30, 50 and 65, 13.61 and 48.5. This is year 1. You have to repeat this for year 2. You will have to repeat this for year 2. Expected cash flow and SD of year 2. Year 2 is 30, 40 and 55. Expected cash flow is 41.5, standard deviation is 9.76. Standard deviation is 9.76. You will have to repeat this for third year. You will have to repeat this for the third year. SD of year 3, 30, 40 and 45. Once you get these 3 numbers, that is standard deviation for every year and expected cash flow for every year. You will have to calculate expected cash flow for every year and standard deviation for every year. I may have to repeat this for project Y also. One good part about project Y is year 1, year 2, year 3, all the 3 years the same number will be there, because they have not given separately cash flow for each year. They have given the same cash flow for all the years. They have given the same number for all the 3 years. So there, when you do NPV and standard, so when you do expected cash flow and standard deviation, you calculate for first year, the same will be for second year, the same will be for third year. That is as far as the project Y is concerned. Once we are done with this, computation of NPV, year, cash flow, PVF, DCF. This is the format you would have learnt as part of investment decision to calculate NPV. Year, cash flow, PVF and DCF. Three years. Year 0, the outflow of the project is 70 lakh. Year 1, we are earning 48.5. Year 2, we are earning 41.5. Year 3, we are earning 38.5. You will not be in a position to write this. Understand the calculation properly. Every year, what is the expected cash flow we have calculated. Every year, we have also calculated the standard deviation. Both have been done. Expected cash flow and standard deviation. What is the discount rate given in the question? 10%. 10%. And this is my NPV. I'm not going to spend any time on explaining this part of it. So what we did is for every year, we we calculated the expected cash flow. We calculated the expected cash flow and calculated the weighted average of that, and then did this answer. This is the expected NPV of the project. Any doubts on this? Any doubts on the expected NPV? Next comes the standard deviation. This is slightly tricky. Computation of standard deviation. Year standard deviation, discounted standard deviation square. What is the reason for square and all, you will understand. Year standard deviation, PVF for 10%, discounted standard deviation, and DSD square. What is this DSD square? You will understand. Every year I had told you to calculate standard deviation. Every year we did a standard deviation calculation. First year the standard deviation was 13.61. Second year the standard deviation was 9.76. Third year the standard deviation was 5.94. Every year we had to calculate a standard deviation. Now you have calculated the standard deviation of every year. You cannot add them together. Standard deviation of year 1 is the first year value, then second year value, then the third year value. You need to discount them at that cost of capital, which is 10%, and this is called discounted standard deviation. Another thing is square of this. This is called discounted standard deviation square. You will do a square of this. You will do a square of this. See, one is you have the standard deviation, multiply with the PVF, that's called discounted standard deviation. Then there's something called as discounted standard deviation square. Now SD if cash flow are dependent, SD if cash flow are independent. There are two types of cash flow. Okay, what is dependent cash flow is if you get a bad year, you will continue to get a bad year. Dependent means if you start the project first year it is successful, it will continue to be a successful project. First year is bad, it will continue to be a bad project. This is a slightly riskier proposition. Dependent cash flow is risky because if you get a good year, you are happy, you will continue to get a good year. But if you get a bad year, you are gone, you will continue to have only bad years. Independent means 1 year could be good, second year could be bad, third year could be good, fourth year could be bad, fifth year could be moderate. So you will get a combination of it. You will get a combination. So independent is less risky. Independent is less risky. Dependent is more risky. Now what you need to do is, one of the answer is square root, because you took a square. Now you need to take a square root. See, DSD, then we squared it. We squared it. I put a total of that. There is a total for discounted standard deviation. There is also a total for discounted standard deviation square. There is a total for discounted standard deviation. There is also a total for discounted standard deviation square. For the square, take a square root. One answer is 24.89 lakhs and another answer is 15.42 lakhs. Your independent is less risky, so it will have lesser standard deviation. Dependent is more risky, it will have more standard deviation. One answer is total of DSD, another answer is total of DSD square with a square root. Total of DSD square with the square root. So one answer is 24.89 lakh, another answer is 15.42 lakh. It all depends whether the cash flows are dependent or independent. Some question may even tell that. Some question may even go ahead and tell that. Just give me. Yeah, you have SD if cash flows are dependent 24.89 lakh, SD if cash flows are independent, which is a square root, you end up getting 15.42 lakh. It depends on whether the cash flows are dependent or independent. If the problem is silent, you will have to do both. When you repeat for project Y, when you do for project Y, the only thing I was saying is this 45.5 will be the same for year 1, year 2, year 3. Same 45.5 and same 3.5. It's not going to be different for different years because they have given only one number. So when you did standard deviation, see here, same 3.5 for all the 3 years. Same 3.5, DSD, DSD square, sum of DSD, square root of DSD square. Sum of DSD and square root of DSD square. Let's look at question 4. Jet Airways is planning to acquire a light commercial aircraft for flying class clients at an investment of 50 lakh. The expected CFAT for the next 3 years is year 1 CFAT and probability, year 2 CFAT and probability, year 3 CFAT and probability. Company wishes to take into consideration all possible risk factors relating to an airline operation. Company wants to know expected NPV with a 6% discount rate. Possible deviation is standard deviation if cash flows are independent and if cash flows are dependent. I'm not going to do the question, but I'm just going to explain it here. This question we are not going to do. If you look at this question, it's exactly same as previous question. It's exactly same as previous question. There is going to be a variant of this question which I'll explain in some time. Here what you will do is year 1. What you need to do is calculate expected NPV and expected cash flow and standard deviation. Year 2 expected cash flow and standard deviation. Year 3 expected cash flow and standard deviation. For NPV calculation, year, cash flow, PVF at 6%, DCF, the cash flow is the expected cash flow which you calculated. Standard deviation they are asking both. See here, cash flows are independent, cash flows are dependent. So when you do standard deviation, there will not be a year 0, it will start with year 1. Year, standard deviation, PVF, discounted standard deviation and DSD square, discounted standard deviation and DSD square. Total of discounted standard deviation is dependent answer. DSD square total square root is independent. DSD square total square root is independent. Any doubts on this? We are going to see a variant of this now. This is the dependent cash flows are considered to be riskier. In this case, a weak cash flow will always be followed by a weak cash flow. Good cash flow will always be followed by a good cash flow. The problem is, if I get into a weak cash flow, I will be suffering continuously. I'll be suffering continuously. Whereas if it's independent, you have a hope for recovery. You have a hope for recovery. Good, bad can keep happening. Go through 5. Go through 5. I'll explain the variation which is going to be there in this question. Go through question 5, please. Okay, now listen. I have an initial investment of 1 lakh. Every year the inflow can either be 20,000, 30,000 and 40,000. Life is 5 years, salvage value, everything is given. If I go back, it is similar to this question. Every year the same cash flow is there. Every year the same cash flow was there in that problem also. In that problem also, they said either it can be 40 lakhs, 45 lakhs or 50 lakhs and the probability were given. They did not use the word best to worst or something, those wordings were not used. But it's similar to this question. If you look at this question, the requirement was standard deviation and which project is better. If you look at this question, they want us to calculate worst case NPV, best case NPV, probable NPV. The question is asking for some worst case NPV, best case NPV. When a question asks for worst case NPV or best case NPV, what you are required to do is, for every cash flow you will have to separately calculate NPV. For every cash flow you will have to separately calculate NPV. Once you get the NPV separately for every cash flow, from there on, if you want standard deviation you can calculate. If you want standard deviation thereon, if the question says also calculate standard deviation, question says also calculate NPV, all that is possible. I go back to question 1. If you remember, in question 1 what happened is they gave you different NPV, different probability. So what we are going to do is, first we'll convert this question like question 1. We are going to convert this question like question 1. What is there in question 1? NPVs were given, probability were given. So 1, you will calculate an NPV using this 20,000. Second, you will calculate an NPV using this 30,000. Third, you will calculate an NPV using this 40,000. Once you get 3 different NPV, it becomes like problem number 1. Why am I calculating 3 different NPV? Why not follow the approach which we followed earlier? What did we do earlier? We calculated the standard deviation of cash flow and NPV of cash flow. You can follow that approach also in this question, but you will not be able to answer what is worst case NPV, what is best case NPV. You will not be able to answer what is the worst case NPV and what is the best case NPV. What is worst case, best cases? You will have to give different answers. You need multiple NPVs. For example, this question 1 which we had 4 NPVs in the question. So I can say best NPV is 15,000, worst NPV is 3,000, the probable NPV is what you had calculated. So all that is possible. If I tell you to give me the best case and worst case for question 2, you cannot give because you did not follow that approach. Sorry, question 3. In question 3, what you did is you calculated your final NPV can be either you calculate different NPV and then take a weighted average, or you take a weighted average of cash flow and calculate one NPV. It's your wish whether you want to take weighted average of cash flows and get one NPV as an answer, or calculate NPV and then take a weighted average. Both will give you the same answer. Answer is not going to be different. The only issue is this approach which I said in the earlier question will have to be followed if they ask you standard deviation and they say dependent cash flow and independent cash flow. If the question uses these wordings, you will have to follow what I said earlier. If the question asks you to calculate best case NPV and worst case NPV, best case NPV and worst case NPV, I am not doing this part of the answer. This is the one NPV, this is the second cash flow, this is the third cash flow, and I get 3 NPVs. Okay, so the NPV can be negative 40,180. The NPV can be negative 2,230. The NPV can be 31,700. I am not doing this part of it because you know how to calculate NPV. Here cash flow. In cash flow I have split into 3 different scenario. PVF, DCF also have split into 3 different scenario. Once you get this, you go back to question 1. What did the question 1 do? Question 1 had given the different NPV. Question 1 and also given the different probability. For example, if I go back to question 1, this is what you are done in question 1. In this I am going to write minus 40.18, minus 2.23 and 31.70. The expected NPV is 0.1, 0.7, 0.2. The expected NPV is only 761. Not sure whether the numbers are right. Okay, yeah, number seems to be right. The expected NPV is only 0.76 thousand. The expected NPV is 0.76, and if you want standard deviation, that's also possible. Just give me a minute. The standard deviation is 19,113. The standard, exactly the same approach. Okay, in that question you had NPV and probability given. This question, the NPV and probability were not given. Once you get NPV, probability, do product, do deviation, do PD square. Product total will give you the expected NPV. Square root of PD square will give you the standard deviation. The only headache is if they say dependent, independent, that and all I cannot handle here. Dependent NPV, independent NPV and all we cannot handle in this format. If you want dependent, independent, then you will have to calculate individually every year standard deviation, individually every year expected cash flow, and then follow that format, which is year, standard deviation, PVF, DSD square. So this format can give you only one standard deviation. It cannot give you 2 standard deviation. It can only give you 1 standard deviation. Any doubts on this? Let's look at the requirement of the question. Probable NPV is this 0.76. Probable NPV is 0.76. Worst case is negative 40,180. Worst case is negative 40,180. Worst case is the lowest NPV. Best case is 31,700. Positive 31,700. State the probability of occurrence of the worst case if the cash flows are perfectly positively correlated over time. Now listen. they will ask you for probability, saying two types of cash flow. One is correlated. Correlated means dependent. Correlated means dependent. Second type of cash flows are not correlated or independent. Not correlated or independent. Worst case, the probability of worst case is 0.10. The probability of worst case is 0.10. Listen, if they are perfect correlation, answer is 0.10 or 10%. Answer is 0.10 or 10%. The probability of that was 0.10. I have directly written that. If they are independent, listen, if they are independent, first year has to be bad, second year has to be bad, third year has to be bad, fourth year has to be bad, fifth year has to be bad. If they are dependent also, first year, second year, third year, all year have to be bad. But the problem is independent, once the first year is bad, second year will only be bad, third year will be bad, fourth year will be bad, fifth year. So if it's independent, first year bad is 0.10, second year bad is again 0.10, third year bad is again 0.10, fourth year bad is 0.10, fifth year bad is 0.10. It's like that when you toss 5 coins, all the 5 coins should be head, which is 1 by 2 into 1 by 2 into 1 by 2 into 1 by 2 into 1 by 2. So if it's independent, the probability is 0.10 into 0.10 into 0.10 into 0.10 into 1.10. It will be a very insignificant number, because independent means all 5 years will not be bad. That's the lowest possibility. That's the very rare possibility that all 5 years will be bad, and that probability is 0.10 power 5. 0.10 power 5. Whereas if it's dependent, first year bad is 0.10, second year bad is into 1 into 1 into 1, because once it is bad, it's always bad. Once it's bad, it's always bad. So here also joint probability only 0.10 into 1 into 1 into 1 into 1, because if you get a bad year, you will continue to get a bad year. So first year 10% chance of a bad year, second year 100% chance. If you get a bad year, it's only a bad year after that. So 0.1 into 1 into 1 into 1, it becomes 0.10, and this is I think 0.0001. So it will be a very insignificant number, because 0.10 power 5. Clear? Able to understand this? Any doubts? Two types of cash flow: dependent, independent. Dependent are considered to be more risky. Dependent are considered to be more risky, and the probability of the worst case is 10% there. Probability of the worst case is 10%. Independent is less risky, the probability is also lesser. Okay, next approach is RADR, risk adjusted discount rate. I've discussed on NPV and standard deviation. Again, I'm repeating. One NPV could be given in the question. You do NPV, probability, product, deviation, PD square, and be done with the question. Cash flows could be given in the question. If they give cash flow, calculate expected cash flow and standard deviation for every year. Expected cash flow will give you NPV, standard deviation year, standard deviation PVF, DSD square will give you the standard deviation. This approach, but they want best case, worst case and all in the question. Then first calculate NPV for the given cash flow, go back to question 1 format and complete the solution. Next is RADR approach, risk adjusted discount rate. Now what does RADR approach says is that you can have multiple projects. Now all projects do not carry same risk. Some projects have higher risk, some projects have lesser risk. So you cannot say that you will have to use the same discount rate, because what normally companies do is they'll say my cost of capital is 12%, use 12% as the discount rate for all projects. But some projects carry more risk, some projects carry less risk. So using the same discount rate for all projects is not logical. So under RADR approach, we are going to use different discount rate for different projects. Calculation of NPV is simple: year, cash flow, PVF, DCF, but the discount rate can be different for different projects. Let's look at question 6. ABC is evaluating 3 projects, P1, P2, P3. Following information is available: particulars, cost, inflow of year 1, year 2, year 3, year 4, risk index. Minimum required return of 15%, applicable tax rate is 40, risk-free rate is 10%. Find out the RADR, risk adjusted discount rate. Which project is the best? Now, some question will give you directly the risk adjusted discount rate. Some question may give you risk index. Some question may give you coefficient of variation. Different ways are there. Coefficient of variation can also be given. Working note 1, computation of RADR. Working note 1, computation of RADR. RADR is equal to in this question RF plus beta into RM minus RF. RF plus beta into RM minus RF. RF plus beta into RM minus RF. plus beta into RM minus RF. Project 1. The risk-free rate would have been given in the question 10. Beta means risk index. Beta basically means risk index here, 1.8. RM means the normal rate, 15% minus 10. 10 plus 1.8 into 15 minus 10. RF plus beta into RM minus RF. 10 plus 1.8 into 15 minus 10. If your risk index is more than 1, it's a riskier project. Risk index less than 1, it's less riskier project. 10 plus 1.8 into 15 minus 10, how much you get? 19%. Project 2, 10 plus 1 into 15 minus 10. 15% as it is. 10 plus 1 into 15 minus 10. 10 plus 1 into 15 minus 10. Project 3, 10 plus 0.6 into 15 minus 10. 10 plus 0.6 in 13%. I am not doing beyond this. You have the cash flow. You will have to use the discount rate, year cash flow, PVF, DCF, and whatever NPV you calculate, that's called as risk adjusted NPV. That's technically called as risk adjusted NPV. So this is discounted at 19%. Second project is at 15%. Third project is at 13%. You are going to use different discount rate for different projects. An enterprise is investing. Let's come to question 7. An enterprise is investing 100 lakhs in a project. Risk-free rate of return is 7%. Risk premium expected by the project is management is 7%. Life of the project, following are the cash flow. Calculate NPV based on risk-free rate and also on the basis of risk adjusted discount rate. Go through the question. Okay, I have year, cash flow, PVF, DCF. Year and cash flow are directly given in the question. They want you to calculate two NPV. One is based on risk-free rate. Risk-free rate means discount at 7%. Risk-free rate means discount at 7%. Based on RADR means 7 plus another 7, discount at 14%. 7 plus another 7, discount at 14%, you will get to the same approach. Year, cash flow, PVF, DCF, the NPV will obviously change. 7% will give a higher NPV, 14% can give a lower NPV because you are increasing the discount rate. So this is discounted 7%, then you are discounting it at 14%. Then you are discounting it at 14%. 7 plus another 7, 14% is the discount rate. Question 8. Okay, there's nothing much on this question. Invest Corporation Limited adjust risk through discount rates by adding various risk premium to the risk-free rate. Depending on the resultant rate, the proposed project is judged to be a low, medium or high risk project. Risk-free rate, risk premium. Demonstrate the acceptability of the project on the basis of risk adjusted rate. Now, this question, basically what they are saying is, if you are a low risk project, read it and let me know. If you are a low risk project, what will be the discount rate? Low risk project, what should be the discount rate? Read that table and tell me. Low risk project means what should be the discount rate? 8 plus 4, 12. Low risk means risk is still there, but I need 8 and extra 4. High risk project means what should be the discount rate? 18. Medium risk is 15. Medium is 15, high is 18. Now you need to assume some cash flow, random cash flow, and calculate NPV and then say how the project gets accepted at different levels of risk. This I don't see getting tested in exam. This is just an assumption. Any assumption can be taken. The cash flows were selected in such a manner that low risk project will get accepted, medium and high risk will get rejected. I selected the cash flow in that manner. It may not get tested mostly in exam, but basically you assume some cash flow and calculate NPV and say that the NPV will keep changing based on your discount rate. Okay, let's come to 15. Determine the risk adjusted NPV of the following projects. XYZ, outflow, life, inflow, coefficient of variation. Company selects RADR on the basis of coefficient of variation. Coefficient of variation, RADR, present value factor 1 to 5 years at RADR. Go through the question and tell me what should be the discount rate for X, Y and Z. You go through this for a minute and tell me what should be the discount rate for project X, what should be the discount rate for project Y, what should be the discount rate for project Z. X is what rate? 16%, Y 14%, Z is 12%, and based on that you calculate the NPV. RADR approach basically talks about different discount rates for different project. Now what they can end up doing is they may not give this in question. Coefficient of variation may not be given. Then you may have to calculate coefficient of variation as standard deviation divided by NPV or standard deviation of cash flow by expected cash flow. Some number could be given in the question. They'll give you some number to calculate this. After that is calculated, you get the RADR and then be done with the question. Okay, I'll take a break of 45 minutes. We'll take a lunch break now and we'll resume after that. There's some part of this still pending and then we'll do dividend decision. After this. Okay, let's continue with our discussion. We were doing problems on risk analysis and capital budgeting. We have broadly discussed one, how do you calculate expected NPV, how do you calculate standard deviation, what is coefficient of variation, risk adjusted NPV. I think only two concepts are pending to be discussed. One is certainty equivalent approach and there's something called as sensitivity and scenario analysis. Let's come to question 10. Oil Country Tubular Limited is considering an investment in one of the two mutually exclusive proposal, X and Y, which require cash outlay of 3,40,000 and 3,30,000 respectively. CE approach is used in incorporating risk. Current yield on government bond is 8% and this can be used as risk-free rate. Expected NCF and their certainty equivalence. Which project should be accepted? If RADR method is used, which project must be analyzed with higher rate? Discuss the advantages of certainty equivalent method. Now, see, this chapter focuses on the risk side of it. There's a chapter investment decision which focuses on the return side of it. From risk side, we had first thing called as standard deviation, then we had coefficient of variation, then we had RADR. Now, what certainty equivalent approach says is RADR said different discount rate for different projects. Certainty equivalent said don't change the discount rate and all. You will have to adjust the cash flow. For example, these are the cash flows and these are certainty equivalent factor. What is certainty equivalent factor? It basically gives you what is the probability of this happening. How much confidence do I have that this cash flow will at least come? So this is called uncertain cash flow. You convert this into certain cash flow. Certain means you are 100% sure that at least that much will come. So convert the uncertain cash flow into certain cash flow by multiplying with CEF. After that conversion is done, you will have to discount it at risk-free rate. Let's do this. Working note 1, computation of NPV. So I will have year, cash flow will have 3 sub-columns. Uncertain cash flow, CEF and certain cash flow. Uncertain cash flow, certainty equivalent factor and certain cash flow. You are going to convert the uncertain cash flow into certain cash flow. PVF at, you will discount now at the risk-free rate. You will do discounting only at the risk-free rate, not even risky rate, not even different rates for different project. We normally discount it at risk-free rate. Some question may say you to discount at different rate. That is, they may tell you to discount at risky rate. The only difference between RADR and this approach is in RADR, the discount rate will be different for different project. So here the cash flows are given in the question. 3-year cash flow. The initial outflow is 3,40,000. Inflows are 1,80,000, 2 lakhs and 2 lakh. What we are required to do is, you cannot discount this. use this cash flows directly. If you use this cash flows directly and discount, then that's your normal NPV approach or the RADR approach. Under RADR, the only difference is project X will have a different discount rate, Y will have a different discount rate. So the certainty equivalent factors are, for the first year 0, it's always certain to happen. So we write 1, or you need not even write anything here. You need not write anything here. This is my initial outflow, 3,40,000, 1,80,000 into 0.8. This is what you should take for discounting purpose. Your uncertain cash flow into the certainty equivalent factor will give you the certain cash flow. Use certain cash flow for the purpose of discounting. Use certain cash flow for the purpose of discounting. You cannot use your uncertain cash flow. So this will be discounted at 8%. At 8%, I do the discounting of this, and this will be called as the NPV of the project. Like this, you will have to do it for both the project. This turned out to be minus 7276. You will do the other project, whatever the NPV turns out to be. You will have to convert your uncertain cash flow into certain cash flow. Uncertain cash flow into CEF will give you the certain cash flow. Now, if at all I was following an RADR approach, which project will have a higher discount rate is the next requirement. If you follow an RADR approach, which project should be analyzed with the higher rate? Now, in order to answer this, I'm going to add the CEF. I'm going to add the CEF. The total of this is 2.4. The total of this is 2. 2.4 means this project wise more certain to happen. The certainty equivalent factor tells you how confident are you on the cash flows of the company. The total of the CF was 2.4, which means you are more confident in project Y cash flow as compared to the project X cash flow. This is more certain. More certain means less risk. More certain means less risk. So if I am using RADR approach, project X will be discounted at a higher rate. Project X will be discounted at a higher rate. Project Y will obviously be discounted at a lower rate, because X is considered to be a high risk project, because the certainty equivalent factor is less. It's not on the basis of NPV. The NPV here is negative and positive. I'm not answering based on NPV. I'm answering based on this. The cumulative CF of 3 years is 2 and 2.4. Higher CEF means lesser risk. Higher CEF means lesser risk. Let's go to the last part, which is sensitivity analysis. In sensitivity analysis, we'll have two approaches. One approach would want you to find, see what is sensitivity analysis is. I calculate NPV of a project. The NPV is 5 lakh, 10 lakhs, 15 lakh. It could be positive. But people will keep saying that this is a risky project, this is a risky project. Now, why they keep commenting it's a risky project is, this 5 lakh can become negative. When can it become negative? If there is an adverse movement. What is adverse movement? If selling price comes down, it's an adverse movement. Cost price goes up, it's an adverse movement. Fixed cost going up, adverse movement. Discount rate going up, adverse movement. Initial outflow going up, adverse movement. Anything which is going to negatively impact the NPV. Anything which is going to negatively impact the NPV is an adverse movement. So, though I have a positive NPV, but I'm little worried. That my NPV can become negative. So one approach of doing sensitivity analysis is, I want to know how much should the selling price fall. How much should the selling price fall so that my NPV becomes 0? How much should the selling price fall so that my NPV becomes 0? If it falls more than that, project will become unviable. If it falls more than that, for example, you say if selling price falls by 10%, NPV will become 0. There's a caution for me, because it will become 0, and if it falls even more than that, NPV will become negative. Negative means you should ideally reject that project. So one way of doing sensitivity analysis is finding out what should be the percentage change in these factors. What are the factors? Selling price, cost price, units sold, discount rate, life of the project. So you have multiple factors which can be done. Anywhere the change happens, when do I reach 0? This is one way. The second way of doing a problem is, they'll say assume a 10% variation in the input factor or a 5% variation in the input factor. So they can give you some percentage and then tell you to do sensitivity analysis, or they may tell you to find out when will it become 0. Let's do question 11, where we are testing when will it become 0. PNR Limited is considering a project with the following cash flow: cost of plant 12 crore, running cost 456, savings 12, 14, 11. cost of capital is 12%. Measure the sensitivity of the project to the changes in the level of plant cost, running cost and savings such that NPV becomes 0. Determine which factor is the project most sensitive to. So I want to know when will it become 0. I want to know when will it become 0. How much should be the percentage change. For this type of a problem, we are going to follow this year cash flow PV of DCF only, but with some changes. Year in cash flow, I will write these three items separately, okay. Plant cost, running cost and savings. I am writing them separately, not clubbing them together. I am writing them separately. We normally club them together and write a single cash flow. Plant cost is an initial outflow, running cost and savings you will club it together and write an in between cash flow. You normally club them together, but if it has to become 0, you will have to do a separate analysis. Cash flow, DCF also same three things separately written. Year cash flow, plant cost, running cost, savings. DCF, plant cost, running cost and saving. The discount rate given in the question is 12%. The discount rate given in the question is 12%. I am going to write the plant cost negative 12 crores. Negative 12 crores. Running cost is also separately written, minus 4 crores, minus 5 and minus 6. Savings is 12, 14 and 11. So instead of clubbing them together, we have written this separately. You club it together, you can get the NPV of the project, but sensitivity will become difficult after that, calculation of sensitivity. So I am doing the present value of that, 12 crore into this. Running cost also the same way. And savings also the same way. Instead of clubbing them together, we are doing separate analysis of each of the item. Separate analysis of each of the item. And I am putting a total now. My NPV is basically sum of these three total, okay. NPV is basically the sum of these three total, that is NPV is equal to minus 12 crore, minus 11 crore 82 lakh 90,000 plus 29 crore 70 lakh 60,000. 5 crore 87 lakh 70,000. Now the reason for doing this separately is what you will understand now. I want to know when will the project have 0 NPV. I want to know when will the project have 0 NPV. If I go by plant cost, if I just take plant cost as an example, first factor is plant cost. NPV will become 0 if the value of plant cost goes up by 5 crore 87 lakh 70,000. If the initial outflow increases by 5 crore 87 lakh 70,000, NPV will become 0. NPV will become 0. So sensitivity percentage is equal to change by base. What is the change I want? 5 crore 87 lakh 70,000. Base is 12 crore. Can you tell me this? What is this number? 5 crore 87 lakh 70,000 divided by 12 crore into 100. 40.8. Okay. So the problem is if plant cost goes up by 48% broadly, NPV will become 0. If plant cost goes up by 48.87%, NPV will become 0. Any doubts on this? Factor 2, running cost. If the present value of running cost goes up by 5 crore 87 lakh 70,000, NPV will become 0. If the present value of running cost goes up by 5 crore 87 lakh 70,000, NPV will become 0. So sensitivity is equal to change by base into 100. 5 crore 87 lakh 70,000, base is 11 crore 82 lakh 90,000. If it changes by this level, again it will become negative. What is this percentage? 49 point. So this is the second factor. If your initial outflow, for example, this is an approximate answer, 49.68, you have done rounding off and all here. Just for an imaginary sake, I am adding 49.68% here into 1.4968, you will get a 0 NPV. I am adding 1.4968, 1.4968, NPV has become 0, 3,528, which is broadly 0 NPV, which is broadly 0 NPV. My NPV will become 0 if this goes up by 49.68%. Similarly, if the initial outflow goes up by 48.87, NPV will become 0. 1,26,000 is rounding off, broadly it will become 0. Third factor is savings. Again, sensitivity is equal to change by base. Change is 5 crore 87 lakh 70,000. Base is something we calculated, 29 crore 70 lakh 60,000 into 100. What is this number? How much? 19.7. Okay. My project is most sensitive to a factor called as savings. That is, let's assume your input cost, your initial outflow goes up by 20%. Understand this, your initial outflow goes up by 20%, project will still be accepted. Project will still be accepted because it will not become negative, because the initial outflow should go up by 49% to become negative. Initial outflow goes up by 20%, project will be accepted. Running cost independent, I am not clubbing them together. Running cost goes up by 20%, still project will be accepted. But if savings fall down by 20%, if savings fall down by 20%, project will get rejected. If savings fall down by 20%, project will get rejected. So the project is most sensitive to this factor called as savings. The project is most sensitive to this factor called as savings, because if savings fall by more than 20%, project will get rejected. Clear? This is one approach. The second approach is based on NPV analysis. You will understand that in the next question. So unless you do this separately, you will not be in a position to calculate this. That is why we have done it separately, because for everywhere I wanted this denominator. I wanted the denominator. So that denominator is only possible if we do it separately. Okay. From the following details related to a project, analyze the sensitivity of the project to initial project, annual cash inflow and cost of capital. So they have given three factors: initial project, annual cash inflow, cost of capital. To which of the three factors the project is most sensitive? Variable is adversely impacted by 10%. Variable is adversely impacted by 10%. This is not NPV becoming 0. This is variable adversely impacted by 10. What is adversely impacted? Initial cost going up by 10%. How much is the change in NPV? Annual inflow coming down by 10%. What is the NPV? Cost of capital going up by 10%. What is the impact on NPV? So let's do this. Base NPV. Here I can do it in a table form also. PVF at 10%, DCF, year 0, 1 to 5, year 5, initial outflow is 2 crore, every year inflow is 60 lakh. Can you tell me 5-year annuity factor? Quickly tell me the 5-year annuity factor. $3.790. Okay, ठीक है. So I calculated the NPV 27,40,000. Now I want to know, when I change by 10%, how is the impact on NPV? So first change is adverse impact on cost. I repeat this calculation again. The only thing is this will be now into 1.1. So NPV falls to 7,40,000. From 27,40,000, NPV has fallen to 7,40,000. Percentage fall in NPV. percentage fall in NPV is 20 lakhs by 27 lakh 40. NPV has fallen by some 73%. NPV has fallen by some 73% if there is a 10% change in the project cost. Your project cost was earlier 2 crore, we made it as 2 crore 20 lakh. What is the change in NPV? The next factor is what they mentioned. What is the second factor they are mentioning? Which one? Cash inflow from 60 lakhs becomes 54 lakhs. From 60 lakhs it becomes 54 lakhs. So NPV from 27 lakh 40 has now come down to 4 lakh 66. From 2740 it has come down to 4 lakh 66, percentage fall in NPV. NPV has fallen by some 83%. NPV has fallen by some 83% if there is a 10% change in, your, if there's a 10% change in your initial outflow, sorry, if there's a 10% change in your annual inflow. The third factor what they mentioned, cost of capital. The cost of capital today is 10%. Increasing by 10 means 10 not becoming 20. 10% of 10% is 1%. So from 10 it now becomes 11. Can you tell me the cost of PVF annuity factor for 11%? Annuity factor for 11%. 5-year annuity factor for 11%. 3 point. So my NPV is now 2170. Again it has fallen. Now be very clear, there whichever factor has the lowest sensitivity percentage, when it becomes 0, that is the most sensitive factor. For example, in the previous question, that your annual cash inflow was the most sensitive factor because it had a sensitivity of some 18% something. When you go by change in NPV, listen this carefully. When you go by change in NPV, you look at which factor leads to maximum fall in NPV. The factor which is leading to maximum fall in NPV is the most sensitive factor. There we are looking at what percentage change in the input factor will lead to NPV becoming 0. Here 10% change in input factor will lead to what impact on NPV? Whichever has the maximum impact. In this case, annual cash inflow is the most sensitive factor. Annual cash inflow is the most sensitive factor because this leads to 83% change in NPV. Other factors does not lead to that much change. That does not lead to this much of change. Most sensitive to annual cash inflow. I am not doing some of the other questions. 13 is a good question to solve. It will be more time consuming because it follows WDV method of accounting. So it will take a lot of time for you to do. But the broad rule what I have said is what is going to work there. So you can try doing it. It will kind of revise your investment decision understanding also. 14, similar to the question we have done. Here you are looking at 2.5% adverse variance. We did a 10% variation. This question talks about a 2.5% variance in each of the variable. I think there are some 6 variables: initial capital cost, annual unit sales, selling price, variable cost, fixed cost and discount rate. For all the 6 factors you will have to do the sensitivity analysis. Okay. I think there is one extra question which I wanted to discuss. That's kind of understandable. If you go through it, you'll understand it. Okay. there is this best and worst case NPV. I just want to discuss one thing here. It may look like a very fairly simple, straightforward question. When you read it, you will understand. ASG Limited is considering a project Z with an initial outlay of 15 lakh and life of 5 years. The estimates are as follow: sales 9,000 units, 10,000 units, 11,000 units, selling price 175, 200, 225, variable cost 100, 125, 150, fixed cost 1 lakh, 1 lakh 50, depreciation is 70,000, corporate tax rate is 25. Assume the cost of capital is 15%. Determine the NPV in worst scenario, best scenario, base scenario and best case scenario. Okay, worst scenario, base scenario and best case scenario. In fact, I also did this mistake when I was going through the question. You look at the heading here, it says lower estimates, base estimate and upper estimate. Okay, the wording used there is lower estimate, base estimate and upper estimate. What they want you to find is worst case NPV, base case NPV and best case NPV. Base is okay, whatever is this. Okay, they want us to find the worst case NPV and the best case NPV. Normally I thought this is worst, this is best. That's what I also thought initially when I looked at the question. But the wording used there is lower estimate and upper estimate. Now listen, for the worst case scenario, selling price will be 175. That is fine. But the cost price will be 150. The cost price, the upper estimate, the cost will be the highest. The cost will be the highest for the worst case scenario. The cost will be the highest because they have not used the word worst case and best case. What they have used is lower, base and upper estimate. So your unit sold will be 9,000, lowest unit. Selling price will be lowest, but this will be 150 and this will be 2 lakh. This will be 150 and this will be 2 lakh. For the best case scenario, 11,000, 225, but cost will be 100 and fixed cost will be 1 lakh. Cost will be 100 and fixed cost will be 1 lakh, because they have not used the word worst and best. If they had used the worst and best, I would have copied them as it is, because you see here best case is highest units, highest selling price, lowest variable cost, lowest fixed cost, lowest variable cost, lowest fixed cost. Be very careful, because the wording used in the question is not upper estimate, not best case and worst case. They have used the word upper estimate and lower estimate, and also they did not tell calculate NPV for the lower estimate scenario, upper estimate scenario and base scenario. They said calculate for the worst and best scenario. So worst scenario is highest units, highest selling price, lowest variable cost, lowest fixed cost. Best scenario, worst scenario, this will be lowest units, lowest selling price, highest variable cost and highest fixed cost. Any doubts on this? Any doubts on this? Don't take the scenario as it is. Don't take the scenario as it is. We're kind of done with 5 chapters. I'll move to a bulkier chapter now. I'll go to investment decision. That is going to take away a good amount of time. So we'll move to investment decision. We'll see how much we can complete today of investment decision, and then maybe in tomorrow's session I do management of working capital and dividend decision. Tomorrow the class may start a little late also. I think I'll be here in the academy only by 10:30 types. The class will be here only. Here it should be by 10:30 types or 10:40. Let's keep it as 10:45. Tomorrow's class will start at 10:45. That's the time. I plan to leave my home by 10:15 types. That's the time I can leave tomorrow. So let's keep it as 10:45. Tomorrow's class can even start at 11. Okay, I am not very sure. There's slight bit of tentativeness in my schedule, so I'm not confirming it, but let's keep it as 10:45 start in this place. Let's now move to investment decision. First you go through this theory. I'll give you maybe 2-3 minutes for you to go through this. I know, but tomorrow will be tough to do these two. Dividend will get over in 1 hour. Okay, the focus of investment decision is on calculating cash flows. If you calculate cash flows correctly, you will put in a format called as year, cash flow, PVF and DCF, and that will give you NPV of the project. In order to calculate cash flow, first I start with initial outflow. There are two items of initial outflow. One is called capital expenditure, second is called working capital. There's a capital expenditure and there's a working capital. The second is in between flows. The second is in between flows, where we start with units sold, selling price, get the value of sales, subtract variable cost, subtract fixed cost, you will get profit before depreciation and taxes, subtract depreciation, profit before tax, less tax, profit after tax, add back depreciation and CFAT. After CFAT, you may adjust for two items called as purchase of some additional machine or payment for original machine. There could be a purchase of additional machine, or there could be some payment for original machine which is not done, and you get the CFAT. Working note 3 is terminal flow. There are two items of terminal inflow. One is your net salvage value of existing asset. There's a difference between salvage value and net salvage value. You'll understand when we do a problem. And there's a recapture of working capital. We'll consolidate them together. Mostly calculate NPV. Some question other than NPV, you may do payback, discounted payback, ARR, your profitability index, IRR, anything can be calculated. Apart from that, I think this area also has something called as your capital rationing is there, modified IRR. Two more concepts are there. One is capital rationing, there's a modified IRR. There are few problems on replacement decision. Replacement decision works similar to your investment decision, but with certain changes to be done there. So there can be problems on replacement decision, EAB and EAC. I'll discuss them with the problems. Let's come to question 1. Go through this. Okay, the initial few question I'll focus on calculating only the cash flows. Okay, some question I'll do NPV, profitable index. I'll do one problem where all the techniques are done together so that you kind of understand it. Working note 1, initial outflow. Working note 1, initial outflow. Initial outflow, particulars, machine X, machine Y, machine X and machine Y, X and Y, capital expenditure, working capital. There are two types of outflow, capital expenditure and working capital. What's the capital expenditure of these machines? 1,50,000, 2,40,000. Working capital is 0. If at all the question gives you, we consider it, otherwise it's 0. So this is my initial outflow. Technically I don't need a step for this, but I'm just trying to ensure that you follow the same steps later on. Working note 2, in between flows. Now a machinery can do two things. One, it can bring extra revenues for the company. It can bring extra revenues. The second thing a machinery can do is it can cut down on cost. For example, if I buy a building for renting it out, it is a revenue enhancement because I'll earn revenue out of renting the building. Second thing is I may buy a building and I stay there. If I'm staying there, I don't earn any rental income, but I save rental expense. So in this question, there is a saving in maintenance cost, there's a saving in indirect material, there's a savings in scrap, there's a savings in wages. So all these are inflow of money. All these are inflow of money. So point number 1, savings and cost. Add all the savings and tell me. Savings only they have given. No? Whatever is savings. Whichever is savings, please tell me. sorry, maintenance is not savings, sorry. These two are not. Savings in scrap and savings in wages, only two savings are there. Savings in scrap and savings in wages, 90,000 plus 10,000 and 1,20,000 plus 15,000. So savings is 1,35,000 less increase in cost. They are talking about certain expenses like maintenance, indirect material and supervision. All three put together how much? Maintenance, indirect material and supervision. How much? 25,000 and 35,000. Once you subtract this, you get PBDT, profit before depreciation and taxes. Few question may go ahead and say ignore taxes. Few question may say, not this question, but few question may say, if you are ignoring tax, PBDT is CFAT. If you are ignoring taxes in a problem, profit before depreciation and taxes will become cash flow after tax, because from this what you do is you subtract depreciation, subtract tax and add back depreciation. So depreciation is subtracted and added back. Reason is you have to calculate tax. But anyway, taxes are ignored, so we need not do any of this. In this question, tax, depreciation is there, tax is there. Depreciation minus 30,000 minus 40,000, PBT 45 and 60 less tax. What's the tax rate given in the question? 30%. Tax is 30%. PAT 31,542. Add back depreciation and CFAT. Add back depreciation and CFAT. 61,500 and 82,000. That's all. Our problem is over. Beyond that, how do you calculate ARR? How do you calculate present value index and all? I'll explain that in one question. All the techniques will do it together there. Okay, I think in question number 2 we'll do all the techniques. Let's come to question number 2. Management of P Limited is considering selecting a machine out of two mutually exclusive machine. Company's cost of capital is 8%, corporate tax rate is 30%. Details of the machine. Machine 1, let's just focus on machine 1. Calculate payback, discounted payback, NPV, PI and ARR of each machine. Advise the management of P Limited to which machine they should take it up. So let's focus only on machine 1. And we will try to calculate all these techniques. Let's first calculate the cash flow. Any problem, any technique you do, cash flows are the starting point. So working note 1, computation of cash flows. Computation of cash flow. I'll focus only on machine 1. Particulars machine 1. What is given in the question? They have given some number. What is that they have mentioned? Annual income before tax and depreciation. See, your working note 2, which is normally your in-between flows, it can start with revenues. Sometimes it may even start with PBDT. Sometimes it can start with PBT. Sometimes it can start with PAT. Sometimes the CFAT itself could be given in the question. Here, what is given in the question? PBDT less depreciation, PBT less tax, PAT, add depreciation, CFAT. PBDT less depreciation, PBT less tax, PAT, add depreciation and CFAT. What's the PBDT given in the question? 3,45,000. Okay, tell me the depreciation amount. Depreciation is 2 lakhs. PBT is 145. What's the tax rate? 30%. PAT, add back depreciation, and CFAT. Now in this question I am required to do all the techniques together. I'll tell you what are the columns needed for different techniques. Okay, so I'm going to do a one single format to calculate all the 5 techniques together. So year, cash flow, cumulative cash flow, these 3 are needed if you want payback. If you want to calculate payback, year, cash flow, cumulative cash flow. Then PVF, DCF, CDCF. PVF, DCF, listen, year cash flow and cumulative cash flow is needed for payback. Year cash flow, PVF, DCF, CDCF is needed for discounted payback. For NPV, you need year cash flow, PVF, DCF, all the four are there. For profitability index also you need the same thing. For ARR you need profits, depreciation, profit. This 8 columns if you put, you can calculate all the techniques except IRR. IRR you will have to do a separate calculation, because for IRR you need one positive NPV and one negative NPV. But these 6 columns can help you in calculating all 5 techniques. All 5 techniques. So year, 5 years. What is the initial outflow? 10 lakhs. Every year inflow is 3,01,500. So year and cash flow. Year and cash flow. Cumulative cash flow is the cumulative value of this. Cumulative cash flow is the cumulative value of this. I start with minus 10 plus 301 plus 301 plus 301 plus 301. I'll keep adding this. PVF, you know what needs to, what's the discount rate given in the question? 8%. So these are the PVF at 8%. DCF is cash flow into PVF. Cash flow into PVF. CDCF is the cumulative value of the DCF. Cumulative values of the DCF column. Cumulative values of the DCF. So I start with this plus this plus this plus this plus this, and I keep doing this. Cumulative values of the DCF. Depreciation can be only for year 1 to 5. I cannot have depreciation for a single day. Single day. Year 0 is a single day. PAT plus depreciation is cash flow. PAT plus depreciation is cash flow. So cash flow minus depreciation is PAT. This is not in fact needed in this question. Some other question it may be needed. This question I don't need this, because anyway I know what is the profit they are making, because I have done the statement here. The profit is 1,01,500 every year. So I know that, but anyway, if it's some other question where the profits are different for different year, you may have to calculate like this. First requirement is payback. Payback is equal to base year plus unrecovered cash flow of base year divided by cash flow of next year. For payback purpose, you will have to look at CCF column. For payback purpose, you will have to look at CCF column and find when it is negative for the last time. Find when it is negative for the last time. Started with minus 10, minus 6, minus 3, minus 95, positive. So it's minus 95 for the last time, which is year 3. Base year refers to the last year in which cumulative cash flow is negative. Year 3. How much negative it is? 95,500. How much negative? That's called unrecovered cash flow of base year. Unrecovered cash flow of base year. When is it negative for the last time? Year 3. How much negative? 95,500 divided by cash flow of next year, 301,500. 3 years, you divide this 95,500 by 301,500. Tell me how much it is. 95,500 by 301,500. 0? 316. Okay, 3.316. In this decimal portion alone, multiply with 12. This 0.316, whatever you got, you multiply with that alone with 12.
3.800.
How much?
3.800.
Or 3 years and 4 months. Broadly 4 months. The decimal portion I am multiplying with 12. You can even write it as 3.8 months also. You can multiply and then write that portion as 3.8 months also. 3 years and 4 months is the payback. Payback means you don't do any discounting there. Same thing, discounted payback, same formula. Look at CDCF and tell me when is it negative for the last time. 4th, how much negative it is? 1,431. And what is the CDs? What is the discounted cash flow of the next year? Not the normal cash flow. Unrecovered cash flow of base year divided by discounted cash flow of next year. What is the discounted cash flow? 205, 322. 205, 322. Tell me this answer. 4 point. It is broadly 4 years, I think. 1431 by 205322 is how much? 4.006. Okay. Can you convert that portion alone, multiply with 12? 0. After multiplication with 12. 0.0? Okay. So this is what it comes out to be, 4 years and 0.08 months. Broadly it's 4 years. NPV is equal to inflows minus outflow. NPV is equal to PV of inflow minus PV of outflow. Your inflow is all these 5 numbers, which is 12,03,891. All 5 numbers, inflow total is 12,03,891. So NPV is 12,03,891 minus 10 lakh. 2,03,891. 2,03,000. That answer is already there. That is the CDCF of the last year. That is CDCF of the last year, because CDCF was adding all this number. Profitability index means PV of inflow by PV of outflow. PV of inflow by PV of outflow. You can write this in times. You can write this in percentage, 1.203891 times, or you can do into 100 and write it as percentage. Into 100 and write it as percentage. Profitability index is otherwise called as benefit cost ratio. Sometimes they will use the word benefit cost ratio. Then you have ARR, accounting rate of return. There are 2 ARRs. ARR on initial investment. ARR on initial investment, which is average profit by initial investment into 100. Average profit is 1,01,500. Every year same profit. You have to take an average of that. You will add the 5-year profit and take an average. It's 101,500 divided by initial investment is 10 lakh into 100. 101,500 divided by 10 lakh into 100. This is called ARR on initial investment. Then you also have ARR on average investment. Formula is simple, average PAT by average investment into 100. Average PAT is 101,500. Average investment is opening 10 lakh plus closing by 2. Closing is equal to salvage value. Closing is equal to salvage value. Opening plus closing by 2. Opening is 10 lakh. Closing is, if there is no salvage value, closing is 0. If there is no salvage value in the question, closing is 0. So opening is 10 lakh, closing is 0. Closing is 0. So my average investment is 5 lakh. Average investment is 5 lakh. Opening is 10 lakh, closing is 0. There is no salvage value in this question. If there is a salvage value, you consider that as the closing investment and then take an average of that. I have not done IRR in this question. 3 you can manage. It's basically the same thing which needs to be repeated. Question number 4, go through it. I want you to calculate cash flows of project A, just the cash flows, nothing beyond that. That also is broadly given in the question, but some changes have to be done. So, in fact, just give me a minute. Okay, I want you to just tell me the initial outflow of project A and project B. Project A, what is the initial outflow? Project B, what is the initial outflow? Just calculate that. I don't want anything beyond that because the cash flows are given. Initial outflow of project A and project B. Just do the calculation of initial outflow. Project A, how much initial outflow? 5 plus. Okay. Model A, 5 lakh is the initial investment. You will sell the old machine for 1 lakh. So 5 minus 1 will become 4. Utilities on the existing machine can be used if you use company A. Additional cost of utilities 1 lakh. So 5 minus 1 plus 1. 5 lakh is my initial outflow. For project B, 5 minus 1 plus 2 lakh minus 0.2 lakh. Plus 2 lakh and minus 0.2. I think it will be 5 lakh 80. 5 lakh and 5 lakh 80. I am not doing anything beyond that because the cash flows are given. I have explained you in one question how to calculate payback, discounted payback, ARR. IRR is something which is still pending. Just give me a minute. Can you write the cash flows of this question? Just want you to calculate the cash flows. Year cash flow, I want you, okay, I'm going to do IRR in this question. I want you to listen. When you do IRR in a problem, you need space for at least 8 columns, okay? Think about at least having 8 columns. You will need space for that much. Year cash flow. Start with year and cash flow. Have space for 8 columns. Think about that. I want you to write year and cash flow alone. Year and cash flow. Read the question carefully and write the year and cash flow alone. Year and cash flow. I don't want anything beyond that, okay? Year cash flow. We'll do IRR in this question. It's a 10-year project. What is the year 0 cash flow? Minus 70 lakhs. Minus 70. Year 1 minus plus minus 1 crore. Now they said net cash flow after tax but before depreciation. So they are saying cash flow is after tax and depreciation was not subtracted. That is nothing but cash flow after tax. That's technically your cash flow after tax because depreciation has not been subtracted by them, which is 25 lakh in year 2, 30 lakh in year 3, 35 lakh in year 4, 40 lakhs in all the years. 40 lakhs in all the years. Okay, now listen. I have to do IRR for this. This question, even if it comes in exam, it's easier. Reason is you have already done one NPV at 15% and you would have done one NPV at 10%. Maybe one gives positive, one gives negative and it becomes easier. Now what you need to do is for doing IRR, unless they give you table values below the question, you have to put a total of this. Just put a normal total of this. It comes to 1 crore 60 lakh, okay? The normal addition of this is 1 crore 60 lakh. I don't want you to listen for some time. Total of this is 1 crore 60 lakh. Divide by 10 years, the average profit is 16 lakh rupees. 1 crore 60 lakh is the profit without doing any discounting, okay? This is 1 crore 60 lakh is the profit of this project. I divide by 10 years, the average profit is 16 lakhs. Average investment is, there is 170 lakh of investment and 1 crore of investment. That's like an opening investment, okay? That's like an opening investment. You invested 1 crore 70 initially. Salvage value is not given in the question. So average is 85 lakh. It's not average of 70 and 1 crore. It's average of 1 crore 70 and 0 in the end. ARR on average investment. ARR on average investment. 16 lakh, what I did is I just put a total 1 crore 60, all this in calculator, nothing needs to be presented in exam. Please don't end up presenting any of this in exam. ARR on average investment 16 by 85. How much you get? 18 point? 2/3 of this number. There's no logic for 2/3 and all. 2/3 of this number. 12 point? Final IRR is expected to be closer to this number in most of the question. Final IRR is expected to be closer to this number. So I'll start with 13% for discounting. I'll start with 13% for discounting, because in an exam scenario, if they give you table values below, you're okay. What is exact IRR here is, exact IRR is 13.2. The formula gave 12.54. The formula gave 12.54. So you will start at 13%. You may get a positive or negative, increase the rate or reduce the rate. This is only in a scenario where you are struggling to know what rate to start with. Some question they may give below the table itself something, then directly start. Don't present any of this in your notebook, because this is just for your purpose, what rate to start with. What rate to start with. Assuming I start at 13, okay? Not 15 and 10 which is given in the question. You would have done this problem 15 and 10 because they wanted NPV at 15 and 10. One positive, one negative automatically would have come. Assuming I do at 13%. Why I said I need 8 columns is, you will do 13 DCF. You get a positive answer, you will increase the rate. Again do, unfortunately again positive, increase the rate. So you should at least have space to calculate NPV 3 times. You should have space to calculate NPV. If you don't have space, then you'll have to again repeat writing year and cash flow, which will unnecessarily consume time. So at 13%, one by 1.13. The NPV sum 1,40,000. The NPV is 1,40,000. I'll increase it to 15%. I'll increase this to 15%. The only difficult part of IRR is knowing what rate to start with. That's the difficult part you will face. DCF. One positive and one negative. 1,40,000 is positive NPV, 15% has given me negative NPV. Somewhere in between is the IRR. I'll explain the formula now. Somewhere in between is going to be the IRR. At 13%, 1,40,000. At 15%, negative 11,82,000. Somewhere in between here, it will be 0 NPV. I want to know what is 0 NPV. So there's a formula called as, this is an interpolation formula, L1 NPV at L1 divided by NPV at L1 minus NPV at L2 into L2 minus L1. This is technically called as interpolation. Basically you are trying to find what rate in between will have 0 NPV. The lower rate is 13, L1 means lower rate. NPV at lower rate is 1,40,000. Divided by 140, minus of minus will become plus 1182. 140 minus of minus, 140 minus of minus into 15 minus 13. L2 means higher rate, L1 means lower rate. Can you do this part and tell me how much it is? 1,40,000 divided by 1,40,000 plus 1182 into 15 minus 13. Into 15 minus 13. 2. Okay, so 13.21 is the answer. Exact answer is 13.2%, which is what the Excel gave. The material can have a different answer because there the gap would be higher. 15 and 10 is a higher gap. You should have as low as gap. This turns out to be 13.4. This turns out to be 13.4. Question 6. This is the cash flow. I want you to tell me the ARR on average investment. Just like this I did know. What should be the initial guess rate? I did this initial guess rate calculation where I put a total of the, listen for a minute. You will put a total of the cash flows, that will be called average profit, sorry, that will be called total profit, divide by number of years, that will be called as average profit, opening investment, closing investment by 2, average investment, ARR on average investment, and 2/3 of that. Quickly do this for question 6. Cash flows are there, minus 136 plus 30 plus 40 plus 60 plus 30 plus 20. Hello? Hello? Okay. No, I have first the problem. All of this has to happen only in the calculator. I don't want you to present anything in your solution there in exam also. Minus 136 plus 30 plus 40 plus 60 plus 30 plus 20 is how much? How much? What is the average profit? Sorry, what is the total profit? All 5 years put together, what is the total? Not 180. Minus 136 plus 30 plus 40. Minus also has to be subtracted. Minus has to be subtracted. That is the total profit of the project. That is the total profit of the project divided by 5 years, 8,800. That is the average profit. That is the average profit. Average investment is 68,000. Average investment is 68. 8,800 by 68,000 into 100 is how much? Into 2 by 3. So the initial rate can be 9%. This is what would have been presented here. The initial rate is 9%. The initial outflow, sum of inflows, total profit of project, average profit, average investment, ARR on average investment, initial guess rate. I don't want you to present this. There is no logic for 2/3 friends. Historically, the IRR has turned out to be closer to 2/3. There's no logic. There are some questions where it will not be 2/3, it should be 3/4 and all. So there's no great logic for why we are doing 2/3 and all. This will broadly give you a number which is closer to your final IRR. There are problems where the final IRR can be far away from this number also. Here the IRR answer is 10.7. Your 2/3 said 8.63. So the variation is slightly on the higher side. The variation is on the higher side. It can be even higher also because we cannot exactly say. The only rule is just take 2/3 of that number. This will give you a number to start with. If you start at 9, I normally increase it by 2%. I normally increase it by 2% so that the rule also says the gap between two rates should not be very high. So you cannot start with 10 and make it 20. That will be a very high gap. So in that solution, 10 and 15 was done. The answer turned out to be 13.40, whereas the exact answer is 13.20. If the gap is lesser, your answer accuracy would be better. Let's come to 7. Following are the data on a capital project being evaluated by management of X Limited. Annual saving, 4 years life, IRR 15%, profitability index 1.064, NPV, cost of capital, cost of project, payback, salvage value, discount factor and their the discount factor and their PVFs are given below. Go through this. No, Vishwa, I don't think so. Mark will be reduced by ICA if there is less accuracy, but you cannot have a very high gap. Very high gap will be a trouble in exam. I'll come to it. Okay, now in this question, I have an annual cost saving, useful life is there, IRR is there, profitability index is there. I am required to calculate NPV, cost of capital, cost of project and payback. Now, first thing what I am going to do is, I am going to use this. IRR is the rate of return at which NPV of the project is 0. IRR is the rate of return at which NPV of the project is 0. So if you use 15% and discount, you will get 0 NPV only. That does not mean project has 0 NPV. IRR is the rate of return at which NPV of the project is 0. You will understand working note 1, computation of cost of project. Computation of cost of project, year, cash flow, PV at 15%, DCF, year 0, 1 to 4, year 0, 1 to 4. Every year, what is the inflow they have given in the question? Inflow is given. What is the inflow given in the question? Annual cost saving, that's the inflow. Outflow is not given in the question. Outflow is not given in the question. At 15%, 4-year annuity factor is 2.855. 4-year annuity factor is 2.855. NPV has to be 0. So I multiply this. This can be 0 if this is minus 114,200. If this is minus 114,200. And this can be minus 114,200 if this is minus 114,200. In short, cost of project is 114,200. Cost of project is 114,200. Present value of inflows is not 114,200 because if we use that, NPV will turn out to be 0. Inflows is not 114,200. Cost of project is 114,200. Okay. Inflows is also showing 114,200 because we have used IRR for the discounting purpose. But what we use for discounting purpose is not IRR. We should use cost of capital. What can I do next? Which information can be used? Profitability index is equal to PV of inflow by PV of outflow. PV of inflow by PV of outflow. How much is the PV of inflow? How much is the PV of inflow? That's not there. 114,200 is not PV of inflow. Okay, that was discounting at 15%. PV of outflow, whatever be the discount rate, it will be 114,200. You can use any discount rate, doesn't really matter because for year 0 there is no discounting done. For year 0 there is no discounting done. So outflow will be 114,200 only, whatever be the discount rate. This will give you PV of inflow. How much is the PV of inflow? 1 lakh? 21,508. NPV is this minus 114,200. NPV is inflow minus outflow. NPV is inflow minus outflow, 121,508 minus 114,200. 121,508 minus 114,200. How much is the NPV? Okay, I go back to this calculation. Okay, I go back to this calculation. This was 114,200. Fine. I don't know this number. Okay, this is what I'm trying to calculate. Cost of capital is not given in the question. This is 121. How much you said? Inflow of 121? 5 So the NPV was this, which means this has to be 3.0377. Your DCF should be 3.0377. In that below table, one of the rate will be 3.0377. Which rate? 3.0377 is 12%. So cost of capital is 12%. I'm not doing payback. For payback, you have to do year cash flow, cumulative cash flow. Year cash flow and cumulative cash flow. Initial outflow is 114,200. Every year is 40,000. See when is it becoming negative? Base year plus unrecovered cash flow of base year divided by cash flow of next year. Go through question 8. Go through 8. Now onwards the focus would be on calculating cash flows. We have done at least 2 questions on 3 questions on techniques. Now it will be only cash flows. Okay, I'm going to follow those 3 steps: initial outflow, in between flows, terminal flow. Consolidation and calculation of NPV is not which we are going to do. That is something which you can manage. A hospital is considering to purchase a diagnostic machine costing 80,000. Life is 8 years, salvage value 6,000, operating cost 7,500, revenue goes up by 40,000. It is outsourcing and is earning some commission income of 12,000 net of taxes. Whether it will be profitable for the hospital to purchase the machine. Working note 1, initial outflow. Initial outflow. There are two items of initial outflow: capital expenditure and working capital. Capital expenditure and working capital. How much is the capital expenditure in this question? 80,000. No working capital. So my initial outflow is 80,000. Initial outflow is 80,000. Working note 2, in between flows is the same amount for all the 8 years. Particulars and amount. It's going to be the same amount for all the 8 years. Now listen, what is the tax rate given in the question? What is the tax rate given in the question? No, what is the tax rate given in the question? Not given. Two choices, okay? Normally if tax rates is not given, I can ignore taxes. Second, I can take tax rate of 25%, which is your general corporate tax rate, and proceed ahead. This question, ignoring tax rate will not work, because somewhere they said commission income is 12,000 net of taxes. So taxes do exist. I'll have to assume a tax rate. So I'm assuming tax rate to be 25%. So the revenue this machine will give me is 40,000 less expenses. Expenses to run the machine is 7,500. PBDT 32,500 less depreciation. Calculate depreciation. I'll come to it. Less depreciation. I'll come to commission in a minute. 9,250. PBT less tax at 25%. This is assumption, okay? Tax is at the rate of 25% is an assumption. You can take any other rate also. PAT, add depreciation. I'll come to commission in a minute. CFAT. Okay, the question says this hospital is presently outsourcing this diagnostic work and is earning a commission income of 12,000 per annum net of taxes. If that word net of taxes was not there, this 12,000 is an opportunity cost which I would subtract here. I would subtract here because this is a loss for me. This is a loss. Earlier I was outsourcing it outside. Now I will subtract commission, but I will subtract it here, because commission is net of taxes. Commission is net of taxes. So I will subtract 12,000 here and incremental CFAT because of the machine. Because of the machine we are earning 14,687. Because of the machine we are earning extra 14,687. Alternatively, what I could have done is this 12,000 I divide by 75%. It becomes 16,000. You subtract here. You can, pre-tax, you subtract here, you will get the same 14,687 here. CFAT directly you get 14,687. It is an opportunity cost, but has to be subtracted at the right place, because this is after tax. That 12,000 is after tax. Then working note 3 is your terminal flow. There is nothing on the working capital side. For salvage value, we will have to calculate the sale value. I will explain this in this question, though it will not make any difference. Book value, capital gain or loss, tax paid or saved, NSV. The sale values after 8 years, we will sell it for 6,000. What is book value is value of this asset after 8 years of depreciation. We started with 80,000. First year 9250, second year 9250, third year 9250, fourth year 9250. So this value is 6000. The book value is also 6000. No capital gain, no tax. NSV is equal to salvage value. And your NSV is sale value plus or minus tax. Sale value plus or minus tax. It's not a continuation. It's not a continuation. Sale value plus or minus. If you are paying taxes, subtract that. If you are saving taxes, add that. I am not getting into the NPV calculation part. That is something which is a formality. Go through question 9. Go through this question. Okay, a question where again we'll have to calculate cash flows correctly, because that's the most important part. The final requirement is, should the project be accepted or not? You calculate NPV, positive NPV, accept the project, negative NPV, reject the project. So let's do working note 1, initial outflow. Initial outflow. Particulars and amount. Capital expenditure, working capital, initial outflow. Capital expenditure and working capital, initial outflow. Read the question and tell me what's the capital expenditure. How much? 120. There is also an additional equipment which will be needed when? Beginning of the third year. So that will go to the in between cash flow. It will not be here. Minus 120, working capital is minus 15. Put together my initial outflow is 135. Put together my initial outflow is 135. Working note 2, in between flows. In between flows. Totally 8 years are there. Particulars. I can combine some of the years, but sometimes you may make a mistake, so I am writing separately. Some years combining is possible in this question. Particulars and 8 years. Particulars and 8 years. I am writing the format. I want you to do the cash flow. Units sold, revenues, less variable cost, less fixed cost, PBDT, less advertisement, I want you to do this. Get do this. Start with units sold, revenues, variable cost, fixed cost, advertisement, PBDT, depreciation on original machine, depreciation on additional machine, PBT, less tax, PAT, add back depreciation, CFAT, purchase of additional machine and revised CFAT. You will make mistakes at few places, we will discuss them. Go through it and try doing this. Eunice, I want you to do this, please try, please try. Please do it. Another minute and then I'll start discussing this. Okay, the 100% capacity utilization is 4 lakhs. Initially it will be 20%, so 0.8 lakh, then 1.2 lakhs, 3 lakhs for these 3 years, and then 2 lakhs for the last 3 years. The selling price is 100. I'm doing it in lakhs. Selling price is 100. Variable cost, PV ratio is 60%, which means variable cost is 40%. Variable cost is 40%. Fixed cost given in the question is 16 lakhs. Fixed cost is 16 lakhs. Advertisement is 30 lakhs in the first year, second year 15 lakhs, 10 lakhs for third, fourth and fifth year, and last 3 years is 4 lakhs. There is a possibility of combining some of the years. PBDT 2 lakhs, 41 lakhs, 154, 154, 154 and 100. Original machine we have purchased it for 120 lakh. There is no salvage value, so depreciation will be 15 lakhs. Depreciation will be 15 lakhs. New machine, when are we buying? Beginning of third year. which means third year also I will provide depreciation. Third year also I will provide depreciation. So 10 lakh minus 1 lakh of salvage value 6 years, 1.5. 10 lakh minus 1 lakh by 6 years. 10 lakh minus 1 lakh by 6 years. PBT. If you read the first line of the question, it says it's an existing profit making company. It's an existing profit making company. So when you make losses, what you will do is you will set off against the existing profits, and this will reduce the overall tax outflow of the company. Losses will save taxes for the company. Losses will save taxes for the company. The tax rate in the question is 50%. So this minus of minus into 0.5. So indirectly first year alone it is positive. Every other year there will be a tax outflow. Every other year there will be a tax outflow. This is an existing profit making company. So first year you are going to save taxes. First year. There are going to be variants of this question. I will discuss them in some time. This year you are going to save taxes. So indirectly my PAT is lesser than PBT. My losses have reduced. My losses have reduced. I add back depreciation. I get CF 80. Which year are we buying the machine? End of second year. It's not the third year. Third year beginning. Your capital budgeting assumes all cash flows to happen at the end of the year. All cash flows. What is day 0 is nothing but, year 0 is nothing but beginning of year 1. It's only a single day. It's a beginning of year 1. So beginning of year 3 means end of year 2, and this will be my cash flow. 8.5, 18. I could have clubbed 3, 4, 5. I could have clubbed 6, 7, 8. We could have clubbed them together and written as a single item also. I am not doing the terminal flow. Once you are done with this, okay, I have not discussed even one question where we do finally the NPV. Once you are done with this, year 0 will come from the initial step 1. This will come from your step 2, and last year is step 2 plus step 3. Step 2 plus step 3. And whatever working capital is stuck on day 0, it will be recaptured. Basically, you are getting that money back. Whatever money is stuck on day 0, you will get that back. And net salvage value, you will have to calculate sale value less book value, gain or loss, tax paid or tax saved. So overall 16 lakh was there. Now variance of this question, I'll come back to 10 in some time. Just give me a minute. Okay, I don't know, I don't think so I have that question. One question will specifically say that losses cannot be set off or something. Just give me a minute. Okay, let me come to 14th question. We are going to solve the question. Let's just listen. Come to 14th question. PD Limited, an existing company, is planning to introduce a new product with a life of 8 years. Project cost at the end of years, no residual value, working capital. Everything similar to the question we had done. Everything similar to the question we had done. Advertisement expenditure. Okay, this has assume that losses cannot be carried forward. Assume that losses cannot be carried forward. There is one wording which said losses cannot be carried forward. If you see the previous question we did and this question, in the top they are not mentioning it's an existing profit making company. That question mentioned that it's an existing profit making company. That question did not mention anything about setting off losses or carrying forward. Nothing was mentioned. It just said existing profit making company. This question in the top just says it's an existing company, not an existing profit making company, and they have said losses cannot be carried forward. When you do your cash flow, you get minus 38 here. You get minus 38 here in the first year. Tax is 0. I don't give any tax benefit. I don't give any tax benefit because it's not a existing profit making company. If the existing profit making company word is not there, you are not giving tax benefit. You can alternatively also write saying that the company could have other profits and we are giving a benefit, but this question did not have that word, so we are not giving tax benefit. Alternatively, some question, for example, this question we did know. This question can say losses will be carried forward and set off over a period of next 2 years. The wording just says next 2 years. Then this year, zero tax. This year, zero tax. When it comes to next year, the profit in your books of accounts is 26. Taxable profit is only 13 lakh because this 13 lakh will be carried forward to the next year and set off, and it will become only 13 lakh of profit for the next year. If the question said losses have to be carried forward and set off, this is as per your Income Tax Act. Losses if have to be carried forward and set off. There are three types of problem. One, no set off, no carry forward. The question which I did an immediate set off. Immediate set off, basically tax, because there are other profits. The problem which I showed you there, what they said is losses cannot be carried forward. Unfortunately, losses cannot also be set off because I don't know whether there are existing profits or not. Third type of a question where they'll say losses cannot be set off immediately, but it can be carried forward to future years and then set off, carried forward to future years. So this year, okay, let me just take some number. Let me take it as minus 45, okay, for the time being. This year, zero tax. Minus 45 means zero tax because 26 lakh of profit, entirely it will be set off. Entirely it will be set off. This year, of the 137.5, I already still have 19 point, I already have some, how much? 19 lakh which is carried forward. So my taxable profit is 118.5 into 0.5. My taxable profit is 118.5 into 0.5. The question may say in 2 years you have set off. You are not able to set off in 2 years, that is lapsed. That loss will get lapsed and you cannot carry it forward further. Clear? Any doubts in this? So the question can be of three types. One, you do an immediate set off where the wording was like this. Existing profit making company. It's an existing profit making company. Make a loss, have a tax saving in the same year. If the question uses the word losses cannot be carried forward, then you don't have a choice of carrying forward. It also does not mention it's an existing profit making company. You cannot immediately set off also. Immediate set off not possible, carry forward not possible, so that loss is a loss, that's all. You cannot get any tax benefit out of that. The third scenario is you can carry forward but you cannot immediately set off. Carry forward means when you make profits, set off at that year. Clear? Any doubts on this? Any doubts on this part? Okay, let's take a break of 15 minutes and then continue. Okay, let's continue now. Let's come to question 10. Now onwards I think we'll have some detailed type of question for calculating cash flow. Let's come to question 10. MNP Limited is thinking of replacing its existing machine by a new machine which will cost 60 lakhs. Cost of production is 80,000 units. Current production is 80,000, will increase to 1 lakh. Selling price is 200. Following is the cost data. Existing machine has an accounting book value of 1 lakh, fully depreciated for tax purpose. Machine will be useful for 5 years. The supplier has offered to accept the old machine for 2 lakh 50. Market price of the old machine is 1 lakh 50, expected to be 35,000. Opportunity cost of, estimate NPV of the replacement decision. Go through the problem. Go through the question. Go through the question. Okay, this is a question on replacement of an existing machine with a new machine. For a replacement decision problem, we'll separately analyze existing machine, we'll separately analyze new machine and calculate something called as the extra cash inflow or outflow in every step. So every step, let's start step 1, initial outflow. Step 1, initial outflow, particulars, existing machine, new machine, existing machine and new machine, existing machine and new machine, capital expenditure, working capital, NSV of existing asset at year 0, NSV of existing asset at year 0. See, for an existing machine, I cannot have any outflow of money. For an existing asset, I cannot have an outflow of money. We are basically trying to calculate what will be the cash flow of the existing asset if you continue using it. What will be the cash flow of the new asset if you buy it? That's what we are trying to analyze separately. So any existing asset cannot have any outflow on day 0. But if you continue using it, you lose the opportunity of selling it today. You lose the opportunity of selling it today. So technically, whatever is the salvage value of this existing asset today is like an opportunity outflow. Is like an opportunity outflow. So the new machine has a capital expenditure of how much? How much is the cost of the new machine? 60 lakhs. No working capital. 60 lakhs and 0. No working capital. No working capital. Note 1, NSV of existing asset at year 0. NSV of existing asset at year 0. Once I am done with this, you will understand it better. NSV of existing asset at year 0. Sale value, book value, capital gain, tax paid. This question has capital gain, so I have written capital gain. Else we will calculate and see whether there is a gain or loss. Today you can sell the old asset for how many lakhs? Today the old asset can be sold for how much? Now read it carefully. 2,50,000. The supplier of the new machine has offered to take it for 2,50,000. What is its book value?
1 lakh, sir. Accounting.
What is its book value? Read it carefully. What is its book value? No, it's not 1 lakh. What is the purpose of writing book value here? Why are we writing book value here? We are writing book value to calculate capital gain, and for capital gain purpose it's going to be income tax, and income tax they are saying the asset has been fully depreciated for tax purpose. So income tax authorities will take this as 0, which means my capital gain is 2,50,000. My capital gain is 2,50,000. Tax paid on this is 40%. So my NSV is 2,50,000 minus this 1 lakh. NSV is 2,50,000 sale value minus tax paid. So if I continue using this, I lose the opportunity of selling this for 1,50,000. I lose the opportunity. This is my initial outflow of existing asset, new asset, and technically the incremental cash flow is new minus old, which is 58,50,000. New minus old is 58,50,000. How will this exactly be 58,50,000 in the practical world is, you will buy the new asset for 60 lakh and sell the old asset for 1,50,000. So net your outflow is 58,50,000. Net your outflow is 58,50,000. Buy the new machine for 60 lakh, sell the old machine for 1,50,000. So your initial outflow is 58,50,000. Working note 2, in between flows. In between flows, again existing and new, existing and new, particulars existing new. We start with revenues. Revenues is 80,000 units into 200 rupees. 80,000 into 200 and 1 lakh into 200. 80,000 into 200 and 1 lakh into 200. Revenues is 80,000 into 200 and 1 lakh into 200. Less, we have multiple expenses. Material cost 80,000 into 75, 1 lakh into 63.75. Wages 80,000 into 51.25, 1 lakh into 37.5. Supervision 80,000 into 20, 1 lakh into 25. Repairs and maintenance 80,000 into 11.25 and 1 lakh into 7.5. Power and fuel 80,000 into 15.5. I'll come to it. Depreciation, I'll come to it in some time. Allocated corporate overheads, apportioned corporate overheads, general corporate overheads, all this is not an expenditure of this project. All those are not an expenditure of this project, so they will not be considered in your expenses. Allocated overheads, apportioned overheads, general overheads, distributed overheads, all those are not expenses of the project, so they will not form part of the project expenses. I get PBDT. PBDT. Depreciation, they have mentioned something in the question. How much per unit? So how much is the depreciation? How much is the depreciation of two projects? I don't know. You calculate and tell me. What's the depreciation of the two machinery? Please go through it and tell me the depreciation figure. What's the depreciation of the existing machine? Existing machine depreciation is 0 because it's already fully depreciated for tax purpose. It's already fully depreciated for tax purpose. That 0.25 is of no use. That's an accounting depreciation. Similarly, new machine, it's not that 5 rupees per unit. New machine is 60 lakh minus what is the salvage value? 2 lakh 50 divided by 5 years. So 11 lakh 50,000. 11 lakh 50,000. This is what Income Tax Act will allow, because I am calculating depreciation for the purpose of calculating taxes. Depreciation for the purpose of calculating taxes. So PBT less tax 40%. PAT add depreciation CFAT. PAT add depreciation and CFAT. Neither this 1296 is useful nor 3580. What will go in NPV calculation is extra, new minus old. 22,84,000 is the cash flow for year 1 to 5. New minus old. Every step you will have to do new machine minus old machine, which is 22,84,000. New machine minus old machine. Similarly, terminal flow. Terminal flow. Particulars existing new. Existing new or old and new. Working capital recapture not there. Salvage value. Existing machine after 5 years. Existing machine after 5 years can be sold for how much? Something is mentioned in the question. Existing machine after 5 years can be sold for? No. 35,000. Sale value will be 35,000 of the existing machine. There will not be any book value. There will be some capital gain. There will be some tax payment. Net it will be 21,000. Net it will be 21,000 after tax payment. This will be 2,50,000. 2,50,000. And again, what will go to the final NPV analysis is incremental, new minus old. Every step you will have to do new minus old and then calculate NPV. At every step we will have to do new machine minus old machine, and for your NPV analysis 1,50,000 which is new minus, sorry, 58,50,000 which is new minus old, 22,84,000 which is new minus old, 2,29,000 which is new minus old, and then you calculate NPV with this, IRR with this, whatever you want to do. Whatever you want to do, you can calculate.
Then for all this replacement, we can do the incremental
Yeah, new minus old. New minus old, you calculate and then do the analysis. Any doubts on this? We separately calculated for the old machine, we have separately done the calculation for new machine and then did the subtraction to get the cash flow. You can calculate NPV, you can calculate any other technique also. The question can even ask you IRR, profitability index, anything can be asked. Come to question 11. Beta Limited receives 15 lakh a year after taxes from an investment in an automatic plant that has 12 more years of life. The company's required rate is 12%. It can make improvements to the plant which will cost 48, which will give you inflow of 48 lakh. This will cost 2 crore 10 lakh. With the improvement, the plant value at the end of 12 years would rise from 7 lakh 50 to 75 lakh. Would the improvements provide a return satisfactory to Beta Limited? Go through this. Where is the remote? New machine? There will be a book value, you know. When you calculated depreciation, what did you do? So if you see, this will be the new machine calculation. We did not depreciate it fully, no. 11 lakh 50 was the depreciation. Go through question 11. Guys, please. Okay, coming to this question, I am receiving 15 lakh a year from an automatic plant which has a life of another 12 years. There is no taxes and all in this question. I am going to make improvements to this. So my initial outflow is 2 crore 10 lakh. My initial outflow is 2 crore 10 lakhs. Because of the improvement, I will get how much? 48. 48 is not the cash flow. What we follow is an incremental principle. So what you get additionally is 33 lakh. 48 minus 15, 33. This will be for 20 years. This is there only for 12 years. Because the life will extend to 20 years is what the question has mentioned. But I have been given data like this. I have said today you invest for 2 crore 10 lakh. You will get 48 lakh for a period of 20 years, but maybe I plan to sell it after 12 years. I don't want to use it beyond 12 years. So today my outflow is 2 crore 10 lakh. I will use it for 12 years. In that I will earn 33. And at the end of 12 years, I will get extra 67 lakh 50. At the end of 12 years, I will get extra 67 lakh 50. So invest 2 crore 10, get 33 lakh for 12 years, get 67.5 at the end of 12th year and see whether NPV is positive or negative. Depending on that, NPV is positive, we go ahead with this investment. NPV is negative, we will not make this investment. Go through question 12. Go through this question. Okay, this question has only outflows. There are no inflows in the question. If there are only outflow, we go by something called as PV of outflow. We don't call it as NPV. We calculate something called as present value of outflow and select a project which has lower present value of outflow, because there are only outflows which are happening. Let me analyze only plant A. So we will do it like this: year, cash flow, PVF at 10%, DCF. I'm doing plant A. Year 0, my outflow for this project is My outflows I'm writing it as positive, okay. Outflows I'm writing it as positive. If there's any inflow, I'll write it as negative. We are calculating PV of outflow. We are not calculating NPV here. Year 0, 60 lakh. 1 to 10 years. 1 to 10 years, we will have an outflow of 30 lakh labor cost and another 5 lakh of overhead cost. So 35 lakhs. 35 lakhs. And at the end of 10 years, there's no salvage value. There's no inflow at all in this question. Even salvage value inflow is not there. So this is 1. The annuity factor given is 6.1446. So this is the PV of outflow of project 1. Similarly, you will calculate the PV of outflow of the project 2 and select whichever has lower PV of outflow. Listen, in this question, both the project have same life. If the life of the two projects is different, we calculate something called as equated annual cost. We'll have to calculate equated annual cost. We'll see in one question. We'll have to calculate EAC and then decide which is a better project. Go through 13. Okay, let's understand this question. It is considering replacing an older machine which is fully depreciated with a new machine costing 40,000. The new machine will have a depreciation over a period of 8 years. It will reduce labor cost by 8,000 per year. There will not be change in any other expenses. For me, the question ends here, okay. This is an irrelevant data unnecessarily given to complicate things, because this information is not going to change in any way, because they have told because of the new machine what will happen. One, labor cost will come down by 8,000. Depreciation will go up because you are buying a new machine, you will charge depreciation on that. So what is the cash flow of this machine is initial outflow is 40,000. In between flow is 8,000 is the cost saving. Depreciation of this machine is 5,000. PBT of the machine is 3,000. Tax is 35%. PAT of this new machine is 1,950. Add back depreciation, new machine will give you 6,950. New machine will give you 6,950 over a period of 8 years. No salvage value. Calculate NPV. Positive, go ahead. Negative, reject it. The question, this data is of no use because nothing is going to change there. Nothing is going to change there. 6,950 existing cash flows are not relevant. The only benefit of the machine is cost reduction, and the same has been considered as inflow in our analysis. Go through question 15. Okay, this is a problem on replacement decision. We'll separately do the existing machine calculation, new machine calculation, and find out the difference in the cash flow. This existing machine was purchased for 15 lakh 40 3 years ago. It has a remaining life of 7 years. It is being depreciated using straight line basis method. Its maintenance cost will increase by 40,000 from the 6th year of its installation. Realizable value today is 6 lakh 50. The new machine will cost you 27 lakh, installation expense will be 95,000, some subsidy will be received. It's subject to same rate of depreciation. Its realizable value after 7 years is 5 lakh 70. With the CNC machine, your annual cash operating cost will reduce, productivity will go up, the tax rate is 30%, cost of capital is 11%. Let's do working note 1 initial outflow. Working note 1 initial outflow. Initial outflow, particulars, existing machine, new machine, capital expenditure, working capital, NSV of asset on day 0, NSV of asset on day 0, capital expenditure, working capital, NSV of asset on day 0. Capital expenditure, working capital, NSV of asset on day 0. The capital expenditure of the new machine is 27 lakh 95,000. 27 lakh 95,000 including those installation expense. Including the installation expense, 27 lakh 95,000. Some subsidy will be received, we'll come to that later. 27 lakh 95,000. Working capital is not there. Working capital is not there. NSV calculation. Sale value, book value. First let me capture these two, then I'll know whether it's a gain or loss, and then I do the balance calculation. Today the machinery, the old machine can be sold for how much? 6 lakh 50. If you are not selling it, it's an opportunity cost, 6 lakh 50. Now listen, this old machine was purchased for 15 lakh 40,000, was purchased for 15 lakh 40,000 3 years ago. It has a remaining life of 7 years. So total life is 10 years, which indirectly mean every year depreciation is 1 lakh 54,000. Every year depreciation is 1 lakh 54,000. It was purchased 3 years ago, has a remaining life of 7 years. So depreciation is, book value is 15 lakh 40 minus 1 lakh 54 into 3. 15 lakh 40 minus 3 years of depreciation. 3 years of depreciation. There is a loss on sale, capital loss. Capital loss. Tax saved. Tax saved 30%. And net salvage value is sale value plus tax saved. Sale value plus tax saved. There is a tax saving. We purchased the asset for 15 lakh 40,000 3 years ago. Overall life was 10 years. So every year depreciation is 1 lakh 54,000. So after depreciation, the value left over is 1078. There is a capital loss. So this is 778,400. And technically my initial net outflow is this much. New minus old. Extra 20 lakh I'll spend. Basically, I'll buy the new asset for 27 lakh 95,000 and sell the old asset for a net of 7 lakh 78,400. Sell the old asset for net of 7 lakh 78,400. Clear? Any doubts on this? Sell the old asset for net of 7 lakh 78,400. Working note 2 in between flows. Now, if I look at the old machine, it doesn't seem to be generating any cash flows. The question has not mentioned any cash flows generation of the old machine. It says its annual maintenance cost is expected to increase by 40,000 from the 6th year of its installation. I don't know what is the AMC figure today. I don't know. That's not mentioned. Maybe I'm not sure whether I missed it out while typing. But it says annual maintenance cost will increase by 40,000 from the 6th year of its installation. 3 years already gone by. Another 2 years it can survive. After that 40,000 will be the maintenance cost. Purchase price of CNC machine is 27 lakh 95,000. Subsidy equal to 15% of purchase price will be received at the first year of its installation. This subsidy you can assume to be tax free, you can assume it to be taxable, and accordingly do the calculation, because tax free means calculation will be different, taxable means calculation is going to be different. It is also subject to same rate of depreciation. Its realizable value after 7 years is 5 lakh 70. With the CNC machine, my cost will come down by 2 lakh 16 and revenue will increase by 2 lakh 76. Now listen, particulars, year 1, year 2, year 3 to 7 together. If you have a doubt why I have done 3 to 7 together in an exam scenario, you are not able to think through this, you write all 7 years separately. Write all 7 years separately. Listen, first is cost saving. What is cost saving out of this machine is, it is going to reduce cost of 2 lakh 16. It will save cost of 2 lakh 16. Revenue increase, which is 2 lakh 76. 2 lakh 76. Saving in maintenance cost. See, moment I replace the machine, I am going to give away the old machine. In the old machine, what is likely to happen is, they said after the 6th year of installation, you are going to incur maintenance cost of some 40,000 rupees. We are going to incur a maintenance cost of 40,000 from the 6th year of installation. What is 6th year of installation? 3 years already gone by. Year 4 and year 5 is technically year 1 and year 2, and 6th year onwards you will incur this 40,000. Because you are shifting, you will save this 40,000 also. You will save this 40,000 as well. So totally 3 savings will be there. 1, there is a cost saving, there is a revenue increase, and there is a maintenance cost saving, because you are shifting from the old machine to the new machine. Old machine has depreciation of 1 lakh 54. I am not separately calculating old machine, new machine, because old machine has only outflow. If you do, everything will be negative. So I am clubbing the step together here. Every item I am trying to find the incremental number. You can do it separately also, but lot of items will be negative. New machine depreciation will be 27 lakh 95,000. What is the salvage value given in the question? 5 lakh 70,000 divided by 7 years. Can you tell me how much is this? There are alternate answers possible. I'll come to the alternate in a minute. 3 lakh 17. Okay, alternate answers to this is, 1, I can say that the subsidy of 15% which is subtracted, will be subtracted from the cost of the asset, and depreciation will be on the lower amount. I'm not sure what exactly they have followed. Your depreciation can be on 2795. It can be on 2795 minus this 15% minus the salvage value, or whatever we have done. I assume it will be 3,17,857 less incremental depreciation. Every year the extra depreciation is 3,17,857 minus 1 lakh 54. This will be PBT. Of the project. This will be the PBT of the project, less tax, PAT, add depreciation, CFAT. Less tax, get PAT, add back depreciation and get CFAT. Instead of separately doing the calculation for the old machine, separately doing for the new machine, we have clubbed them together. This new machine is going to bring in saving of 2 lakh 16. It will bring in a saving of 2 lakh 76 extra revenue, and also a saving of this 40,000. Depreciation can be a debatable item. Depending on the alternate depreciation, which can be is 2795 into 85%. This by 7 years, it's 257,964. The other final option is not even considering salvage value and depreciation. I don't know what they have followed, but depreciation, multiple answers are possible depending on the assumption you take. What's the tax rate in the question? 30%. So into 0.3. PAT add back depreciation, CFAT. Then we'll have to do the salvage value calculation for the old machine, new machine, and again get to the incremental number. Let me see what they have done finally here. Old machine, okay. Just give me a minute. Okay, they have done it on 18,20,000. They have done, okay, sorry, just one small error in my calculation. Your 27 lakh into 85%, 27 lakh into 85%, because subsidy is on the cost of the asset, not on 27 lakh 95. Installation cost was 95,000. Installation cost was 95,000. So they have subtracted the subsidy component. They have subtracted the subsidy component and taken this as 260. Taken this as 260 to do the calculation. They have subtracted the subsidy component. If you see here, old is done separately, new is done separately, it doesn't really matter. That way it doesn't really matter, because net the extra cash flow will come. Just give me a minute. Just 1 minute, friends. Sorry, 2,60,000. 1,54,000. The depreciation is 2,60,000. The depreciation is 2,60,000. Assuming the subsidy component is adjusted. Assuming the subsidy component is adjusted. This will be my incremental CFAT, and this is what you would have got here. 376,200, 404,200. 376,200 and 404,200. In year 1, on top of this, you'll have to add the subsidy component. In year 7, on top of this, you'll have to add the salvage value. In the first year, you'll have to add the subsidy component, and in the last year, you will have to add the salvage value component. So here, I kept on calculating existing and new separately and then did it. I didn't want to follow this because everything will be negative here. If you see, everything is negative. Depreciation is negative, PBT is negative, PAT is negative. This is one approach. The other approach is combining them together and writing it as a single item like this, where what we have done is revenues, revenue increase, saving in maintenance cost, incremental depreciation, incremental PBT. We are doing everything at an incremental level. Yeah.
Can you explain the incremental depreciation again, sir?
The new machine depreciation is 2,60,000. Old machine depreciation is 1,54,000. The difference is 1,06,000. So everything is incremental here. Everything is taken at the incremental level. Go through 16. Go through 16 and you try doing it. This is WDV method. I want you to calculate cash flow. Go through 16 and try doing it. Calculate cash flows. One question on WDV method, just the cash flow part. That approach basically assumes that you are not writing off the subsidy to the cost of the asset. I think accounting standard has some say on that. Accounting standard allows you to write it off. It's basically your grant which you get, or the subsidy which you get is in the form of capital contribution, not in the form of capital contribution. I think some accounting related aspect is there. So whether you write it off or not to the cost of the asset is the point. I want you to do this calculation, please do cash flow calculation. Do cash flow calculation for 16. Only the in-between cash flows. Do only the in-between cash flows. Okay, in-between and salvage, do both. The terminal flow, in-between and terminal, please do it. In-between cash flow and terminal cash flow. We'll discuss it in some time. do the in between cash flow and terminal cash flow. I want you to do it, please. You will make some mistakes in the terminal cash flow. I want you to try it. WDV method, so cash flow will be different for each year. Do the cash flow calculation. For a WDV method problem, it is good if you can prepare a depreciation schedule. It will make it easier to calculate the cash flows. You can do even without a schedule, but it will be more convenient if a schedule is prepared. It will make easier for you to do. So opening WDV, less depreciation, closing WDV. This will be your CFAT numbers for different years. The PBDT is given in the question. Depreciation will be different for each of the years. PBT, subtract tax, PAT, add back depreciation, CFAT. Salvage value is also a very critical calculation here. You cannot ignore salvage value. Question says salvage value 0. That does not mean net salvage value is going to be 0. Scrap value 0 does not mean NSV is 0. Does not mean NSV is 0. Your CFAT numbers are there. Opening WDV, less depreciation, closing WDV for all the 5 years is presented. Opening WDV, less depreciation, closing WDV for all 5 years is presented. And listen, now salvage value will be computation of NSV, sale value is 0, book value is 262.14, sale value is 0, book value is 262.14, capital loss 262.14, tax saved, tax rate is 40%, tax saved, and NSV is going to be sale value plus tax saved. So this will be taken as net salvage value. This will be taken as net salvage value in the calculation. Okay, listen, some questions will say ignore capital gain tax. Listen for some time. Now some important points. Ignore capital gain tax. If the question uses that word, sale value is equal to NSV, don't do any of this calculation. Sale value is equal to net salvage value, ignore capital gain tax if they say. Another part they may say, company follows block of assets method. You would have learnt about block of assets method in income tax. So if there is a block of assets method, and if you have an asset and you buy a new asset or sell an old asset, you will not get capital gain or capital loss unless that block is fully exhausted, So if the company says the company is following block of assets method, then what will happen is you may not have this tax payment or tax saved there also, depending on whether the block has value or not. For example, if you are going to replace an old asset with a new asset, the new asset will come, old asset will go out, there will not be any short-term capital loss or short-term capital gain, because under income tax that value has to become 0 and you should get a higher consideration, then only you will have STCL or STCG. If you are buying a new asset, selling an old asset, if new asset has a higher value, then it may not have. For example, question may say your existing asset has a book value of 2 lakh. You are planning to sell this for 3 lakh, okay? You are planning to sell this for 3 lakh. Normally you will have 1 lakh of capital gain. You are buying a new machine for 10 lakh rupees. So 2 lakh minus 3 lakh and new machine for 10 lakh. There will not be any capital gain. That's one part. Second part is when you calculate depreciation, you will calculate depreciation only on 9 lakh, because under your income tax act, the WDV in the books of accounts will become 9 lakh. This is going by what is there in income tax. I think there is one problem which is there in the additional questions. I'll see that later. But this is a concept also which can get tested. One is ignore capital gain, then you need not do any sale value NSV calculation and all is not needed. Second part is if they say block of assets method, you will have to go by what is there in your income tax principles. And income tax principle basically says there cannot be STCG or STCL unless that block is fully exhausted, unless the value is exhausted. Just give me a minute. Okay, yeah, come to this question. Question 14. This is in the additional questions, page 198. I'm going to do major part of discussion only. Solving may not be that much. Page 198, question 14. An existing company has a machine which has been in operation for 2 years. Estimated remaining life is 4 years with no residual value. Its current market value is 3 lakh rupees. Management is considering a proposal to purchase an improved model of a machine which will give higher output. The details are purchase price of the existing machine, new machine, life, residual value, annual operating days, operating hours, selling price, material cost, output, labor cost, fixed overhead excluding depreciation, working capital. Assume that cost of capital is 20%. Company has written down value of depreciation at 20% and it has several machines in 20% block, block. Advise the management on the replacement of machine as per the NPV method. The important part is it has several machines in 20% block. This basically tells you that they want you to follow block of assets method, which is there in your Income Tax Act. Go through the question. I'll discuss some of the important points. The two important points which I want to discuss is, one is on salvage value, second is on depreciation. Balance is a formality, that's not much critical, we have done it in other questions and all. Okay, now listen. What you normally do is existing machine, new machine. Point number 1, capital expenditure. Capital expenditure is 10 lakh. Point number 2, working capital, which is 1 lakh and 2 lakh. Point number 3 is NSV of old machine. NSV of old machine on day 0. What you do for NSV? Sale value 3 lakh. Sale value 3 lakh. What would have been the book value? 6 lakh by 6 years. In 1 year, 1 lakh is depreciation. 6 lakh by 6 years. In 1 year, the depreciation is 1 lakh rupee. It has a life of 2 years. So indirectly, the depreciation would have been, it is already 2 years are over. Another 4 years are pending. So the book value today is 4 lakh of the existing machine. The book value today is 4 lakh. If I do in a normal manner, sale value 3 lakh, book value 4 lakh, capital gain, tax paid and NSV. None of them I have done and I have directly written this 3 lakh. None of them is done and we have done directly 3 lakh, and we are saying company has many assets under 20% block and hence sale of asset will not lead to capital gain. Salvage value has been taken as net salvage value. Not only for working note 1, even for working note 3, the same thing will happen. This is one part. Second is, you will calculate units sold, you will calculate material cost, you will calculate labor cost, you will get PBDT. All that in the normal manner. That is your units sold, revenues, material cost, labor cost, fixed overheads, you will get PBDT. Till PBDT, I don't have a problem, okay? I'm not going to even discuss till PBDT. When you buy the new machine, normally what you will do is, you will charge depreciation on 10 lakh rupees. You're going to charge depreciation on 10 lakh rupees. 10 lakh into 20%. 10 lakh into 20% is what you will normally do. 10 lakh into 20% will be the rate of depreciation. But that's not going to work here. That's not going to work here. I don't know what my block of assets has till now. Let me ignore that for the time being. The changes because of this, what is going to happen is 1 plus 10 lakh will be there. What is this plus 10 lakh? This plus 10 lakh is basically the purchase of new machine. There's going to be a purchase of new machine which will add us your 10 lakh of capital expenditure will be added here. 10 lakh of capital expenditure will be added here. There is a WDV of just give me a minute. 3 lakh 84. Just give me 1 minute. Okay, just one error. I have assumed SLM in my calculation. Just one mistake. Sorry, the 6 lakh is there. This old machine minus 20% for 1 year. The history, in the history, 1 lakh 20, 4 lakh 80, another minus 20%, 96,000. So this had a opening WDV of 3 lakh 84,000. What Income Tax Act says is, let this 3 lakh 84 be as it is. I am not going to allow you to remove this or do anything. I am not telling you to pay any capital gain at all. You have purchased an asset for 10 lakh. But the old machine had a WDV of how much? 3 lakh 84,000. We have sold old machine for how much? 3 lakh. So there's a difference of 84,000. There's a difference of 84,000. This 84,000 ideally should have been a capital loss. Ideally should have been a capital loss. But Income Tax Act is not allowing it because it follows block of assets. So my block will have 10 lakh, 3 lakh 84 of old asset, 3 lakh removed because of sale of old asset. So net 10 lakh 84,000 will be there in the block. Net 10 lakh. Apart from this, other assets can also be there. I am not bothered about the other assets. I am not bothered about the other assets. Apart from this, so many other assets can be there. So I am going to technically charge depreciation on 10 lakh 84,000. I am going to charge depreciation on 10 lakh 84,000 as per block of assets method. 10 lakh 84,000 as per block of assets method. For the existing machine, you will charge depreciation on 3 lakh 84,000 as per the block of assets method. You continue with the old asset. Even in the terminal flow, I am not going to have any capital loss and all. I am not going to have any capital loss. See, this old machine has some value. This machine also has some value. In the end, there is this, 4,44,006, there is a value which is there in the block of assets. Also, there is a value of 1,57,286. What we normally do is sale value less book value, capital loss, tax paid, all that will come. In this question, none of them is going to come because you have more assets in your. So, if the company follows block of assets method, sale value is equal to net salvage value. So, no need to do that sale value less book value, capital gain, capital loss, all that headache will not be there. Second point which you need to take into consideration is, if the depreciation is to be calculated not on the purchase price of the asset, purchase price plus the WDV of the old asset minus the sale value of the old asset. In case this combination becomes negative, then only you will have STCL or STCG. Then only you will have STCL or STCG. Otherwise, there cannot be any STCL or STCG in case of block of assets method. Clear? Any doubts on this? Let me see. I think there's one more discussion. ठीक है. Go through question 17. Go through 17. Go through this. Okay, most important aspect of this question is this word, ignore tax. If taxation is to be ignored, I am not going to even calculate depreciation. I am not going to calculate depreciation. So, every year I am going to sell 1 lakh units. Every year I will earn a contribution of 3 lakh. Every year I will, after fixed cost, there is a 2 lakh of earning. In that 2 lakh, 20,000 extra expense in the first year and 30,000 extra expense in the fifth year. So, first year alone my inflow will be 1,80,000 because there is an extra expense of 20,000. Second year 2 lakh, third year 2 lakh, fourth year 2 lakh and fifth year is 1,70,000. Fifth year is 1,70,000, sixth year is 2 lakh. No concept of salvage value calculation and all, no concept of depreciation because the question said ignore taxation. Ignore taxation. 180, 2 lakh, 2 lakh, 170, 2 lakh, 2 lakh. I am not bothered about anything else. I am not going to even calculate depreciation because the question has clearly mentioned taxes are ignored. So, PBDT is equal to CFAT. Go through 18. I'll take you through this. This is a very good question. Go through the problem. Read through the entire question. Hmm?
That big question.
I'm not sure. I don't think so. I've not done this in the class.
So it's an batch.
Okay, not sure. Go through the question. Okay, it's an existing profit making company, makes a lot of importance. That line, ABC Limited is an existing profit making company. It is planning to set up a solar power plant. Initial outflows 280 plus another 30, 310 lakhs. That's my initial outflow. 280 lakhs is the cost of power plant, 30 lakh is the cost of land, 310 lakhs is the initial outflow. Subsidy of 25 lakh from state government to be received at the end of first year of installation. This subsidy is an inflow. Do you pay taxes on this? That's your assumption. Second, do you want to charge it off against the cost of the power plant and claim lesser depreciation? That's also could be an assumption based area. Let's see if there is some clarity on this. Sale of electricity will be at 2.25 per unit. This will keep going up by 0.25 and thereafter it will go up by 0.50. This will tell me how much revenue I am making. Maintenance cost will be 4 lakhs in year 1 and same will increase. Life is 10 years. Cost of capital. Residual value of power plant is nil. So there is no salvage value. Land value will go up to 90 lakhs at the end of year 10. We purchase the land for 30 lakhs. It will go up to 90 lakhs. Indirectly it leads to some capital gain. It will lead to some capital gain. From 30 lakhs it goes up to 90 lakhs. Depreciation will be 100% of the cost of power plant. Entire 280 lakhs is to be depreciated without considering subsidy. We did one problem where subsidy was adjusted with the cost of the asset. This question they very clearly mentioned without considering subsidy, please write it off entire amount in 1 year itself. Entire amount in 1 year itself, and the same will also be allowed for tax purpose. Gross electricity 25, 4% of this is free tax. You are required to suggest the viability by calculating NPV while ignoring the tax on. This means no need to do the salvage value, net salvage value calculation and all. That capital gain on land is not taxable. That capital gain on land is not taxable because they have said ignoring the tax on capital profit. Assume that tax savings, if any, are utilized in the year of their occurrence. They are making it more clear. Whenever that first year there will be a loss because you are going to write off the entire amount. When you write off that entire amount, whatever losses you are making, you can set it off in the same year. And because of that, this line made that reference. One is profit making company. Even if this profit making company word was not there, last line is very clear saying that whatever tax savings is there, you assume that you are utilizing it in the same year. You are utilizing it in the year of their occurrence. I'll directly do in between cash flow, particulars and 10 years. We cannot club it together because the selling price is different for different year. The selling price is not same. Some of the points where there can be a confusion have been clarified in the question. One is on the subsidy. They mentioned that you are not writing off the subsidy to the cost of the asset. Another confusion which I can have is that subsidy which I am receiving, is it a taxable subsidy or a tax free subsidy? Because Income Tax Act has certain subsidies which are taxable, certain subsidies could be not taxable. So I don't know that. That's an assumption based area. Point number 1, units sold. We are generating 25 lakh units every year. Gross electricity generation will be 25 lakh units per annum. In that 4% will be given free of cost. So this is 25 into 96%. I will sell 24 lakh. Selling price, I start with a price of 2.25. Increase it by 25 paise till year 7. Increase it by 25 paise till year 7. and thereafter increase it by 50 paise. Thereafter increase it by 50 paise. So this will give the revenues. The revenues will be different for different year because of the price. After we get the revenues, there are certain expenses they have given. One is maintenance cost. For maintenance, what they have mentioned is it will be 4 lakhs in the first year and will increase by 2 lakhs every year. So we start with 4, make it 6, and it will keep going up by that. 8, 10, 12, 14, 16 will keep going up. Then we have there's a subsidy receipt. We'll capture subsidy receipt later on. I'm assuming it's not taxable. I don't have any other expense. I don't have any other expense in the question. Depreciation. Depreciation. See, I normally do PBDT and then do less depreciation. It's not necessary for you to show PBDT. You can subtract depreciation and directly show PBT also, or show PBDT and then subtract depreciation. Why I normally do PBDT is I can stop at PBDT if taxation is not there. If tax is not there, if tax is there, we'll have to do this. Depreciation for 1 year is 280. Depreciation for 1 year is 280. So we have given effect to power plant cost, land cost, subsidy will capture it, sale of electricity, maintenance, life, residual value, okay, we'll capture it later. Depreciation is done, gross electricity is done. So now I have PBT, and most probably year 1 will be a loss. Year 1 will be a loss, all other years will be a profit. The question could have mentioned that losses cannot be set off immediately. You carry it forward and then set off over the next few years. But here they have clearly mentioned that it has to be set off immediately. So less tax. Tax is 50%. Depreciation can indirectly increase your cash flow. So depreciation is a non-cash item. It will indirectly increase your cash flow. You will understand it here. PAT. In practical world, there are a lot of assets where Income Tax Act provides an accelerated depreciation. You could have heard about windmill which are charged at 80% rate of depreciation in your Income Tax Act. I think there are also a provision to claim even 100% depreciation. These are tools given by government to motivate people to invest in those assets. So normally in the month of March and September, you will see a lot of capital investments being done. The reason for that is you can claim depreciation, and by claiming depreciation you reduce your profits, and because of that you have lower outflow. So in this case what happens, I add back depreciation, I get my CFAT, and you will see the first year cash flow will be very high. The first year cash flow, though the unit sold is same, but look at the first year cash flow, it's very high as compared to the other years. It's extraordinarily high. The reason for that is of the tax benefit. That 280 lakh indirectly contributes to 140 lakh of tax saving. The 280 lakh of write-off indirectly contribute to 140 lakhs of tax saving. On top of this, subsidy can be added. On top of this, subsidy can be added. Subsidy of another, I think 25 lakhs will be received. Your wish, you whether want to take it as taxable or tax free. The assumption is it's tax free here. The assumption is it is tax free. You can even take it as taxable. You can even take it, if you take it as taxable, it will come this side. It will come above. If it's tax free, it will come below. Terminal flow, I am not calculating any tax, okay. I am not calculating any tax because land I am writing it directly, because the question said ignore tax on capital profit. So we have ignored the tax on capital profit and written the figure as it is. Consolidation and calculation of NPV. The NPV is very high, probably because of this item. Probably because of depreciation being claimed. If the same amount was claimed every year, no, maybe it could have negative NPV also. This project can have negative NPV if you claim depreciation in every year rather than claiming it at one go. Because by claiming it at one go, what happens is the value of that is 0.870. If you claim it here, the value is only 0.284 or 0.327. So the worth of that depreciation saving will come down significantly if you are not claiming it immediately. Go through 19. Okay, this is a question again on investment decision, but in this question we are not going to have any revenue increase, but we are going to have cost decrease. We have done one problem where this had happened. What is the initial outflow? How much is the initial outflow here? 20 lakhs. Presently I am following this system. I am going to follow an automated system. Now it's a manual system. So the in between flows is cash cost saving of 200 into 10,000. Cost saving of 200 into 10,000, which is 20 lakh. This is treated like a revenue. In your in between flow. Less your cost is 5 lakh. So 20 lakh minus 5 lakh. My PBDT is 15. Depreciation is 2 lakh. PAT is 13. Tax rate is 30%. Sorry, PBT is 13. Tax rate is 30%. PAT would be 9 lakh 10. Add back depreciation, you may get 11 lakh 10. Add back depreciation, you will get 11 lakh 10. Any cost saving is to be treated like a revenue inflow. Any cost saving is to be treated like a revenue inflow. So cost saving is treated like a revenue item, revenue slash cost reduction. It's revenue slash cost reduction. Okay, go through 20. This will be the last problem for the day. We'll do this and then leave. Go through 20. Okay, if you read through this question, is considering replacement of a 5-year-old equipment. It has to incur excessive maintenance cost. It has currently 0 written down value, but you can also modernize it at 1,40,000. You can also modernize the existing asset at 1,40,000. Then you can sell it at 30,000 after 5 years. The modernization would help in reducing some of the cost. Another alternative is you buy a new machine at a cost of 3,50,000. Whose salvage value is 60,000. The new machine will be able to is more efficient. We want to know, should I go for modernization of equipment or buy a new machine? If I go for modernization, my initial outflow is 1,40,000. If I go for purchase, my initial outflow is 3,50,000. Separate, no concept of new minus old and all. Modernization is a separate alternative and this is a separate alternative. When we do replacement, it's always new minus old because you will buy the new machine and sell the old machine. Now it's not that you are going to purchase the new machine and modernize the old machine. It's not a combination of two things. So modernization will be a separate analysis. New purchase will be a separate analysis. When you modernize, you reduce cost of this much. 1,20,000 minus 7,500. 1,20,000 minus 70,500. That's like a revenue item. 1,20,000 minus 70,500 because the existing equipment, the cost is 1,20,000. By modernizing, you are bringing down the cost to 70,500. So the cost saving is 120 minus 7,500, which is 49,500. For new machine, the cost saving is 120 minus 39,500, which is I think 80,500. This will be taken as a revenue item. Less There are no extra cost and all of this new machines. They have not given any other cost. There's only cost saving which is given in this question. So you take cost saving, subtract depreciation, PBT, subtract tax, PAT, add back depreciation, get CFAT. So 49,500, 80,500, depreciation, PBT, tax, PAT, add back and get the CFAT number, and then do the normal discounting, whichever has better NPV. Modernization has an NPV of 14,123, new purchase has an NPV of 50,282. So I'll go for modernization and not for new purchase. I'm not linking them together. New minus old, incremental, all that cannot be done here because both items are standalone decision. They are standalone, mutually exclusive decision. Clear? Okay. With this, I'll end today's session. Tomorrow's class will start at 10:45. I'll update in the group in case there's any change in the timeline. I'll update that in the group. We'll end with this then. Okay. Good morning, friends. Good morning, friends. Okay, let's continue with the capital budgeting discussion. Maybe for some 30-45 minutes, we'll discuss on capital budgeting, the balance areas, and then I move to the next areas. Let's come to question 21. WX Limited is considering a proposal to replace an existing machine. The details of existing machine and new machine are as under. Particulars: existing machine, new machine, cost of machine, present estimated life, present book value. Out of the life of 10 years of present machine, 5 years have already lapsed. Management can continue with this machine for the remaining lifetime. Activity level is same, residual value is 60,000, there will be a saving of 2,40,000 in variable cost. If the old machine is sold, then it will fetch 90,000. Minimum return of 11%, corporate tax, no depreciation is to be charged in the year of sale. You are required to comment on the suitability of replacement of the old machine. Go through this. Okay, this is also a question on replacement of machine. The bigger difference is in the last year when you are selling the asset, you should not charge depreciation. That's question's specific requirement, that you should not charge depreciation in the last year when you are selling the asset. Maybe that could get reflected as short term loss or short term gain. I'm not sure. When you do the calculation, you'll understand. We purchased this asset for 3,75,000. 10 years of life. 5 years have already passed by. Now the book value is 187,500. So the book value as of now is 187,500, which means every year they would have charged depreciation of 37,500. Just give me a minute. Just give me a minute. Friends, you are able to see the screen? Okay, the asset was purchased for 3,75,000. After 5 years of depreciation, the asset value is 187,500, which can you close the door? Which indirectly mean the depreciation per annum is 37,500. They have been charging depreciation of 37,500. I have purchased a new asset which will have 5,25,000. There will be a residual value of 60,000. This will have a life of 5 years. The only thing is, in the last year when you are selling the asset, you should not charge depreciation. Technically that doesn't make any big difference. You will understand how it doesn't make a difference when we do the calculation. Let's start. Working note 1, initial outflow. Working note 1, initial outflow. Initial outflow. Particulars: existing asset, new asset. existing asset, new asset. We'll calculate the incremental cash flow, existing and new asset. For existing, you'll have to calculate NSV of existing asset, and for this, you'll have to calculate capital expenditure, initial outflow, NSV of existing asset, capital expenditure, and initial outflow. Now, the new asset, the capital expenditure on that new asset is 5,25,000. 5,25,000. For the existing asset, computation of NSV of existing asset, sale value, book value. Today, what is the sale value of the old asset? What is the sale value of the old asset today? 90,000. Book value is 187,500. Loss on sale. Loss on sale. Tax saved. There's a loss on sale, so we're going to save tax. Tax saved is 30%. Tax saved. And NSV is sale value plus tax saved. Sale value plus tax saved. And net my initial outflow is the incremental number, new minus old. The incremental number is new minus old, 4,05,750. New minus old, 4,05,750. That is the initial outflow. The initial outflow is 405,750, which is the extra outflow which is happening. Working note 2, in between flow, particulars, old machine, new machine. Now, it has a balanced life of 5 years. The only thing is, I'll split it as year 1 to 4 and year 5. Reason for this variation is, question has clearly mentioned that you are not going to charge depreciation in the year of sale. Saving in cost. New machine will save you 2,40,000. New machine will save you 2,40,000. Old machine, nothing is mentioned in the question. Saving in cost of new machine is 2,40,000. There will be a saving of 2,40,000 in variable cost by the usage of new machine. The saving in cost is technically PBDT. There are no expenses given in the question, so this is technically PBDT less depreciation 37,500 0. 37,500 and 0. In the last year, I cannot charge depreciation. In the year of sale, depreciation cannot be charged. This is 5,25,000 minus 60,000 divided by 5 years. SLM method, 5 years life. So last year we don't charge depreciation, but the life is anyway 5 years. 5,25,000 minus 60,000 divided by 5 years. No depreciation here. So PBT less tax, PAT, add back depreciation, CFAT. So this could be a loss making scenario because I don't have other information here. The tax rate is 30%. We get PAT, add back depreciation and CFAT. And what matters is new minus old, which is 184,650 and 1,68,000. New minus old. This will go to my final step when I calculate the NPV. Year 1 to 4, the cash flow will be 184,650 and the last year the cash flow will be 1,68,000. New minus old. Then comes your working note 3, which is on terminal flow. The problem is this question has said no depreciation in the last year. I'll tell you that is an irrelevant adjustment per se. Even if you ignore that also, you'll get the same answer. But from an exam point of view, obviously presentation has to be that way. The old asset, new asset. Old asset will be sold for 0. New asset will be sold for 60,000. New asset will be sold for 60,000. It has a residual value of 60,000. Old asset today can be sold for 90,000. After 5 years, nothing is mentioned, so it is 0. It will have a book value of 37,500. What is this 37,500? Is the last year depreciation. Last year you did not charge depreciation. This will have a book value of 5,25,000 minus 93,000 into 4, which is 1,53,000. What is that 1,53,000? Is technically 60,000 of residual value and last year depreciation. You did not charge the depreciation in the last year. So this will become loss on sale. On loss on sale, you are going to save tax, and your NSV number is, and the incremental NSV number is 76,650. Now if you see, last year the cash flow is 244,650. The last year the cash flow is 244,650, which is nothing but I could have charged depreciation here. If I had charged depreciation here 37,500, 93,000, I would have got same 184. This would have been 0. This would have been 60,000. So charging depreciation, not charging depreciation does not really matter in the last year, because last year automatically it will get reflected as STCL or STCG. So the point is, the question specifically wanted us to do it this way. Else I could have calculated 184,650 for all 5 years and added the salvage value of 60,000. I would have got 244,650. Just added the salvage value. But question specific requirement is no depreciation is to be charged in the year of sale. I should not charge any depreciation in that year. Let's come to question 22. Company UVW has to make a choice between two identical machines in terms of capacity A and B, designed differently, exactly do the same job. Machine A will cost 7,50,000, 3 years, 2 lakh per year to run. Machine B is an economy model costing only 5 lakh, will last for only 2 years, 3 lakh per year to run. The cash flows of A and B are real cash flow. Opportunity cost of capital is 9%. Which machine should the company buy? Go through the question. Okay, this problem has information only on outflow, so we calculate PV of outflow. Another issue here is machine A has a life of 3 years, machine B has a life of 2 years. So we will calculate PV of outflow. After PV of outflow, in order to make the decision, I'll have to calculate equated annual cost, because the life is different. Obviously a 3-year machine will have higher outflow as compared to a 2-year machine. So working note 1. Computation of PV of outflow. Computation of PV of outflow. Year cash flow PVF DCF. Year 0, the outflow is 7,50,000. I am writing outflow as positive item. If there is any inflow, we will write it as positive, so negative item. 1 to 3. 2 lakh, 7,50,000 and 2 lakh. The annuity factor is 9%, 1, 2.531. So the PV of outflow is 12,56,200, 12,56,200. Equated annual cost is equal to PV of outflow divided by annuity factor for the number of years of life. The life in this case is 3 years. So this will be called as equated annual cost. 4,96,326 divided by 2.531, equated annual cost. The annuity factor is 2.531 for 9% for 3 years. So I have divided by that. When it comes to machine B, it has an initial outflow of 5 lakh. It takes 3 lakh to run. Can you tell me the 2-year annuity factor? 9% annuity factor for 2 years. How much? 1.75? 9. So this has an outflow of 10,27,700, which is lesser than 12 lakh. But from an equated annual cost point of view, machine 1 is better. The first machine is better from an equated annual cost. Equated annual cost is PV of outflow divided by annuity factor. PV of outflow divided by the annuity factor. Clear? Any doubts on this? Let's come to question 23. BT Pathology Lab Limited is using an X-ray machine which reached at the end of their useful life. Following new machines are of different brands with same features are available for the purchase. Brand XYZ ABC, cost of machine, life of machine, maintenance cost, rate of depreciation. Residual value shall be dropped by 1/3 in the first year and thereafter will be depreciated at the rate mentioned above. Alternatively, ABC can be taken on rent and be returned back to the owner after the use on the following terms and condition. Rent shall be paid at the beginning of the year. First year will be 1,02,000. Rent for subsequent years will be 102,500. Last 5 years will be 109,950. Rent agreement can be terminated by making a payment of 1,00,000 as penalty. The penalty would be reduced by 10,000 each year of the period of rental agreement. Advise which brand can be acquired if you want for a period of 20 years and if you want for a period of 5 years. Go through this. Okay, I need an X-ray machine. My purpose could be for a period of 20 years. Another purpose is for a period of 5 years. If you look at XYZ has a life of 15 years, ABC has a life of 10 years, and you can also take ABC on rent, which also has a life of 10 years. Requirement is I need it for 20 years. So I don't have data to calculate for 20 years because I have data of only 15 years, 10 years and 10 years. So what we will do is, there are only outflows again in this question. You will calculate the PV of outflow for 15 years, PV of outflow for 10 years, which is your buying of ABC, PV of outflow for 10 years, which is the renting option. And for all the three, you will calculate equated annual cost. For all the three, you will calculate equated annual cost. Whichever alternative has lower EAC, you go ahead and select that from a point of view of 20-year life. If it's a 5-year life, buy XYZ and sell it at the end of 5th year. Buy XYZ and sell it at the end of 5th year, put only 5-year cash flow. Buy ABC and sell it at the end of 5th year, only 5-year cash flow. Rent ABC and terminate the agreement at the end of 5th year, only 5-year cash flow. Whichever gives, there is PV of outflow, no EAC to be used. Whichever has lower PV of outflow, that is the option to be selected. Now let's try to put the cash flows alone. First one is purchase of XYZ. Purchase of XYZ. I'll focus on year and cash flow. I'm not going to do discounting at all. Discounting is something you can do. Year cash flow. Year 0, I have an outflow of 6 lakh. Year 0, I have an outflow of 6 lakh. Year 1 to 5, I will have an outflow of 20,000 maintenance. 1 to 5 outflow of 20,000. 6 to 10, outflow of 28,000. 11 to 15, outflow of 39,000. Now in calculator, if you want annuity factor for 6 to 10, what you should do is 1 divided by whatever the number you put equal to, that's the first year factor, don't do anything, equal to second year, equal to third year, equal to fourth year, equal to fifth year. After that, when you put equal to, put m plus 6, 7, so it will add 6, 7, 8, 9, 10, or you manually note it down and then add them together, whatever way you are. Now at the end of 15th year, I am going to sell this. Now what question says is 6 lakh is the cost. It will go down by 1/3 in the first year itself. It will go down by 1/3 in the first year itself. The cost of the asset will fall by 1/3 in the first year. So 6 lakh minus 2 lakh, it will become 4 lakh. And after that, it will be depreciated at the rate of 4%. Depreciated at the rate of 4%. So 4% of 6 lakh, okay? 4% of 6 lakh, the original cost of the asset. So minus 24,000 into 14. Can you do this and tell me? 4 lakh minus 24,000 into 14 years. 4 lakh minus 24,000 into 14 years. 64,000. This is my salvage value minus 64. This is an inflow. This is an inflow. So minus 64,000. Whatever is the PV of outflow, divide by the 15-year annuity factor and get the EAC. Divide by the 15-year annuity factor and get the EAC. Minus 64,000. This is an inflow from the asset. My value is 6 lakh minus 1/3, which is 4 lakh minus 24,000 per year for another 14 years. 24,000 because they said at the rate of 4% for all the subsequent years. Thereafter shall be depreciated at the rate mentioned above. The next scenario is year cash flow. Year 0, the outflow is 4 lakh 50. Year 1 to 5, 31,000. 6 to 10, 53,000. And at the end of year 10, from 4 lakh 50, 1/3 value is gone, 1 lakh 50 is gone, you are left with the value of 3 lakh. Depreciation is 6% of 4 lakh 50, 6% of 4 lakh 50, which is 27,000. So 3 lakh minus 27,000 into 9 more years, 27,000 into 9 more years, 57,000. So this is second option. You calculate the PV of outflow, divide by the annuity factor of 10 years and get the equated annual cost. Third scenario is going for renting. Year cash flow. The thing is, the rent is to be paid at the beginning of the first year. Beginning of the year is nothing but year 0. Beginning of year 1 is nothing but year 0. So year 0, my rent is 1,02,000. This is the first year rent, okay. This is to use the asset for the first year, you are paying it in year 0. Then they are saying annual rent for the subsequent 4 years, again that will be paid at the beginning of the year. So 1 to 4, 102,500. This is technically the rent for second to 5th year. Second to 5th year, because you have paid rent for the first year and day 0, then you are paying rent. And then it says for the next 5 years is 1,09,950. This is technically the rent for 6th to 10th year. Again, this is not a 9-year life, this is a 10-year life. You will have to divide by the annuity factor of 10 years and see whichever has the better equated annual cost. I am not repeating the 5-year calculation. In 5-year calculation, your salvage value will have to be calculated at the end of 5th year using the same logic. 1/3 fall minus whatever is the depreciation into 4 years balance life. And when it comes to rental option, I think there is some penalty also to be paid. You will have to pay a penalty of 1 lakh is the penalty. If you terminate the agreement in between, the penalty will keep reducing by 10,000 each year for period of rental agreement. That is, if you terminate the rent agreement after 1 year of usage, you will have to pay a penalty of 90,000. After 2-year usage, you will have to pay a penalty of 80,000. 3-year usage, you will have to pay a penalty of 70, 4-year 60, 5-year 50. So that part I am not doing it. So we get the PV of outflow. After the PV of outflow, you divide by the annuity factor and then decide which is the better option. Here option 1 turns out to be better. Option 1 has the lowest equated annual cost. When it comes to the second requirement, I just calculate PV of outflow. I don't go by any calculation on EAC because all the 3 has a life of 5 years. Even if you divide by 5 years, you will get the same EAC, similar EAC. So automatically the decision is made on the basis of PV of outflow. Okay. Apart from this, I think one more concept which is there. One is your capital rationing. I'm doing question 25 for that. And there's another concept called as modified IRR. I don't think so it's there in the material, so you can just see that. Let's come to question 25. A company has 1 lakh available for investment and has identified the following 4 investments in which it has to invest. 40,000, 1 lakh, 50,000, 60,000. NPV is 20, 35, 24 and 18. You are required to optimize the returns from the package of projects within the capital spending limit. If projects are independent and are divisible, projects are not divisible. There are 2 scenarios, both are there in this question. Go through this. I'm coming to it. Okay, capital rationing basically refers to a situation where I have limited amount of money. I have how much? 1 lakh. All 4 have positive NPV. So given a choice, I would want to do all the 4 projects. 40,000 plus 1 lakh, 1 lakh 40 plus 50, 1 lakh 90 plus 60, 2 lakh 50. I don't have sufficient money to do all the projects. So I'll have to do a pick and choose job. I'll have to do a pick and choose. So 2 lakh 50, availability is 1 lakh. So capital rationing exists. Now how do you do a pick and choose job is you do a ranking. So let's do ranking of projects. Ranking of projects. Ranking of projects. Project, investment, NPV, profitability index and rank. Ranking happens based on profitability index. Ranking happens based on profitability index. Investment and NPV is given in the question. 40,000, 1 lakh, 50,000, 60,000. NPV is 20, 35, 24 and 18. Now what is profitability index? Is inflow by outflow. Inflow is nothing but outflow plus NPV is the inflow. Outflow plus NPV will become the inflow, because the formula for NPV is inflow minus outflow. So my inflow is nothing but NPV plus the outflow. Outflow is the investment. So this plus investment divided by investment. NPV plus investment divided by investment. You can express it in percentage, you can express it in times. So I have done the profitability index. This is my rank 1, this is my rank 2, this is my rank 3 and this is my rank 4. This is my preference. First preference is project C, second preference is project E, third preference is project D and last preference goes to project F, based on the profitability index. Projects are divisible, that is easier scenario to do. If divisible, I have 1 lakh available. So what I am going to do with 1 lakh is project C. First I will do project C. I will do project C. Project C will take away 40,000 of my money. Then I will do project E. Project E will take away another 50,000 of my money. I am left with 10,000. With 10,000, I am going to do project D. I am going to do project D. Divisible means you can do 1 by 10 of project D. 1/10 of project D. Project D needs 1 lakh rupee. You need not invest 1 lakh, you can invest 1/10 of that. If you invest 1/10 of that, you will get only 1/10 of the NPV also. You will get only 1/10 of the NPV. You are not doing the full investment, you are doing a partial investment. That is called as divisible project. Now this combination will give me an NPV of 20,000, 24,000 and 3,500. 20,000, 24,000 and 3,500. This is called as divisible project. This is an easier part. If projects are not divisible, you will have to go through combination approach, trial and error. I'll start with rank 1. With that, I'll try to see if I can combine some other project, rank 1 and rank 2, rank 1 and rank 3, rank 1 and rank 4, whatever is possible. So project C and E, only C and E. I am not adding anything beyond that, because C and E itself will take away 90,000. I have a limit of 1 lakh. Then I do C and D is not possible. C and D is not possible because D itself needs 1 lakh. So C and F will take away 1 lakh. Then project D on a standalone basis. E, I don't think so I can add it with anything. Project E, which is my rank 2 project, I am not able to club it with any other thing. E and C we have already clubbed. E and F is not possible. E and D is not possible. I don't see any other combination possible. Check if you can do any other combination with 1 lakh being the limit. Your limit is 1 lakh. In that 1 lakh, if you can put any other combination, we will add it. Else, I see this combination. I think ICA material may have F as a standalone answer also. But that doesn't matter because F is anyway part of this. So they may have an answer called as F as a standalone. For all this combination, we calculate the NPV. Okay, only 3 combinations they have given. Calculate the NPV, whichever gives you maximum NPV, you do it. Indivisible means more restriction, so you earn only lesser amount. Here you are earning 47,500. Here you are earning 47,500, here you will earn only 44,000, because there you were having extra 10,000 and you did a part of the project. Here you did not have that flexibility. So this is on your divisible projects and indivisible and capital rationing. Let's just go to those few additional questions which were added. Go through question 12. Go through question 12. Go through question 12. Page 195. The additional questions. We want to do a quick discussion. Go through this. Go through question 12. Okay, it's a manufacturer of computers. It wants to introduce AI while making computers. It estimates that annual savings from artificial intelligence includes a reduction of 5 employees with annual salary of 3 lakh. So this is one of the in-between inflow. Savings of 5 lakh into 5 people into 3 lakh. 15 lakh savings will be there. This is another inflow, 3 lakh saving. Another inflow, 2 lakh 50 reduction in loss sale. Another saving of 2 lakh from billing issue. So all put together, this would be the benefits of the new system. Just give me a minute. So the benefit of the new system is all this. 21 lakh is the cost of the asset, the salvage value is 0, so depreciation will be 4 lakh 20. Operation will require 2 computer specialists with annual salary of 5 lakh per person. So 10 lakh is an expenditure, 1 lakh 50 is an operating expenditure. So if you try to calculate cash flow, 5 into 3 lakh, 15 lakh of saving plus another 3 lakh of saving, 18 lakh plus another 2 lakh 50 of saving plus another 2 lakh of saving. In that, these are the expenses, you have depreciation and do it. Now I want to discuss more on this. You are required to obtain the cash flows and the NPV on the assumption that book salvage value for the depreciation purposes 2 lakh, even though the machine is having no real worth in terms of its resale value. Also the book salvage value of 2 lakh is allowed for taxation purpose. Originally you see here your depreciation is 4 lakh 20. Your depreciation is 4 lakh 20. You calculate the cash flow. Initial outflow is 21 lakh. Every year inflow is 8 lakh 96. NPV calculation was not asked in the question. Now they are saying, though the salvage value is 0, but I will still consider the salvage value to be 2 lakh for the purpose of income tax. I will consider the salvage value to be 2 lakh for the purpose of income tax. So in the second part, my depreciation will be 21 lakh minus 2 lakh by 5 years, and this 2 lakh will go to the last year, and this will be a capital loss on which you will save taxes. This will be a capital loss on which you will save taxes. So indirectly, if you see here, you get 8,96,000. In this case, you get 8,84,000, which is a reduction of 12,000. Which is a reduction of 12,000. That reduction has happened because of depreciation. That reduction has happened because of depreciation. But every year 12,000 reduction. So 5 years, you get that as salvage value 60,000. You get that back as salvage value of 60,000. But obviously the second part will have lower NPV. It will have lower NPV as compared to the first part. The reason for lower NPV is simple, because this you get it at the end of 5th year. There you are getting every year. So every year that will have a better present value. This will have a lower present value. Let's come to 13. Superb Limited construct customized parts for satellites to be launched by USA and Canada. The parts are constructed in 8 locations around the world. The finance director chooses to implement video conferencing to speed up the budget process and save travel cost. She finds that in earlier years, the company sent 2 officers from each location to the central headquarters to discuss the budget twice a year. The average travel cost per person, including airfare, hotels and meals, is 27,000 per trip. The cost of video conferencing is 8,25,000 to set up, plus 300 per hour average cost of telephone time to transmit signal. A total of 48 hours of transmission time will be needed to complete the budget. The company depreciates this over a period of 5 years. Alternative is to rent the facility, which can be rented at 1,500 plus 400 per hour for telephone charges. You are required to know whether it is worthwhile to implement video conferencing. Now, what is happening is, this company was earlier doing the budget preparation. For budget preparation, the employees were required to travel and come to the central place. So they were earlier not having video conferencing. Against this I have 2 choices now. One is no video conferencing, own video conferencing, renting video conferencing. You will have to decide which is better, because I can either go for owning. If you want to go for owning, you will have to spend this much, and then there is some extra expenses to be spent. If you go for alternative approach, which is renting of the local conferencing facility, there you have to spend some 1,500 per hour and 400 per hour average cost for telephone charges. You will have to decide which one is a better option. Now, earlier what used to happen is, I think it has some 8 location including the central headquarter, 8 location including the central headquarter. So basically from 7 locations people have to come and reach this place. From 7 locations people have to travel and come. So if you were doing the earlier system, I think the average cost, travel cost per person including airfare, hotel and meal is 27,000 per trip, and 2 officers have to come twice a year. So if you don't go for video conferencing, 27,000 into 7 location, 27,000 into 7 location, 2 people from each location 2 times a year, 2 people from each location 2 times a year, you will have to spend 7,56,000. You will have to spend 7,56,000 on travel cost. We will have to spend 7,56,000 on travel cost if I am not implementing the video conferencing facility. If I implement the video conferencing facility, I will have to incur 8,25,000 plus 8,25,000 to set up a system at each location. So every location it's 8,25,000 plus 300 per hour average cost of telephone time to transmit signal. A total of 48 hours of transmission time will be needed to complete the budget each year. So now the problem is, if I go for purchase 8,25,000 system, but it has a life of 5 years. It has a life of 5 years. So into 8 location, every location you have to do this. Every location you have to, so indirectly you will have to spend this 13,20,000. On top of that, 300 per hour to transmit signal, which is 48 hours of transmission time would be needed. One thing which is not very clear is this 300 per hour average cost is per location or all 8 location put together. It doesn't seem to be very clear. The 300, is it per location or all 8 locations put together? As of now I am taking that this is for all locations put together.
By 5 years, why are you doing
because I will be using this asset for over a period of 5 years, no. So next year I am not going to spend on the video conferencing capital cost, no. This is a capitalized cost, no. Video conferencing, this whatever you are paying 8,25,000 not for 1 year, no, that is paid for a period of 5 years. So next year you will not have this cost, but there is a depreciation on that technically. And on top of this 48 into 300, this is possible to be multiplied with 8 also, okay. This is possible that it gets multiplied with 8. I am not sure what is there in the answer. 48 into 300 is what I am writing as of now. We'll see. We'll see.
Sir, before the 300, it is mentioned to set up a system at each location plus 300 per. So we can like.
No, so I read this each location for 8,25,000 plus 300 per hour average cost of telephone time to transmit signal. A total of 48 hours of transmission time will be needed to complete. Okay, I prefer this would be better answer. Let me do into 8. I am not sure. Let's check. Into 8 should be better. Should be each location. Can be each location. So let's do into 8. Then an alternative approach is to rent local facility, which will be rented at 1,500 per hour plus 400 per hour of telephone charges. 1,500 per hour plus 400 per hour. So 1,500 into 48 hours into 8 location. Into 48 hours into 8 location, and 400 again I have done into 8. So I think it is better to go for renting of video conferencing facility. Renting of video conferencing facility. See, in this analysis we are not considering an element of non-qualitative or non-financial factor, which we do at CA final level. For example, the experience of a video conferencing vis-a-vis a normal physical is totally different. So your budgets can be better when it is at a face-to-face discussion, because in a video conferencing you will not be sure whether the participation is always there from all people. So those are non-financial factor which we are not bothered about. 756, 1435 200 and 729 600. So we will go with 729 600. 14 we had already discussed. Go through 15. Go through 15. Okay, let's look at this question. It's considering replacing a manually operated old machine with a fully automatic machine, fully depreciated for tax purpose. This is a very important statement. Fully depreciated for tax purpose, which means there is no depreciation left on the old asset. But as a book value of 2,40,000, the machine has begun causing problems with breakdown and it cannot fetch more than 30,000 if sold in the market at present. Sale value is 30,000, book value will be 0 if you are doing the calculation. It will have no realizable value after 10 years. The company has been offered 1 lakh for the old machine. So for the old machine, the person is offering 1 lakh in return of 4,50,000. You will have to buy a new machine for 4,50,000. The life of the new machine, the salvage value of the new machine is 35,000 after 10 years. The company follows straight line depreciation method, but for tax purpose WDV method at 7.5% is allowed taking this is the only machine in the block of assets. So they are saying follow block of assets method, follow block of assets method, and the rate of depreciation is 7.5% under WDV method. Given below are the data. On top of that, last line says ignore capital gain tax, ignore capital. So one, I'll have to follow block of assets method for calculating depreciation. Second, even if this is the only asset in the block, there cannot be any capital gain or capital loss, because there is question says ignore capital gain tax. My initial outflow will be 4,50,000 of outflow and 1 lakh of inflow on the sale of the old asset. So net outflow will be 3,50,000. Net outflow will be 3,50,000. Can you do subtraction at this stage and tell me PBDT of both machine? Tell me PBDT of both machine, not PBT. Or add back the depreciation. You add back the depreciation which is there. Tell me the PBDT of both machine. 3,48,750. Okay, which means the extra PBDT is 80,000. Extra PBDT is 80,000. Because I have to follow WDV method, I have calculated the extra PBDT which is 80,000. PBDT of the new machine is technically 80,000. You will have to subtract depreciation every year, and depreciation is under WDV method, and the opening WDV in the block of assets will be 3,50,000. Why will it be only 3,50,000? You buy for 4,50,000, your block has zero value. You buying for 4,50,000, you are selling the old asset for 1 lakh. So you will be left with only 3,50,000 under Income Tax Act. You will be left with only 3,50,000, and beyond that there is nothing much to discuss. You keep charging on 3,50,000. You keep charging on 3,50,000. At the end of 10 years, salvage value is 35,000. No concept of NSV calculation, because we are not having any taxation on your capital gain. Even if this is the only asset, it may have this value 1,60,000 in the block, but for this 1,60,000 you are not going to get any tax benefit. No STCG, no STCL, because the question says ignore capital gain tax. Okay, go through 16. I'll quickly discuss this. AC on AC on antarla. Go through question 16. Okay, now let's look at ABC & Co is considering whether to replace an existing machine or to spend money on revamping it. ABC & Co currently pays no taxes, which indirectly mean I will have to ignore taxes. Replacement machine will cost 18 lakh, require maintenance of 2 lakh at the end of every year for 8 years. At the end of 8 years, it will have a salvage value of 4 lakh and would be sold. The existing machine require increasing amount of maintenance. That's the data. Opportunity cost is when should the company replace the machine. The question is not asking whether the replacement is to be done or not. Question's requirement is when should you replace the machine. First scenario, I replace today. Which means on day 0 I will get an inflow of 8 lakh. I will have an outflow of 18 lakh, and 1 to 8 years I will have an outflow of 2 lakh. At the end of 8 years, you will have an inflow of 4 lakh. So this is a scenario of 8-year life. Second situation is you will replace it at the end of year 1. When you replace it at the end of year 1, year 0 nothing happens. Year 0 nothing happens. Year 1 you will incur 2 lakh. You will get an inflow of 5 lakh. You will have an outflow of 18 lakh. Year 2 to 9 you will have to incur maintenance cost, and at the end of year 9 you will sell the new asset. So it will have 9-year life. Then replace at the end of year 2, which will have a 10-year life. Replace at the end of year 3, which will have a 11-year life. Replace it at the end of year 4, which will have a 12-year life. For all these 5 options, we'll have to calculate equated annual cost, because the first option has a life of 8 years. Replacing today means overall life is 8 years. Replacing at the end of year 1 means 9-year life. Year 2 means 10-year life. Year 3 means 11-year life. Year 4 means 12-year life, and then you do the calculation. Okay, quickly go through 17. I just want to discuss an item called a sensitivity analysis. Go through 17. How is? If you replace today, old machine 0 years, new machine 8 years, put together 8 year. If you replace at the end of year 1, old machine 1 year, new machine 8 years, put together 9 years. Old machine 2 years, new machine 8 years, put it will go on like that. Go through 17. I want to discuss on something called a sensitivity analysis. Okay, let's look at this question. Stand Limited is contemplating replacement of one of its machine which has been outdated and inefficient. He has decided machine 1 and machine 2. This is not a replacement decision problem. This is like a new purchase itself, because they have given no data on the old machine. New machine, initial investment 12 lakh, 16 lakh. Life 3 years and 5 years. The life is different. So when you do the calculation, you may get an NPV answer or an EAC PV of outflow, but life is different, so you'll have to go by either EAC or EAB, equated annual cost or equated annual benefit. Residual value, contribution per annum, the new machine will earn so much. Fixed maintenance cost, other fixed cost. In that other fixed cost, one more information is maintenance costs are payable in advance. So first year maintenance cost will be written in year 0. Second year maintenance cost will be written in year 2. So it will go first year. Third year maintenance cost will be written in second year. All other cash flow occur at the end of each year. Depreciation is under straight line method and has been included. The expected cost of capital, the important word again is here. Ignore tax. If I am ignoring tax, I am not bothered about calculating depreciation, calculating tax. So machine 1 initial outflow is 12 lakh. Then contribution is year 1 11 lakh 60. I am going to write it like this: year 0, year 1, year 2 and year 3. So 1160, 1160, 1160. Maintenance cost will be 40,000 here. Year 0, year 1 and year 2. Maintenance cost will be in year 0, year 1 and year 2. And then we have another item called as your other fixed cost, which is 7 lakh 20. In that depreciation is included. You have to eliminate the depreciation. You will have to eliminate the depreciation. So your cash flows will be like this. And for this you calculate the EAB 291, 191 and 372, 291. This is the equated annual benefit. This is the equated annual benefit. The maintenance cost is written as year 0, 1 and 2. The maintenance cost is written as year 0, 1 and 2. I am not bothered about the taxation and other things, because anyway the question has told us to ignore it. Another important element is calculate the sensitivity of your recommendation to changes in the contribution generated by machine 1. To the changes in contribution generated by machine 1. Machine 1 is currently generating a contribution of 11 lakh 60. Every year it is generating a contribution of 11 lakh 60. What has happened is, as of now, my choice, My choice is to go with machine 2. My choice is to go with machine 2. What is sensitivity is basically, sensitivity is basically going to lead to a reversal of decision. What is reversal of decision? We are selecting machine 2. Can I go to machine 1? From machine 2, can I go to machine 1? I can go to machine 1 if this EAB is also 3,72,291. If this EAB is also 3,72,291. This EAB can be 3,72,291 if my contribution goes up. If my contribution, what is the difference in EAB? Can you tell me the difference in EAB? How much? 81,100. And if the contribution can go up by 81,100, if the contribution can go up by 81,100, I will change my decision. I'll change my decision. That is basically called as the sensitivity analysis. I can change my decision if the contribution changes by 81,100. With this, we have kind of done with your investment decision discussion. I think a bigger topic. This is completed. I'll move to an area called as management of working capital. We'll move to an area called as management of working capital. Go through this for maybe 3-4, I think I'll give you 5-6 minutes. Go through this and then we start doing it. Is the AC remote there? Okay, you go through this first. Go through the theory part. The material is not there as of now, so they'll have to print it. So I'll tell them, let me. Yeah, that is there. Hard copy material. Okay, let's start with the working capital chapter. Now, this chapter is classified into multiple sub-segments. The first segment is working capital estimation. Under working capital estimation, we are going to learn about operating cycle method, WC estimation for existing company and new company. WC estimation for existing company and new company, and another segment called as MPBF, maximum permissible bank finance calculation. This is one segment of the chapter. The second segment of the chapter is on cash management, where we have cash budget, optimum cash balance as per Baumol model. This is basically same as your EOQ. You would have learned as your EOQs, the same concept you will use here. The third part is on receivables management, where you need to decide whether to extend or shorten or tighten credit, extend or tighten credit given to a customer. Along with that, factoring analysis. Along with that, there will be a factoring analysis. These are the multiple segments which are there as far as this chapter is concerned. Apart from this, there can be 1 or 2 questions even on inventory management or payables management. This chapter is basically, the first part is on working capital estimation, second is on cash management, third is on inventory management, which is what you learn in costing. So there haven't been any question as such on inventory management. Then payables management, receivables management, and last segment is MPBF, maximum permissible bank finance. So let's start with operating cycle method. Under operating cycle method, what we are trying to do is, we are trying to find how much time does it take for a company to convert the cash back into cash. So your cash becomes raw material, then becomes WIP, then becomes FG, then becomes debtors, then become cash. So your operating cycle is equal to raw material days plus WIP days plus FG days plus debtor days minus creditor days. Raw material days is calculated as average stock of raw material by raw material consumed. WIP days, average stock of WIP by cost of production. By cost of production. FG days is equal to average stock of FG by cost of goods sold. Debtor days is equal to average debtors by credit sales, and creditor days is equal to average creditors by credit purchases. See, the denominator is basically an item which comes next in the cost sheet. For example, your cost sheet format is opening stock of raw material, add purchase, less closing stock. After that, you get raw material consumed. So the denominator is raw material consumed. Then after that, you have direct labor, direct expense, you get prime cost, factory overheads, you get gross works cost, add opening WIP, less closing WIP. After closing WIP, you get net works cost or COP. So COP is the denominator. Add opening FG, less closing FG, you get cost of goods sold. So COGS is the denominator. Profit and sales. Sorry, after cost of goods sold, you may have other overheads, cost of sales, profit and sales. So receivables is obviously dependent on credit sales, payables is obviously dependent on credit purchases. Then I also have something called as individual estimation of working capital. Individual estimation is, I'm going to estimate each of the items separately. I'm going to do an estimation of each of the items separately. When you want to do individual estimation, we'll have 2 types of problem. One for an existing entity, another one for a new entity. For an existing entity, the format is simpler because the assumption for an existing entity is opening FG is equal to closing FG, opening WIP is equal to closing WIP, opening raw material is equal to closing raw material. So first you will have to prepare a cost sheet. So you start with direct material, direct wages, overheads other than depreciation, GWC, NWC, COP, COGS, because your opening WIP and closing WIP is same. So your gross works cost and net works cost will be same. Opening FG and closing FG is same. So your COP will be COGS. Once you are done with this, this is how you estimate. Raw material is on raw material consumed, WIP is on cost of production, what I said there. Your FG is on cost of, this can be on even cost of goods sold technically. FG can be on cost of goods sold as well, or cost of production depending on the data in the question. Debtors is on credit sales, creditors is on credit purchases. Then you have to do it for a new entity. When you do it for a new entity, same format, but you will have to write opening and closing. Opening stock of raw material, closing stock of raw material. Opening will be 0. Opening will be 0, closing will have a value. Opening WIP 0, closing WIP will have a value. Opening FG 0, closing FG will have a value, and then you prepare the cost sheet, and after that you do the estimation. Working capital forecast, based on that you do a statement. There are 2 types of approach. One is called total approach and second is called cash cost approach. In total approach, we include everything like non-cash item and also consider profit. In cash cost approach, depreciation will not be written. Depreciation will not come, not applicable. Profit will also not be captured. Profit will also not be captured. Then you have your cash management, where you calculate your optimum cash, square root of 2 into annual demand of money. Like you have annual demand of raw material. Like you have ordering cost, here it is called transaction cost, and like you have carrying cost, here it's called opportunity cost. This is on your maximum permissible bank finance. There are three methods of calculating MPBF. Method 1 says 75% of current assets minus 75% of current liability. Method 2 says 75% of current assets minus 100% of current liability. And method 3 says there is something called as core current asset, non-core current asset, 75% of non-core current asset minus 100% of current liability. Let's directly get into some problems. Let's go to question 1. Go through question 1. Go through this quickly. Okay, we are required to calculate operating cycle period, number of operating. This is a fairly simple question because all the data is almost there. Let's start. Operating cycle is equal to raw material plus WIP plus FG plus debtors minus creditors. Raw material plus WIP plus FG plus debtors minus creditor. Raw material given in the question is 45, WIP is 20, FG is 25, debtors is 30, creditors is 60. How many days is this? 60 days. So one cycle to convert the cash back into cash, it takes 60 days of time. Number of cycles in a year is 360 divided by 60, 6 cycles in a year, 6 operating cycles in a year. Amount of working capital required on cost basis. Now in this, I'm not sure whether I have okay, on cost basis, whether I wanted to mention on cash basis, I don't know. There are two ways of calculating your working capital. One is on cash cost approach and second is on total approach. I'll do both here. Total approach means 25 lakhs into 60 by 360 and cash cost means 22 lakh 50, depreciation is ignored, okay, into 60 by 360. Not sure whether there was a typing error. 60 by 360. Company is a market leader in its product and has no competitor. Based on a market survey, it is planning to discontinue sales on credit and deliver products based on prepayments in order to reduce its working capital. You are required to compute the reduction in working capital requirement in such a scenario. Reduction is now the cycle is 60 days. Debtors will not be there. So cycle will fall down to 30 days. Cycle will fall down to 30 days. So my working capital now will be 25 lakh into 30 by 360 or 22.5 into 30 by 360 and you can tell how much is the reduction in working capital. Whatever is the amount it turns out to be, whatever is the reduction in working capital. Both approaches I am presenting because I am not sure what is needed. Amount of increase if all purchases are made on cash basis. All purchases are made on cash basis. So your creditor will not be there. So from 60 days it will now go up to 120 days. From 60 days it will go up to 120. So what is the increase we'll have to see. It is assumed the company is following cash cost approach for estimating working capital. So the answer had only cash cost approach, but the problem was not clear. So we ended up presenting both. But here the question has been solved using only cash cost approach. Go through question 2. Go through 2. Okay. Again, similar requirement. I want to calculate what is the net operating cycle period. How many cycles are there in a year? Amount of working capital requirement. The difference between the earlier question and this question is they have not given those days directly. So let's start. Raw material days is equal to average stock of raw material by raw material consumed. Average stock of raw material by raw material consumed. Your average stock of raw material, tell me the average of 45,000 and 65,536. Sorry, 65,356. Average stock of raw material 55,178. Raw material consumed is opening stock plus purchases minus closing stock. Opening stock plus purchases minus closing stock. How much? 3 lakh 644 into 365. We'll keep it as 2 decimals for the time being. Finally, I'll round off the number of days. How many days is this? 53.05 days. We'll do the final rounding of later. 53.05 days. WIP days is equal to average stock of WIP by cost of production. Average stock of WIP by cost of production. Average is 35,000 and 51,300 average. How much? 43,150. Cost of production is 7,50,000 into 365. 20.99 days. Okay, next FG days. Average stock of FG by cost of goods sold. Average stock of FG by cost of goods sold. Average of FG 60,181, 70,175 average. How much? 65,178 divided by COGS is 9,15,000 into 365. 20? Okay, 25.99 days. Then you have debtor days, which is on your average debtors. Average debtors. Tell me the average debtor number. 1 lakh 561 divided by credit sales 11 lakhs into 365. 40 point. Okay. Then creditor days. Creditor days is your average creditors 50,079 plus 7469 by 2. How much is that? 60. Okay. 274 divided by 4 lakhs into 365. 55 point. Okay, 55 days. Now I'll get my operating cycle is raw material plus WIP plus FG plus debtor minus creditor. So operating cycle is, calculate and tell me. Raw material plus WIP plus FG plus debtor minus creditor. 86 days. I'll round off at this stage. Operating cycle is 86 days. Then they've asked number of operating cycle. Number of operating cycle is 365 by 86. We will have this in decimals itself. 4.24 operating cycles. And last requirement is working capital. Working capital is calculated based on annual operating cost. It's calculated based on annual operating. They have not mentioned about depreciation and all. So no concept, no confusion of total approach and cash cost approach here. 9,50,000 into 86 by 365. Whatever number you get, 9,50,000 into 86 by 365. Any doubts on this? Okay, this is the second type of a question. Let's come to the third type of a question. Go through this. Go through question 3. Go through question 3. Go through this. Okay. Again, we are required to calculate the working capital requirement by operating cycle method. We are required to do the same thing: raw material days, WIP days, FG days, debtor days, creditor days. The only difference is the previous question gave you all those numbers like COP, COGS. Here you will have to first prepare a cost sheet. We'll prepare a cost sheet, only cost sheet I'll prepare. Balance part is a formality which I'm not going to do, which you know how to calculate raw material days, how to calculate WIP, how to calculate FG, debtor, creditor. So let's focus on preparing a cost sheet. Cost sheet of Beta Limited. Cost sheet of Beta Limited for the year ended March 2011. I am not bothered about calculating prime cost, all those things I'm not going to get into it. Even if you write prime cost doesn't matter, because prime cost is not going to help me in solving my problem. So it may not be exactly the format which we follow. Particulars amount, direct material, opening raw material, purchases less closing raw material. What will go to the outer column is your raw material consumed. Opening raw material given in the question is 1,80,000, purchases is 11 lakhs, closing raw material is 2 lakhs. So raw material consumed is 10,80,000. Then we have direct wages. Direct wages is 3 lakh. Direct expenses are, let me use the word whatever they have used, production expenses 2 lakhs. At this stage we will get GWC, gross works cost. I have not written prime cost. At this stage I will get gross works cost. Add opening WIP less closing WIP, we get net works cost slash cost of production. The difference between net works cost and cost of production is those 5 line items which you could see in cost sheet, but here anyway I am ignoring all of that. None of them would be there in the question mostly. Opening WIP is 60,000, closing WIP is 1 lakh. You get cost of production. Add opening FG less closing FG, we get cost of goods sold. Opening FG given in the question is 260, closing is 3 lakh. Cost of goods sold. We have some admin expense and selling expense. Assumption is this admin is general admin expense. If you treat it as relating to production, then it will go above, but if it's relating to production, it should have been in the trading account rather than in the P&L account. They have put this in the P&L account. General admin expense, selling expense, cost of sales, profit and sales. Your general admin expense is 175, selling expenses 75,000. Cost of sales is technically annual operating cost, okay, that's technically annual operating cost, 2,50,000. Sales is 20 lakh. Your raw material days will be calculated based on 10,80,000. WIP days will be calculated based on 15,40,000. FG days will be calculated based on 15 lakh. Debtor days will be calculated based on 20 lakh, and creditor days would be calculated based on 11 lakh. Creditor days would be based on 11 lakh. Obviously, you will have to do average stock of raw material, average stock of WIP, average stock of FG, average debtors, average creditors. But the base is this. That is what is prepared in the cost sheet. Okay. Now we are going to move to an area called as individual estimation, line by line estimation. You are going to prepare an individual estimation of a cost sheet. We have done what under operating cycle method. Now we will move to individual estimation. Go through question 4. Go through question 4. go through the question. Okay, now I have to do estimation of working capital. Question has not told you to follow operating cycle method, which means you'll have to do individual line by line estimation. If the question does not say operating cycle, you'll have to follow individual estimation. Your wish, you want to follow total approach or cash cost approach, that's your choice. Okay, both approaches will give different answer. Both approaches will give different answer. I think in the solution I follow total approach, so I'll follow total approach for this calculation. But your wish, you can follow even a cash cost approach. In the question, nowhere they are mentioning that it's a new company. Nowhere they are mentioning it's a new project, so it's an existing company. First thing we'll prepare is a cost sheet. Working note 1, cost sheet, particulars, calculation, amount. The cost sheet will make it very simple, starting with direct material. No concept of opening stock of raw material, closing stock of raw material, because both are same is the assumption. Direct material, we are required to prepare the cost for 78,000 units. 78,000. So 78,000 into 117. 78,000 into 117. Then we have direct labor, which is again 78,000 into 49. Then we have factory overheads. If I was following total approach and cash cost approach, I'll split. Cash cost approach will not include this depreciation of 18. It will not include the depreciation. 78,000 into 98 as it is. 98 as it is. The total is called GWC, NWC, COP, COGS and even COS in this question. There are no other cost. The question has not mentioned about any other expense. So this is also the cost of sales. This estimation is critical because when you do the this cost sheet will be very useful when you do the estimation part of it. After this you have profit, sales. Profit is I think 36 per unit. And selling price is some 300. So this is my simple cost sheet which has been prepared. Some question you may feel that you can even do without a cost sheet, but many questions you will struggle if you don't do a cost sheet. So it's okay to spend maybe 2-3 minutes on the cost sheet. Once the cost sheet is done, working note 2, estimation. Current assets, will write the format. Then maybe some 7-8 lines, and current liabilities, current assets and current liability. Now you read the question, somewhere you will get to know one of the items, any item could be there. First line says average raw material in stock. So stock of raw material. Stock of raw material is based on raw material consumed. It's based on raw material consumed, which is there in the cost sheet. 91,26,000 into, it says 4 weeks, so 4 by 52. If they have used 4 weeks, I do 4 by 52. If they say 1 month, I'll do 1 by 12. I'll do 1 by 12. 1 by 12. So 91,26,000 into 4 by 52. Into 4 by 52. Next is stock of WIP. This is very tricky. Stock of WIP is on cost of production, but they will give something called as degree of completion. The cost of production which we have calculated is 2,05,92,000. This has to be split into 2. This has to be split into 2. Material cost is 91,26. Other cost is 1,14,66,000. Other cost is 1,14,66,000. If the problem is silent, take this number, do into 2 by 52 and do into 100%. The normal assumption is degree of completion for WIP is 100. Take this number, do again into 2 by 52 and do into 50%. The normal assumption is the degree of completion is 100% and 50%. 100% for this, 50%. The question has said take this as 80 and this is 60. 80% and 60%. Whatever is your cost of production, split into raw material cost and other cost. Raw material cost into 2 by 52 into 100% is the normal scenario. This question into 80%. Other side, normally you take 50%. This question you are taking 60%. So this calculation is 91,26,000 into 2 by 52 into 80% into 80%. That's the question specific requirement. Balance number 1,14,66,000 into 2 by 52 into 60%. So put together it turns out to be 545,400, 80% and 60%. Then we have stock of FG 2,05,92,000 into 3 by 52, 3 weeks. It said 3 weeks, so 3 by 52. Debtors, it is on sales, but it's on credit sales. Somewhere the question has said company sells 1/5 of the output against cash, 1/5 of the output against cash. So 4/5 is only credit sales. So 2,34 lakhs into 4 by 5 into 4 by 5, which is your credit sales, into what's the credit period given? How much is the credit period given to debtors? 6 by 52. 6 by 52. That is your debtors portion. Credit from the supplier, creditors, credit allowed from supplier 8 weeks, 91,26,000 into 8 by 52. 91,26,000 is your raw material purchased or raw material consumed. Both are same because your opening stock and closing stock is anyway going to be same. Then we have wages payable. The wages expenditure is 38,22,000. So 38,22 into 1 by 52. Overheads payable, which is 2 weeks, 76,44 into 2 by 52. 2 by 52. Apart from that, there is a cash balance of 2,50,000. Cash balance of 2,50,000. On top of this, questions can give you some margin maintenance and all. They can say some contingency margin is to be maintained. My working capital is the gap between this, which is some 30,73,900. Any doubts on this? Important part is WIP estimation. Important part is WIP estimation. Is there any other item? Overheads, what happened? 70. Okay, sorry. In overheads, by mistake, I have also included depreciation. So depreciation, you cannot have any outstanding overheads for that. So that part alone have to be removed. 6240. In fact, one thing which we should do is, it's better to do it this way itself. Factory overhead other than depreciation and depreciation, this is into 80, this is into 18. This into 18 will not come. It will not come if you are following the approach of cash cost. It is better to write it this way because your outstanding overheads will anyway be on only 62,40,000. Depreciation, you cannot have an outstanding depreciation kind of a thing. Go through question 5. Go through 5 and start doing a cost sheet. Do a cost sheet. Prepare a cost sheet.
So I did with cash costing, question number 4. But I'm not getting, like, profit itself is different.
It will be different. Profit is 0 for cash cost, in fact. We don't even write the profit there. And the answer is obviously going to be different. Prepare the cost sheet. I just want you to quickly prepare the cost sheet. Spend time on cost sheet. Cost sheet is what is most critical rather than the estimation. Estimation is just a formality. Spend time on cost sheet. Spend time on cost sheet. Please get the cost sheet correctly. Your wish which approach you want to follow. I think the problem is silent again. Okay, cash cost. Last line says cash cost basis. You have to do it on cash cost basis. Get the cost sheet. $54,000 into 120 is direct material. Your selling price is 200 rupees and that 60% is raw material cost. 54,000 into 120, 54,000 into 20, 54,000 into 40. I'm not writing anything in profit, and the total, this is technically not sales, this is technically called as cash cost of sales. But in a format we write it as sales only, but this is technically cash cost of sales. It is technically the cost of sales rather than the sales. I'm not going to write any profit in the cash cost approach. Any doubts on the cost sheet? I'll get into the estimation part then. Estimation though takes more time, but that's more of a formality. There's nothing much you're going to learn out of estimation. Estimation, except for one or two adjustments here and there, everything is going to be more like a formality. It depends on your cost sheet. It depends on your cost sheet. So STN Limited is a ready-made garment company. Production cycle indicates that material are introduced in the beginning. Wages and overheads accrue evenly. Following figures: selling price, duration of production cycle 1 month. This is for WIP. Stock of WIP is 1 month. One thing is, they have mentioned 50% of wages and overheads are supposed to be conversion cost. Technically they are mentioning degree of completion for wages and overheads is 50%. For material, the degree of completion is 100%. It's introduced at the beginning of the production cycle. So my stock of WIP is raw material into 1 by 12 into 100%, 1 by 12 into 100%, and then this direct labor factory overhead into 50% into 1 by 12, 50% into 1 by 12, direct material directly into 1 by 12, and for direct labor and overheads I have added them, made them 50% and did into 1 by 12. Your production cycle is 1 month. Duration of production cycle is 1 month. Any doubts on this? Next we see raw material inventory held 2 months consumption. So stock of raw material is, it's a formality. Take this into 2 by 12. Into 2 by 12. You will keep changing the period alone. Sometimes it could be 4 weeks, sometimes it could be 8 weeks, 2 months. Then stock of FG is 1 month. You will have to take this number into 1 by 12. Into 1 by 12. Then we have credit allowed to debtors 1.5 month. Okay, there is no concept of cash sales in this question. Listen, credit allowed to debtors, take this cash cost of sales. Take cash cost of sales, not the normal sales. not the normal sales. That's why I did not write profit. I did not write profit into 1.5 by 12. Then we have credit allowed by creditors 1 month. So creditors is this number into 1 by 12 into 1 by 12. Then we have wages are paid in the next month following the month of accrual, which means outstanding wages is 1 month. Outstanding wages is 1 month. So wages payable into 1 by 12. Outstanding wages is this. Then we have cash is held to the extent of 40% of current liability. Current liability is 6,30,000. Cash is 6,30,000 into 40%. Into 40%. On top of this, you add a margin of 15%. They said safety margin of 50% and final working capital. Final working capital. Safety margin is 15%. And my final working capital is this. What matters is the cost sheet. You get the cost sheet correctly, your problem is over almost. Almost problem is over if you get the right cost sheet. If I had followed total approach, the only difference would have been debtor. Debtor would have been on the sales. The question said us to follow cash cost. WIP is the most important part. The most important part is WIP estimation. Go through this, prepare the cost sheet. Prepare cost sheet and then okay, first you prepare the cost sheet. I'll tell you if anything else is to be done. Prepare cost sheet first. Cost sheet, estimate WIP, estimate debtors. Follow cash cost approach. Okay, follow cash cost approach. Cash cost approach, prepare cost sheet. After that, estimate WIP, estimate debtors. Yeah, follow cash cost approach. That is what I have done in the solution. I want you to prepare a cost sheet, estimate work in progress, estimate debtors. Please write the cost sheet. I want you to do that. Please prepare cost sheet, estimate WIP, estimate debtors. I don't want to do anything beyond that. Prepare cost sheet, estimate WIP and debtors, nothing beyond that. We are following cash cost approach. Estimate work in progress and debtors. Your cost sheet should look something like this. Material is 1,44,000 into 45. Labor is 1,44,000 into 20. and overheads is 1,44,000 into 40. Profit is 0. I'm following cash cost approach. Profit is taken as 0. I wanted to estimate only 2 items, WIP and FG. Only 2 items are to be estimated, WIP and FG. For work in progress, the degree of completion will be taken as 50% for both. 50% for both material as well as labor and overheads. 4 weeks means you'll have to do into 4 by 52. You will have to do into 4 by 52. And when you do debtors calculation, you will have to take the cash cost of sales, not the normal sales, do into 80%. Into 80% because 20% of the output is sold against cash. And then on top of that you will do into 2 by 12. Some of them are in weeks, some of them are in months. For months you will have to do 2 by 12. For weeks you will have to do 4 by 52. The WIP figure I get is 5,81,538. 581,538. That is, I have taken the raw material costs into 4 by 52 into 50%. Wages and overheads into 50% into 4 by 52. And when it comes to debtors, cash cost of sales into 80% into 2 by 12. Yep.
Material rate 64 lakh 80 into 50% because I got different WIP. I'm telling you the split, sir.
Okay.
I did 64 lakh 80 into 50% into 4 by 52. Labor and overheads 8640 into 50% into 1.5 by 52.
Where is 1.5 coming from? WIP is 4 weeks, no? Okay, let's come to 7. No, Krishna, RM is not always 100%. The question has to say, because we saw a question where RM was 80%. In this question, RM is 50%. It's no rule that it has to be always 100%. Go through question 7. The question has to mention, no? Question, if silent, I'll take 100%. 150 is normal rule. If question says something else, I can't do much about it. Last question said, take wages and overheads 50%. Material we took 100%. Previous question said material 80%, wages and overhead 60%. This question everything is 50%. If the problem is silent is where assumption comes, no? Go through 7. I'll focus on preparing the cost sheet. My focus will be on the cost sheet. Estimation is not the big part of it. Go through 7. Okay, we are going to prepare a cost sheet. Question wants us to prepare it under both total approach and cash cost approach. So let's prepare the cost sheet. The cost sheet also looks different under total approach and cash cost. Let's do this. Particulars, total approach, cash cost approach. Slightly different from the earlier questions. Total and cash cost. Again, it's an existing company. Existing company becomes simpler. Also, there are talks of depreciation being there, counting depreciation as part of COP. So, depreciation is there in this question. Maybe it's not given. So, how do we get to that? We'll see. Starting with direct material. Direct material. Raw material consumed given in the question is 9 lakhs. Direct material is 9 lakhs. Then we have direct labor, which is 7,20,000. Factory overheads, depreciation. I cannot ignore depreciation in this question. There is a depreciation also. Factory overheads, they said manufacturing expenses outstanding at end of year is 80,000. Outstanding at end of year is 80,000. Cash expenses are paid 1 month in arrears. So basically this 80,000 is 1 month expense. This 80,000 is 1 month expense. So my manufacturing expenses 9,60,000. 9,60,000. Apart from this, depreciation is there. We'll see depreciation later. Cash cost is 0 this side. This total is GWC NWC, COP, COGS. No, COS will not come because there are other items like your admin expense and sales promotion, they are there. This side I'll put a total. Question has mentioned the gross margin is 25%. The gross margin is 25%, counting depreciation as part of COP. In short, COP is 75%. Your gross margin is 25%. So COP is 75% of 36 lakh. 36 lakhs into 75%. Depreciation is a balancing figure which will be 1,20,000. Depreciation is a balancing figure. Other side I am not going to write depreciation. Cash cost approach I am not going to write depreciation. We can write it like this: factory overheads other than depreciation and for example, if you are going to calculate FG, stock of FG, the formula is COP or COGS into whatever the time period. For total approach you will take 27 lakh. For cash cost approach you will take 25 lakh 80. For when you do WIP, for total approach you will take 27 lakh. For cash cost approach you will take 25 lakh 80. Then we have admin expense, sales promotion, cost of sales, profit and sales. Admin expense they have mentioned 2,40,000 paid as above. Paid as above just mean that they are paid 1 month in arrears. It is not that it is 1 month expense. They have just said total admin expense. Paid as above means they are paid 1 month in arrear. So this will, there will be an outstanding administration expense when we calculate. So this is 2,40,000. Sales promotion is 1,20,000. Cost of sales is 30, 60 and 29, 40. This is 36 lakhs. Profit is 5,40,000. This side 0. This side 29, 40. When you estimate debtors, your debtors will be calculated on 29 lakh 40 under cash cost approach. Debtors here would be calculated on 36 lakh. 36 lakh into 2 by 12, 2 months credit. But other side you will have to do 29, 40 into 2 by 12. Estimation I am not getting into much of it. This is a simple formality. When you do total approach, take the number from total approach value. Here you take it from cash cost column, 29 lakh 40 into 2 by 12. There you take on 36 lakh into 2 by 12. So you take the appropriate value from whichever approach you are following. Okay, come to question 8. Come to this. I'll quickly discuss few items here. Okay, it's like a normal problem on estimation only. The only issue is I'm not going to prepare a cost sheet in this question. The reason for not preparing a cost sheet is the data has some inaccuracy. Now in an exam scenario you may not be able to find that data has inaccuracy or not. So if the same question gets repeated, you can directly do the estimation without preparing a cost sheet, because there is some issue with the data, because when I prepare a cost sheet the numbers were not adding up to what is given in the question. Question talked about some GP margin of 20%, it was not adding up to that number. So there was some inaccuracy in the problem. Now sales will be, debtors will be 24 lakh into 1 by 12, 24 lakh into 1 by 12, 1 month's credit. Export sales 10 lakh 80,000 into 3 by 12, 10 lakh 80 into 3 by 12. Material used 9 lakh into 2 by 12, suppliers extent 2 months credit. So 9 lakh into 2 by 12, this will be your creditor figure. Wages 7 lakh 20 into 0.5 by 12. Manufacturing expenses 10 lakh 80 into 1 by 12. Administration expense 2,40,000 into 1 by 12. Sales promotion 1,50,000 into 1 by 4 quarterly in advance. Income tax payable 2,25,000 into 1 by 4. One installment is not paid. Rate of GP is 20%. Ignore work in progress and depreciation. The problem is this GP was not fitting in. That's why I'm not preparing a cost sheet. If I prepare a cost sheet, the GP amount was not fitting in. So I can calculate stock of raw material also. Stock of raw material is raw material consumed into 1 by 12. Finished stock is where we will struggle. Finished stock is where we will struggle, because for finished stock I need COP or COGS. I need one of them, COP or COGS. Now listen. COGS is equal to 80% of 24 lakh. 80% of 24 lakh, which is the domestic sale, plus the GP margin is 20%. The problem is your domestic sales happen at 100 rupees, profit is 20, this is 80. Just because you are exporting, the cost of exports cannot be lesser, because what you are doing is you are selling it at a lower price. Exports are being sold at a lower price. Because we are selling it at a lower price, my cost cannot come down. Indirectly, the GP margin can't be 20% for export sale. In export, you are selling it at 90. Cost will continue to be 80 and this is 10. Cost will continue to be 80 and your profit is only 10. Profit is only 10. In short, the cost here is 10,80,000 into 80 by 90. This was 80 by 100. This is 80 by 90 into 80 by 90. Let's not get into calculation part of it. I want to discuss few more things in this question. Read this line and tell me what will come in current asset and what will go in current liability. Read this carefully and let me know. What should go to current asset, what should go to current liability? Or only current asset or only current liability? Read it carefully. What do you mean by this and what should go? What amount should go to current asset, what amount should go to current liability? Let me know that. Or only current asset, only current liability. What is the current asset? No, ignore stock and all. Believes in keeping 2,50,000 is a cash. That is a cash. Believes in keeping 2,50,000. So tell me what should go to current asset, what should go to current liability? How much is the cash balance? How much is the overdraft balance? Whatever is the sense. How much? It is not yet utilized, so it cannot go to current liability. Not yet utilized. So what should I keep us? Read it carefully and let me know. I want some answer so that I discuss it. If you face this in exam, what are you going to write as cash balance and what are you going to write as overdraft balance? 1 lakh? Okay, it's only cash and it's only 1,75,000. See, I want 2,50,000 margin with me. When I say 2,50,000 cash, I want immediately there is a need, I need 2,50,000. So what I am doing is at my home I am keeping 1,75,000 cash. And I know a friend who will give me 75,000 whenever I ask. So that is a limit which I have with my friend. That limit is not yet utilized by me. So it cannot be a liability for me as of now. So cash is 1,75,000, bank overdraft is 0. If you had utilized this, cash would have become 2,50,000, bank overdraft would have become 75,000. See, net I need 2,50,000. If I have the limit with me, I will need lesser cash. If limit is not there, I will need more cash. So cash will be 1,75,000. A cost sheet has been prepared here, but this is not going to fit into that number. I had to take another expense balancing figure and all. It was not fitting into that number which was given in the question. Sorry. Cash is 1,75,000. Cash is 1,75,000. Clear? Any doubts on this? Go through 9 and I want you to prepare a cost sheet, estimate WIP. Cost sheet, estimate WIP. I'll let you know if I want you to estimate anything else. Prepare a cost sheet, WIP and debtors, two things. Cash cost approach again. It's your wish, you can follow any of the approach. It's not necessary that cash cost is to be done. Cost sheet, WIP and debtors. Okay, your cost sheet would look something like this: 6,000 into 80, 6,000 into 20, 6,000 into 60. I'll not include depreciation because I'm following a cash cost approach. Your COP, COGS, GWC, all that will be 6,000 into 160 into 160. Now WIP estimation, what I'm going to do is, my raw material is 4 lakh 80 into 100% into 0.5 by 12, and others are also 4 lakh 80 into 50% into 0.5 by 12. They have said 50% complete for conversion. Conversion is cost other than material. Conversion is cost other than material. When it comes to your estimation of debtor, cash sales are 75% less than credit sales. So they have mentioned cash sales is 75% less than credit sales. It does not mean cash sales is 25, credits is 75. Nothing like that has been mentioned. Cash sales is 75% lesser than credit sale. Cash plus credit is equal to total sales. Cash is 0.25 credit sales. 0.25 credit plus credit is equal to total sales. In short, 1.25 credit sales is equal to total sales, and my credit sales is total sales divided by 1.25. Technically it will be 80%. Credit sales is 80%, cash sales is 20%. Credit sales is 80%, cash sales is 20%, and you will have to do that on 9 lakh 60. You will have to do that on 9 lakh 60. That's okay. Any of the approach you follow, total approach or cash cost, that's up to you. Okay, go through 10. Go through 10. This is a newly formed company. Go through question 10. Go through question 10. This is for a new company. I'll take you through a detailed cost sheet. Friends, please go through the problem. I don't want any discussion. Go through the question. It's a newly formed company which has applied to a private bank for the first time for financing its working capital requirements. Estimated level of activity 31,200, WIP 12,000, raw material, wages, overheads which includes depreciation, selling price, raw material in stock, WIP 100%, 50%, FG stock is 24,000, supplier, debt, purchaser, direct wages, lag, expected cash balance, assume that production is carried on evenly throughout the year, wages and overheads accrue similarly. All sales are on credit basis. You are required to calculate the working capital requirement on cash cost basis. We are required to do it on cash cost basis. Let's first prepare a cost sheet. The cost sheet will be a detailed cost sheet. Particulars, calculation amount. Moment you are done with the cost sheet, you will also get the answer of three things, which is your closing raw material, closing WIP and closing FG in the cost sheet itself. That will go to the estimation. So the cost sheet is very critical here. Particulars, calculation amount. Direct material, underline that. Opening raw material, add purchases, less closing raw material consumed. Opening is 0. This is where the difference comes. Opening raw material is 0. Add purchases, less closing raw material consumed. Now listen, my cost is 40 per unit. I have produced 31,200. WIP is 12,000. I also incur raw material cost for WIP. So I'll incur it on 43,200 units provided the degree of completion for WIP is 100%, which is given in the question. The degree of completion for material is 100%. So my raw material cost is 40 into 43,200. 40 into 43,200. 40 into 43,200. Sorry. This is here, okay. Raw material consumed. Raw material consumed is 40 into 43, 200, which is your 17,28,000. Closing raw material is, they have said average 30 days consumption. Average 30 days consumption. So this is 1728 into 30 by 360. 30 by 360. And purchases, which is a balancing figure. Purchases, which is a balancing figure, is reverse working 18,72,000. When you calculate creditors, you will have to calculate on 1872. When you calculate raw material, you will have to calculate on 1728. Anyway, that's already done. I'm just going to copy paste this in my estimation later. Clear? Any doubts on this? No, I have not done the purchase creditor calculation. Where have I done the creditor calculation? I said when you do the creditor calculation, you will have to do it on 18,72,000. This is stock of raw material. Where is creditor here?
No, sir, I thought it's 60 by 360.
So what is the stock of raw material?
Sir, rather than consume 17,28,000, sir.
What is the stock of raw material?
Sir, that's what I thought it was 60 days, sir. If you
No.
multiply, you'll get the closing stock. Like the
That is creditor, no? Credit allowed by purchases, creditor.
I got confused.
Okay, not an issue. Next is direct wages. Direct wages will also be on 43,200 provided the degree of completion is 100%. Whereas what they mentioned degree of completion is 50, which means it will be on 31,200 and half of 12,000, which is 6,000. Half of 12,000, which is 6,000, which is 37,200. So this will be 15 into 37,200. 15 into 37,200. Because the question said 50% degree of completion for your conversion cost. Then overheads other than depreciation, anyway I am not going to write depreciation. Overheads other than depreciation is 30 into 37,200. I could have written depreciation if it was a total approach, that would have been 10 into 37,200 into 37,200. This stage we get GWC. This stage we get GWC. In this, opening WIP is 0 less closing WIP. Opening WIP is 0 less closing WIP. Closing WIP is simple. Whatever you had added earlier, you did not do it on 31,200. You did something on 43,200. So raw material will be your closing WIP 40 into 12,000. This is raw material addition. 40 into 12,000. Then 15 into 6,000 and 30 into 6,000. 40 into 12,000, 15 into 6,000 and 30 into 6,000. This I need to subtract now. This needs to be subtracted, and listen, you will get NWC COP. How many units have been produced by the company? How many units are produced by the company? Something is mentioned in the question. 31,200. And if you divide this by 31,200, you will get the cost per unit, which is 85 rupees. You will get the cost per unit, which is 85. What we did indirectly is we added 12,000 in material cost, we added 6,000 in raw material direct wages, we added 6,000 in overheads, and then removed that as part of closing WIP. Remove that as part of closing WIP. If you don't add it, you will estimate this wrongly. This estimation can go wrong. So you added it and now you have removed it. Added and removal is also done. So you get to the COP number. Add opening FG less closing FG. I don't have any opening FG. Closing FG, how many units are given in the question? 24,000 into 85. 24,000 into 85. Sorry? 40 plus 15 plus 30 rupees. 40 rupees of raw material, 15 rupees of wages, 30 rupees of overhead. We are following cash cost approach. So 40 plus 15 plus 30 rupees. That's how you get the 85. So closing FG, COGS. I think COGS or COS. We don't have anything else. COGS or COS. Have they given the selling price in the question? Okay. Anyway, cash cost approach selling. Okay. Anyway, doesn't matter. it doesn't matter. I am following cash cost approach. Now once this is done, stock of raw material is calculated, stock of WIP is calculated, stock of FG is calculated. These three things you copy paste. These three things you will copy paste in your cost sheet. Apart from that, I'll read if at all anything else is there. Nothing is there. Finished goods is done. Credit allowed by supplier is 30 days. So your supplier is this 18,72,000 into 30 by 360 on purchases. Credit allowed to purchaser is your customer. This is credit allowed to purchaser on cash cost of sales, which is on 6,12,000 into 60 by 360. 6,12,000 into 60 by 360. Wages 15 days. You have your wages figure. 5,58,000 into 15 by 360. Cash balance is given. So almost everything will get estimated here. And see here, stock of raw material, stock of WIP, stock of FG was copy pasted from this. Balance you do the estimation. Balance estimation you can do, which is a fairly simple thing. Question 11, try to prepare a cost sheet. Same logic which I said. Try to prepare a cost sheet. Do it under total approach. Prepare a cost sheet under total approach. Prepare a cost sheet. In the cost sheet, most of the times will get estimated. Most of the items would get estimated. If you get the cost sheet correct, the problem is almost over. Beyond that, I'll talk on MPBF. The question also wants us to calculate MPBF. I just want the cost sheet. I'm not bothered about estimation. In the cost sheet, anyway, 3 items will get estimated. Stock of raw material, stock of WIP and stock of FG. So please do that quickly. Do the cost sheet quickly. We'll do total approach. Almost the same format it will be. Even a similar question only, but I want you to do this properly. What will be the raw material consumed figure? What into what?
8640.
No, what into what, you just tell me. How many units into what you are multiplying?
Sir, 1,08,000.
1,08,000 into 80. 1,08,000 into 80. What is 1,08,000 is production of 1,04,000 and WIP of 4,000, which is fully complete. WIP is fully complete. 86,40,000. Closing raw material is 4 weeks consumption. 4 by 52. 4 by 52. Purchases will become a balancing figure. 93,04,615. Purchases will become a balancing figure. 93,4,615. Purchases is a balancing figure. Wages what into what? 1,06,000 because only 50% complete. So 1,04,000 is complete. 2,000 of incomplete. 2,000 incomplete. 1,06,000 into 30. Overheads other than depreciation is 1,06,000 into 60. Depreciation is not there. GWC. Opening WIP is not there. Now 4,000 into 80, remove material content, and 2,000 into 90, wages and overheads put together. I have added them. 4,000 into 80 and 2,000 into 90. I am removing this. The reason for adding and removing it, if you don't add it, you will estimate your stock of raw material will be lesser, your purchases could be lesser. So all that can go wrong. This will technically be 1,04,000 units into 170. It will technically be 1,04,000 into 170. How much is the closing FG? Closing FG is how many units? 8,000 into 170. 8,000 into 170. 1,63,20,000. Your selling price given in the question is 200. So 96,000 into 200. Balancing figure profit is this much. Any doubts on this? Any doubts on this part? Now, when I do this, I've already got three items which I wanted. One is stock of raw material, stock of WIP, stock of FG. I'm not getting into the balance estimation, but I want to do MPBF. I want to do MPBF, maximum permissible bank finance. Any doubts till this? Once you are done with this, the question, if you had solved it fully, your current asset in the question is 55,03,461. This would have been the current asset figure. Okay. Current liability is 8,07,471. And question somewhere said maximum permissible bank finance under three methods if core current asset is 20% of total current asset. I want something called as non-core current asset. Can you tell me 80% of this is how much? Non-core current asset. Core is 20%, non-core 80% of 55 lakh.
44,02,768.
Okay. So assume you have got all these three. You have done your calculation. Now MPBF works through three methods. See, the MPBF was introduced by, see, the purpose of doing working capital estimation is you will go to the bank, present this statement and ask for a loan from the bank because you need money to run your day-to-day operations. So bankers will not give you entire money because if they give you entire money, then the promoter has not put any money from his side. So we want promoters also to put money. So there is a method one in which what we do is 75% of current assets minus 75% of current liabilities. I'll not do the calculation, I'll just write it. 75 into 55,3,461 minus 75% into 807,471. This is one method. This is one method. Method two, what the banker is going to do is 75% of current assets minus 100% of current. In this method you will get lesser loan. In this method you are going to get even a lesser loan because there you were subtracting only 75% of current liability. Now you are saying you are going to subtract 100% of current liability. Method 3, 75% of non-core current asset, 100% of current liability. So you will do 75% of 44,02,768. 44,02,768 minus 8,07,471. The last method will give you the lowest answer. So different methods you will have funding requirement. So first method you will give 35,21,993. Second method 33,20. Third method, theoretically we take the lowest of the three, but in a practical world different industries different methods use. So these are the answers under three methods of your This is called as MPBF, maximum permissible bank finance. I also want to discuss one more item, and after that we'll take a break. Now we calculate this reserve for contingency 12%. For example, this is the question where the working capital was 6,51,250, reserve is 78,150, final answer is 729,400. Some question will say the company plans to maintain a contingency of 12% on the final working capital including the contingency, on the final working capital including the contingency. In that case, what you need to do is, you have calculated 651,250 contingency and final is taken as 100, contingency is taken as 12, and the working capital which you have calculated is 88. Normally you take 12% of 651,250. In this scenario, what you need to do is 651,250 into 12 by 88 into 12 by 88, because the working capital contingency is on this number. The 740057 you don't know. On this it is 12%, which is 88,807, but you don't know that number. So that is why what you do is you first calculate 651,250. After that you say that is 88, contingency is 12, final answer is 100. So my contingency figure is the earlier figure which you have calculated into 12 by 88 into 12 by 88. Clear? Any doubts on this? Okay, let's take a break of 45 minutes and then we resume again. Okay, let's continue now. We were doing estimation of working capital. In that we have done with operating cycle method. We are done with an existing company analysis. In new company also we have done few problems. Let's do maybe one or two more problems. A newly formed company has applied for a loan to a commercial bank for financing its working capital requirement. To prepare an estimate of the requirement, 10% to cover unforeseen contingency. Information about the P&L is given: sales, COGS, GP, admin, selling, PBT, provision for tax. COGS has been derived as follows: material used, wages and manufacturing expense, depreciation, less stock of finished goods, and COGS is 15,30,000. Figures given above relate only to the goods that have been finished and not to work in progress. Goods equal to 15% of the production are in progress on an average, requiring full material but only 40% of other expenses. 2 months of consumption of material in stock, cash balance 40,000, lag in payment 1 month, suppliers extend 1.5 month, credit sales are 20% cash, 70% income tax has to be paid. You are required to make other assumptions as you deem necessary for estimating on cash cost basis. Okay, I'm going to prepare first a cost sheet. The focus will be on the cost sheet only. If you look at the two questions which we did till now, they said 31,200 is the production, WIP was 12,000. Another question said 1,04,000 is the production, WIP is so much. In this question, what they have done is they have given the cost sheet to us. So good part is cost sheet is given. The trouble with the cost sheet is they are saying the figures given above relate only to the goods that have been finished and not to work in progress. So this is not a good cost sheet, because in cost sheet I have to consider for even work in progress. Another issue is this question does not tell what is the production. The production information is not given. So my assumption is 100 units have been produced. I go back to, I'm going to convert this question like the previous question. In the previous question 1,04,000 units were produced. This question 100 units are produced. WIP is 15 units. WIP is 15 units in which the degree of completion for material is 100%, others is 40%, and the cost per unit was given directly there. The cost per unit is divided by 100, 8,400 per unit, divide by 100, 6,250 per unit, divide by 100, 2,350 per unit. Now it becomes like the previous question. It becomes like the previous question. Everything I have divided by 100. 8,40,000 by 100. The cost is so. When I look at the previous question, it said raw material 80 per unit. Now raw material is 8,400 per unit. Wages was 30 rupees. Now we have calculated some 6,250 per unit. Depreciation is 2,350 per unit. Estimated level of activity is 100. Work in progress is 15. It exactly becomes like the previous question. It becomes like the previous question. Production is 100. WIP is 15. Raw material cost is your whatever the number we had calculated divided by 100. 8,400 per unit, wages and manufacturing expenses 6,250 per unit, depreciation is 2,350 per unit. Let's prepare the cost sheet. We'll do the cost sheet under both total approach and cash cost approach. Estimation is only, cash cost is required. This is just for understanding. Anyway, I'm not going to do the estimation part. Let's start with the cost sheet. Particulars, total approach, cash cost approach. Direct material, in that opening raw material add purchase, more or less this format, some addition here and there can be there, some extra items can be there. My opening raw material is 0 and 0. Raw material consumed given in the question is 8,40,000, but that's not the right number. That is only for 100 units, whereas we are producing 100 plus another 15 which needs 100% material. It needs 100% material. So 8,400 into 115. 8,400 into 115 is the raw material consumed. 8,400 into 115 is the raw material consumed. Closing raw material they have mentioned in the question is 2 months of consumption. 2 months of consumption is the closing stock. So into 2 by 12. Purchases is a balancing figure. 1127. Purchases is 1127. This is one part of it. Direct wages is 2,350 per unit. We had calculated, sorry, 6,250 per unit. Your wages cost would be incurred for 100 plus 15 into 40%. The degree of completion is 40%. The degree of completion is 40%. So 106 into 6,250. 106 into 6,250. Wages and depreciation were, sorry, wages and overheads were clubbed together here. Depreciation is 2,350 per unit. So 2,350 into 106 and this side 0. In this approach we don't consider it. I put a total. No opening WIP. Closing WIP is 15 units into 8,400. 15 units into 8,400. We made an assumption of 100 units. WIP was 15 units. 6 units into 6,250. 6 units into 2,350. Even depreciation will be considered for stock valuation. 6 units into 6,250. 6 units into 2,350. This side, this depreciation part will not be there. 6 into 2,350 will not be there. In cash cost, depreciation is not considered. So you get to 17 lakh and 14 lakh 65. 17 lakh is what is given in the question. In the question somewhere there is a number of 17 lakh which is this number. Closing FG is 10%. 10%. My COGS is this. This is what would have been given in the question, 15 lakh 30. COGS given in the question would have been 15 lakh 30. It's not COS, there are other expenses also. We have other expenses like admin, selling. Admin is 1 lakh 40, 1 lakh 30. COS number, this profit and sales. Profit is 3 lakh, sales is 21 lakh. And when you do cash cost approach, it's 0 and 15, 88,500. So I've converted like the previous question. What I did is I assumed 100 units as the production. We got raw material as 8,400 per unit. Wages as whatever the 2,350, 6,250 and got to the answer. Beyond this, I'm not doing it. Beyond this, its estimation is more of a formality. Your stock of raw material, stock of WIP, stock of FG is already calculated in this. Any doubts on this part? Clear? Let's come to question 13. Marks Limited is launching a new project for the manufacture of a unique component. New project means new company. New project technically becomes new company. At a full capacity of 24,000 units, the cost per unit is material, labor, fixed, depreciation. Selling price is 200, selling expense 10, 80% being variable. In the first 2 years, production and sales are as follows. Production, sales. We have to assess working capital. Statement of profitability and working capital based on total approach. Statement of profitability and working capital requirement. Statement of profitability is basically the cost sheet. I'm going to just do the cost sheet again. Again, cost sheet is what I'm going to do. Working capital estimation is just a formality. You'll have to take number from there and keep doing multiplication, division, some into 2 by 12 into 4 by 52, some percentages you'll have to do, and you'll get to the answer. So let's focus on preparing the cost sheet. We'll try to prepare the cost sheet. In the first year, 15,000 is the production, 14,000 is the sales, closing stock is 1,000. Closing stock is 1,000. Next year, opening stock is 1,000, production is 20,000, sales is 18,000. What is the closing stock? Closing stock is 3,000, not 2,000. It is 3,000 because there is an opening stock of 1,000. Opening stock plus production minus sales will be the closing stock. Let's do this now. We are required to do it under total approach. It's a new company, year 1, year 2, opening raw material is 0, opening raw material is 0, year 1, let's first do year 1, opening raw material is 0, raw material consumed is, in year 1 the production is 15,000. Another important information is there is no work in progress in this question. There is no work in progress. If there is a work in progress, we need to inflate this 15,000. We need to inflate this 15,000. There is no work in progress, so 15,000 into 80, 15,000 into 80. Closing stock of raw material is 3 months, so into 3 by 12, 3 months into 3 by 12. Purchases balancing figure is 15 lakhs, purchases balancing figure is 15 lakhs. Then we have labor and variable expense, 15,000 into 40, 6 lakh. Just give me a minute. Manufacturing and admin, if they had used the word admin and manufacturing, I would have taken it below. They have used the word manufacturing and admin, which is 20 per unit. Can you tell me what should be the amount here in year 1? 20 into what? Year 1, what should be the manufacturing and admin expense? 20 into what? What should I multiply this with? Then what is the difference between labor and variable expense and fixed manufacturing and admin expense? Why should they use that word fixed there? Okay, I'll do 20 into 15,000. Okay, next year what should I do? How can I write the same thing for both? Next year the production is different, no? Then you cannot do 20,000, you cannot do 15,000. 20 is into 24,000. At full capacity of 24,000 units, the cost per unit is calculated as under. This calculation was done on a base of 24,000 units. Variable expense by rule will keep changing. 40 into 24 I can do if you produce 24,000 units. What happens in fixed expenses? If produce less also, your fixed expense does not come down. So 20 into 24,000. Depreciation is 10 into 24,000. Depreciation is 10 into 24,000. So 25 lakh 20, no opening WIP, no closing WIP, cost of production, no opening FG. This divided by 15 into 1, divided by 15,000 into 1,000 is the closing stock. 1,000 is the closing stock. COGS. Then they have said there is some selling expense of 10 per unit. In that 80% is variable. Fixed is 2 rupees. 2 rupees will be multiplied with what? Fixed 2 rupees will be multiplied with what? 24,000. Your fixed 2 rupees will be multiplied with 24,000. Variable of 8 will be multiplied with the units sold. With the units sold. So 2 into 24,000. I'll call this as fixed. And variable is 8 into 14,000. We get cost of sales. Your sales figure is 14,000 into 200. This gives the profit for the first year. Profit for the first year is 2,88,000. When it comes to the second year, my opening raw material is 3 lakh. Opening raw material is 3 lakh. Raw material consumed is 80 into 20,000. 80 into 20,000. We have produced 20,000 units in the next year. 80 into 20,000. Closing raw material is raw material consumed into 3 by 12. Into 3 by 12. Purchases is balancing figure. Can you tell me what is the purchase figure? Balancing. 3 plus something minus 4 is equal to 16. 3 plus 17 lakh minus 4 lakh is 16. Direct wages and variable overhead is 40 per unit, so 40 into 20,000. This is same 480 and 240. Same 4 lakh 80 and 2 lakh 40. Opening stock is 168. This is 20,000 units. This is 1000 units. Your wish whether you want to follow FIFO method or average cost method. Both methods will give you a different answer. I think, just a minute, question has given something, I remember. Okay, average cost. Stock of finished goods is to be taken at average cost method. So, average cost method, we have done this in cost sheet chapter. Cost of production plus value of opening FG divided by units produced plus opening FG units into closing stock. So, 4,69,714. This 48,000 will remain as it is. Your variable cost is 8 into units sold. 8 into 18,000. Cost of sales, profit and then sales. Any doubts on this? Any doubts on this part? Your fixed expense has to be on the overall capacity of 24,000 units. Okay, we are kind of done with your estimation part. Your working capital, the first segment of the chapter is over. MPBF part is also taken care of. Next segment is on the cash management side. On the cash management side, I have one problem on preparing something called as an optimum cash calculation and maybe 2-3 problems on cash budget. Let's look at this. A firm maintains a separate account for cash disbursement. Total disbursement are 260-500 per month. Administrative and transaction cost is 25 per transfer. 25 per transfer is like 25 per order. Ordering cost per order. Carrying cost is 7.5% per annum. Carrying cost is 7.5%. Determine the optimum cash balance. So, square root of 2 into annual demand of money into ordering cost is called transaction cost divided by opportunity cost or carrying cost. 2 into annual demand of money is 260-500 into 12. How much? 260-500 into 12. 31 lakh 50,000. Transaction cost is 25. Opportunity cost is 7.5%. See, there it used to be a percentage of purchase price. It is 7.5% of technically 1 rupee because your annual demand is in rupees. There the annual demand was in units. So, we were getting the price of 1 unit and then multiplying. So, 7.5% of 1 is 0.075. 7.5% of 1 is 0.075. You will take a square root, you will get to the answer. 45,826. Question can expand further and say, how many transfers will happen in a year? How many transfers will happen in a year? You will say 31 lakh annual demand divided by quantity value per transfer. Total ordering cost, here it can ask total transaction cost. Average inventory, here they can ask average money which is being maintained by the company, half of your optimum cash balance which you calculate. So, whatever is asked in EOQ, the same thing can be asked here as well. Go through question 15. Go through 15. Okay. Prepare monthly cash budget for 6 months beginning from April 2017 on the basis of following information: sales, wages and salaries. Of the sales, 80% is on credit, 20% for cash. 75% of the credit sales are collected within 1 month, balance in 2 months. There are no bad debt losses. Purchases 80% of sales and are made on credit and are paid in the month preceding the sales. Firm has 10% debenture of 1,20,000, interest is to be paid quarterly. Advance payment of tax, cash balance, any surplus or deficit above is made up by temporary investment or liquidation at the end of each month. Interest on this is to be ignored. So basically I'll have to keep a balance of 20,000 above that or below that. I'll put it in an investment or I'll borrow that money based on requirement. Let's start. Cash budget for the period of April 2017 to September 2017, 6 months. April to September. Opening cash. The most tricky part or the difficult part would be the collection from customer. If that is done properly, problem will almost be simple. Opening cash is 20,000. Add inflows. Cash sales, collection from customer. Cash sales and collection from customer. I may split this further. Cash sales and collection from customer. What the question has mentioned is, of whatever sales is happening, 80% is on credit, 20% is on cash. So let's quickly close the cash sales part. 16,000, 20% of sales, 12,000, 16, 20, 16, 12,000. Collection from customer, the rule is simple. What they are saying is 80% is on credit, 20% is on cash. Whatever credit sales is happening, 75% of the credit sales will be collected in 1 month and the balance in 2 months. Now listen, January month sales, I'll collect 75% of the credit sales in which month? Feb, and 25% in March. Least bother about January because it's not that in my period. So now listen, I'm going to write it like this, from Feb sales. From February, some part of it would be collected in the month of April. I can do it as a separate working note rather than clubbing it here. I am doing it here, but you do it as a separate working note. From March sales, from April sales, from May sales, from June sales, from July sales, and from August sales. September sales will not be collected now. September credit sales is not going to be collected now. Now the rule is 80% is credit sales. So I am writing here February in bracket 96,000, 80%. February in bracket 96, March in bracket 1,12,000, April 64,000, May 48,000, June 64,000, July 80,000, August 64,000. So this is the credit sales, and now I know how the collection is going to happen. 25% of this in the month of April. 25% of this in the month of April, 75% here, and 25% here. March month, April and May. This 64,000, 75% here, 25% here. This 48,000, 75%, 25%. 75 and 25. This 80,000, 75% and 20%, 25%, and this is 75%. So this way we have collected the collection figure. You can do it as a separate working note, or you do it this way, whatever way you are find it comfortable. Better to do it as a separate working note rather than making it in the main working note. Apart from this, I don't see any inflow being there. There are no inflow being there. Purchases are there, some interest payment is there, advance tax payment is there. So there are no other inflows. You can have some borrowing to be taken. If you have a negative balance, you may have to borrow, or if you go below 20,000. If you go below 20,000, they said which is the minimum desired cash, any surplus or deficit will have to be made by temporary investment or liquidation of temporary investment or temporary borrowing. So I may borrow money, that could be an inflow, but that will come later. As of now I cannot write. So these are my total inflows. Total inflows. Cash sales and collection from customer. Cash sales and collection from customer. In the payments, in the outflows, the first item of outflow is purchase amount to 80% of sales are made on credit and paid for in the month preceding the sales. Paid for in the month preceding the sales. Now it is slightly tricky, the part is not very clearly mentioned here. Listen, purchase is going to be 80% of sales and are paid for in the month preceding the sales. So I am not sure whether the purchases is done in the month of sale or they do it previous month. If they are doing previous month, when are they paying is also not very clearly mentioned. What is the credit period given is not clearly mentioned in the question. I am assuming that it is 80% of previous month. 80% of previous month. So payment to supplier, so sorry, are paid for in the month. Okay, so your payment will be, for example, in the month of April you will pay 80% of May month sales. April the payment will be 80% of May month sales because it is paid in the month preceding the sales. So sales of May is 60,000, this would have been 48,000. 48,000. 60,000 is the May month sales. Your purchases is 80% of sales. Purchases is 80% of sales. In the month of April, I am going to pay for May month sales. In the month of April, paid in the month preceding the sales. May month we will pay 64,000, 80,000, 64,000, 48,000, 80,000. I am paying May month in April, June in May, the previous month. Apart from that, there is some interest to be paid. Interest of 1,20,000, this has to be paid quarterly. So 1,20,000 into 10%, 12,000. Quarterly payment is 3,000 per quarter, which is in the month of April 3,000 and July 3,000. January, April, July, and every 3 months you have to pay this. Every 3 months you have to pay this. Apart from that, I think there is an advance tax. Advance tax is 5,000 in the month of July. So these are total outflow. Total outflow. Closing cash, borrowing / investment, revised cash. I may get a cash balance which is more than 20,000, but I don't want to maintain more than 20. The rule is very clear. If you have more than 20, 93,000, I'll create a deposit of 73. I'll create a deposit of 73,000. I'll have a cash of 20. Next year it is 20 opening balance. You get a closing cash of 44, deposit 24,000, your revised cash is 20. Get a closing of 8,000, borrow 12,000, closing is 20. Deposit 8,000, 20. Deposit 44,000, 20. Is there a wages and salaries also? Okay.
Answer was different. That's what I was saying. Why it's
Then maybe typing error. I have not written the point on wages and salaries. So I'm not sure where is this wages and salaries coming from. Okay, it is there. But when are they paid is not mentioned, no? Okay, this wages and salaries would be paid as it is. They have not mentioned the time period. So let me take as it is then. Sorry, I did not see this wages and salaries. Wages and salaries, assuming they are the payment, 9,000, 8, 10,000, 10,000, 9 and 9. So now 64,000 of deposit, 16,000 of deposit, 22,000 of withdrawal, 2,000 of withdrawal, either you withdraw money or you deposit money depending on the cash flows. 64 minus 16, 22, 2 minus 35 and 9. This is the temporary either liquidation or you create a deposit or you borrow money depending on whether you have surplus money or not available at your end. The most important part is this. Be very clear on this collection part. This collection part is the most critical part in a cash budget. Go through question 16.
in the classwork. To give like cash flow, you give many sums. So revising for exam, enough if I go to what for cash
No,
flow,
do the class one.
for cash flow.
Okay, let's quickly discuss. If needed, we'll solve it or else we'll discuss this question. Slide Limited is preparing cash flow forecast for the 3 months period of friends please. Friends, Jan to end of March. Following volume have been forecasted. So December to April sales is given. Selling price is 600. Sales are all on 1 month credit. So simple. Your Jan, Feb, March collection would be this into the previous month. Previous month sales into 600. No splitting it further and all. Production of goods for sale take place 1 month before sales. Each unit produced required 2 units of raw material costing 150. No raw material inventory is held. Raw material purchases are on 1 month credit. Now listen this carefully. Jan month sales. Production will happen in December. Production will happen in December. Purchase will happen in December. Payment for that will happen in Jan. In short, Jan payment is for Jan month sales itself from a raw material point of view. Raw material point of view, January you will sell the product. You are going to produce that in the month of December. Raw material you are not holding, so you will purchase in the month of December and you are going to pay. In short, payment to supplier. Payment to supplier will be this into 300, this into 300, this into 300. The same month because production happen, sales happen in January, production for that happen in December, purchase for that happen in December and payment for that happen in January. In short, payment happens for the same month of sales. Payment happens for this is for raw material. So raw material if you see, payment is equal to and hence payment is equal to sales month. Payment is equal to sales month, only the raw material part, okay. Then other thing, variable overheads and wages are equal to 100 per unit and are incurred during production and are paid in the month of production. So my wages and variable overhead will be 100 into the next month sale. 100 into the next month sale because the production will happen 1 month before and payment is done immediately. Payment is done immediately. Raw material also should have been next month sales only, but in raw material what is happening is you are given a 1 month credit period. You are given a 1 month credit period. Opening cash balance is 35,000. 2 lakh is expected to be received in the month of March. So this is a loan which is being taken and you will purchase a machinery. So this will give you, there is a loan which is taken and there is a purchase of machinery. Apart from this, they are asking forecast current ratio at the end of 3-month period. Forecast current ratio at the end of 3-month period. Few points which I can say. One, there will be a closing stock. There will be a closing stock. What will be the closing stock is 2250 units. Closing stock will be 22. Why will this closing stock be there? Because you produce 1 month in advance. You produce 1 month in advance. Production happens 1 month prior to the sales. So there will be a closing stock of FG of 2250 into, FG will be 2250 into 400 rupees. What is 400 is raw material cost of 300 rupees and labor and overheads of 100 rupees. So this is the closing FG. There will also be a closing debtors. What is closing debtors is you are collecting 1 month later. So whatever March sales has happened, you would not have got the money for that. That money would not have come. So 2100 into 600. There is also a cash. Closing cash is there in the cash budget, which is 902 500. 902 500 when you prepare. There will be one item of current liability. What is that item? One item of current liability. That is creditor. What I said in creditor is you sell in the month of April, produce in the month of March, purchase in the month of March, payment in the month of April. So there would have been a creditor. So creditor is for the April month sales. I would have done the production now. For the April month sales, I would have done the production now. While doing the production, I would have also done the purchase of raw material. I would have done the purchase of raw material. So this is my current asset. Assuming there are no other thing, this should be my ratio. Assuming there are no other current liability, I don't see any other information at least in the question. Just a minute. I don't see anything else. So your current ratio is 4.54 is to 1. The current ratio is 4.54 is to 1. Balance question on this you can manage it. 17th one question is only there that you can manage. I'll now move to an area called as receivables management. In receivables management, we are going to broadly classify the chapter into two parts. One is on your extension of credit or tightening of credit, which is a purely format driven. I may do even, I think we may do some 6-7 question. Every question I'll do only same format, nothing beyond that. It's a format driven question. I'll first explain the format to you. We'll write sales less variable cost less fixed cost and call this as gross benefit. Gross benefit is or technically the profit which you get. After this, a company can have bad debt, cash discount, credit admin cost, interest cost and net benefit. I don't see anything beyond this being there in any of the question, but if there we'll see. But mostly this is what you are going to do in every question. The next I think some 6-7 question, nothing beyond this. This is the format we will put in. When you have to calculate this, there is a note which you need to do, which is you need to estimate debtors. Interest cost is dependent on the debtor figure. Debtor is calculated based on full cost of sales. Debtor is calculated based on full cost of sales. Normally the formula for debtors is when you did working capital estimation, debtors is equal to credit sales into credit period by 12. This area says don't take it on credit sales, take it on cost of sales. Like we had a cash cost approach under. If the problem is silent, we do it on full cost of sales. Problem tells us to do something, we'll follow that. If the problem is different, we'll follow that. Based on this, you'll calculate debtors, and based on this, you'll calculate interest cost. Let's see it in few questions. You'll understand this format when we do a problem. Radiance Garment Limited manufactures ready-made garments, sells them on credit basis through a network of dealer. Present sales 60 lakh, 20 days credit period. Company is contemplating an increase in the credit period with a view to increasing sales. Variable cost 70%, fixed cost 8 lakh per annum, pre-tax return of 25%. Proposed credit policy, collection period 30, 40, 50, 60, sales increase to 65, 70, 74 and 75. Which credit policy should the company adopt? Present your answer in tabular form, 360 days, 2 digits after decimal. Go through the question. Just quickly go through the question first. Okay, there's an original scenario and they have given some rework scenario saying that policy 1, credit policy 1, credit policy 2, 3, 4. Let's capture the data given in the question. Sales is 60 lakh. It can go up to 65, 70, 74, 75. Variable cost is 70% of sales. Fixed cost is not given in the question. Sorry, fixed cost is 8 lakh. Fixed cost is 8 lakh. It will remain same whether sales go up or come down. Gross benefit is, it's a purely format driven area. Gross benefit is this. Any information on bad debt? No. No cash discount, no credit administration, nothing is there, okay. Then I have something called as interest cost, which is depend on debtors. Full cost of sales is variable cost plus fixed cost. Variable cost plus fixed cost is called full cost of sales. Variable cost plus fixed cost. Question has not said debtors have to be valued like this, like that, nothing is mentioned, then we follow this. Originally we are giving a 20-day credit period, so this into 20 by 360, 20-day credit period, 20 by 360. Next we are increasing it to 30-day credit period, 30 by 360. Then we are increasing it to 40-day credit period, 40 by 360. Then we are making it 50-day credit period, and finally we are making it 60-day credit period. So we take that number into 20 by 360, 30 by 360, 40 by 360, 50 by 360 and 60 by 360. Your interest cost is depends on the return which the company wants. They want a return of how much? 25%. So this into 25%, into 25%. Every question I am going to do the same thing. So this is my interest cost. My net benefit is whichever gives me highest net benefit, I will choose that. I will choose policy 3. I will choose credit policy 3 because that gives me the maximum net benefit. That gives the maximum net benefit. So which is for giving a credit period of 50 days. We will give a credit period of 50 days because that gives me the maximum benefit. Clear? Any doubts on this? Let's look at this. You are going to see mostly the same thing I am going to do. A company is presently having credit sales of 12 lakh. Existing terms are 1 by 10 net 45. What is 1 by 10 net 45 is? You will get 1% discount if you make the payment in 10 days. Otherwise, you need to make the payment in 45 days. Average collection period is 30 days. So some people could be paying in 10 days, some people could be paying in 45 days. On an average, I collect my money in 30 days. Current bad debt is 1.5%. In order to accelerate the collection process, the company is contemplating liberalization to 2 by 10 net 45. Instead of giving 1 by 10 net 45, I want to make it 2 by 10 net 45. Sales will increase by 1/3. Bad debt will increase. Collection period will decline. Contribution to sales is 22%. Opportunity cost is 15%. 50% of customers in terms of sales revenue are expected to avail cash discount under existing. Tax rate 30%. Should the company change its credit policy? I'm going to do this question also. Beyond this, I would want you to try it out. So the same format, I'm not going to do anything beyond this. Original and revise, that's all. Only two policies are there, original and revise. What is the sales today? 12 lakhs. The sales will go up to how much they are saying? Some increase is going to happen in the sales. 1/3, 16 lakhs. Variable cost, what is the percentage? Variable cost, how much percentage? Somewhere that variable cost percentage is given in the question in an indirect manner.
Sir, contribution to sales.
Contribution is 22%, so variable cost is 78%. Anything on fixed cost? If not there, we take it as 0 and proceed ahead. Anything on fixed cost? No. Anything on bad debt?
1.5%.
Okay, 1.5% of sales. Then it increases to 2%. 1.5 and 2%. 1.5 and 2%. Cash discount, they are saying, as of now I am giving 1% discount. Okay, I want to make it 2% discount, and they are saying 50% people today and 80% people later will take this scheme. 50% and 80% of customer in terms of revenue are expected to avail cash discount under existing and liberalization scheme respectively. So today 50%, later it is 80%. So this is sales. 50% people take the discount and discount is 1%. 50% people take the discount, 1% is discount. This is 80% people take the discount, 2% is discount. 80% people take the discount, 2% is discount. No credit administration cost. Coming to debtors figure, I copied the variable cost plus fixed cost. There is no fixed cost in this question. Variable is fixed. What is the collection period today? How much is the collection period? No.
30 days.
30 days. Later on it is becoming
20 days.
20 days. The average collection period is 30 days. Later on it is becoming 20 days. And my interest cost percentage given in the question is 15%. 15%. That's all. The problem is over. 2,28,300 and 2,84. I'm okay to go with the liberalization scheme. I'm okay to go with the liberalization scheme. Clear? Any doubts on this? Every question you put it in this format, you will get to the solution. Any doubts on this? Do the next one. The only difference, the only thing I want to talk just for a minute. If they give you debtors turnover ratio, listen. If they give you credit period, you do full cost of sales into credit period by 360 or 365. If they give you debtors turnover ratio, full cost divided by debtors turnover ratio will give you the debtor. Divided by the debtors turnover ratio. Please do it. Put it in the same format. Put it in the same format and get to the answer. You may have some of the items. It's not necessary to write this fully, okay? I have just kept it at this format. Whatever item is available, you have that. If, for example, credit administration was not there in this question. So put it in this format and then let me know the answer. Quickly do it. Present policy, option 1, option 2. do it quickly. The same format, nothing there to be done. $11,50,000 in the revised policy 1. I think policy option 1 has the highest net benefit. Debtors will be full cost of sales divided by debtors turnover ratio. You'll have to divide by the debtors turnover ratio. Normally you'll have to do into credit period by 360, 365. Here you'll have to divide by debtors turnover ratio. Any doubts on this? Clear? Can we proceed? Any doubts? Okay, let's come to 21. It's a slightly different question. Let's come to 21. Any doubts in the earlier question? Okay. A company has sales of 25 lakh. Collection period is 50 days. Bad debt loss are 5%. Collection expense are 25,000. Cost of funds is 15%. Two alternative collection program. Evaluate which program is viable. It is similar to the previous set of questions and all, but this is not a credit policy, this is a collection policy. The difference is simple. Credit policy means you give more credit to customer, because of that sales can go up. What is collection policies? If you have one employee, you may collect the money in 100 days, but if you increase the number of employee, it is possible to collect the money faster, because they are going to do quicker, they are going to do a lot of follow up, and that's possible. So in this question, I can increase my collection expense, reduce my collection period, reduce my bad debt. I'm going to do it like the previous question only, but we will do only this 4. Only the costs are there. There are no benefits given in the question. Sales is there, but I don't know what is the cost of sales, and I don't want to capture also, because the sales is going to remain same for all the option. Your variable cost of sales will remain the same for all the option. Gross benefit will remain the same for all the option. So this is a problem. We are going to do it in the same format, but our focus will only be this part, which is bad debt, cash discount, credit administration, interest cost, and there's no concept of net benefit and all. So we'll call it as bad debt. I don't think so. Cash discount is there in this question. Credit administration, interest cost, and total cost. We will select a plan which has the lowest cost. We will select a plan which has the lowest cost. And debtors, when you estimate in this question, that estimation will happen only on the basis of debtor estimation. In this question, you don't have a choice. You will have to do only on the basis of sales, because you don't have information on cost of sales. Sales is 25 lakh. I don't know the cost of sales. I don't know the cost of sales. So for example, if I start with bad debt, bad debt as of now is 5% of sale, 1,25,000. It can become 4%, 1,75,000. Collection expense, credit administration is collection expense. Today is 25,000. Then later on it will become 50, 80. Interest cost is 25 lakhs into, today the collection period is 50 days by 360 or 360, I am taking 360, even you can take 365, doesn't matter, into 15% cost of funds, into 15%. Same 25 lakh, now the collection period is 40 days, and then it becomes 30 days, whichever has the lower total cost, I will go ahead with that plan. Whichever has the lower total cost, I will go ahead with that collection policy. Sometimes in an exam scenario, they may, this happened in only one exam, they may forget to give this number, then you assume some cost of funds and proceed. Interest cost will be there in all question, because if the collection data is given, so you will have interest cost in all the question, but if in case that data is missing, you please assume a interest cost and proceed ahead. Clear? Any doubts on this? Go through 22. Okay, as a part of the strategy to increase sales and profit, the manager wants to sell goods to a new customer who has a 10% risk of non-payment. We'll put it in the same format. The only difference here is this rate is given after tax. Maybe we have not noticed it till now, but every question had used the word pre-tax rate of return. Every question was using the word of pre-tax rate of return, or it was silent. Now this 25% is used to calculate interest cost. This 25% would be used to calculate interest cost. I'll convert this 25 divide by 1 minus tax rate, and 50% is the pre-tax rate. 50% is the pre-tax rate. 25% is after tax. I cannot work with after tax. I will have to work with pre-tax rate of return, because in my calculation I don't subtract tax. I don't subtract tax. So I'll come to this 50% in some time. The sales to these customers is 1 lakh. The sales to these customers is 1 lakh. The production and selling expenses 80%. No fixed cost. So the gross benefit is 20,000. 10% risk of non-payment. Debtors is 80,000. What is the collection period? How much is the credit period given to them? How much is the credit period given to this customer? 1 point. So debtors is 10,000. Everything is same manner. Just that you cannot take 25% given in the question. It has to be 50%. It has to be 50%. Why it has to be 50%? Because that 25% was after tax. So I make this 50%. If you still have a net benefit, go ahead and give credit to this customer. If you still have a net benefit, go ahead and give credit to customer. If the net benefit was zero, we are indifferent. And it technically means you are getting a return of 50%. The 25% was given, no. You get a return of 50% if exactly net benefit. IRR is the rate of return at which NPV is 0. Similarly, if net benefit turns out to be 0, that's the net return I am earning. I wanted some return. The return would be equal to whatever we had been given in the question. The question had said 25% return after tax. We converted into 50%. If the net benefit turns out to be 0, we are earning that return. Net benefit is positive, we are earning a higher return. Net benefit negative, we are earning a lower return. Same concept in IRR. If NPV is positive, IRR is more than the discount rate. If NPV is 0, IRR is equal to the discount rate. If NPV is negative, IRR is lesser than the discount rate. The reason for discussing this is, the next part says, I want to know what should be the risk of non-payment if I want a return of 30, 40 and 60%. Listen, I am going to repeat this calculation fully. I'll keep the net benefit as 0, okay? Net benefit as 0. I want a return of 30, 40 and 60. So debtors is 10,000 into 60%. What is 60%? Is 30% after tax. Before tax is double of that. 40% means 10,000 into 80%. 10,000 into 120%. 10,000 into 120%. 30, 40, 60 is the after tax. We are converting into pre-tax. For converting into pre-tax, you are technically doubling it. You divide by 50%. Bad debt is a balancing figure, which is 14,000, 12,000, 8,000. Indirectly, 14,000 means 14% risk of non-payment. 14,000 is 14,000 on sales of 1 lakh. If there is a 14% risk of non-payment, it is possible that I will earn a return of 30% after tax. I'll earn a return of 30% after tax if there is a 14% risk of non-payment. If there is a 12% risk of non-payment, I will earn 40% return, and if there is a 8% risk of non-payment, I will earn 60% after tax. I'll earn 60% after tax. Your bad debt is a balancing figure. Bad debt is a balancing figure because when net benefit is 0, it means you are earning that return. Net benefit is 0, it means you are earning that return. So degree of risk of non-payment is 14, 12 and 8%. 14% will give you 30% return. Risk of non-payment comes down, your return will go up. 12% means 40% return, 8% means 60% return. Any doubts on this? 14, 12 and 8. Okay, go through this and put it in that format. Go through 23 and put it in the format. Go through 23 and put it in the format. Quickly do it. Go through this question and put it in the format. Quickly put it in the format. Put it in the format quickly. Do it and let me know. The table would guide you to the solution. I'm not going to extend this policy, the liberalization or whatever they're asking, that's not going to be done. One place where you could have made a mistake, fixed cost should be 8 lakh for both scenario. If you take it as 10% and make 8 lakh 50, I can't help it. It has to be 8 lakh in both the scenario. Fixed cost has to be 8 lakh. That's a place, if you have made a mistake, then that's a little bit of a worrying sign. Please take care of that. Your fixed cost cannot change. Balance is more of a formality, nothing much. Fixed cost alone, if you could have made a mistake, that is avoidable error. Please take care of that. Any doubts on this? Okay, let's come to 24. Now onwards, I think we may have a little bit of a different set of questions. Still the similar format can be done, but let's come to 24. Some of the questions I'll solve it, some of the questions we'll discuss it. Let's come to 24. Tony Limited manufactures color TV set and is considering liberalization of existing credit terms to 3 of their large customer. Credit period and likely quantity that will be sold is 0, 30, 60, 90 is the credit period. Units which can be sold. Selling price is 9,000, contribution is 20%, cost of carrying receivable is 20%. Determine the credit period allowed to each customer, assuming 360 days in a year for calculation purpose. Listen. I'm not going to tell you to do solving now, but it's the same format. You're going to put it in the same format. Customer A, what you will do? 0 days, 30 days, 60 days, 90 days. You will have to do a statement for every customer. What you will do? Sales, less variable cost, less fixed cost, gross benefit, less bad debt if at all there, less your credit administration cost, less cash discount, less interest cost, and you get a net benefit. Customer A, I am not going to do anything because his sales does not change. So it's better to give him a no credit period. Whether you extend credit period or you don't extend credit period, he is very clear that he will buy only 1000 units. So let's give no credit to him, because when I give credit, I'll have interest cost. In customer B, the sales keeps changing. So what you will have to do is you will have to do the statement in the same format. Sales less variable, less fixed, gross benefit, less interest cost, net benefit. The net benefit is the highest at 90 days. The net benefit is the highest at 90 days. Similar statement you will have to do for customer C. The net benefit is highest for 90 days. So for both of them, the net benefit is highest at 90 days. You will have to do the statement which I have told till now, but you will have to do customer wise. You will have to do this customer wise. Now another thing they are saying is, what are the problems the company might face in allowing the credit period as mentioned above. Now the analysis says customer B you have to give 90-day credit period, customer C you have to give 90-day credit period, customer A no credit period. If customer A gets to know about this, it can become a trouble, because he is not being given any credit period, whereas others are given credit period. Also the table says customer C, for 1000 units itself, you are giving him 60 days credit. So this customer A can very much ask for this credit. Customer B is buying 2000, for example, 1500. At 1500 here it's 90 days, 1000. So you cannot have varying levels of credit for different set of customers. So that can become a problem. Customer A is taking 1000 TV set where credit is there or not. Customer C is taking 1000 at 60 days. Hence A may also say, please give me 60 days credit. B will take 2500 for credit, whereas C is taking only 1500. In such case, B will say, give me further relaxation. Further relaxation, because I am anyway buying more than that the other customer. Just give me a minute. Okay, not needed. It is exactly the same format. I don't have anything there. So I'm not discussing question 25. Nothing much is there. Okay, let's come to 26. Let's come to 26. It's again a different set of question. A bank is analyzing the receivables of Jackson Company in order to identify acceptable collateral for a short-term loan. The company's credit policy is 2/10 net 30. Bank lends 80% on accounts where customers are not currently overdue and where the average payment period does not exceed 10 days past the net period. A schedule of Jackson's receivable has been prepared. How much will the bank lend on pledging of receivables if the bank uses a 10% allowance for cash discount and returns? So, I go to a bank saying that I have debtors of 1,08,800. Can you give me loan against this? Now, for getting a loan against this, there are two rules the bank is saying. The customer should not be currently overdue and the average payment period should not exceed 10 days past the net period. The net period is 30. This outstanding should not exceed 30 first. The outstanding should not exceed 30. So, this customer is eliminated. This guy is eliminated. 91 and 114 will not get any, I will not get any loan against 91 and 114 from the bank. From the bank, I will not get a loan. This is one first condition. First condition is it should not be overdue. It should not be overdue. Overdue is 30 days. I am assuming 30 days is the credit period. Second, historical payment period should not be 10 days post the normal net credit period. So, the historical data should not be more than 40 days. In this customer is also eliminated. In this customer is also eliminated. See, for example, your, I think 74 is not overdue and historically also is fine. 107 not overdue, historically fine. 108 not overdue, historically fine. 116 not overdue, historically fine. 123 not overdue, but historically there is a problem. Historically there is a problem. So, I will get credit on 4 accounts, which is, it adds up to, can you tell me the total of this first? Tell me the total of this. Total of these 4. In that only 80% will be lent. In that only 80% will be lent. In that another 10% the bank is going to deduct for some allowances, some return, something has been mentioned. So, net the bank will give a loan of 48,816. 48,816. Go through question 27. Go through 27. Go through the question. Okay, now let us discuss this question. I am doing business with this customer. The credit period could be anything, but historically this guy doesn't seem to be paying the way I wanted him. He pays 15% of the bill in 30 days, 34% of the bill in 60 days, 30% of the bill in 90 days, 20% of the bill in 100 days, and 1% is bad debt. Now, if I put it in this format, the sales with this guy is 15 lakhs. The sales with this customer is 15 lakh rupees, and what they mention is 15 lakh sales. The selling price is 150, profit is 5 rupees. Selling price is 150, profit is 5 rupees. So, cost is 145. Cost is 145, which will broadly work out to be 14 lakh 50,000. 14 lakh 50,000. Also, there is another expense of some 5,000 recurring expenditure. So, my gross benefit is only 45,000 rupees. My gross benefit is 45,000. 1% goes in bad debt. The problem is with interest cost calculation. It is going to be slightly tricky now. So, I have to come to the interest cost calculation. I have calculated bad debt, everything is fine. Now, coming to interest cost calculation, listen. My debtors is 14 lakh 55,000 cost of sales. 14 lakh 55,000 is the cost of sales. In that 15% of the bill, 15% of the bill is paid within 30 days. What is the interest cost given in the question? Interest cost.
24.
So this is the interest cost for the first 15%, 14,55,000 into, let's not do the calculation, into 15%, because 15% of the bill would be paid into 30 days. So this amount is due for 30 days and 24% is my rate of interest. Then next 14,55,000. Next segment, what percentage? 34%. How many days? 60 days into 24%. So this is another expense for me. This is another expense. Third segment, 14,55,000 into what percentage? 30%. 90 days, 24. Fourth segment, 20%, 100 days. This is my interest cost. This is my interest cost. So interest cost is going to be done in a slightly longer manner, because he's not, if it was a single credit period I could have done it, but this guy is working with multiple credit periods. So 15% of the sales, 30 days, this much is the cost. 34%, this is the cost. 30%, this is the cost. 20%, this is the cost. Net interest cost is so much, net benefit is negative. So no point in doing business with this customer. No point in doing the business with this customer. Clear? Any doubts on this? 28, I'm not doing it. It is going to be pretty much the same format which we had done. You'll put it in the format. The only thing is this cost, this question also has some increase in fixed cost. So you'll have to give effect to that as well. Normally fixed cost is written as same amount. This question talks about some change in fixed cost. Just give me a minute. Okay, this is also not needed. Just give me. Just give me a minute. Okay, I come back to this question. Okay, question 23 which we had done. 1/10 net 30 was the credit period in that question. 50% of the customers were taking credit. Listen, some question in exam this data may be missing. Average collection period is 20 days. Average collection period is 14 days. This data could be missing in the question, but they will tell you what percentage of people are taking discount, what percentage are not taking. In that question, originally 50% were taking discount, 50% were not taking discount. If the collection period is not given, average collection period is equal to people taking discount 50% into 10 days, people not taking discount 50% into 30 days. This is how you will calculate the average collection period. 50% into 10 days plus 50% into 30 days. After discount is given, 80% into 10 days, 20% into 30 days. This will be 20, this will be 14. It's not necessary that this calculation has to match with what is given in the question. If problem does not give you the collection period, you will have to do this. Problem as given, then because the collection period can be even different than this. Because I tell my customer to pay in 30 days, some customer may even pay in 40 days. So that's beyond my control. If the collection period is given, great. If it's not given, it is equal to weighted average of people taking the discount, not taking the discount. People taking the discount pay in how many days, people not taking the discount pay in how many days, and then do the calculation. No, I think every question has given that data. Every question has given the collection period data. I think there was one problem, but I don't think so I have in this. In my regular material, I think I have one question. Let's come to question 30. This is on factoring. I'll move to factoring now. I'll move to factoring, go through question 30. Okay, now let's first understand what is a factoring kind of a question. See, factoring is basically an arrangement where I am not ready to collect money. I tell someone else to collect money on my behalf. So I give this responsibility to someone else. He will do the job of collecting money from the customers. The benefit for me is I can focus on my main business. So I will not focus on this credit administration, collection effort, bad debt risk can come down, but the factor will also charge a commission. There will be two types of question. One, the question will ask you for effective cost of factoring. Second, the question may not ask you for an effective cost of factoring, but they'll say whether a factoring arrangement is to be entered or not. In that also you may have to calculate an effective cost of factoring. In those type of question also we may have to calculate an effective cost of factoring. Sometimes we cannot calculate effective cost of factoring. When you cannot calculate, I'll explain as we proceed. This question wants us to calculate effective cost of factoring. For doing effective cost of factoring, first we calculate working note 1, computation of amount lent by factor. Again, it's a format driven area. Computation of amount lent by factor. Amount lent by factor. Particulars amount. Computation of amount lent by factor. Annual sales. Annual sales. I'm doing it in lakhs. 320 lakhs. Annual sales is 320. Debtors. Debtors is 320 into what's the credit period we give to the debtors here? 90 by 360. Debtors is 80 lakh. My factor will not get to know what is the profit, and also when you do factoring, it's always on the sales only, no concept of cost of sales, because the factor will never get to know what is the profit margin. So basically I'll go to the factor and say I have 80 lakh of debtors, can you give me a loan against this? For that, what the factor will do is he will deduct certain items. He is going to deduct reserve of 10%. He is going to deduct reserve of 10%. Less reserve. First, reserve would be subtracted by him. He will also subtract his commission, because before lending this money, he will say I want to subtract my commission. So the commission which this factor has is, when you go to bank and ask for a loan, the bank will, for example, if you give a gold worth 1 lakh rupee, the bank will not give you a loan of 1 lakh. He'll say your gold is worth 1 lakh, I'll give you a loan of only 80,000 or 70,000. I want some protection at my end also, no? So why will I give the entire amount? So 10% is there. In that earlier question we did 80% bank was funding, 20% was deduction. On top of that, another 10% was also deducted by them. Less commission, commission is 2%. Amount eligible to be lent. Ideally this much money I should get. I should get this much money from the factor. Now factor is going to say I'll give you this money, but let me deduct my interest also. There's an interest cost which is 18%, so he will deduct this also. Less interest, this into 80%, rolling period is 90. Every 90 days this money will keep rolling into 90, and amount lent by factor. Factor will basically give this money. I wanted 80 lakhs, I will get 67 lakh 23,200. I wanted 80 lakh rupees, I will get only 67 lakh 23,200 from the factor. This is the first thing. Then working note 2, effective cost. Effective cost. Costs. Commission, interest. These are the two expenses the factor will mostly charge. Commission is on the entire sales. Now we are doing the annual calculation. 320 lakhs into 2%. Interest what you calculated here was for 90 days. So into 360 by 90. Into 360 by 90, or in other words, it is this amount, eligible amount into 18%. Eligible amount into 18%, which is 12.6720. Eligible amount into 18%.
What is this purpose, sir? Because that is for 90 days, this is for 1 year.
1 year calculation. Now, these are the expenses I have to incur for the factor, but there are certain benefits also. I will save on bad debt, credit admin cost. I'll save this money. The bad debt as of now is 1.5%. My assumption is when I do this factoring, the loss of bad debt, the factor will bear this. That's an assumption. 320 into 1.5%. Credit administration, I'm going to save 5 lakh rupees on collection of money. So net cost, I will be spending 9,27,200. I will be spending on factoring only 9,27,200. Effective cost in percentage 9.2720 by 67.2320 into 100. So my effective cost of factoring is 13.79%. I'll be spending 9,27,200 for one full year for getting how much? 67,23,200. That's a rolling amount. You will keep getting this amount throughout the year. So earlier, which we did calculation was for 90 days. The annual calculation is done here. For 90-day period, you will get 67,23,200. That money goes back, you again get it back, goes back, again you get it back. So it's a rolling amount. It's a rolling amount. So effectively, your cost is 13.79. This cost would be compared with the cost of a bank loan. If the bank loan is at 14%, I will go ahead with the factoring arrangement. If the bank loan is at 12%, I will go ahead with the bank loan. I'll go ahead with the bank loan. 13 points. The above cost is to be compared with rate of interest on a bank loan to decide whether we can go ahead with the factoring arrangement. If bank loan interest rate is higher than 13.79, then we'll choose factoring. Otherwise, we'll choose bank loan. I'll take a break of 15 minutes and then continue. Okay, let's continue now. Friends. Let's move to question 31. Again, it's on factoring. You'll understand the difference of this question. Navya Limited has annual credit sales of 45 lakhs. Credit terms are 30 days. Management of receivables have been poor and collection period is 50 days. Bad debt is, guys, 0.4% of sales. Factor has offered to take over the task of debt administration and credit checking at an annual fee of 1% of credit sales. Navya Limited estimates that it will save 35,000 on credit administration. Due to the efficiency of factor, average collection period would reduce to 30 days. Bad debt would be 0. Factor will give 80% of invoice debt and annual interest. Whether factor service should be accepted or rejected, that's the question's requirement. Now, these type of problem also you can calculate effective cost of factoring and answer it. But in a question, there is one scenario where you will be normally giving a credit period of some 50 days, 60 days. But because factor has come in, he'll be able to collect the money faster. If that is there in a question, in that situation, effective cost of factoring cannot be calculated. For example, today the collection period is 50 days. If you move to factoring arrangement, it will be 30 days. This problem cannot be solved under effective cost of factoring route. It cannot be solved under effective cost of factoring route. Let's do cost benefit analysis of factoring arrangement. Cost benefit analysis of factoring arrangement. Particulars calculation amount. Benefits, costs. Let's read from the beginning. It has an annual credit sale of 45 lakhs. Credit terms are 30 days, but its management of receivable has been poor. Average collection period is 50 days. The first benefit for me is interest saved. What is interest saved is 50 lakhs. As of now, it takes 50 days for collection. This will come down to some period. So this is the overall interest saved, but I'll be incurring some interest cost. I'll factor that in some time. As of now, I'm having an overdraft at the rate of 10%. So moment I bring in factor, I'll save this money. Will I incur something else? Yes, I'm going to incur something else on this. I'll come to that in some time. So this is the first saving. We will save some 68,000 because of factoring arrangement. 68,000. Then bad debt is 0.4. Bad debt will not be there. 50 lakh into 0.4%. This is the second saving. A factor has offered to take over the task of debt administration credit checking at an annual fee of 1%. This is the expense fee. 50 lakh into 1%. 50,000. Navya Limited estimates that it will save 35,000 in credit administration. 35,000 saved. Due to the efficiency of the factor, the collection period will reduce to 30 days. It's not becoming zero, so my interest cost will still be there. My interest cost will still be there to factor to bank. Listen, 50 lakh. Good part is it will be now only 30 by 365. It will be only 30 by 365. The problem is factor will give me only 80% of the money at an interest rate of 11%. So I will get 80% from factor at 11%. I will need balance 20% also. I will get that from the bank at 10% rate of interest. I'll get that from the bank at the rate of 10%. So I don't save that entire 68,000. I incur some interest cost, but this is going to be lower than that 68,000. Lower than that 68,000. Sorry, credit sales is 45 lakhs. Okay, sorry, I've done everything on 50 lakhs. Okay, let me complete this question on 50 lakhs. The question says credit sales is 45. Sorry, in a hurry, I've taken it 50. So let me complete the entire problem on 50 lakhs itself. 30 by 365. Sorry about it, but let me complete this in this rate itself. To bank will pay 20%, 10. So the average collection period will reduce to 30 days. Bad debt will become nil. We have analyzed bad debt. Factor will give 80%. We have considered that interest cost is currently financing at 10%. That's also considered. So everything is done. Now we'll see the net benefit or the net cost. So these are the benefits. These are the extra cost. Net factoring arrangement is beneficial. All the calculation have been done for 50 lakhs. I should have done it for 45. I should have done it for 45, but broadly the calculation will be the same manner. 45 into 0.4% into 10, 30 by 365 into 80 into 11 into 10. So net the factoring arrangement is beneficial. Can you do effective cost of factoring in this question? Not possible. Effective cost of factoring is not possible for type of problem where there is a reduction in the credit period. Let's come to 32. A company is considering to engage a factor. The following information is available. The current collection period is 90 days. 0.5% of debtors default. The factor has agreed to pay the money due after 60 days. After 60 days, and will take the responsibility of any loss on account of bad debt. So earlier money was coming in 90 days. Now the money is going to come in 60 days. So again, effective cost of factoring is not possible. Annual charge for factoring is 2% of turnover. Admin cost saving is 1 lakh. Annual credit sale 1 crore 20 lakh. Variable cost is 80%. Cost of borrowing is 15% should the company enter into a factoring arrangement. So let's quickly do the cost benefit analysis. First cost is this 2% of turnover. So 2% into 1 crore 20 lakh, that is on the cost side. Administration cost saving is 1 lakh, which is on the saving side. Bad debt is 0.5% into 1 crore 20 lakh, 0.5% into 1 crore 20 lakh. So that will also come in the saving side. Another saving is, earlier I was incurring interest cost technically for 90 days. Now I will incur interest cost only for 60 days. Factor is not giving me money and all. Factor is not giving me any money. I am not going to pay any interest to the factor also. I am going to pay interest only to my bank. But the only difference is, earlier our interest was calculated on 90 days. Now the interest is calculated on 60 days. Now the interest is calculated on 60 days. this one issue or one debatable area is they have calculated debtors based on cost of sales. They have calculated debtors based on cost of sales. Logic for this is factor is not going to give me money. Factor is going to collect the money in 60 days and give it to me. So earlier I went to the bank and asked for a loan for 90 days debtor. Now I'll go to the bank and ask for a loan only for 60 days debtor. When we were doing your extension of credit policy or reduction of credit policy, we were calculating debtors based on full cost of sales. In factoring, I said it has to be on sales. It can't be on full cost because debtors, my factor should not know what profit margin I'm making. So he will not get to know. But here factor is not giving a loan. So the debtors have been calculated on cost of sale. The debtors have been calculated and there's a saving in interest cost of 1,20,000. There's a saving in interest cost of 1,20,000. Net there is a benefit of 40,000. You go ahead with the factoring arrangement. Okay, this is on a payable, I think, question. A Limited is in the manufacturing business. It acquires raw material from X Limited on a regular basis. As per the terms of the agreement, payment must be made within 40 days of purchase. However, you have a choice of paying 98.50 per 100 if you make the payment on 10th day of purchase. Examine whether A should accept the offer of discount. Average billing is 10 lakh, alternative investment yield of 15% and company pays the invoice. So, the point is what happens in my cash discount is I can pay 98.50 today. I can pay 98.50 today and save 100 rupees. This is paid on 10th day. This is saved on 40th day. Indirectly 98.5 will become 100 rupees in 30 days. Today pay 98.5, save 100 after 30 days. Today pay 98.5, 10th day. You pay 98.5 on the 10th day and you can save 100 rupees by day 40. So the return here is 100 minus 98.5. This is my return. Divided by 98.5 into 365 by 30 into 100. Tell me the percentage here. Okay, so I earn a return of some 18.5. The alternative investment will give me a return of only 15%. So it makes sense for me to avail the discount. It makes sense for us to avail the discount. 34 is something you can manage. Let's go to those additional questions. In that I just want to discuss one question alone. Okay, I just want to discuss this question 24 alone. Only 24. Alliance Limited, a petrochemical sector company. Question 24, page 208. A petrochemical sector company had just invested huge amount in its new expansion project. Due to huge capital investment, the company is in need of additional 1,50,000 in working capital. There are following plans. The company's bank will lend 15%. A 10% compensating balance will be required, which otherwise would not be maintained by the company. I'll explain one by one of each scenario. The bank will give me I need 1,50,000. Bank will give me a loan of 2 lakh, or he can even give me a loan of 1,50,000, whatever I need. The problem with the bank is, if he gives me 2 lakh, he'll say deposit 20,000 in your account. A 10% compensating balance. 10% compensating balance. Let's assume I go to the bank and take a loan of 100 rupees. On 100, I have to pay interest of 15 rupees. But how much money I can use? Only 90 I can use. Only 90. So indirectly, my interest cost is 15 rupees on 90 into 100. 15 rupees on 90. Because 10 rupees I cannot use. 10 rupees cannot be used. This is 16.67%. This is the first option. Second option is, company has offered credit term from its major supplier of 3/30 net 90. 3/30 net 90, that is pay 3% discount. Pay 97 rupees on day 30. Pay 97 rupees on day 30 and save 100 rupees by day 90. Save 100 rupees by day 90. 3/30 net 90. 3/30 pay within 30 days get 3% discount. So my return is 100 minus 97 divided by 97 into 365 by 60 into 100. 365 by 60 into 100. You are going to basically get a return. You are going to basically get a return of 3% for a 60-day period. For a 60-day period. So 100 minus 97 by 97 into 365 by 60. Pay 97 today. Save 100 rupees 60 days later. Or pay 97 by day 30. Save 100 rupees by day 90. A factoring firm will pay the company's receivables of 2 lakh per month, whichever collection. The factor will advance up to 75% of the value of the receivables. At 12%, the factor will charge commission. Okay, I'm not getting into this part. This is basically you have to do the cost of factoring. The format which I said. You'll have to do the cost of factoring. Effectively, it is some 20%. The cost of factoring is 20%. Whichever is the cheaper cost, I'll go ahead with that funding. Okay, we'll go to dividend decision. This is the last area. You go through this. I'll be back in 2-3 minutes. You go through dividend decision. Okay, let's come to the last area, which is on dividend decision. In this chapter, the focus areas are, we are trying to find how the dividend of a company affects the share price. For example, Modigliani-Miller approach, whether you pay 10 rupees dividend, 2 rupees dividend, or you don't pay any dividend, the value of the firm is not impacted. So the share price can go up or come down. The value of the firm will not change whether you pay dividends or you don't pay dividends. So we may have to do problem where we have to prove this fact. Then we have Walter's approach, which is an approach to calculate the share price also. The share price is calculated as D by KE, dividend by KE, plus R by KE into E minus D whole divided by KE. There's one part called as dividend by cost of equity, another part called as retained earnings by cost of equity with a multiplier effect to that. Under this policy, it depends on the relationship between R and KE. Depending on the relationship between R and KE, we may decide whether to pay dividends or not. The dividend payout can change based on the relationship. If R is equal to KE, any amount of dividend can be paid, indifferent. If R is greater than KE, dividend should be 0. If R is greater than KE, dividend should be 0, and if R is less than KE, dividend should be 100%. Then we have something called as Gordon's model, where the dividend is again calculated. Dividend is equal to, or price is equal to D1 by KE minus G. This is an extension of the formula which we used to do. K is equal to D1 by P naught plus G. G goes this side. KE minus G is equal to D1 by P naught. P naught goes this side. D1 by KE minus G. Apart from this, there are, I think, other two models are there. I don't have any problem on them. One is on Graham and Dodd model, where the price of the share, according to this model, it is better to pay dividends. It is better to pay dividends. That's all. It does not say any relationship and all. Price is equal to some multiplier into dividend plus earning by 3, not retained earnings, earning by 3 itself. So maximum dividend should be paid. If you have an earning of 12 rupees and you pay 12 rupee dividend, 12 plus 12 by 3. If you pay only 4 rupees dividend, it will be 4 plus 12 by 3. So the earnings remain as it is. On top of that, dividend is added and then is a multiplier. Lindner's model is basically going to tell how much dividends are to be paid. It does not have any effect on the price of the share. Let's first look at Modigliani-Miller problem. Let's come to question 1. X Limited has 8 lakh equity shares outstanding at the beginning of the year. The current market price is 120. Board of Directors is contemplating 6.4 per share as dividend. Rate of capitalization is 9.6%. Based on approach, calculate the market price when the dividend is declared, not declared. How many new shares are to be issued if the company decides to fund an investment, assuming the net income for the year will be 1.6 crores. Now, I'm going to directly do it in one format, all the requirements of the question. Some extra things also we are going to do, because some other question can ask extra information. Working note 1, analysis as per approach, particulars, dividend declared, dividend not declared. 2 scenario, dividend declared and dividend not declared. First one is price today. Price today, what's the price today? What's the current market price? 120. Cost of equity.
9.6%.
How much?
9.6%.
9.6. Dividend. How much the dividend the company wants to pay? 6.4. This side 0. Okay, now listen. MPS at end of year. MPS at end of year. Listen. What I want to know is 120 is my price today. This should go up by 9.6% and I should make it 131. This is my requirement. 120 should at least go to 131.52 because I need a return of 9.6%. The cost of equity is 9.6%. So investor needs a return of 9.6%. So he is saying, can you make 120 as 131.52? Company says, I will give you dividend of 6 rupees 40 paise. So the price will be 125. On top of that, dividend will be 6 rupees 40 paise. Price will be 125. On top of that, dividend will be 6 rupees 40 paise. You will get your 131.52. So the price at the end of the year is equal to opening price into 1 plus cost of equity minus dividend. 1 plus cost of equity minus dividend. Then total investment. The question has said some investment to be done. How much is the investment to be done? 3 crore? 3.2 crores. Total earnings. How much is the profit they have earned? 1 crore 60 lakhs. Less dividends, retained earnings. Less dividends and retained earnings. How many shares are there?
8 lakh.
8 lakh. So I will have to pay dividend of 8 lakh into 6.4. This side dividends are not paid. This side dividend is 0. One side dividend is 8 lakh into 6.4, which means I already retain so much. I retain 1 crore 8 lakh and 1 crore 60 lakhs. I have a retained earnings of 1 crore 8 lakh, which means fresh equity. Fresh equity is, I need 3 crore 20, in that 1 crore 8 is available, 1 crore 60 is available, balance has to come in the form of fresh equity. Balance has to come in the form of fresh equity. So I need fresh equity share of 2 crore 11 lakh 20,000 and 1 crore 60 lakh. Fresh shares. This divided by 125 and this divided by 131. Divided by 125 and divided by 131, I have to issue so many shares. So one of the requirement of the question would be how many shares are to be issued. How many shares are to be issued. So I need 2 crore 11 lakh 20,000 divided by closing price, because at the end of the year you will make this issue. Closing shares, closing value. How many shares are there originally? 8 lakh. So I end at 9 lakh 68 and 9 lakh 21, and the value of this is this into 125, this into 131, both will be same. Some rounding of difference can be there. Both will be same value. Whether you pay dividends or you don't pay dividend, the value of the firm is going to remain same. Closing price is equal to opening price into 1 plus cost of equity minus the dividend which has been paid. That will give you the closing price. Closing shares will depend on how many shares you are issuing. Shares issued is equal to fresh equity divided by the closing price. Fresh equity is equal to capital investment to be done minus the retained earnings. Investment to be done minus the retained earnings. I am not doing next question. Broadly the same requirement. The requirement remains same. Come to question 7. This is on Walter's model. Come to question 7. Come to question 7 on Walter's model. We'll come back for some of the question. 1 and 2 is done. 2 is on Modigliani Miller. Go through question 7. Okay, earnings is ₹10, rate of capitalization is cost of equity, which is 10%. I have 3 options of paying dividend, either 50% or 75% or 100%. What should be the market price as per Walter's model if ROI is 15, 10 and 5? Now listen, Walter's model price is equal to D by KE R by KE into E minus D divided by KE. Now the dividend can either be 5 rupees 50% of 10 or 7 rupees 50 paise or 10 rupees. The dividend can either be 5, 7.5 or 10. So the dividend can be 5, 7.5 or 10. The rate of retained earnings can be, the R can be either 15, 10 and 5. The rate on the retained earnings can be 15, 10 and 5. So in this case it's 5 by 10% plus 15 by 10 into 5 divided by 10%. R D by K, D is 5 rupees divided by K 10% plus R by K 15 by 10 into E minus D, which is balance 5 whole divided by 10%. This is how much? 50 plus 75, 125. This is 7.5 by 10% plus 15 by 10 into balance 2.5. This is divided by 10%. 112.5. This is 10 by 10%. Other side is going to be 0. 10 by 10%, 100. Here R is equal to K. We can do the calculation, but everything will be 100. R is equal to K. When R is equal to K, whatever dividend you pay does not matter. Whatever dividend you pay does not matter. We can do the calculation in an exam scenario, but it will turn out to be 100 for all the three. This scenario, 5 by 10%, 5 by 10 into 5 by 10%, this will be 75. If you do the calculation, it will be 75. This will be 87.5 and this will be 100. In short, if R is equal to KE, any amount can be declared as dividend. If R is equal to KE, any amount can be declared as dividend. If R is greater than KE, ideally you should declare 0% dividend. As you increase the dividend, the value is coming down. Your dividend should be 0%. If R is less than KE, the dividend should be 100%. As you increase the dividend, the value is going up. So 125, 112.5 and 100. Best in the first scenario is 0% dividend. Second scenario, anything doesn't matter. Third scenario, you should have a 100% dividend payout. We should have a 100% dividend payout. Let's come to question 8. Following information is collected from the annual reports of Z Limited. Particulars amount, PBT, tax rate, retention ratio, number of outstanding shares, equity capitalization rate, rate of return on investment. What should be the market price according to Walters and Gordon's model? Both Walter and Gordon has been asked. Go through the problem. Okay, we are required to calculate the price of the share as per Walter and Gordon model. Before I start doing that, first I need the dividend and earnings per share. The earlier question said earnings per share is 10 rupees, dividend is 50%, 75%, 100%. This question, the earnings per share is not directly given. So first you will have to put it in the format which we normally do: EBIT less interest, EBT less tax, EAT less preference dividend, number of EAES, number of equity share, EPS. So first we'll have to get to that. Working note 1, computation of EPS and dividend per share. EPS and dividend per share. Particulars and amount. Earnings per share and dividend per share. We start with PBT less tax, PAT, number of shares, EPS and dividend per share. PAT can otherwise be called as EAES. PAT can otherwise be called as earnings available to equity shareholder. The PBT given in the question is 250 lakhs, 2.5 crores. Tax rate is 40%. PAT is 150. Number of shares are 50 lakhs. So earnings is 3 rupees and retention is 40%, which means payout is 60%. Dividend is 1 rupee 80 paise. Earnings is 3 rupee and dividend is 1 rupee 80 paise. First, under Walter model, 1.8 by D by KE. KE is 12% equity capitalization rate plus R by KE D by KE plus R by KE into E minus D whole divided by KE. 1.8 by 12% is 15. This side how much? 15 by 12.5. 27.5. This is as per Walter's model. Under Walter's model, we will not have a confusion of D0, D1 assumption and all. That confusion will not be there. When it comes to Gordon's model, the dividend which you have calculated can be taken as D0, can also be taken as D1. That's a confusion we had when we were doing cost of capital. So P0 is equal to, if I assume it to be D0, 1.8 by KE minus G. Cost of equity is 12%. Growth rate, growth rate is ROE into retention ratio. My ROE is 15%, retention is 40%, which is 6%. Both the approaches will not give the same answer. If you change your assumption under Gordon's model, the answer will change to 31.8. If you take it as D0, the answer is 31.8. If you take it as D1, the answer is 30. That's a confusion which will always be there under Gordon's model. Try question 9. Try question 9 quickly. Under Gordon's model, do question 9 quickly. Question 9 under Gordon's model, please attempt it. We'll discuss. Same way, first calculate the earnings per share. The dividend can keep changing based on the scenario. Get the earnings per share. Try question 9. Please attempt it. You'll struggle somewhere when you do 25%. You will find one challenge. Your growth rate will turn out to be more than cost of equity, which indirectly means Gordon's cannot get the answer. Gordon's model cannot give you the answer for 25% payout. If you do 25% payout, the growth rate will be 15%. Growth rate will be 15%. So as per the Gordon's model, the cost of equity should be greater than the growth rate. Growth rate is, and hence price cannot be computed as per Gordon's model. Price cannot be computed as per Gordon's model. So I wanted you to face that. When you do it only, you'll understand. The growth rate has to be lower than the cost of equity in the practical world, because what is the formula for cost of equity is D1 by P0 plus growth rate. So growth rate obviously has to be lesser than cost of equity. If it's more, then there's something wrong with the data. Second scenario, it will be 5 rupees divided by 14 minus 10%. Third scenario, 10 rupees divided by 14%. Quickly get the answer to question 10. Get the answer to question 10, Gordon's and Walter's formula, both. Question 10. Gordon's and Walter's formula. Both Walter and Gordon needs to be done. Gordon, Walter.
No, what?
Huh. Is there a light coming there? On, is there a light in the projector? There's a light. No. Is there a light? What is the color of the light?
Blinking.
It's blinking. Switch it on. Yeah, like it is happening for the last 2 minutes. So once we this is a switch, right?
No, red light. No, green blinking. Keep it 1 minute.
Just give me a minute. You try question number 5. If you are done with this, try question number 5. Try question 5. Do question 5. The balance questions I'll take you through. Do question 5. Do question 5 quickly. Which one? Which alternate answer? Gordon's model. That dividend which you calculate, you can either take it as D0 or D1. That's the assumption. No, that's a typing error there. It's just a typing mistake. 18 minus 16.5 divided by 1.5%. Would have copied it from some other question, so in that I think there's a typing error there. Okay, I assume you have practiced question 5. I'll do some more questions which has some learnings there. Let's come to question 4. Question 4. The following figures are collected from the annual report of XYZ Limited. Net profit, outstanding preference share, number of equity share, return on investment, cost of equity. What should be the approximate payout ratio so as to keep the share price? 42 by using Walter model. So we are going to calculate dividend which will give the share price of 42. This question had come once in exam where they missed this data. The cost of equity got missed out in the question. Another time when it came in exam, they have given the cost of equity. So if such a question comes and they miss out that cost of equity, we have to assume a number and proceed ahead because the question did not have that data. Now they want us to calculate what should be the payout ratio so as the share price is 42. Let's use the formula of Gordon's model. 42 is equal to D by K is 16%, D by 0.16, R by K 0.20, 0.16, into E minus D. My earnings per share would be 30 lakhs minus 12 lakh of preference dividend. 30 lakhs minus 12 lakh of preference dividend, which is 18 lakh, divided by 3 lakh shares. Divided by 3 lakh shares, which is 6 rupees. So 6 minus D. 0.16 is common here. 42 into 0.16 is equal to D plus 1.25 into 6 minus D. 0.20 divided by 0.16 is 1.25 into 6 minus D. 42 into 0.16 is how much? 6.72 is equal to D plus 7.5 minus 1.25 D. Net, can you calculate D, how much it turns out to be? $3.12, which is broadly 52% payout. 3.12, which is broadly 52% payout. So if you have a dividend payout ratio of 52%, if you have a dividend payout ratio of 52%, we will get the share price to be 42 for the given information. Determine the optimum dividend payout ratio and the price of the share at such payout. Optimum is depending on the relationship between R and KE. R is 20%, KE is 16%, R is 20%, KE is 16%. The optimum payout ratio is how much here? 0, and the price at that optimum payout ratio is 0 by 16%, 0.20 by 0.16 into 6 whole divided by again 16%. Calculate this price. 7.5 by 16%. 46 point. The question wanted only price of 42, which worked with the 52% payout. Here 46.875 is the price if you work with the payout ratio of 0%. 0% is the optimum payout ratio. Prove that the dividend payout ratio is optimum by using random payout ratio. Now, this is one of the question which came recently in exam. Random payout ratio, they wanted us to, the optimum payout ratio is 0%. You take any number other than 0, the price should be lesser than 46.875. You can take 10% and 20%, two numbers, or 14% and 25%, 25% and 50%. So they have taken a random payout ratio of 25, 50, 75, 100. At all these levels, price would be lower than 46.875. 46.875 was the maximum price which was at a 0% payout ratio. Any random payout ratio other than that, just two ratios are also fine. We are proving that fact that the optimum payout ratio in this question, has to be 0%. Go through question 3. Go through 3. Okay, I'll do some of the points to be discussed here. The share capital is 25 crores, reserves is 15 crores, profit after tax 3.7, dividend paid is 3 crore. Can you tell me 3 divided by 3.7 is how much? 0.81. So 82% basically. You have paid a dividend of 82%. Comment on firm's dividend policy. See, dividend policy will depend on the relationship between R and KE. If R is greater than KE, the optimum payout ratio is 0%. If R is less than KE, the optimum payout ratio is 100%, and if both are same, any amount is fine. So I'm not sure whether they have done the right thing. They would have done the right thing if R is equal to KE, because any amount of payout is fine. Now dividend is 3 crore by 2.5 crore shares, 1.20 per share. Dividend is 1.20 per share. Earnings is 3.7 by 2.5. How much is this? 1.48 per share. Price today is, the earning P ratio is 26.7. So price today is 1.48 into 26.7. How much is this? 1.48 into 26.7. 39 point. Okay, that's the price today. Now listen, K is equal to D1 by P naught plus growth rate. K is equal to D1 by P naught plus growth rate. I'll come to this in a minute. D1 by P naught plus growth rate. R is equal to return on equity. R is equal to EAES by amount of equity. The company has earned a profit of 3.7 crore. Amount of equity is 25 plus 15, 40 crore. Let me know what is the return on equity. 3.7 crore by 40 crore. 9.25. Growth is equal to ROE into retention ratio. ROE into retention ratio. 9.25. Retention is 100 minus that 82%, 18% broadly. You can do the exact calculation also. It was 82% of payout, so 18% would have been the retention. How much is the growth rate?
1.6.
How much?
1.6.
1 point? Okay, 665, so 67%. Let me take it as 1.67. So my cost of equity is going to be 1.2 by 39.516 plus growth rate of some 1.67%, whatever number you had calculated, plus the growth rate. This will give you the cost of equity. This 1.20 can be assumed as D0, can be assumed as D1. Based on that, answer can change. So net the calculation till now is like this. The cost of equity is 4.84. The cost of equity is 4.84. The your return on equity was 9.25. What is the optimum payout ratio here? What is the optimum payout ratio here? Cost of equity is 4.84. Return on equity is 9.25. 0% is optimum. The company has ended up paying some 81%. The company has ended up paying some 81%. So they are not following the optimal dividend policy. The firm has a dividend payout of 81 with the value of the share at this. The rate of return is 9 point, and it's more than the cost of equity, is not following an optimal dividend policy. If you follow the optimal dividend policy, it will be 58.44. It will be 58.44. The last requirement of the question is, find out what should be the P ratio at which dividend policy will have no effect on the value of the share. Dividend policy will have no effect on the value of the share if R is equal to KE. 9.25 is equal to D1 by P naught plus your growth rate. D1 by P naught plus growth rate. You try to get to a balancing figure of P naught. You try to get to a balancing figure of P naught, and based on that you do the calculation. You get a price of 16.28. You get a price of 16.28, and the P multiple turns out to be 11 times. The P multiple turns out to be 11 times. Because now what happens is, I want the return on equity to be equal to cost of equity. The return on equity has to be equal to cost of equity. That is possible if the price is 16.28, which indirectly mean the P multiple is 11 time. The P multiple has to be 11 time. If it's 11 time, R is equal to KE. Okay. There are 2-3 areas which is not there in my material. One is, there will be one problem on step up growth model. You may find it in your regular material, or also it's covered in the additional question. You can just see that. And one or two question, please see it on Graham and Dodd model and Lindner's model. Those questions have not been covered because they have not been tested in exams till now. The material has only those questions which have been tested either in your MTPs or RTPs. So with that, I think we have kind of covered comprehensively whatever areas needs to be covered. We have done that. As I said during your costing part, after this, try to first complete the material fully. Some of the questions, if we have not discussed in FM, I have discussed more question than what I did in costing, so the coverage could be slightly better, but still most of the questions I would have done at my end. So I would want you to complete the revision material and then write some mock test. If you write mock test, I think that should kind of take care of the preparation. I'll end with this. If there are any doubts, you get back to me. Sure. Thank you, friends. Thank you.